The Crisis of America's Social Contract, Managing Risk in U.S. Housing, Finance and Health Insurance Welfare Markets, by the Grand Rapids Circle.
The American social contract is in crisis. Even before the Great Recession exposed its inadequacy, it was clear that the existing American social contract, the system of policies and institutions designed to provide adequate incomes and economic security for all Americans, needed to be reformed to meet the challenges of the 21st century. What is needed is not mere incremental tinkering, but rather rethinking and reconstruction. Policies that have worked should be expanded, while others that have failed should be replaced. The result should not be just a modification of today's partly failed economic security system, but a substantially reformed system incorporating the soundest elements of the old, a new social contract for a new America. The social contract can be thought of as a system of economic security and adequacy based on three elements: wages, income maintenance programs, and merit goods, or goods which all citizens should have but which are undersupplied by the private sector. Modern social contracts or compacts have been a response to the challenges of industrialization and urbanization. In one country after another, as soon as the majority of farmers was replaced by a majority of urban workers selling their labor in manufacturing or service industries, older systems of means-tested poor relief and rural family support networks were overwhelmed. In the industrial economies, mass unemployment caused by business cycles, financial crises and depressions could not be blamed on the moral failings of individuals, and inadequate response by government led to widespread hardship and threatened unrest or revolution. For these reasons, every modern society has some kind of social contract designed to cushion the majority of its plea against the blows of economic forces. Industrialized nations have experimented with different methods of providing the wage-earning majority with a minimum of economic security. One approach in the US was sponsored by elements of the business community in the early 20th century and is sometimes known as welfare capitalism. As an alternative to government benefits and minimum wages, American business leaders including the conservative Henry Ford and the progressive Gerard Swope of General Electric favored paternalism by companies that would not only pay decent wages but also provide health insurance, pensions, and in some cases child care. Franklin Roosevelt's National Industrial Recovery Act, NIRA, encouraged each industry to create its own industry-wide minimum wages and benefits so that generous, paternalistic companies would not be undercut by rivals that paid low wages and provided no benefits. Although the NIRA did not survive, elements of welfare capitalism like tax-favored employer-based health insurance remain important to this day. After the Supreme Court ruled the NIRA unconstitutional in 1935, Congress tried another approach: public social insurance. The Social Security Act, SSA, passed in 1935, created systems of unemployment insurance, means-tested federal assistance to the poor, and a universal public pension, called Old Age, Survivors, and Disability Insurance or OASDI, which came to be known as Social Security. Later expansions of social insurance include Medicare, Medicaid, and SCHIP. In the last decades of the 20th century, economic and demographic changes eroded the employer-based and family-based elements of the mid-century social contract. Pressured by growing global competition and deregulation, employers retreated from providing health insurance and pensions. At the same time, the entry of most mothers into the workforce created the need for more child care and elder care. Meanwhile, the public social insurance component of the American social contract proved to be the most stable and efficient element. Instead of compensating for the decline of employer-based benefits and family-based care by an expansion of social insurance, however, Congress adopted a third approach to the provision of income maintenance and merit goods, individual tax expenditures. Influenced by neoliberal economic theory, a bipartisan consensus held that the best way to provide merit goods to Americans was not the direct public provision of income maintenance and merit goods by public agencies, but rather their indirect provision by means of voucher-like tax credits and tax-favored private savings accounts. According to the theory, the creation of artificial markets in these areas would combine universal access with cost restraint, as competition among providers for vouchers would drive costs down. Policymakers in both parties relied heavily on tax expenditures to strengthen all three parts of the social contract: wages, through wage subsidies, the earned income tax credit; social insurance, through subsidies to individuals for health insurance and retirement savings, employer-based health insurance, 401(k), S and IRAs; and merit goods, through tax subsidies for the private purchase of higher education, housing, and child care. Although President George W. Bush's push for partial privatization of Social Security failed, the neoliberal approach prevailed in the design of the Affordable Care Act of 2010, better known as Obamacare. Combining an individual mandate to buy private health insurance with means-tested subsidies delivered through the tax code, the ACA rejected the alternative of universal public social insurance or public health care provision and replaced one private welfare state approach, employer-based benefits, with another private welfare state approach, tax credit vouchers. The extreme reliance on tax-favored private spending in order to provide social goods makes the US an outlier among advanced industrial democracies. Between 1965 and 2010, tax revenues in other developed countries as a share of GDP have risen from an average of 25% in 1965 to 34% in 2010. In the same period, however, combined federal, state, local tax revenues in the United States have stayed flat. They were 24.7% of GDP in 1965 and 24.8% in 2010. Of industrial nations, only Mexico and Chile have lower shares of GDP going to government. As this history shows, the American social contract does not reflect a single public philosophy. Instead, it is the result of contests among conflicting approaches, favored at different times from the 1930s to the early 21st century. The economic security system for Americans is partly public, consisting of purely federal social insurance, Social Security and Medicare, and federal-state hybrid social insurance, Medicaid, unemployment insurance, SCHIP. And it is partly private, including what Christopher Howard has called a hidden welfare state that uses the tax code to subsidize purchases of privately provided health insurance and retirement assets. The structure of the American social contract must be reviewed and evaluated in light of a number of trends that are transforming the economy and society of the 21st century United States. The service sector workforce. More than 8 in 10 American workers is employed in the service sector, and the proportion is likely to grow further as a result of automation in goods-producing industries. While professional service jobs are often well remunerated, much of the service sector workforce labors in menial jobs for low wages and no benefits. An aging population. The aging of the population is not a demographic disaster, but something to be welcomed. However, a lower work-retiree ratio will require adjustments to be made in America's system of providing for workers and retirees alike. Working parents. While the mid-20th century American social contract was based on the assumption that homemakers would be responsible for child care, today over 70% of mothers of children are in the workforce. 3 arrangements for child care and family work policies have not caught up with this social trend. Uneven sharing of the gains from growth. In the last quarter-century, many of the gains from economic growth have gone to a tiny number of individuals, while incomes and total wealth for many Americans have stagnated or declined. This represents a dramatic change from the mid-20th century, when all classes in the US shared the benefits of economic growth. The United States is a rich country that will steadily grow richer as a result of productivity growth, notwithstanding the crisis of the Great Recession and its aftermath. America can afford decent wages and an adequate safety net for all of its citizens. The question is how to provide these necessities to citizens in ways that are fair, efficient, and economically sustainable. The existing social contract in the US is an incoherent and inefficient blend of inherited programs and policies that reflect 6 major approaches to providing adequate wages, economic security or merit goods, labor market regulation, federal social insurance, public provision, means-tested in-kind benefits, federal-state social insurance, and tax expenditures for employer and individual benefits. Of these 6 methods of providing adequate income, economic security, and merit goods, the first 3, labor market regulation, public provision, and universal federal social insurance, are the simplest, fairest, and most efficient. All of the other approaches create inefficiencies, perverse incentives, and sometimes uncontrollable costs. Many of these design defects have been exposed by the Great Recession. Of the various methods of providing for economic security, means-tested programs, often known as public assistance or poor relief, are the oldest, antedating the Industrial Revolution. 4 centuries in Western Europe and its colonial offshoots, local governments as well as religious and secular charities provided safety nets for the poor. Means-tested poor relief has usually been controversial and unpopular. Members of the working class and middle class who have been ineligible for poor relief have resented the resources going to the poor. Because of their political unpopularity, means-tested programs have typically been inadequately funded. As the saying goes, programs for the poor are poor programs. In addition to suffering from insufficient funding, means-tested programs tend to be intrusive and paternalistic. Eligibility for public assistance is often determined by humiliating investigations into personal and family wealth and work history, designed to deter free riding at the expense of taxpayers. When means-tested poor relief takes the form of cash grants, they are often conditioned on certain kinds of behavior, on the theory that the poor lack discipline and need to be compelled to change their lifestyles. And when means-tested programs take the form of public employment or workfare, the wages are often subpar and the work unattractive in order to encourage the poor to find jobs in the private sector. In many democratic countries, the general public has preferred that means-tested benefits for the poor take the form of in-kind benefits, like food stamps and public housing, which only provide funding for specific items. In-kind benefits are yet another kind of behavioral policing, ensuring that the poor will have access only to socially approved goods. In short, means-tested economic security programs, if they are to obtain the support of the majority in democratic countries, are almost always designed to be humiliating, intrusive, punitive and manipulative, in order to reassure taxpayers that the poor are being disciplined and that the taxes of the majority are not being wasted on the undeserving. The result can be a vicious circle, in which a system designed for stigmatization and punishment alienates the poor, whose alienation in turn creates contempt toward them by the majority. Cooperative federalism is the term for programs that are administered concurrently among different levels of government. Examples of cooperative federalism include hybrid federal-state social insurance programs like Medicaid, SCHIP, and unemployment insurance. Often these federal-state partnerships operate by encouraging states to spend money on particular social purposes in order to obtain federal matching grants. In prosperous times, this system generally works. During economic downturns, however, states face an impossible dilemma. As tax revenues dry up, the demand for welfare benefits from these programs increases. Worse, while the federal government can run deficits, 49 out of 50 states have balanced budget agreements that force them by law to balance the budget every year. This is the situation today. In the wake of the Great Recession, state governments are still looking at more than a $55 billion shortfall in FY 2013, up from more than $100 billion in preceding years, and are being forced to lay off teachers and other employees, cut benefits, and raise taxes in an effort to balance their budgets. The federal government can help out when times are hard, and it has assisted states and local governments in paying for Medicaid and unemployment in the last few years. But federal support for state programs can often be too small, meaning that America's system of social welfare is not the automatic stabilizing mechanism it ought to be. Federal state insurance programs are also flawed in other ways. Increasingly, Congress has relied on unfunded mandates. It has used federal mandates to require states to provide benefits, but not given states enough funding to meet those mandates. And federal-state hybrids weaken oversight and cost control by dividing responsibility among federal and state governments while producing unfair variations in benefits among different jurisdictions. A 2005 OECD report based on cross-national comparisons shows that matching programs with concurrent contributions by central and state or provincial governments tend to have problems. Even if lower-income regions get better matching rates in an attempt to minimize regional disparities, these regions are still less likely to spend their own funds, and the resulting equalization effect is, at best, weak. A tax expenditure is a substitute for government spending that takes the form of eliminating tax liability for money that is spent for a particular designated purpose. Tax expenditures have the same effect on budgets as spending does because they reduce government revenue. In the last quarter-century, Congress has used tax expenditures to subsidize low wages, the Earned Income Tax Credit or EITC, income maintenance, tax-favored retirement savings accounts such as 401(k), S and IRAs, families with children, the child tax credit, and merit goods, employer-provided health insurance, the home mortgage interest deduction, tax-favored lending to homeowners and college students. The heavy reliance of the U.S. government on tax expenditures in social policy has appealed to conservatives because tax expenditures can be portrayed as tax cuts, although the revenue must be made up by higher taxes elsewhere if the tax expenditures are to be revenue neutral. Tax expenditures have also appealed to progressives as an alternative to direct spending programs that might draw opposition. But while tax expenditures may make good politics, they do not make good policy. The excessive reliance on tax expenditures to achieve social welfare goals has produced what Christopher Howard calls the hidden welfare state and Suzanne Mettler the submerged state. The use of tax expenditures as the tool of choice in American public policy has been misguided because it has been invisible, inequitable, inefficient, and inflationary. The fact that tax expenditures are invisible distorts public policy, leading to an undersupply of government programs. As Suzanne Mettler found through her research on the submerged state, many of those who benefit from tax expenditures do not realize the support comes from the government. For example, 60% of people who used the home mortgage interest deduction did not think they had ever used a government social program. As a result, there is an unwillingness to adequately fund public programs, even those that are broadly popular. Tax expenditures are inequitable because many of them, like the home mortgage interest deduction, disproportionately benefit the affluent. Tax-based spending by nature is more likely to help those who have more money because they pay higher taxes. Tax expenditures are inefficient because of the costs imposed by for-profit middlemen in many indirectly provided goods and services, including student loans and home loans and tax-favored, privately managed retirement savings accounts. Finally, tax expenditures tend to be inflationary. The flood of subsidies for the private purchase of merit goods has been associated with levels of cost inflation in healthcare, higher education, and housing of a kind unknown in other, similar nations that do not rely on this tool of public policy. In theory, providing tax credits or tax-favored loans for the private purchase of merit goods is supposed to lead to lower prices through competition for the vouchers. In practice, however, healthcare, higher education and housing are imperfectly competitive markets in which subsidies to purchasers may allow producers to raise their prices in order to extract rents from the taxpayers rather than lower costs through competition. Even worse, some of those rents can become tools to entrench the system, as powerful producer interests deploy some of their profits in the form of campaign donations to pressure Congress to increase subsidies and reject regulation. During the business cycle, tax expenditures tend to be harmful because they are pro-cyclical rather than counter-cyclical. Because they vary with income, government subsidies in the form of tax expenditures swell during booms and shrink during economic busts. In contrast, social insurance programs like unemployment insurance act as automatic stabilizers, replacing demand during downturns and shrinking during economic upturns. Replacing individual tax expenditures with social insurance transfer payments would help cushion Americans from economic fluctuations, as well as potentially help to moderate cycles of boom and bust in the economy as a whole. Unlike means-tested programs, federal state social insurance and tax expenditures that subsidize the private purchase of merit goods, the other three major approaches to building a social contract, labor market regulation, federal social insurance, and the public provision of merit goods, tend to be more efficient and politically sustainable. The minimum wage, as a labor market regulation, is simple and straightforward, unlike the complex Earned Income Tax Credit, EITC. It helps low-income Americans without requiring intrusive means testing and bureaucratic supervision. It is impossible for employers or individuals to game. It is politically sustainable as well because higher minimum wages enjoy strong public support. A recent survey found that 73% of likely voters support increasing the minimum wage to $10 an hour and indexing it to inflation. Universal, purely federal social insurance programs like Social Security and Medicare are strong elements of the social contract as well. Unlike means-tested programs, these universal programs enjoy broad public support and do not have humiliating eligibility requirements. Unlike federal-state hybrid programs, their solvency is not dependent on the condition of finances in particular states. And unlike tax expenditures, they link highly visible benefits with highly visible taxes, in the form of payroll taxes. As an approach to merit goods, public provision is often preferable to the use of tax expenditures to subsidize private purchases of those goods. Public education, provided directly as a public service by state and local governments with some federal help, has not been plagued by the cost inflation and abuses of student loans that have accompanied the channeling of subsidies through the tax code to university students. Similarly, the public provision of healthcare via the Veterans Administration to eligible military veterans and their families has avoided the cost inflation and inefficiency characteristic of the taxpayer-subsidized private insurance and healthcare industries. As in the case of social insurance, the transparency of costs of universal, in-kind public services sustains political support even as it ensures fiscal accountability. The crisis of the American social contract is also an opportunity. Americans can now draw from more than a century of experience, in the United States and other countries, to evaluate what works and what doesn't when it comes to providing economic security and equity for a modern industrialized nation with a majority of wage earners. America's own recent history makes it clear that the most solvent, efficient, and equitable social contract is one based on a few simple, universal programs of social insurance. The American social contract cannot be renegotiated overnight, but the broad outlines of a more solvent, efficient, and fair social contract are clear. As a bold framework that can guide long-term reform, we propose an alternative social contract to be built almost exclusively on three approaches: labor market regulation, federal social insurance, and public provision. A living wage. Adequate income for all Americans who work full-time would be achieved by a labor market regulation, a minimum wage that is also a living wage, indexed for inflation. Expanded social insurance. Economic security for all Americans would be guaranteed by an expanded, streamlined system of purely federal social insurance, from paid family leave to a more adequate and solvent social security system. Expanded state and local public services. Finally, public provision would be the preferred approach to ensuring access to merit goods like education for all Americans. Public provision for the most part would take the form of expanded state and local public services, funded by a new system of federal revenue sharing that would partly replace more regressive state and local taxes. The three elements of the next social contract, a living wage, expanded federal social insurance and increased state and local public service provision, would be mutually reinforcing. A higher minimum wage would result in higher payroll tax revenues, benefiting federal social insurance. The complete assumption of responsibility for all social insurance by the federal government would liberate state and local governments to concentrate on providing public services like education. At the same time, increased hiring by state and local governments, paid for by federal revenue sharing, would create a tighter labor market in the private service sector, reducing the danger that a high minimum wage would produce a large gray market in labor. The next social contract that we propose would ensure that a virtuous circle would replace today's vicious circle of low wages, inefficient and out-of-control private welfare spending and wasteful subsidies to for-profit middlemen to provide what ought to be public goods and services. The original purpose of the minimum wage was to promote economic independence on the part of American workers, whose incomes would be sufficient to keep them out of poverty without the need for public welfare or private charity. The failure of Congress to provide for the automatic adjustment of the minimum wage for inflation led to a steep reduction in its real value, notwithstanding periodic increases, from the 1970s to the present. While the Earned Income Tax Credit, EITC, has reduced poverty, as a form of means-tested welfare it has increased the dependence of a new underclass of the working poor on government for survival. It is time to return to the original vision of the minimum wage, a wage sufficiently high that a full-time worker need not be dependent either on public welfare or private charity. From the late 20th century until the present, a bipartisan consensus has supported the Earned Income Tax Credit, EITC, over the minimum wage as a method of helping low-income Americans. Conservatives approve of the EITC because it takes the form of a tax break rather than a direct spending program and subsidize workers in the private sector. Many progressives favor enlarging the EITC to raising the minimum wage because the benefits of the EITC are more narrowly targeted and there are fears of the minimum wage causing job loss due to adverse effects on employment. But the debate over the EITC versus the minimum wage has been fundamentally misconceived. The minimum wage was never intended to be a targeted poor relief program. Instead, it was originally justified by two purposes. First, promoting the independence of mainstream American workers from welfare, including welfare taking the form of wage subsidies, and second, discouraging low-road economic strategies by employers, industries, and states in the American federal system. Each of these objectives is better achieved by a high minimum wage than by the EITC, which makes workers dependent on government and subsidize inefficient, low-wage employers and industries. Campaigns for a living wage in the U.S. began in the 19th century. Often they were justified by the claim that a democratic republic like the United States requires a middle-class majority, whose members have a degree of economic independence not only from employers but also from government and private charity. In the early 20th century, some champions of the minimum wage supported it because it discouraged low-road economic strategies. Companies and industries whose executives feared competition from rivals using low wages and other exploitative labor practices became advocates for a minimum wage. And some corporate leaders and union leaders alike viewed national minimum wages as methods of preventing low-wage, low-tax, anti-union southern states from luring industries away from the more industrialized Northeast and Midwest. The first attempt to create a federal minimum wage system was the National Industrial Recovery Act of 1933. Its purpose was not merely to combat the Great Depression but also to create a new, permanent system of industrial relations. Instead of a single federal minimum wage, the NERA sought to create different minimum wages for different industries. In return for being granted relief from some antitrust regulations, the firms in each industry, acting through trade associations, would be required to negotiate with organized labor to write codes that would create, at the very least, an industry-wide minimum wage and an industry-wide employer-based pension system. The role of the federal government was to approve the arrangements negotiated by business and labor in each sector. Similar systems of tripartite government-business-labor corporatism, have been used successfully by many other democracies from the early 20th century to this day. In Britain, Germany, and other advanced industrial nations, statutory minimum wages were confined to so-called sweated industries like home production, in which unionization was difficult. Most workers were covered by particular minimum wages agreed upon by business and labor in their industries, with government supervision. Only countries with relatively weak labor movements, like France, relied heavily on statutory minimum wages. After the Supreme Court struck down the NERA in 1935 on grounds that had to do with federalism, Congress created a single statutory federal minimum wage in the Fair Labor Standards Act, FLSA, of 1938. In addition to creating a federal minimum wage of 25 cents per hour, the FLSA limited the workweek to a maximum of 44 hours. The Earned Income Tax Credit originated in a completely separate sphere of public policy that had nothing to do with minimum wage policy, targeted anti-poverty policy. The Social Security Act of 1935, which also created a purely federal public pension for the elderly and federal state unemployment insurance, established a means-tested federal anti-poverty program, Aid to Dependent Children, later changed to Aid to Families with Dependent Children, or AFDC. Intended originally for widows and orphans, AFDC became controversial because many of its beneficiaries were single women with children out of wedlock, many of them poor and black. By the early 1970s, the search for alternatives to AFDC led many conservatives and liberals to favor a negative income tax, NIT, a basic income provided through the federal tax code. But as in other democracies, including the Nordic welfare states, the idea of a basic income proved to be unpopular with voters, who dislike welfare programs with no connection to individual work effort. An alternative to the NIT, championed by Louisiana Senator Russell Long of the Senate Finance Committee, was the use of a refundable tax credit to supplement low wages. The purpose was to encourage the entry of welfare recipients into the workforce, a goal that enjoyed strong public support. To reduce the number of non-working poor receiving government benefits, both parties supported the enactment of the EITC in 1975 and subsequent expansions in 1986 and 1993. Although the EITC was advertised as replacing welfare with work, it simply replaced welfare for the poor without work requirements with welfare that came with a work requirement. A means-tested wage subsidy like the EITC is a form of welfare. The EITC reduced the welfare caseload, but it did nothing to reduce the dependency of the working poor on government, because without wage subsidies their market wages were too low to allow them to escape destitution. It was during the 1980s and 1990s that the minimum wage and the EITC collided. Originally created as an alternative to non-work-based welfare, the EITC was used as an excuse by conservatives and neoliberals to avoid raising the minimum wage. From its origins in 1938, the minimum wage had never been indexed to inflation. Instead, Congress had to restore its value periodically by legislation to prevent it from being eroded by inflation. The value of the minimum in inflation-adjusted constant dollars plunged between 1978 and 1989, thanks to high inflation and the failure of Congress to act. The real minimum wage dropped from almost $8 an hour in the 1950s and 1960s to less than $5 an hour in 2006. The case for the EITC rather than the minimum wage relies on two major arguments: that a higher minimum wage would increase unemployment, and that the EITC targets the poor more effectively than the minimum wage. Would increasing the minimum wage increase unemployment? Despite the insistence from conservative politicians that the minimum wage is a job destruction program, there is no consensus among academic economists on this issue, in part because economists tend to divide along partisan lines. The argument that increases in the minimum wage automatically lead to higher unemployment tends to be based on a priori deductions from axioms of neoclassical economics, not empirical studies of particular cases in which minimum wages have been increased in the US and abroad. They also tend to ignore the role of a higher minimum wage in creating at least some jobs, as better paid workers at the bottom of the wage distribution spend more money. The most widely cited work on the effect of the minimum wage on employment is the 1994 study by David Card and Alan Kruger of fast food restaurants in the Mid-Atlantic following the New Jersey state-level minimum wage increase in 1992. Card and Kruger did not find that an increase in the minimum wage led to job losses, and a wide range of other studies show similar results. Undoubtedly, there is a point at which too great an increase in the minimum wage would create large-scale unemployment. The question is whether a minimum wage adequate to keep a full-time worker out of poverty would have that effect. If the answer were yes, that is still not a damning indictment of a higher minimum wage. There are other methods to address unemployment, and society might decide that, as a matter of principle, it is preferable to respond to the incidental unemployment caused by a living wage by other measures, like public employment, rather than to deliberately create and maintain an underclass of workers paid too little by their private sector employers to survive without assistance from welfare. The argument that globalization means that high wages prevent the US from competing with foreign economic rivals is unpersuasive. To begin with, low labor costs are only a small part of the advantage of low-cost producer nations like China, less important than undervalued currencies, subsidized or free land, energy, and infrastructure for businesses and state-directed credit. In any event, the US is competing, not with low-wage developing nations, but with high-wage countries like Germany, Japan, and South Korea, which have been far more successful than the United States in expanding their global market shares in high-value-added industries even though their wages are equivalent to or higher than American wages. While conservatives tend to argue that a higher minimum wage would cause unemployment and reduce America's international competitiveness, many progressives prefer an expanded EITC to a higher minimum wage because the former is a narrower program targeting the poor more effectively. While this is true, a means-tested program like the EITC risks lacking the broad political support that could sustain a universal program like the minimum wage that can benefit middle-class teenagers and part-time workers as well as the poor. The case for the EITC instead of the minimum wage depends on effacing any moral or political difference between a minimum market wage and a minimum income consisting of a below-poverty market wage and a government subsidy. But while the two approaches may produce identical incomes, the adequate market wage frees the worker from dependence on government. The EITC and similar wage subsidy schemes divide the single US labor market into two castes: ordinary workers, who live on their market wages alone, and a dependent underclass of the working poor who cannot escape poverty with the help of market wages alone, no matter how hard they work. The EITC does not reduce welfare dependency. It is a form of welfare dependency. The EITC has merely replaced one form of highly visible welfare to which voters object with another form of welfare that is invisible to voters because it is hidden in the tax system. The proposal to make the working class and the middle class, as well as the new underclass of the working poor, dependent on government wage subsidies should be treated as what it is: an admission of defeat in the project of creating an independent middle-class citizenry in the United States. In addition, EITC benefits are greater for workers with children than for single workers or childless couples, adding additional complexity and further segmenting the labor market by discriminating against some categories of workers rather than others. The original rationale for the minimum wage as a living wage remains compelling. Nobody who works a reasonable number of hours per week in any job in the United States should be poor and dependent for survival upon government agencies at any level of government. Nor should any full-time worker be unable to make ends meet, in the absence of additional paternalistic support from employers or dependence on private religious or secular charity. The goal of the living wage is to provide both dignity and the minimum of self-reliance that is necessary for citizens of a democratic republic. Another traditional rationale for the minimum wage, the high road case for discouraging employers and industries that rely on low wages, also remains persuasive. An adequate federal minimum wage provides a floor that limits a race to the bottom by firms within particular industries and by individual states and localities within the US. Indeed, a number of studies suggest that high wages provide incentives for employers to invest in new technology or more efficient organization in order to use costly labor more effectively. After reviewing cross-country inequality trends, Daron Acemoglu of MIT concluded that there may be greater incentives to invest in technologies complementing workers whose wages are being pushed up by labor market institutions. Another argument against raising the minimum wage is that an increase would hurt the consumers of goods and services produced by low-wage labor. As we have seen, substituting technology for low-wage labor might allow many of the same goods to be produced at the same or lower cost, even if the lowest wages in a particular industry were higher. Furthermore, the consumers of luxury services provided by low-income workers are disproportionately affluent or rich. There is no reason why the costs of subsistence of a low-income worker should be partly socialized by American taxpayers, so that worker can provide menial services as a maid, or gardener, or pool cleaner, to upper-income Americans who could afford either to pay more for the same services or live without them, as working-class and middle-class Americans are compelled to do. What about merit good services for low-income Americans, like health care or shopping for the homebound elderly? If turning the minimum wage into a living wage threatened the ability of low-income Americans to purchase any necessary services, then the appropriate response would be to increase the provision of those services by the public sector, the non-profit sector, or both. One method for the provision of necessary services for low-income Americans who could not otherwise afford them might be the adoption, in the US, of service vouchers, a program used in many European countries. Service vouchers subsidize the wages of workers who perform in-home services like cleaning and yard work for eligible citizens, such as elderly people with modest incomes. Service vouchers are wage subsidies, just like the EITC. But because they are targeted wage subsidies, the public, through its elected representatives, can make sure that wage subsidies go only to certain socially desirable occupations, like help for the elderly, instead of being showered indiscriminately on all low-wage workers, including low-wage factory workers and the menial servants of the rich. In the aftermath of the Great Recession, the United States may be afflicted by high levels of unemployment for years to come. Compounding the challenge to public policy is the fact that many jobs in many sectors will never be restored, either because they depended on debt-enabled demand during the bubble economy years, like many jobs in finance, real estate, and construction, or because they are vulnerable in the long term to offshoring or automation. At the same time, the aging of the American population will create growing demand for personal services, including but not limited to medical care. About a fifth of the US population will be older than 65 by 2050. For this reason, social assistance and healthcare services are set to be the fastest growing sectors of our economy for the next decade. If labor markets were as frictionless as they are assumed to be in the ideology of free market fundamentalism, labor would flow easily from labor-shedding sectors like construction to sectors like elder care, where labor is in growing demand. In the real world, however, this doesn't really happen organically. It takes intelligent public policy to direct, accelerate, and smooth such historic transitions. In today's polarized, unequal America, in which a small minority has enjoyed many of the gains from economic growth in the last generation, a disproportionate share of service sector job creation may come in the form of luxury services for the rich few. This inflates the number of maids, nannies, pool boys, and other servants in the workforce. At the same time, on the demand side, growing numbers of middle-class and poor Americans might find themselves unable to afford the kind of personal assistance that would enable them to stay in their homes and function normally as long as possible in old age. Economists have long identified a category of merit goods, goods that citizens in any society need in order to live according to widely shared conceptions of dignity but are undersupplied by the free market. While Medicare, Medicaid, and other programs already provide the merit good of affordable health care to the elderly and the poor, a case can be made that non-medical personal assistance for the elderly should be defined as a merit good as well. The elderly need assistance in performing daily, non-medical activities, such as bathing, dressing, eating, getting in and out of chairs, walking, using the toilet, using a telephone, preparing meals, shopping, managing money, and other housework. Currently, an informal care market largely serves their needs. An estimated 43.5 million American adults play the role of unpaid part or full-time caregiver. This gray sector represents millions of potential jobs, foregone contributions to Social Security and Medicare for individuals, and unknown losses in tax revenues for local and federal governments. Elder care also contributes an estimated $33.6 billion in costs to businesses per year in lost worker productivity, as middle-aged employees rush off work in emergencies to care for their parents, and an additional $13.4 billion in increased healthcare expenses due to increased stress for working caregivers. Public policy also has a role in correcting another market failure: inadequate compensation. It is seldom pointed out that the creation in recent years of a huge group of the working poor in many unskilled or semi-skilled service sector jobs has been indirectly enabled by programs of the welfare state, like food stamps or wage subsidies in the form of the Earned Income Tax Credit. These programs allow workers to work in jobs that pay wages that are inadequate for minimum subsistence, jobs like store clerk and gardener. In practice, conservatives as well as centrists have long accepted a role for government in topping up low market wages with a social wage of some kind. Why not address the challenges of unemployment and of aging by subsidizing private sector jobs with decent wages for workers who specialize in assisting the elderly? It is possible for the government to subsidize private sector elder care jobs while boosting the ability of the non-rich elderly to pay for non-medical personal services. We propose here a policy innovation that has worked well in other, similar democracies: service vouchers. This is how a service voucher works. Individuals who qualify receive vouchers from the government that they can use to employ workers for domestic service tasks such as shopping or housekeeping for nothing or a modest fee. The service workers must be employed by a certified company. The government subsidizes the employer so that the worker receives a decent wage that is the sum of the voucher user's payment plus the government subsidy. Service voucher programs have been successfully implemented on a national scale in a number of European countries, including Belgium, France, and Sweden. These programs were created to stimulate both formal sector employment and consumer-directed household and personal care for the non-elderly and elderly alike. Family caregivers can choose to work full-time or remain as a caregiver, but in the formal sector. Belgium, for example, started a federal program in 2004 that offered subsidized vouchers, Titus services, for domestic services, to be redeemed with government-accredited companies. Individuals living in Belgium can purchase 750 tax-deductible vouchers. Each voucher is worth 1 hour of service per calendar year, or 2,000 if they are disabled, have a disabled child, are elderly, or are a single parent. The cost of the service is split between the user, who pays about 1/3 of the cost of the service after taxes by purchasing the voucher, and the government, which pays about 2/3 of the cost of the service through two routes: tax deductions to the user and direct reimbursement of costs to the service provider. Belgian service workers in the program have a service vouchers employment contract, allowing them to accrue social security rights and making them eligible for other benefits, such as workers' compensation. This is important, as 2/3 of workers in the Belgian program identify leaving the grey market as a motivation for their participation. Evaluations of the Belgian voucher program lend insights about costs and cost offsetting. About 40% of the program's costs to the Belgian government are offset by reduced government spending on unemployment benefits and other welfare subsidies, additional social security contribution revenues, and additional personal income tax revenues. This calculation does not take into account the value of other positive effects, such as improved productivity and health of workers with fewer caregiving pressures and a better work-life balance, the social benefits of formalizing the grey market, and the improved health and self-esteem that comes with decent employment. In France, the CESU Social, Che Emploi Service Universal, or Universal Services Employment Vouchers, is a national voucher program implemented by local and regional governments. CESU Social was created in 2005 to promote formalization of the personal services sector, 60% of which is estimated to be undeclared in France. Vouchers can be used for the direct payment of workers or for workers hired through companies for housework, assistance for the elderly, disabled, or dependents, including children, help with schoolwork, household and gardening work, and caretaking. Recipients of Social Security benefit programs, including the elderly, receive a personal CESU card, CESU Prix, with a prepaid amount on it, redeemable only for specific services. The recipient uses the card to pay for services. The service provider is reimbursed by the local government, often via a private management company, and the local government pays the Social Security contributions owed by the service provider if the service provider is an individual. Incentives to join the scheme include reduced value-added tax rates and subsidized Social Security contributions on services provided to the elderly, for businesses providing CESU social paid services, a 50% tax credit on spending on CESU social services for private individuals, and for self-employed service workers, exemptions from employer public pension contributions on CESU social service payments. In Sweden, where more than 70% of elder care was estimated to be informal, the government introduced a voucher system in 1993. To receive care, municipalities first carry out a needs assessment to identify services to be delivered to the elderly person. Then users receive a virtual voucher redeemable with approved public or private providers for the identified services. The result is that users of elder care services pay about 4% of the costs while 80% is paid for by local taxes, and national taxes contribute about 16% of costs. Local governments thus enjoy significant independence in how they provide services. However, the national government has placed caps on the maximum amount users pay for services, whether they are publicly or privately provided, and enforces financial sanctions upon municipalities that fail to ensure services are provided. The need in America. Currently, nothing like a service voucher program exists in the United States. The Community Living Assistance Services and Support Class Act, initially created as part of the 2010 Affordable Care Act, would have provided for in-home services like help in dressing and bathing, but was extremely restrictive, with eligibility limited to disabled individuals. Unlike service voucher programs, the CLASS program was a voluntary insurance program funded by premiums paid by beneficiaries. Perhaps lending credence to claims that such a plan would be unsustainable, the Obama administration announced that it was scrapping the CLASS initiative because of concerns that it would be too costly for participants. At the state level, the most closely related program might be Oklahoma's Advantage program, which provides both medical and non-medical assistance to Medicaid-eligible elderly, and allows care recipients to choose the care providers from a list of private, state-certified companies, which are reimbursed by the state. Instead of service vouchers, The United States has respite care programs that provide relief to family caregivers with money channeled to states through the enactment of the National Family Caregiver Support Program, NFCSP, under the Older Americans Act amendments of 2000. These programs simply offer respite vouchers for family caregivers, giving the person a chance to hire another caregiver and take a break. California, for example, has a statewide program offering caregivers vouchers of up to $3,600 per year in respite care, allowing families to choose respite providers. While respite care programs are worthwhile because of their focus on family caregivers, they will not help the growing number of childless Americans in their old age, nor will they help those who live far from children and relatives and receive no care at all from them, or adults who must work instead of caring for their parents. In contrast, a service voucher program could be designed to be open to all elderly Americans, whether they have family caregivers or not. But if we're seeking to increase government involvement in the provision of non-medical elder care, why not just have public employees do the tasks directly, instead of a system of public subsidies for private service workers? In theory, public workers can do the job, of course. But one benefit of a service voucher system is that it reduces the need for people to leave their homes for institutional care. Moreover, the idea of a public home care service is manifestly unpalatable. Even the social democratic countries of Northern and Western Europe have opted for public subsidies for privately provided home care instead of creating legions of public maids and public yard workers assigned to individual households. Moreover, service vouchers would also have another economic benefit. If introduced to the United States, they would provide policymakers with a valuable and flexible tool to supplement, not replace, the Earned Income Tax Credit, EITC. This would mark an advance, for several reasons. One is the over-reliance of American public policy on the EITC as a tool for raising the incomes of the poorest Americans. The EITC is a federal income tax credit for low to moderate income workers. The tax credit is refundable, meaning that the government pays money to supplement the wage income of workers whose incomes are so low that they do not pay income taxes. Most economists agree that the EITC works best in smoothing out the income of workers with limited or interrupted labor market participation. But with the support of Republicans and Democrats alike, the EITC has also been greatly expanded as a substitute both for in-kind benefits, which are unpopular with the American electorate, and a higher minimum wage, which is opposed by most conservatives and many businesses. Over-reliance on the EITC may be good politics, but it's bad policy. The EITC suffers from other design defects as well, especially when it is diverted from its best use in helping workers with intermittent work records and turned into an all-purpose tool for raising incomes at the bottom of the labor market. Like other wage subsidies, including service vouchers, the EITC indirectly subsidizes the employers of low-wage labor, even as it directly subsidizes low-wage workers. As presently designed, the EITC has no limits on what kind of employers receive tax subsidies. The EITC can subsidize workers who help elderly people shop or keep their homes clean. But it can also subsidize non-union workers toiling in sweatshop or armies of menial servants laboring on the estates of billionaires. A service voucher program avoids this problem by strictly limiting the kinds of jobs that are subsidized. Shoppers for the elderly, yes. Pool boys, no. Service vouchers have another advantage over the EITC program, as well as over other kinds of general wage subsidies. While both the EITC and service vouchers produce a limited redistribution of income, service vouchers also provide a limited redistribution of purchasing power to the middle class and poor elderly by permitting them to obtain services they could not otherwise afford. To meet the needs of the elderly while creating jobs for low-skilled workers, we propose our specifically American version of the service voucher idea, which we call the Dignity Voucher Program, an innovative system of service care vouchers for the elderly. Modeled on the best practices of service voucher programs in other democracies, and complementing existing, limited respite care programs intended to aid families that care for their members, the Dignity Voucher Program could increase employment of low-skilled workers by stimulating demand, even as it raises tax revenues and worker wages by replacing informal grey market labor with new jobs in the formal economy. The federal government would provide state governments with funding for elder care services in the form of dignity vouchers. Qualified retirees would be able to use the dignity vouchers to purchase a limited number of hours of non-medical personal assistance in tasks like housekeeping and transportation from personal service companies that are certified by federal and state governments. The dignity vouchers would permit retirees to pay less than the minimum wage to the employees of the personal service companies, while the companies would be required to pay above the minimum wage. Government would pay the service companies the difference between the voucher payment and the employee's wage. Congress or states may choose to require employers to provide specific benefits to workers, healthcare, pensions, or limit overhead costs as a percentage of the value of services provided. In order to minimize any possible abuse while maximizing effectiveness, an experimental dignity voucher program needs to be carefully designed. The subsidy must go to a government licensed company that employs the service providers, care workers, not directly to the recipients or the providers. That will ensure that the money is not used for off-the-books payments to black market labor. It would also ensure that the employers obey federal and state workplace, civil rights, and minimum wage laws. Qualified employers would be elder care service companies that are licensed by the states and meet all local, state, and federal requirements. They should be regularly audited in order to deter abuses of the system, and could be private or public entities. The decentralized Swedish example may be a good model for the Dignity Voucher program because it pushes private sector competitive efficiencies and job creation but avoids the type of cost escalation seen in the US healthcare system. In fact, because the United States has a larger existing pool of private elder care providers than Sweden did at the outset of reform, the provision of vouchers can more quickly stimulate competition and growth in the sector, making it an appealing job creation option. Just as in each of the models outlined above, non-medical activities that qualify for subsidy under the Dignity Voucher program would be defined by federal and state law. They might include personal assistance in housework, transportation, cooking, and other chores. Medical assistance should be excluded from the Dignity Voucher program as that would be covered by Medicare and Medicaid. Qualified recipients should include the middle-class elderly as well as the low-income elderly, but a means test might exclude affluent retirees. The Dignity Voucher program might also include the disabled of all ages. Because need is more easily determined by local officials, the qualification of recipients might be left to state or local governments, like the municipal government evaluation of individuals in Sweden, even though the funding comes from the federal government. However, individual evaluation or means testing could undermine political support for the program, and it would also significantly increase its administrative costs. Awareness campaigns, the responsibility of local governments, although qualified employers will have a vested interest in advertising their services to qualified recipients as well, could target qualified recipients. To work, the Dignity Voucher program must operate in the formal sector, and the Belgian case shows that integrating service workers into the social welfare system, social security, Medicaid, unemployment insurance, etc., is key to drawing workers out of the informal sector and protecting them from exploitation. Service workers in the Dignity Voucher program must therefore be qualified providers, qualified by state standards and given all of the rights and responsibilities of employees under federal law. Qualified providers, or service workers, would further be limited to US citizens or legal immigrants. During the initial phase of the program, preference might be given to individuals who have suffered prolonged periods of unemployment during the present recession. The benefits of dignity vouchers or similar service vouchers in the United States would not be limited to new kinds of decent jobs for domestic service workers and access to needed aid for the elderly. In Europe, service voucher programs have had some success in shrinking black markets in labor by reducing the demand for extra-legal employment. Evaluations of the Belgian voucher model show that a significant portion of the cost of the program to the government, at least 40% in the Belgian case, can be directly offset by increased revenues and decreased tax expenditures. These offsets largely depend upon how successful the program is in formalizing grey market elder care, and thus increasing income tax receipts and reducing benefits paid to unemployed or underemployed individuals. A service voucher program like the Dignity Voucher program that we propose could deter illegal immigration to some degree by reducing the demand for off-the-books labor. The Dignity Voucher program would allow the elderly to pay less than the minimum wage to US citizens and legal immigrants who, thanks to the government subsidy to the service company employer, would be paid above the minimum wage. Paying the mean national caregiver wage would help ensure that government subsidies do not serve to undercut existing caregivers or create a situation in which service workers are unable to earn a living wage and become dependent upon other government aid. The automation of recipient selection, perhaps using the Social Security Administration, and implementation of the program also reduces administrative costs. For example, the French model seems to lower the costs of being in the formal sector for both workers and recipients. On the supply side, Social Security contributions of workers in France are calculated automatically with the prepaid CESU card, and on the demand side, the system promotes direct hiring and payment of service workers, potentially lowering costs and hassle for service recipients, who have a free choice in purchasing services. The United States should learn from the success of other nations that have adopted service voucher programs. Like other countries, the United States must address both unemployment and the challenges presented by an aging population. Claims by politicians, pundits, and policy analysts that a two-for-policy proposal can solve two problems at the same time should be subject to critical scrutiny. We believe that our proposal can withstand the test. Increasingly, our economy will be dominated by personal services that cannot be automated or offshored, and a large part of the service economy will be driven by demand for eldercare services generated by the aging baby boomers. This demand is currently being met in part by family caregivers as well as the informal labor market. U.S. businesses lose worker productivity and pay higher healthcare costs for employees providing caregiving at home, while black market labor costs local, state, and federal governments' tax revenues. Existing respite care programs for caregivers are inadequate and could be supplemented or replaced by a service voucher program. The Dignity Voucher program proposed here should be tested as a pilot program. If it is considered a success, then Congress should consider scaling it up and making it a permanent part of America's system of social insurance, addressing the previously unmet needs of many elderly Americans for modest personal assistance by a mix of public funding and private provision. The cost of the program would depend on its scale. Some, if not necessarily all, of the costs could be offset in the federal budget as a whole by savings in unemployment payments or by reductions in tax expenditures for home ownership and healthcare that disproportionately benefit the affluent. An American service voucher program could be paid for by a small, dedicated payroll tax, by another dedicated tax like a portion of a federal value-added tax, or by general revenues. Tested abroad and needed here, service vouchers can provide a new and useful tool in the repertory of American public policy. A service voucher program of this kind would accomplish multiple goals. It would increase demand for low-wage service sector workers. At the same time, it would provide indirect financial assistance to elderly Americans who are capable of functioning and living in their own homes but need occasional personal assistance that they cannot afford on their own. It would help American families by reducing the burden of supporting their elderly relatives. Finally, it would generate tax revenues, as informal, off-the-books, underpaid labor is replaced by adequately paid labor in the formal labor market. The use of service vouchers to create jobs while helping the elderly is exactly the kind of bold new idea that America desperately needs today. While a moderate increase in the minimum wage need not necessarily increase overall unemployment, it might very well hurt some businesses and industries that depend on paying below poverty wages to their workers. This is a virtue of the minimum wage, not a vice. U.S. employers are not permitted by law to employ child labor, or to force workers to work 18-hour days, or to endanger the safety of their workers. Why should they be allowed to pay their workers below poverty wages? Perhaps the single greatest advantage of a living wage over a system of wage subsidies is the fact that a living wage is simple and easy to enforce. Relying on wage subsidies like the EITC to compensate for inadequate market wages is highly inefficient. To begin with, any means-tested program requires an intrusive bureaucracy to ensure that the recipients meet eligibility requirements and are not cheating. To make matters worse, in the case of the EITC, that agency is the Internal Revenue Service, IRS. As it is, the enforcement capacity of the IRS is extremely limited. It is perverse to require the IRS to spend its limited enforcement budget, not on identifying and punishing wealthy scofflaws, but on supervising and policing millions of the working poor. Our argument is not that the EITC should be completely rejected. The argument, rather, is that in the last Generation 2 programs with completely different rationales, the minimum wage and the EITC have been treated mistakenly as competing substitutes for means-tested welfare without work requirements. In a new system based on an inflation-adjusted living wage, there might be room for a modest EITC tailored to workers who are unable to work full-time jobs. But no American citizen or legal immigrant who works a full 40-hour week at any occupation should require government welfare in the form of a wage subsidy. Turning the minimum wage into a living wage would not, by itself, increase wages for most Americans or ensure that workers share in the gains from economic growth. And in the absence of a tight labor market, produced by factors including full employment macroeconomic policies and limits on unskilled legal and illegal immigration, a higher minimum wage might expand black and gray markets in off-the-books labor. One method of creating tight labor markets that would reinforce the minimum wage and also increase the bargaining power of workers paid more than the minimum wage would be a permanent expansion of public employment in the provision of necessary public services. If producing adequate jobs and income for working-age adults is the first goal of the social contract, ensuring adequate income for non-workers, the elderly, children, the unemployed and disabled, is the second objective. In the area of income maintenance for non-workers, the existing American social contract is a mixture of successful approaches that should be emulated and failed methods that should be abandoned. Social Security and Medicare have succeeded because they are universal programs that include all Americans regardless of class and do not require humiliating eligibility tests. They are based on individuals and thus not dependent on an employer, and they are efficient in that they minimize government overhead or the investment of personal time. They can serve as models for an expanded system of social insurance to provide economic security for all Americans. The U.S. should move away from a tax code-based hidden welfare state that is invisible, inequitable, inefficient, and inflationary and toward universal social insurance programs like Social Security and Medicare. Nowhere is the contrast between the inefficient tax expenditure system of the hidden welfare state and the efficiency of social insurance more visible than in the area of retirement security. America's retirement system combines inefficient and inadequate programs of subsidized private retirement savings with a simple and successful public pension. The public component of retirement security, Social Security, is the most important and successful part of America's system of economic security. Its benefits to American society go beyond those to individual retirees. As President Franklin D. Roosevelt declared when he signed the Social Security Act in 1935, the Social Security system is a structure intended to lessen the force of possible future depressions. It will act as a protection to future administrations against the necessity of going deeply into debt to furnish relief to the needy. The law will flatten out the peaks and valleys of deflation and of inflation. It is, in short, a law that will take care of human needs and at the same time provide for the United States an economic structure of vastly greater soundness. When Social Security was created in 1935, business opposition was limited because the payout was so low that it did not conflict with existing employer pensions. In the spirit of welfare capitalism, many employers offered defined benefit pensions to workers that guaranteed a specific payout to employees for their retirement. The result was an informal two-tier system, which benefited workers with employer pensions. Over the past 2 decades, American companies have steadily shrunk their private pension contributions and have put more of the risk onto employees. They have done so in 2 ways. Either by eliminating company retirement plans altogether or by shifting from a defined benefit to a defined contribution pension program. In a defined benefit system, a retired worker knows exactly how much he or she will receive each month. In a defined contribution system, the employee makes a contribution into a retirement account such as a 401k or IRA, which is then invested in the bond and equity markets with attendant risks. The experience of the past decade shows that this shift in the nature of U.S. retirement policy has worked to the disadvantage of American workers while creating more vulnerability and uncertainty. The flaws of tax-favored private retirement savings accounts were painfully exposed at the beginning of the 21st century by 2 stock market crashes in less than a decade. Unlike Social Security or a traditional private defined benefit pension, a 401k or IRA account can lose much of its value as a result of volatility in the stock market or inflation. Those who retire during a stock market downturn find that their private savings are far smaller than they had planned. Low interest rates have also devastated retirement savings since the beginning of the Great Recession. Between 2008 and 2011, the money earned by Americans from interest payments dropped by roughly 27%, from $1.4 trillion to $1 trillion.19. Although it is not an imminent danger, inflation, too, can wreak havoc with plans for a secure retirement. While Social Security is adjusted for inflation, tax-favored private retirement savings plans are not. Investors with 401k or IRAs must hope that the gains from their investments are not erased by inflation. Volatility and vulnerability to inflation are not the only flaws of tax-favored private savings accounts. Only some American workers have access to 401ks through their employers, and of these, many contribute nothing or far too little to take advantage of the tax break. Those who do take advantage of tax-favored retirement savings plans often lose vast amounts of money because of bad decisions and hidden fees by money managers. In the late 20th century, proponents of voucher-like schemes for the private delivery of economic security and merit goods emphasized the importance of choice. But there is no evidence that the American public was clamoring for replacing employer pensions or Social Security, to name only 2 examples, with complicated, difficult-to-understand choices advertised by for-profit companies. In any event, history has proven that most individuals do poorly when left to make their own investment choices. According to one study, from 1991 to 2001, investors in stock mutual funds earned an average annual return of 3.8%, well below the S&P 500 annual return of 9.1%. The study attributes this miserable performance to a combination of irrationality on the part of investors, buying when stocks are high and selling in a panic when they are low, and excessive broker fees generated through too much trading. Social Security has grown in importance because of the decline in defined benefit pensions provided by employers and the shift toward defined contribution savings accounts like 401(k). Social Security and Medicare have played key roles in reducing elderly poverty. In 1959, the first-year poverty was measured for the elderly. Elderly poverty was at 35.2%. In 2010, it was 9%. Many Americans depend on Social Security for their livelihood. For those currently 65 and older, Social Security is the largest single source of income, accounting for 37% on average. By contrast, private pensions and annuities income account for only 9%. The numbers are even starker for low-income Americans. For the bottom 20% of Americans ages 65 or older, Social Security accounts for 84.3% of their income, and private pensions and annuities only 1.8%. Social Security is the largest source of income for more than half of America's elderly. In spite of this success, Social Security is under attack in the name of deficit reduction. But rather than cutting Social Security, a better approach to the deficit would be reducing or eliminating tax expenditures for private retirement savings and to strengthen Social Security to cement its role as an essential pillar of stable retirement income for workers. As another alternative to today's failed retirement security system, with its mix of sound Social Security payments and volatile tax-favored private savings, some have proposed creating a new category of universal defined benefit pensions to replace employer-based defined contribution plans like 401(k) and traditional employer-based defined benefit pensions. For example, Teresa Ghilarducci has proposed a mandatory plan for all workers in which employers and employees would have to contribute up to 5% of earnings with a guaranteed annual rate of return adjusted for inflation. While such a reform would be an improvement over the present inadequate retirement system in the US, the weakness of such proposals lies in the fact that a universal, defined benefit public pension plan already exists, Social Security. These proposals would create two defined benefit pensions, a new one, in which pooled money was invested by the federal government in the stock market, atop the older Social Security system, based on payroll taxes. The relationship between Social Security and demography is usually discussed in the context of rising ratios of retirees to workers by those claiming that social insurance systems are doomed to bankruptcy. These alarmists, however, are frequently guilty of factual and logical mistakes. While it is important to understand that the aging of the population will lead to more seniors using Social Security, many commentators neglect to take into account rising productivity, which permits both workers and retirees to enjoy higher living standards even as the number of retirees per worker increases. The increase in labor productivity in the last half-century has allowed 3 of today's workers to support the same number of retirees that 5 workers were required to support 40 years ago. To maintain living standards with projected dependency ratios, labor productivity growth in the US would have to increase by 40% by the 2030s. This is quite possible, given the levels at which labor productivity increased between 1960 and 2000. Although Americans should not be forced to work longer, better health may enable many to do so voluntarily in the future. Ignoring the fact that productivity growth can increase the incomes of both workers and retirees in spite of lower work-retiree ratios leads some to propose that a fixed work-retiree ratio be maintained by increasing the admission of working-age immigrants to pay payroll taxes. But in order to keep the present work-retiree age ratio the same, the US would have to import truly mind-boggling numbers of immigrants. In 2000, the UN Population Division calculated that maintaining the work-retiree ratio in the US between 2000 and 2050 would require the US, which admits roughly 1 million immigrants a year, to let in an average of 12 million immigrants per year. According to the UN, to maintain a stable work-retiree ratio, the US would have to admit nearly 600 million additional immigrants in the next 40 years. The US Census Bureau's Population Projection Branch has dismissed the idea that immigration can play a significant role in the solvency of Social Security and other social insurance programs. International migration may address a high dependency ratio decisively in the short term, yet is highly inefficient in reducing it over the longer term, especially if considerations of population scale, as well as age composition, are taken into account. The US can afford to maintain a decent standard of living for its retirees. The only question is whether to pay for Social Security benefits solely on the basis of payroll taxes, or to supplement payroll revenues with other revenues that can tap into non-wage income. If it were desirable to invest part of individual retirement savings in the stock market, then it would be easier for the government to invest some Social Security payroll taxes in the stock market. But why invest Social Security revenues in the stock market at all? The suggestion is an anachronistic legacy of the bubble economy, when unsustainable stock market returns were outpacing the growth of the real economy. The great advantage of the Social Security system is that its payroll tax base is more stable than the stock market. It is true that payroll revenues can collapse during periods of mass unemployment, like the Great Recession, and payroll revenues can suffer if the gains of economic growth are not adequately shared in the wages of American workers, as has been the case for a generation. But the solution should be to augment, or replace, narrow payroll taxes with a broader base, like a national consumption tax, not to make Social Security, the program on which most retired Americans rely, dependent on the success of the federal government as a stock market speculator. In retirement security, as in other parts of the American economic security system for individuals, complexity is linked to vulnerability, not stability. In the late 20th century, the conventional wisdom, reflected by the World Bank and other agencies, held that governments should diversify their retirement systems. In many official reports, retirement security policy was compared to a stool with multiple legs. The flaw in this metaphor should have been obvious. A stool with two wobbly or disintegrating legs is less stable than a single, solid column. The design defect of America's retirement security system from 1935 to the present is clear. From the beginning, Social Security has been too small a part of the overall retirement security system. Each of the tax-favored private systems that were intended to supplement Social Security payouts, tax-favored employer pensions and tax-favored individual savings accounts, have been failures. The prudent way forward is to expand Social Security, the successful, efficient social insurance component of the system, while phasing out tax-favored private pensions and individual savings accounts. The first step toward a sounder American retirement security system should be to increase Social Security's replacement rate, the percentage of pre-retirement income that is replaced by Social Security. As Stephen Hill has pointed out, in other, similar countries public pensions tend to replace a much higher percentage of pre-retirement income than in the US, where first employer pensions and more recently, 401(k)s and IRAs, were supposed to supplement relatively low Social Security payments. A case can be made for restructuring Social Security, while expanding it. Many other democracies have a two-tier or double-decker system of public retirement security, consisting of a universal, flat benefit to keep the elderly out of poverty that is the same for everyone and a public-defined benefit program that varies among citizens on the basis of their lifetime incomes. In this way, two goals, redistribution and insurance, are performed by two different programs. In contrast, in the current American Social Security system both functions are performed by a single program, on the basis of a complex formula that is partly redistributive and partly determined by variations in earnings among individuals. From the late 1930s to the present, there have been many proposals to turn Social Security into a two-tier system. The projected exhaustion of the Social Security Trust Fund may provide an occasion to do so. Absent other changes, Social Security will be able to fulfill only about 3/4 of its obligations to retirees at some point in the 2030s. The precise date depends on prior rates of economic growth and revenue collection. One option for dealing with the projected Social Security shortfall would be to maintain the existing one-tier formula and raise the revenues needed by increasing the payroll tax. Other methods include lifting the cap on earnings subject to payroll taxation, infusing non-payroll tax revenues, or a combination of those. But a case can be made that payroll taxes should be reduced, not increased, for lower-income workers and perhaps all workers, permanently. From this it follows that the Social Security system would need an infusion of revenues other than payroll taxes, all the more so, if Social Security's average payout were expanded, as we propose. Unlike Social Security, Medicare is funded by multiple sources of revenue. Significantly, the streams of revenue in Medicare are not promiscuously intermingled, but fund distinct programs. Medicare Part A, which pays for hospitalization, is financed almost entirely by the Medicare portion of the payroll tax, 2.9%. Medicare Part B, which pays for doctor's visits, is financed by general revenues, 75%, and patient premiums, 25%. In addition, there is Medicare Part C, which allows individuals to obtain healthcare services through a provider plan, funded by Medicare Parts A and B, and Medicare Part D, a voluntary plan which provides prescription drug coverage and is paid for by Medicare plus individual premiums. If Medicare can have Parts A, B, C and D, with distinct funding streams, then why can't Social Security also have distinct components with distinct funding streams? This would be preferable to the politically likely alternative of repeated bailouts of Social Security in its present form with the aid of general revenues, perhaps in multi-year patches, once revenues fall short of promised benefits a generation from now. We propose replacing the present incoherent mix of Social Security, tax-favored employer pensions, including state and local public employee pensions, and tax-favored retirement savings accounts with a single, purely public two-tier expanded Social Security system. The first tier of expanded Social Security would be a universal, flat benefit, indexed to inflation and equivalent to the minimum wage, once the minimum wage has become an above-poverty living wage. It would be funded by general revenues or a dedicated tax, such as a portion of a VAT. This new, universal first tier of the new American retirement security system could be created by the universalization and expansion of the present Supplemental Security Income, SSI, program for the poor and disabled, which is funded out of general revenues. The second tier of expanded Social Security would be a public-defined benefit pension, reflecting variations in lifetime earning among individuals through higher benefits, within limits. It would be paid for solely by the payroll tax. This public pension would be a version of today's Social Security, or OASDI. Because most or all Americans would receive both the universal, flat Social Security benefit and the earnings-dependent Social Security benefit, the latter might be reduced, to permit a corresponding reduction of payroll taxes, without reducing the overall income of most American retirees from the new Social Security system as a whole. Along with the new two-tier public retirement security system, tax breaks for private retirement saving would be eliminated. The increase in the Social Security replacement rate, by the combination of the first and second tiers of the new system, would greatly reduce the need for most Americans to put aside additional money for retirement. Those who chose to do so nevertheless should be taxed at a capital gains rate equal to the rate of taxation imposed on income earned by wage labor. The U.S. economy might benefit from an end to the misallocation of resources produced by an inadequate public social insurance sector and a bloated tax-favored private savings sector. At the same time, an expansion of Social Security payouts would have a permanent positive effect on the real, productive economy. Lower-income people are more likely to spend an extra dollar on goods and services, and decreasing the amount of retirement income that comes from tax-favored private savings accounts may also discourage asset bubbles from developing in the future. Proposals to increase retirement security by expanding Social Security are likely to find widespread public support. By large majorities, Americans support raising taxes for Social Security over cutting benefits. An August 2012 Associated Press poll found that 53% of adults said they would rather raise taxes to pay for Social Security for future generations than cut benefits, while only 36% said they would cut benefits. And according to a 2009 poll, 3 times as many Americans said that too little rather than too much is spent on Social Security, 45% to 15%. 66% agreed with the statement that with the economic crisis and the stock market crash, it's more important than ever to strengthen Social Security to make sure that retirees and the disabled can count on secure benefits for generations to come. Most American social insurance programs are not purely federal, like Medicare and Medicaid, but partly federal and partly state programs, like Medicaid, SCHIP, and unemployment insurance. Medicaid is administered by states with federal matching funds that vary inversely with a state's per capita income. The most important issue facing Medicaid, along with healthcare in general in the United States, is controlling the rapidly increasing costs. While the Affordable Care Act will increase the number of people who will have some form of health insurance and eliminate some cost inefficiencies in the system, it did not address much of the underlying and unsustainable cost structure. The federal-state funding combination exacerbates the cost issue for Medicaid. As noted, state governments struggle to meet their financial obligations during downturns, and thus important social programs end up being pro-cyclical drags on state budgets. It is not sensible to have states be responsible for social programs that are central to the lives and well-being of many Americans when they cannot undertake counter-cyclical spending by running deficits when necessary. Freeing states from these debilitating funding issues would also give them more flexibility and ability to pay for other important programs that are being squeezed out by Medicaid costs at the state level. States have had to cope by cutting reimbursement rates or freezing payments to hospitals. As a result, patient access to quality care is in jeopardy. Converting Medicaid into a federally run program similar to Medicare would allow the government to set a federal reimbursement level that would likely lead to higher participation from providers. Moving toward Medicaid as a federal program should have 2 primary elements, according to a proposal by Greg Anrig. First, the federal government should assume all costs of dual-eligible Medicaid and Medicare patients, removing the onus of dual-eligible Medicare premiums and long-term care away from the states. Second, the federal matching rates for Medicaid should be gradually ratcheted up until the federal government assumes all costs. The Medicaid provisions in the Affordable Care Act set the stage for this approach to work successfully. One basic reality is quite simple. The central fiscal problem confronting both the federal government and the states is the prospect of a continuation of rapidly rising healthcare costs. For the states, relieving them of the number one obligation causing their financial distress would enable them to regain the capacity to function much more effectively. For the federal government, taking over Medicaid would entail large new outlays, but it would also create much greater leverage in directly confronting the underlying problem of soaring medical inflation. Logistically, there are two primary approaches that should be pursued to phase in federalization of Medicaid. One entails federal assumption of the full cost of dual-eligible Medicaid and Medicare beneficiaries, and the other involves ratcheting up federal matching payments for Medicaid and CHIP until the 100% threshold is reached. If Medicaid were to be federalized, that would create new possibilities for later merging it with Medicare, or a new public insurance plan that would be made available to everyone on the state insurance exchanges, which in turn could become federalized as well. In 1982, President Ronald Reagan proposed a grand bargain. The federal government would become entirely responsible for financing Medicaid in exchange for giving states responsibility for more than 40 other federal programs, including aid to families with dependent children, the primary welfare program that President Clinton and Congress would radically reform 14 years later. Previously, in 1969, 1977, and 1981, the U.S. Advisory Commission on Intergovernmental Relations, which comprised officials in all levels of government, had recommended that the federal government assume full financial responsibility for all public assistance programs, including Medicaid. The Commission argued that its ideas would greatly improve an intergovernmental system that had grown more pervasive, more intrusive, more unmanageable, more ineffective, more costly, and above all, more unaccountable. Reagan's plan entailed basically the opposite of what the Commission suggested, moving programs to the states, with the important exception of Medicaid. The motivation behind Reagan's proposal was ideological, the promotion of what he called a quiet federalist revolution aimed at removing the federal government from a wide range of domestic activities while discouraging states and localities from replacing Washington's efforts. Even so, there was widespread agreement that radical change was needed to fix the nation's deeply dysfunctional system of federalism. The sorting out idea never gained much traction, however, largely because of opposition from state officials. Reagan ended revenue sharing, reduced grants to state and local governments, and slowed spending on Medicaid and other safety net programs. In addition, the large deficits created by his 1981 tax cuts and generous defense spending became an ongoing rationale for austerity. More than 3 decades later, federal-state relationships remain no less dysfunctional. The tumultuous legal and political battles over implementation of the Patient Protection and Affordable Care Act, known as Obamacare or the ACA, which is scheduled to take full effect in 2014, have laid bare why America's highly decentralized system of federalism impedes effective responses to national challenges. The healthcare legislation extends coverage to the uninsured through 2 main channels, both of which were intended by Congress to intimately involve the states. One of these is an expansion of Medicaid, the state-administered insurance program for low-income Americans and nursing home residents that is jointly financed by the federal and state governments. The other is through the creation of so-called insurance exchanges, which are governmentally organized and regulated marketplaces where uninsured Americans and small businesses can shop for health plans while paying premiums that will be partially covered by the federal government. On both the Medicaid and insurance exchange fronts, unforeseen developments have greatly bogged down progress, and the decentralized system has exacerbated some of the issues. The Supreme Court erected the surprise Medicaid hurdle in Chief Justice John Roberts' ruling upholding the constitutionality of the Affordable Care Act, allowing states to opt out of the legislation's requirement to extend Medicaid coverage to Americans with incomes up to 138% of the poverty level. That decision opened up an escape hatch that at least 10 states have already jumped through and another 5 are leaning toward, with an additional 12 remaining completely undecided. Even though states would likely end up saving money from expanding Medicaid due to reductions in what they currently owe to medical providers for non-Medicaid uncompensated care, it is possible that as many as half of all the states will fail to adopt that foundational element of Obamacare upon its launch in 2014. Even worse from the standpoint of feeding public hostility to the law are the roadblocks that have emerged to rolling out the insurance exchanges. In many respects, uninsured citizens will form their judgments of healthcare reform based on their experiences with those exchanges, much as taxpayer views about government are shaped by their interactions with motor vehicle departments, the Internal Revenue Service, and post offices. While exchanges have often been analogized to commercial websites like Expedia.com, they are far more elaborate operations requiring a regulatory apparatus whose responsibilities include determining about which plans to include and exclude from the exchanges. Another central problem facing the exchanges is how to minimize adverse selection, which arises when certain plans or exchanges enroll a relatively high-cost group of beneficiaries that leads to escalating premiums. Preventing and responding to adverse selection is an enormously difficult regulatory challenge that is essential to keeping the new system from unraveling. In addition, health insurance plans are inherently complicated, so developing user-friendly interfaces to clearly present options to consumers will be critical to minimizing aggravation and enabling people to make sensible choices. Moreover, the exchanges are the mechanisms by which consumers are supposed to be able to learn the amount of their government subsidies for premiums and whether they are eligible for Medicaid. All of those responsibilities were expected to be daunting for the exchanges under the best of the circumstances. Optimists had predicted that governors would have a strong interest in creating and managing their state exchanges effectively to receive credit from their constituents and avoid blame. But instead, only 18 states have taken up the challenge so far, with at least 25 defaulting the responsibility to the federal government. Political opposition has played an important role in many of the decisions to cede responsibility to the federal government, but in some cases administrative obstacles and difficulties in reaching a consensus about how to manage the exchanges have also bogged down the process. As a result of so many states demurring or dithering over whether to create exchanges, the Department of Health and Human Services has been left with an unexpectedly colossal job for which it is ill-prepared and inadequately financed. Notwithstanding all of these unanticipated impediments to its federalist components, the Affordable Care Act remains a major step toward a more centralized health insurance system. States that have opted out of expansion, mainly due to ideological opposition, are likely to experience intense political and economic pressure to eventually go along with the broadened eligibility threshold in exchange for federal largesse that would flow to healthcare providers and beneficiaries. Because the federal government will bear nearly 93% of the costs of Medicaid expansion from 2014 to 2022, a much higher share than it provides for current enrollees, states that continue to resist will be depriving their residents and medical institutions relative to participating states in ways that are likely to become highly visible and difficult to sustain. As the lion's share of states come to adopt the new broader eligibility threshold and the higher federal matching rate that comes with it, the federal government will gain greater leverage to exert control over additional reforms to the program. The next major medical care legislation should carry the centralizing shift in control over Medicaid to its logical conclusion: full nationalization of Medicaid, which would greatly enhance both the health of the American population and of the nation's system of federalism. Converting Medicaid into a national program like the Superior Medicare model, which covers virtually all of America's elderly through rules and payment schemes that are consistent throughout the country, would relieve state governments, even the recalcitrant ones now resisting healthcare reform, of what has genuinely become an unmanageable financial burden. Soaring Medicaid costs, driven by rising enrollments and many of the same forces escalating inflation throughout the healthcare sector, have ensnared most populous states in a chronic budget squeeze that relentlessly forces cuts in education, social services, and other essential state-level functions. Even though state revenues have rebounded somewhat as the slow recovery continues, forecasts show that most states can expect to remain austere indefinitely as they comply with balanced budget requirements that don't apply at the federal level. Setting aside the reform bill's changes to the program, which impose a minimal new burden on states notwithstanding Republican rhetoric, Medicaid as a whole really does threaten to crush state budgets throughout the country unless responsibility for it is further shifted entirely to federal control where it belongs. Federalization would end the wide disparities among states in the share of the cost they owe per beneficiary relative to the federal contribution, a long-standing historical artifact without logical justification. Although the Affordable Care Act attempts to minimize disparate fiscal impacts among states as they implement the law, large variations will remain in the state's share of the cost per Medicaid recipient. Complex administrative difficulties will arise as a consequence of the new federal matching payment schemes, which full nationalization could ultimately eliminate. In addition, transferring Medicaid's financial burden and administrative responsibilities from states to the federal level would create major new opportunities for controlling medical costs while enabling a greater share of lower-income Americans to receive better care. And because the federal income tax is much more progressive than state revenue systems, federalization would move a higher portion of Medicaid's costs onto Americans who can better afford to bear them while reducing administrative costs through economies of scale. Politically, state-level unhappiness over both the mandated Medicaid changes in the healthcare legislation and the program's central role in the chronic state fiscal quagmire has the potential to eventually unite red and blue state leaders in a push for federalization. With enrollment of non-elderly Americans in Medicaid and the CHIP plan for children projected to increase by about 25% to 43 million by 2022, even after taking into account the negative impact of the Supreme Court decision, the program's myriad shortcomings can be expected to attract greater public attention and scrutiny than in the past. While it has long been apparent to most policy analysts that those flaws largely derive from Medicaid's bifurcated federal-state status, Medicaid's centrality to the health reform bill may well lead a critical mass of political constituencies to recognize that the unavoidable next step for reform is federalization. States' rights advocates may come to see that shedding Medicaid obligations through federalization would liberate state governments to pursue their own goals more freely while cutting state taxes. Even some deficit hawks worried about the federal debt, who can be expected to be the strongest opponents of federalization, may be persuaded that Congress can better constrain Medicaid's costs when it fully controls the program. However the politics of the issue plays out, the changes set in motion by the Affordable Care Act are likely to build an even stronger substantive and political case than previously existed for federalizing Medicaid. Obamacare's heavy reliance on states to carry out reforms to cover the uninsured, including the creation of state-based insurance exchanges along with the Medicaid expansion, perpetuates the nation's long history of decentralized support for the disadvantaged. Before the New Deal, domestic federal spending was only about 20% of state and local outlays. Only the old age pension provisions of the 1935 Social Security Act devised an entirely federal system, while funding and implementation responsibilities were shared between the national and state governments with respect to unemployment insurance and supports for needy women, children, and the elderly. Race loomed large in the congressional debates leading up to the creation of America's social insurance system, with representatives of southern states largely winning their demands to retain control over determining eligibility and benefit levels to prevent interference in how they address the Negro question. That pattern continued as federal support for medical care evolved, beginning with 1950 amendments to the Social Security Act authorizing federal payments for health care expenses of individuals deemed needy by states. The 1960 Kerr-Mills Act, which extended coverage to medically indigent individuals over 65 not receiving Social Security's old age assistance, established a federal matching percentage ranging from 50 to 80% of state outlays, varying inversely with a state's per capita income. That basic formula became enshrined in Medicaid upon its enactment 5 years later, with a top matching rate of 76% for the poorest states, and essentially continues to this day. Arkansas Democrat Wilbur Mills, the fiscally conservative chairman of the House Ways and Means Committee, designed Medicaid to be both independent of Medicare and administered through a joint federal system in part to prevent Medicare from becoming the entering wedge for a nationwide compulsory system of health insurance for everyone. The upshot is that the least populous and economically poorest states, which are apt to be most disdainful toward the federal government, also receive a disproportionate share of national support for Medicaid. Indeed, most of the states opting out of Medicaid expansion would receive substantially more per capita from the federal government than those that are adopting the broader eligibility provisions. The Children's Health Insurance Program, CHIP, created in 1997 to extend coverage to kids from low-income households not eligible for Medicaid, has higher federal matching rates ranging from 65% to 83%. Those levels have the effect of reducing the cost to a state of covering a child by 30% when compared to the regular Medicaid matching rate. Although CHIP is a companion program to Medicaid, it differs in that it makes a capped amount of money available to states as a block grant each fiscal year. Under the Affordable Care Act, the federal government will pay the entire freight from 2014 to 2016 for individuals who become newly eligible for Medicaid under the mandated standard of 138% of the federal poverty level, almost all of whom will be childless adults. That matching rate gradually ratchets down to 90% by 2020, where it will remain thereafter. The law also includes provisions providing some financial relief to relatively generous states that already allowed low-income adults without children to enroll in Medicaid. Otherwise, they would essentially be punished for their past generosity with much lower federal matching rates for existing beneficiaries than states that never covered childless adults will receive. At least 7 states, Arizona, Delaware, Hawaii, Maine, Massachusetts, New York, and Vermont, will receive enhanced matching rates for childless adults who have been enrolled in Medicaid as of December 1, 2009. In addition, beginning in October of 2015, states will receive an increase of 23 percentage points, up to a maximum of 100%, in their CHIP match rate. While it's laudable that the healthcare legislation's much higher matching federal rates for new enrollees include some supplemental assistance for states that pave the way to reform, the wide assortment of payment levels both among and within states, and from one year to the next, defies any sane non-political justification and poses all kinds of costly administrative headaches. Why, say, should the federal government pay the full cost of a newly eligible 35-year-old man in Arkansas earning 125% of the poverty level while requiring California to foot half the bill for a pregnant woman with the same income? Greatly compounding the confusion is the fact that many individuals who are already eligible for Medicaid under a state's existing rules but who only sign up later as a result of the legislation's individual mandate, new outreach measures, or some other factor, may not receive the higher federal matching rate. Particularly for enrollees with incomes near a state's previous eligibility threshold as of the December 2009 cutoff date, sorting out the appropriate payment level after the new system takes effect in 2014 will be difficult. The Federal Center for Medicaid and CHIP Services has been working with states to develop alternative methodologies to make such eligibility determinations, but there will be no simple solution. In manipulating the federal matching formulas to induce much higher Medicaid enrollments and cooperation from states, Congress has twisted the system's always problematic payment scheme into contortions that may no longer be workable. One undeniable argument for complete federalization is that it would in one fell swoop eradicate the impossible to defend, difficult to implement variations in state financial responsibility for Medicaid enrollees across the country. That the Health Care Act initially provides full federal funding for new enrollees in order to maximize state cooperation and recruit as many beneficiaries as possible in its own right suggests that eliminating the state financing obligation altogether is the path toward making the entire system work better. In addition to Medicaid's wide variations in matching rates and eligibility criteria, the program has long been plagued by other shortcomings that the Affordable Care Act attempts to redress to some extent, but which would much more effectively be resolved under full federalization. Those problems include states failing to enroll residents who are eligible for coverage, constraints that limit the access of Medicaid beneficiaries to decent care, rapidly rising costs that are the single biggest cause of chronic state budget shortfalls, and poor coordination of services for high-cost individuals covered by both Medicare and Medicaid. Briefly, here's why building on the Healthcare Reform Act to move further toward full federalization would be even more effective at overcoming those problems. Before welfare reform in 1996, eligibility for Medicaid was linked to qualifying for aid to families with dependent children, which stigmatized Medicaid and connected it to an enormously cumbersome application process and hostile bureaucratic culture. Although some states have made great strides since then in streamlining Medicaid's sign-up procedures and reaching out to enroll eligible low-income pregnant women and children, a large proportion of those who qualify for coverage remain uninsured. A 2008 study by the National Institute for Healthcare Management Foundation concluded that about 1 in 4 non-elderly Americans without health coverage, or about 12 million people, were eligible for Medicaid or CHIP but not enrolled in them. Another report by the Kaiser Commission on Medicaid and the Uninsured, which focused on 13 states, found wide variation in enrollment rates among them, with Mississippi at the low end covering only 36% of residents eligible even under its very limited criteria. The health care bill includes reforms intended to substantially increase Medicaid take-up rates, including the individual mandate requiring everyone to sign up for some kind of coverage to avoid a fine. Other constructive provisions in the legislation include elimination of asset tests that many states still apply in determining eligibility of adults, adoption of a uniform method for determining income eligibility, called modified adjusted gross income, in contrast to widely varying systems among states, and greater state discretion to presume individuals are eligible with minimal paperwork. In addition, the law requires states to establish a website through which residents can apply for Medicaid or CHIP as well as the coverage offered in state-based exchanges. In the aftermath of healthcare reform's enactment, Kaiser and Lake Research Partners interviewed Medicaid program directors and other experts on questions related to improving outreach and enrollment in the program. The consensus view was that the legislation presented an opportunity to foster a new culture of coverage and recast the program as the source of affordable coverage for working people and families, in contrast to its stigmatized past. Some states, thanks largely to CHIP and its extension of coverage to children from families with incomes significantly above the poverty level, made important progress in simplifying Medicaid enrollment and renewal processes for children. Doing the same for adults, the Kaiser report argues, will require a culture shift to reorient Medicaid management, systems, and caseworker training away from welfare-style gatekeeping and toward encouraging participation. Transforming any culture, particularly in a state governmental bureaucracy, is inherently slow and uncertain work that at a minimum requires leadership committed to changing the ways that employees view their jobs. Notwithstanding all of the sound reforms in the healthcare bill intended to streamline the Medicaid enrollment process, many states, especially those balking at Medicaid expansion, may not be dedicated to undertaking changes in their bureaucratic culture because their top officials resent everything about the law. The federal government can try to encourage those states to reach out to newly eligible low-income adults, and even finance almost the entire cost, but there's every reason to expect recalcitrance that will leave large gaps between Medicaid eligibility and actual enrollment. Only full federalization could overcome that basic problem by transferring ultimate responsibility for administering the program to federal authorities. Because federal rules define categories of services that Medicaid must cover, and because the stimulus and healthcare bills have temporarily prohibited states from weakening their eligibility criteria, states facing budget shortfalls are left to reduce Medicaid spending mainly by squeezing the rates they pay to medical care providers and cutting back coverage of non-mandatory services. In the years following the Great Recession, most states significantly cut Medicaid provider rates and benefit packages. Only in fiscal 2013 has that pressure on reimbursement levels and benefits finally begun to abate. Those reductions and constraints have had the effect of limiting the treatment options available to many Medicaid beneficiaries. A study by Sandra L. Decker of the National Center for Health Statistics found that in 2011, 31% of physicians were unwilling to accept any new Medicaid patients, compared to 17% unwilling to accept new Medicare patients and 18% privately insured patients. Controlling for other factors, acceptance rates of new Medicaid patients were lower in states with lower Medicaid to Medicare fee-for-service fee ratios. The state with the lowest percentage of physicians accepting new Medicaid patients was New Jersey, about 40%, which also has the nation's lowest Medicaid to Medicare fee ratio. Other studies have determined that the care of Medicaid patients has become increasingly concentrated among a relatively small proportion of doctors who tend to practice in large groups, hospitals, academic medical centers, and community health centers. Some of those hospitals receive higher reimbursements provided by the federal government for treating a disproportionate share of Medicaid and uninsured patients. Researchers Peter Cunningham and Jessica May didn't assess the quality of care in those centers, but concluded, if these Medicaid providers experience increased financial pressures and rising patient demand, quality of care and access to some services could be negatively affected. In 2008, Medicaid's reimbursement levels to healthcare providers nationwide were only 72% of those for Medicare. In New York, New Jersey, and Rhode Island, they were less than half of Medicare's rates. Not coincidentally, New York also ranked dead last among the states in preventable hospitalizations and poorly on other measures of healthcare quality by the Commonwealth Fund, even though its Medicaid program covers a broader array of services than most states offer. A variety of forces contribute to New York's bad record, but low reimbursement rates are an important factor partly because they lead many Medicaid patients to be treated in overcrowded institutional settings that often fail to offer adequate individual attention. 18 Many states also have been cutting back Medicaid support for particular services, leaving low-income individuals with special needs in the lurch. Among the most vulnerable are the disabled and those with mental health issues. Even though the average cost for disabled Medicaid patients has declined relative to inflation over the past 15 years as institutional care for them became supplanted by less costly in-home services, many states desperate for savings have reduced coverage of home-based care. In addition to creating hardship for the patients, those reductions ultimately could boost Medicaid costs by forcing some of those individuals to return to institutions. The healthcare bill includes a number of constructive changes aimed at helping to address these access problems for Medicaid patients. For example, it requires states to pay full Medicare rates for primary care services in 2013 and 2014, with the payment increase entirely financed with federal money. It also provides additional funds for community health centers, which provide care for many Medicaid patients. Typically, they are found in low-income areas, are open after hours, and can serve as an alternative to the emergency room. When a Medicaid patient receives basic care in an emergency room, the bill is needlessly inflated by the costs of ERS technological equipment, which may not be needed for patients suffering from relatively minor problems. Community clinics can save money while giving Medicaid patients continuity of care in a setting better suited to their needs. Unfortunately, these clinics are also highly vulnerable to federal and state budget cuts, as Congress demonstrated in 2011 by reducing the money initially made available in the Affordable Care Act for new centers. In and of itself, the sizable and sometimes yawning gaps between Medicare and Medicaid reimbursement rates to healthcare providers sustains Medicaid status as a second-tier welfare program. With states likely to remain under relentless budgetary pressures, they can be expected to continue to look for savings through relatively blunt and painful Medicaid cuts that primarily affect low-income residents who lack political clout. Federalization wouldn't eradicate those political forces by any means, but it would help to greatly reduce the fragmentation in the healthcare system that creates so many inefficiencies and inequities, including the poor access to high-quality care available to Medicaid beneficiaries in many states. Setting reimbursement levels at the federal level has helped Medicare to sustain a much higher degree of provider participation and enthusiasm than Medicaid has experienced. Federalization would greatly increase the probability that Medicaid reimbursement levels would be linked nationally to Medicare's, reducing state-to-state variability in access to quality care while broadly improving it across the country. Like private health insurance and Medicare, Medicaid has experienced cost increases well in excess of overall inflation during most years of the past few decades. In part, the same forces that have driven soaring medical inflation throughout the U.S. system are responsible, including rapid adoption of expensive new technologies and the prevalence of fee-for-service compensation that rewards the performance of procedures that are often not medically necessary or appropriate. But Medicaid's costs also climbed rapidly before leveling off because of large enrollment increases arising from the recession, which knocked incomes beneath eligibility thresholds for a larger share of the population. The improving economy in fiscal 2012 helped to reduce the overall increase in total Medicaid spending to 2% as enrollment growth plummeted and healthcare costs generally flattened out. While some analysts have expressed optimism that industry-wide adjustments in anticipation of the Affordable Care Act's full implementation are already helping to contain costs, broader economic forces seem most likely to be responsible for the recent lull in medical inflation. One of the most universally praised elements of Obamacare, even from some Republicans who opposed it, is its inclusion of provisions intended to simultaneously control costs while enhancing the quality of care. Those changes largely focus on Medicare, since it's the program over which the federal government can exert the most control. Innovations like the creation of an independent payment advisory board to make cost-effectiveness recommendations for Medicare, adjustments to Medicare payment changes tied to the productivity of providers, and numerous other large and small experiments have the potential to help achieve the Obama administration's goal of bending the healthcare cost curve. Whichever of those cost control strategies turn out to work best would be much more powerfully transmitted throughout the healthcare sector if they could be applied nationwide to Medicaid as well. Some states are emulating various cost savings ideas. One long-standing difficulty with the nation's past unsuccessful efforts to rein in costs has been the system's propensity to react like a squeezed balloon. Controlling spending in one realm can lead to expanding outlays somewhere else in the system. For a time in the 1990s, the increased adoption of managed care plans by private insurers helped to hold down their costs, but Medicare simultaneously experienced more rapid inflation. Before that, changes in Medicare that succeeded in constraining its costs coincided with soaring spending in the private insurance market. If successful cost control tactics could be carried out together by Medicare and Medicaid, the federal government would have greater leverage over the entire balloon. But that would only be possible to implement in earnest if Medicaid were to be fully federalized. In the absence of federalization, projections by the Government Accountability Office show that state governments will be squeezed in an ever-tightening budgetary vice even after the economy fully recovers. Even though the new healthcare bill in its own right won't add much pressure, the ongoing Medicaid responsibilities for states, as well as their pension and medical insurance commitments to current and former state workers, will be so burdensome as to leave them in a perpetual austerity mode. With all states but Vermont legally obligated to maintain balanced operating budgets each year, the GAO calculated that closing the projected fiscal gaps would require action to be taken today and maintained each and every year going forward, equivalent to a 12.7% reduction in state and local government expenditures, or comparable tax increases. For state budgets, healthcare commitments are like Otto, the relentlessly expanding pet goldfish in the children's book. The Congressional Budget Office projects that state spending for Medicaid and CHIP would amount to about $2.6 trillion from 2014 through 2022 without healthcare reform, plus another 2 to 3% more to be added because of the legislation. Point 22. But while deficit hawks will recoil at the thought of shifting that burden from the states to the federal government, keep in mind 5 realities. 1. Americans have to pay the Medicaid bill one way or the other, whether out of their federal or state taxes. 2. Because state sales, sin, and flat income taxes are regressive, low and middle-income Americans bear a greater share of that cost than they would if it were paid through the much more progressive federal income tax. 3. Constraining costs would be much more manageable under a system in which one level of government bears full responsibility for the program's success, in contrast to the divided federal-state accountability responsible for Medicaid's myriad shortcomings. 4. Because the federal government is not bound by balanced budget requirements that govern states, the widespread public health problems that worsen during economic downturns can be much more effectively mitigated. And 5. By relieving state budgets of Medicaid, governors would regain the flexibility to much more effectively manage their states. If federalizing Medicaid seemed like a good idea to Ronald Reagan, who proposed it in 1982, Republicans and other deficit hawks ought to think harder about the possibility rather than dismissing it out of hand. About 8.9 million Medicaid beneficiaries are enrolled in Medicare as well, according to the most recently available figures from 2007. About 60% of those dual eligibles are frail elderly Americans with very low incomes, many of whom live in nursing homes. Most of the remainder are low-income individuals with disabilities. Although dual eligibles constitute only about 15% of Medicaid enrollees, around 40% of the program spending is devoted to these especially unhealthy and impoverished individuals. Medicaid pays for their Medicare premiums and cost sharing, as well as important benefits that Medicare does not cover like long-term care services. Because dual eligibles are among the costliest of Americans for the federal and state governments to insure, and because both payment structures and medical care for them tend to be highly fragmented, they are an important focal point for reform. The healthcare bill included numerous provisions intended to streamline care and coverage for dual eligibles, including higher federal matching payments to states for creating a single entry point system for access to long-term care systems and supports, and applying standardized methods for determining eligibility for non-institutional services. Additional federal money is also available to states for facilitating the transition of nursing home residents to home and community-based systems of care, among other incentives. Moreover, the legislation established a new office in the Centers for Medicare and Medicaid Services charged with improving coordination between the Medicare and Medicaid programs on behalf of dual eligibles. While all of those reforms are constructive, their reliance on incremental increases in federal matching rates to induce changes in state policies toward dual eligibles is a cumbersome, highly uncertain, and administratively costly lever to rely on. Some states will no doubt ignore the incentives entirely, while others will pick and choose among them, once again yielding highly scattershot outcomes across the country. Here, too, the legislation moves in the right direction while underscoring that Medicaid federalization would be a much more reliable, effective, and cheaper way to achieve the desired results. Unfortunately, debates over America's fiscal condition invariably focus on the outlook for the federal budget while neglecting how any sensible accounting of governmental revenues, outlays, and debt ought to integrate states and localities as well. In America's highly decentralized system of government, federal and state budgets are inextricably intertwined in myriad complex ways. But one basic reality is quite simple. The central fiscal problem confronting both the federal government and the states is the prospect of a continuation of rapidly rising healthcare costs. Viewing that challenge through the rarely used lens of federalism rather quickly clarifies that one of the most promising strategies for controlling those costs in ways that would ultimately strengthen the fiscal condition of both levels of government would be to federalize Medicaid. For the states, relieving them of the number one obligation causing their financial distress would enable them to regain the capacity to function much more effectively. For the federal government, taking over Medicaid would entail large new outlays, but it would also create much greater leverage in directly confronting the underlying problem of soaring medical inflation. In the process, the cost of providing health care to lower-income Americans would shift toward those who can most afford it under the federal government's more progressive tax structure. Not incidentally, more citizens would be likely to receive better care in good times and bad regardless of what state they live in. The Affordable Care Act, which pushed Medicaid in the direction of federalization across the broad array of fronts summarized in this brief, demonstrates that there is political support to at least move in that direction. And the opposition of many conservative states to the legislation's Medicaid mandates suggests that at least some conservatives might be persuaded that, from a states' rights perspective, complete federalization would be preferable to more mandates. The primary political challenge will be to convince deficit hawks that federalization is one of the most promising strategies for controlling healthcare costs, which in turn is far and away the best way to improve the long-term fiscal outlook at all governmental levels. In that context, a politically acceptable approach for financing the added federal costs would need to be agreed upon, as it was for the healthcare bill with its higher taxes on investment income and costly employee health insurance plans. Part of that sales job will include emphasizing the corresponding reductions in state taxes relative to what they would otherwise need to be. Logistically, there are two primary approaches that should be pursued to phase in federalization of Medicaid. One entails federal assumption of the full cost of dual-eligible Medicaid and Medicare beneficiaries, and the other involves ratcheting up federal matching payments for Medicaid and CHIP until the 100% threshold is reached. In both cases, a variety of alternative steps could be pursued to make the transition as the federal government takes over increasing responsibility for the program's implementation, Researchers from the Urban Institute and the Robert Wood Johnson Foundation calculated that fully 80% of the cost of dual eligibles is already covered by the federal government, with the states paying $62.7 billion of the $319.5 billion spent on those individuals in 2011. More than 70% of the state outlays are directed toward long-term care services. 25 In and of itself, federalizing only the dual-eligible population would provide substantial financial relief to the states while greatly enhancing opportunities to improve coordination of the care of these especially unhealthy and poor individuals. And because they are unusually expensive as well, implementing cost-effectiveness strategies nationwide, especially with respect to long-term services, could help to make a significant dent in overall healthcare inflation. The Medicare Payment Advisory Commission estimated that shifting dual-eligible patients from Medicaid-financed nursing benefits to Medicare-financed hospital and skilled nursing facility benefits could potentially reduce costly rehospitalizations between 18% to 40%. Concentrating accountability at the federal level would create a much more transparent and robust regulatory environment for improving the system over time. The healthcare reform bill's full federal funding for newly eligible Medicaid beneficiaries from 2014 through 2016 puts a foot in the federalization door that the Obama administration and Congress should try to walk through with the next round of reforms. Instead of implementing the slight reduction in federal support for those individuals beginning in 2017, the 100% rate for newly eligible enrollees should be made permanent. And to rationalize Medicaid's jerry-rigged payment system at long last, matching rates for everyone else should also be increased over time so that ultimately the federal government pays full freight for everyone. One way to do that would be to restore the higher matching rates that were temporarily put into effect in the stimulus legislation that Congress enacted during the financial crisis. Then, after a period of time, those rates could be further increased until every state's beneficiaries were fully covered by the federal government. Raising the existing baseline rates across the board by the same number of points would help to minimize infighting among the states. Alternatively, Medicaid matching rates could be raised to the higher post-healthcare reform CHIP levels as a next step, and then increased from there until full federal funding is reached. Although states are projected to spend about $2.7 trillion on Medicaid from 2014 through 2022, the price tag of federalization could be reduced significantly below that figure by gradually phasing in the changes beginning in that period and extending into the next decade. Still, the cost to the federal government will be significant, just as the savings will be to the states. Financing the transition to Medicaid's federalization and then sustaining a sufficient level of support going forward should probably entail some combination of an additional source of revenue deriving from upper-income taxpayers coupled with a modest payroll tax increase on all workers that would be earmarked for services provided to current dual eligibles. Because taxing income from investments at the same rate as income from work would enhance both the fairness and simplicity of the tax code, and would emulate changes made under President Reagan in 1986, that reform would be sensible policy in its own right and would go a long way toward financing the transition to Medicaid federalization. The recent tax code changes reducing the favorable treatment of capital gains and dividend income are an important step in that direction, though the additional revenue is not earmarked for any purpose. Although raising the existing Medicare payroll tax to help finance the transition to Medicaid federalization would be an arduous sell politically, targeting an increase to pay for long-term care services would be more plausible than a hike to cover the broader Medicaid population. Since literally anyone can end up near destitution due to a disease like Alzheimer's or other severe disabilities, the rationale for requiring all workers to pay into the long-term care protections in the social insurance system is similar to that underlying the universal coverage of Social Security and Medicare. A payroll tax rate increase of about 0.5% would be roughly sufficient to cover the costs of merging dual eligibles into Medicare, which in turn is a little less than half the cost of full federalization of Medicaid. All Americans would ultimately benefit from a much more effective system for providing health care to its most vulnerable citizens, including low-income children, because today's jerry-rigged, scattershot approach is a drain on the economy and is killing state budgets. Increasing federal revenues to pay for the transition would ultimately produce widely shared benefits extending far beyond Medicaid's current and future beneficiaries. By helping to bring overall medical inflation under control, federalizing Medicaid would ultimately pay for itself by squeezing out much of the rampant waste in the existing system. Federalizing Medicaid would by no means be sufficient to repair all that ails America's healthcare system, which will remain deeply flawed even after the Affordable Care Act is fully implemented. But it's an essential next step to further move toward reducing the fragmentation that lies at the heart of the dysfunction. If Medicaid were to be federalized, that would create new possibilities for later merging it with Medicare, or a new public insurance plan that would be made available to everyone on the state insurance exchanges. reducing the isolation of Medicaid's stigmatized population by integrating them into a system that serves the non-poor as well has the potential to improve their health and overall cost efficiency even more. Sooner or later, America's historical enthusiasm for decentralized governance will give way to the recognition that our system of federalism has become broken and unsustainable. Healthcare is the one realm of public policy where fairly straightforward, if politically challenging, reforms could make all levels of government work better while restoring their fiscal health. Like Medicaid, unemployment insurance, UI, is a hybrid program in which states operate their own systems and set their own eligibility standards, tax rates, and benefit amounts. The federal government covers administrative cost and extended UI benefits. This funding system, however, creates incentives for states to underfund their unemployment insurance reserves and minimize eligibility and payout levels. The need for unemployment insurance is countercyclical. When the economy is poor, more money will need to be spent on unemployment insurance, while at the same time less money will be coming into the state from revenues. Approximately 2/3 of states have had their UI reserves run dry in the Great Recession or tepid recovery, leading to further pressure to limit unemployment insurance and putting more hardship on families who are already under-consuming. These state-imposed limitations on UI come in the form of both eligibility barriers and decreased benefits. States have limited eligibility by increasing the requirements for base periods of previous work experience and preventing temporary or contract workers from coverage. The latter provision is particularly problematic as the economy shifts away from an earlier career model of employment that put a greater emphasis on full-time long-term employment for a single employer. And benefits are so low that the average unemployment insurance benefit in 49 out of the 50 states is below the poverty line for a family of 4. An unemployment insurance system that protects workers and provides a sufficient base in periods of unemployment is most sensible and efficient at a federal level. This system should include all hourly workers as potential recipients and replace the mix of federal and state funds with a single federal program. Like Medicaid, the current hybrid structure of unemployment insurance is unstable, tough on state budgets, and often fails to meet an important minimum baseline of benefits, all problems that would be easier to tackle at the federal level. The new social contract that we propose would add a new universal federal entitlement for all citizens to the existing federal programs for retirement security and unemployment insurance, paid family leave for parents of newborns or caregivers for ailing relatives. The American social contract has failed to adjust to social change between the New Deal era, when most mothers were homemakers supported by a husband who earned a breadwinner wage, and the present, in which both parents in the typical family are in the workforce. In the absence of a coherent public policy, families struggle to provide child care by relying on private or non-profit daycare centers, public schools, relatives, or paid domestic workers. The need for a coherent program to help Americans with child care and related caregiving is a key element of a new social contract with American workers. As Lauren Dam argues, expanding access to paid family leave programs across the country can be done either through unfunded employer mandates, federal-state hybrids, or a federal program. Of these three, a federal program is the most efficient and most equitable option. Placing the cost on the employers directly means added pressure on businesses. Federal-state hybrids struggle with cost control and stability during economic downturns, as conflicts over Medicaid funding demonstrate. The last 3 years have taught us many lessons to the contrary. One of the things we have learned from the Great Recession is that America's hybrid state federal unemployment insurance, UI, system is essentially broken. Most workers are not eligible, and many of those who are eligible do not get enough to keep themselves and their families out of poverty. States routinely exclude millions of workers from coverage and deliberately underfund UI systems that they are structurally incapable of operating in the midst of a recession. Our reconstruction of the unemployment insurance system should start from 3 basic principles. First, unemployment is a national problem for our single, national economy, and requires a nationwide system to respond to it. Second, in order to protect the entire workforce from the sudden shock of wage loss and the economy from the sudden shock of consumer spending collapse, all workers need to be inside the system, contributing and protected. Third, unemployment benefits should be set at a sufficient level to keep individuals and families from falling into poverty and should be automatically extended in periods of economic decline and job losses, when normal expectations that people can find new jobs no longer apply. One of the first casualties of the 2007 recession was in the realm of ideas. Prior to the economic collapse, Fed Chairman Ben Bernanke had confidently proclaimed an end to economic catastrophes. The advent of modern central banking and the liberalization of financial markets, he argued, had ensured that the kinds of systemic failures last seen in the Great Crash of 1929 would never happen again. Future recessions would be mild and short-lived, as central banks would spring into action to head off panicking markets, and the automatic stabilizers of the welfare states of the developed nations would kick in to prevent a panic from turning into a long-term slump in demand. The last 6 years have taught us many lessons to the contrary. One of the things we have learned from the Great Recession is that America's hybrid state federal unemployment insurance (UI) system is essentially broken. The unusually sharp job losses, some 8 million jobs lost from the outset of the recession in 2007 to the nadir of job losses in 2009, caused a sharp decline in consumer spending of all kinds. For example, sales of motor vehicles and parts fell by an average of 10.3% during 2008 and 2009, furnishings fell by an average of 6.3%, and transportation services by an average of 7.55%. One of the purposes of our UI system is to prevent sudden downturns in employment in particular sectors, like construction or financial services, from turning into sudden declines of consumer demand that lead other sectors to start mass layoffs of their own. And yet our UI system largely failed to counteract this slump. Most workers are not eligible, and many of those who are eligible do not get enough to keep themselves and their families out of poverty. States routinely exclude millions of workers from coverage and deliberately underfund UI systems that they are structurally incapable of operating in the midst of a recession. If the US is to truly recover from our current Great Recession and prepare for future downturns, we need to take action to reform UI now. When the architects of the Social Security Act designed our unemployment insurance system in the winter of 1934, they were hampered by structural constraints that do not exist today. They sought to cover a very different workforce, in which 10 million workers still worked in agriculture and 14 million or more workers flocked into ever-growing factories. In addition, the members of the Committee on Economic Security, CES, were vividly aware that they had to design a system that could pass review by a Supreme Court that had already struck down minimum wage and maximum hours laws as violations of liberty of contract, and was currently considering doing the same to the Agricultural Adjustment Act and the National Recovery Act. In the face of this expected hostility, CES staff members could not design a simple unemployment insurance (UI) system, financed by a single federal tax and managed solely by a national Social Security Board. Instead, they designed a complicated workaround in which a federal regulatory tax would be forgiven if states enacted their own unemployment insurance systems. This elaborate system was deemed acceptably federalist by the Supreme Court. The system that we know today, where 50 states operate their own UI systems, each setting a different payroll tax rate, eligibility standards, and benefit levels, was not a decision made on principle by all-knowing founding fathers. Rather, it was a nakedly tactical choice made by Roosevelt administration officials who would have preferred to design their system along the same national lines as old age insurance, Social Security. Unlike the new program of old age insurance, however, unemployment insurance had to deal with state institutions already in place. Concerns about a separate federal system that might override or conflict with existing state systems being constitutionally suspect in the eyes of the Supreme Court led to the complicated forgiven regulatory tax system to fund UI. From the beginning, this design created a dangerous vulnerability within the UI system. Because 49 states have a constitutional requirement for balanced budgets and 27 states have constitutional limits on borrowing, states lack the federal government's ability to resort to deficit spending in recessions. When recessions hit, states find themselves in an impossible bind. As consumption declines, sales tax revenue plummets. As businesses shed jobs and go out of business, corporate income tax revenue declines. As workers find themselves without steady paychecks, individual income tax receipts fall. And when millions of homes and business offices go into foreclosure and the real estate market collapses, so too does revenue from property taxes. While state governments stagger under the burden of sudden deficits, millions of previously employed workers desperate for protection against total destitution increase the demands on unemployment insurance, thereby emptying state treasuries at a time when they are least able to respond. What makes this worse is that the state-run nature of the UI system creates powerful incentives for states to underfund their UI reserve funds. Because states must fund their UI system with payroll taxes on local employers, reducing payroll taxes is often the first bargaining chip that states offer when trying to compete with one another to attract new firms from out of state. The lower the payroll tax rate, the cheaper it is to hire workers. Corporations respond to the leverage they have over furiously bidding states to extract concessions so that they do not have to pay in at all, with the state covering their contributions. The result is a dangerous depletion of UI reserves. 35 states and the US. Virgin Islands had to borrow to cover UI payments during the period from 2008 through 2011, with total outstanding loans that peaked at more than $47 billion in mid-2010, because they let their UI funds run dry. 3 years after the peak, 23 states still owe a combined $28 billion. Many states have responded to their vulnerable position by restricting the number of workers who are eligible for UI. This reduces the drain on the system at the expense of workers who will have no protection when they lose their jobs. By keeping contributing requirements high, and by requiring longer base periods, the length of time one has previously worked in order to be eligible for UI, states are able to keep lower-paid workers and temporary workers from gaining eligibility for state funds. Similarly, by restricting eligibility to full-time direct employees, states exclude part-time workers and so-called independent contractors from coverage. To reduce labor costs, employers have responded to these changes by accelerating their project of replacing full-time workers into contingent ones by chopping full-time jobs into part-time jobs and by redefining their workers as independent contractors even when they are working 100% of the time for one company. Looking to further reduce their costs in the current recession, employers have increasingly turned to professional UI claim challenging firms. In addition to restricting eligibility, one of the ways that states have attempted to limit their exposure to sudden increases in UI costs is to keep their benefits as low as possible, replicating the insidious patterns of pre-New Deal poor relief. At the moment, Mississippi, Alaska, Arizona, Delaware, Florida, Louisiana, Missouri, Puerto Rico, Tennessee, and Alabama pay average benefits that are below the federal poverty line for a single individual, and every state pays an average benefit less than the poverty line for a family of 4 with 2 children. Such low levels of unemployment benefits are clearly unable to support previous levels of consumer spending, meaning that these states' UI systems are failing as automatic stabilizers both for people who get benefits and people who do not. Liberal states like Massachusetts lack the fiscal capacity to do much more, paying an average benefit that falls nearly $100 per week below the poverty line for a family of 4. The result of these dodges is a safety net that is mostly made up of holes. This means that a UI system that is supposed to protect everyone does not, which causes dramatic increases in recession-induced poverty, and a system that is meant to keep consumption from falling too far in recessions is fighting with one hand tied behind its back, which leads to dramatic slumps in consumer spending. When consumer spending falls faster than expected, businesses suffer and respond with frantic layoffs, which creates a downward spiral as newly unemployed workers cut back spending faster than employers can reduce labor costs. This is unacceptable from a policy standpoint. Even in the best of circumstances, our current UI system is incapable of keeping consumer spending level, let alone increasing consumption to stimulate the economy. If we want a system that can really protect American workers from job losses and our economy from sudden collapse of demand, we are going to have to do a total refit of our unemployment insurance infrastructure. Luckily, much of the machinery required for creating a functioning unemployment insurance system already exists. Title III of the Social Security Act, which structures the current UI system, can be used to enact changes through the regular amendment process. We already have a federal unemployment insurance payroll tax system in the form of FUTA, which is a 6.2% regulatory payroll tax that is offset by state UI taxes down to 0.8%. We have federal agencies that are familiar with the program and how it works. In this, we have an advantage over the creators of the Social Security system, who had to create this machinery ab nihilo. Our reconstruction of the unemployment insurance system should start from 3 basic principles. First, unemployment is a national problem for our single, national economy, and requires a nationwide system to respond to it. Second, in order to protect the entire workforce from the sudden shock of wage loss and the economy from the sudden shock of consumer spending collapse, all workers need to be inside the system, contributing and protected. Third, unemployment benefits should be set at a sufficient level to keep individuals and families from falling into poverty, and should be automatically extended in periods of economic decline and job losses when normal expectations that people can find new jobs no longer apply. In public policy, everything begins with financing. In order to save the UI system from the inherent weaknesses of state-level government, the federal contribution to unemployment insurance should be gradually increased. As it stands, the federal government contributes the entire cost of running state UI agencies and employment bureaus, as well as 50% of the cost of extended UI benefits. The stimulus bill has temporarily increased the federal contribution to 100% of extended benefits. This federal contribution could be increased in a series of steps from 25% of the regular UI to 50%, 75%, and eventually 100%. All that is needed to do this is to reduce the share of FUTA that is offset by state UI taxes, while decreasing state UI taxes in step until we have a national FUTA tax of 6.2%. At the same time, we can make the FUTA more progressive by eliminating the current wage cap, footer is only paid on the first $7,000 in wages, which disproportionately burdens low-paid workers while giving the rich a much lower tax burden, and by varying the rate of taxation according to income level. By replacing 50 different state taxes with one national tax, UI would be greatly stabilized. Federalization would remove the incentive for states to compete for jobs by offering a lower UI tax rate and, by sourcing the financing of UI inside the federal government, would also give the system access to the federal government's ability to engage in deficit spending in a time of crisis. Likewise, establishing a single national UI reserve with clear reserve requirements to prevent the fund from running dry in an emergency would be an enormous improvement in the program stability. Ideally, in good economic years, the UI system would accumulate positive balances that could be spent in recession years, allowing for counter-cyclical spending without large deficits. It is important to note that making the UI system nationally funded does not necessarily mean that the program has to be fully nationalized. A number of options are open. States could continue to administer a federally financed and regulated UI program. UI programs could be run through joint federal-state agencies, or the program could become purely federally administered. The extension of UI coverage to all workers would be the final culmination of a long historical process of inclusion. When the system was first established in 1935, the majority of workers were not eligible for unemployment insurance. Notably, agricultural and domestic workers and seamen were not included. While these exclusions disproportionately affected women and African American workers, it was also the case that a majority of white workers were not eligible for UI at the outset. Eligibility was gradually expanded through a series of Social Security Act amendments over the years. Most recently, the 2009 Stimulus Act included a provision known as the Unemployment Insurance Modernization Act. It offered $7 billion in incentive money for states that adopted alternate base periods that allow workers to claim eligibility for UI by counting their most recent earnings as opposed to the previous year's earnings, and agreed to cover part-time workers who are looking for full-time work and workers who leave work due to family emergencies. The ultimately futile opposition of some conservative governors, not coincidentally from states with low UI taxes, underfunded UI systems, and low benefit levels, had as much to do with states trying to preserve a competitive advantage of low taxes and low labor costs as it did with presidential hopefuls looking to appeal to the conservative base through public defiance of President Obama. This incremental process of expansion should be accelerated, with the ultimate goal being the inclusion of all hourly workers in the UI system, including full and part-time, temporary and permanent, and self-employed and independent contractor workers. At the very least, part-time and temporary workers should be able to claim benefits proportionate to what they would have been entitled to had they been working full-time at their hourly rate. In addition to the participation eligibility standards, the current requirement that workers must accept any offer of work to remain eligible for benefits needs to be altered to prevent two abuses. First, claimants should be entitled to refuse work that is substantially below their current income. This is needed to prevent abuses by which employers engage in mass layoffs, offer to hire back their workforce at reduced wages shortly afterwards, and then use the ensuing refusals as evidence that their former workers have voluntarily refused employment and thus the employer is no longer obliged to cover their UI costs. Second, claimants should be entitled to refuse work if they are in a bona fide labor dispute. This is needed to prevent abuses by which employers deliberately incur strikes and then threaten strikers with the loss of their UI benefits if they refuse to work as scabs and break the picket line. Our unemployment insurance was meant to be a system that lifted up American workers and gave them a sense of security so that they would not be completely vulnerable to unilateral decisions of their employers. To allow these abuses to continue would make a mockery of the spirit of the Social Security Act. In order to prevent recession-induced poverty and to ameliorate recession-induced declines in consumer spending as much as possible, a minimum benefit should be established at the minimum wage rate of $290 a week, $13,920 a year. At the peak of the Great Recession, a UI system that provided all of the 15 million officially unemployed with a minimum benefit of $290 a week would have pumped in an additional $226 billion into consumers' pockets, boosting consumer spending by 2.5%. The existing UI system, which includes state benefits and federal support programs, is only supporting 5.9 million workers. Providing benefits for all of the 12.3 million people who are currently officially unemployed, to say nothing of the 10 to 12 million additional unofficially unemployed, would increase consumer spending and spur job growth, making recessions shorter and less steep, thereby reducing the number of workers who would spend extended periods on unemployment benefit and the ultimate drain on our UI system. In addition, eligibility beyond the initial 26 weeks of benefits should be automatically extended during recessions or periods of widespread unemployment. A further improvement that could be studied is the creation of an additional, contributory benefit for families on UI with children, in order to make up the $237 per week difference between a minimum benefit that keeps a single individual out of poverty and a minimum benefit that keeps a family out of poverty. Such a program would provide a badly needed protection against families falling into poverty and requiring TNF assistance. If these three principles are enacted, nationalized funding, universal coverage, and higher minimum benefits, the US will have a UI system that is up to the task of protecting workers from destitution and the economy from sudden shocks to consumer demand. However, we should be very realistic about what an automatic stabilizer can and cannot do. A revamped UI system will make recessions shorter and shallower, but it cannot prevent them. It will make layoffs less painful and should prevent some second-order job losses caused by falling consumer demand, but it cannot keep people from losing their jobs. And in an economy that is increasingly structurally disposed to shed jobs in recessions and rely on productivity increases, casualization, mechanization, and offshoring rather than rehiring during recoveries, even a high-quality UI system will only be a tourniquet on an open wound. What would be needed for that larger problem is a system that can provide genuine economic security by creating incentives for employers to avoid or reduce mass layoffs. 73 years ago, FDR spoke of the hopeful belief that the nation, seeing and understanding the injustice, was determined to make every American citizen the subject of his country's interest and concern. The same challenge that FDR posed to the America of his day, whether we provide enough for those who have too little, remains unanswered today, and it remains to be seen whether we share the determination to grapple with injustice. 22 million Americans lack for work, and only 6 million of them have any kind of protection. Unless we act to protect the other 16 million, and soon, we will have failed the test of progress. Federal social insurance programs like Social Security and Medicare, on the other hand, have been more successful. The United States is now one of only 6 countries in the world without a policy of statutory paid leave for new mothers, putting us in a group alongside Samoa, Sierra Leone, Liberia, Papua New Guinea, and Swaziland. And the United States is the only OECD country without a mandated amount of minimum paid yearly leave from work. Until 1993, American workers had no protection against losing their job if they had to take time off for personal or family illness or if they needed to care for a new child. The 1993 Family and Medical Leave Act, FMLA, changed this, allowing for workers to take up to 12 weeks of unpaid, job-protected leave for certain medical and family care needs. While the FMLA was a step forward, it still falls far short of a just family leave policy, particularly in a changing economy. For example, exclusions to eligibility under FMLA restrict the policy to approximately half of the workforce, and a disproportionate number of those left uncovered by FMLA are low-income workers. And because it only covers unpaid leave, FMLA does not help those low-income workers who are eligible but cannot afford to take off time from work. A handful of states have supplemented the federal FMLA policy with policies to decrease exclusion and thus make more workers eligible for family leave benefits. In addition, California, New Jersey, and Washington have implemented full-paid family leave programs. The California program provides up to 6 weeks per year of partial paid leave, up to 55% of earnings up to a maximum cap of around $1,000 per week, for caring for a new child or a sick family member. Early results from the California program showed that nearly all employers thought the program had positive or neutral effects, but that many low-income workers were either unaware of the program or unable to afford even partial wages for a period of time. These state programs should be models for a new federal family leave system, which, once implemented, should replace them. Structuring paid family leave as a federal social insurance program, funded by a small federal payroll tax in addition to other payroll taxes, is by far the best approach to guaranteeing family leave for all Americans. While paid family leave would provide paid time for individuals to devote to newborn infants or other purposes, the problem of day care for the children of working parents would remain. One solution would be state and local systems of public nursery schools and preschools, which might be created through an expansion of the existing public K-12 system. Many social conservatives, however, would object that this discriminates against homemakers. A possible compromise would be an enlargement of the social insurance system to fund childcare for infants and preschoolers in a way that allows parents to use the money to purchase tuition at public or private or non-profit institutions or to enable one parent to stay at home. The child tax credit, a refundable federal income tax credit of $1,000 per dependent child, might be replaced with a refundable payroll tax credit. Because it costs lower-income families nearly $10,000 a year to pay for a child, permitting each parent a $2,000 tax credit for each child, or $4,000 per child per year, would effectively socialize nearly half the cost of raising children for families of moderate means. In order not to punish the children of divorced or unmarried parents, the tax credit should not depend on the marital status of the parents. Administering an expanded child care tax credit through the payroll tax system, rather than the income tax system, would be efficient, politically sustainable, and fair. It would be efficient because far more Americans pay payroll taxes than pay federal income taxes. It would be politically popular because the child tax credit, like family leave, would be linked to work effort through the payroll tax. And it would be fair because single, childless Americans, through the payroll tax system, would help to subsidize the next generation of American workers, who in turn will subsidize them in retirement through their own payroll taxes. It is fitting that the parents of future citizens and workers should be granted payroll tax relief that helps to defray the costs. The final missing ingredient from a comprehensive, universal social insurance program is health insurance. No matter of public policy is more contested than healthcare, because of its importance both for individuals and the economy. President Franklin Roosevelt left health care out of the 1935 Social Security Act because it was too controversial. His successor, Harry Truman, pushed for universal, single-payer health care but could not get Congress to pass it. President Lyndon Johnson was able to shepherd Medicare through Congress in 1965 only because it was limited to the retired, who did not have access to the tax-favored, employer-provided health insurance system that became entrenched after World War II with encouragement from the Eisenhower administration. President Nixon's proposal for universal employer mandates went nowhere. By the 1990s, when the Clinton administration proposed its ill-fated healthcare reform, the U.S. healthcare system was plagued by two problems: inadequate coverage and excessive costs. The Affordable Care Act, backed by President Barack Obama, focused on the problem of coverage rather than costs. The ACA rejected the New Deal Great Society tradition of universal, taxpayer-based social insurance for the conservative alternative of tax expenditures and individual mandates to purchase private health insurance. This model had been proposed by the Conservative Heritage Foundation in the 1990s and was adopted in Massachusetts under Governor Mitt Romney. While some elements of the law are laudable, as a whole the ACA combines all of the faults of the bad approaches to public policy, while rejecting the sound approach of universal federal social insurance. Means-tested subsidies, tax expenditures, and elaborate federal-state hybrid systems, in this case, healthcare exchanges, are all united in an overly complicated system. For working-age, non-poor Americans, the Affordable Care Act, ACA, envisions a transition from system of tax expenditures based on employers to another indirect system based on tax subsidies to individuals purchasing insurance in state-created exchanges. Even if it succeeds in expanding coverage, the ACA is unlikely to contain costs. Other countries use a variety of methods to ensure universal coverage, from individual mandates to purchase private, non-profit, insurance in Switzerland to the other extreme of single-payer single-provider in the British National Health Service. But all countries that provide similar medical services for much lower costs than the US use all-payer regulation, utility-style price regulation of medical goods and services, negotiated periodically by the central government and the nation's medical providers. All-payer regulation would eliminate the threat to future federal budgets posed by Medicare and Medicaid. In the absence of all-payer regulation, Americans are likely to be given a false choice between government insolvency, because of the effect of healthcare cost growth on Medicare and Medicaid, and rationing, so that Americans are forced to consume less healthcare than Europeans and Asians at much higher prices. In the long run, the health insurance system should be integrated into a single, lifelong, comprehensive social insurance program. As a step in that direction, Medicaid and SCHIP, two inefficient and unfair federal-state hybrid programs, should be completely federalized and merged with Medicare. The U.S. health insurance system is likely to move either toward efficient social insurance or toward inefficient and costly voucherization of the social insurance elements like Medicare and Medicaid, combined with rationing of health care of a kind unknown in other advanced industrial democracies. For reasons of solvency and fairness alike, health insurance needs to be absorbed into an expanded, comprehensive American social insurance system. Most developed nations determine prices in the healthcare sector by a method called all-payer regulation. Here is how it works. The government negotiates with representatives of medical service providers, like hospitals and pharmaceutical companies, to set standard prices for medical goods and services. These include operations, drugs, and hospital stays. The prices are then renegotiated in a few years. This kind of government-industry price negotiation is not unknown in the United States. It is used in the public utility sector, in which rates are set as a result of bargaining among providers and public utility commissions. And Medicare and Medicaid set fee schedules for the goods and services for which they pay. Maryland has long used an all-payer system for hospitals that has kept hospital costs under control. Because of the political power of America's medical industry, all-payer regulation is almost never discussed as a method of reducing exorbitant healthcare costs in the U.S. But without all-payer regulation, excessive prices for medical goods and services are likely to continue to be paid both by Medicare and Medicaid and by private insurers, including those provided with new customers by the Affordable Care Act. In the words of Uwe Reinhard, one of America's leading healthcare economists, at this time, the U.S. health system appears to stand at a clearly defined crossroads. On one road, Americans would seek better control over national health spending through an all-payer system, such as the one operated by Maryland for the hospital sector. On the other road, Americans would seek better control of healthcare prices and national health spending through greater reliance on market forces for most of the health system. Depending on how that road is traveled, it could entail more pronounced rationing of healthcare by income class, meaning less healthcare for those who cannot afford it. The third major element of the social contract, after income and economic security programs, is made up of merit goods. Merit goods are goods or services to which the American people believe that everyone should have access, even though the market does not supply them in adequate quantities or at acceptable prices. In recent decades, Congress has relied heavily on tax credits and tax-favored lending for individuals to increase access to merit goods like housing, higher education, and child care. As we have seen, tax subsidies for the private purchase of specific kinds of goods and services tend to be inequitable and can lead to cost inflation and the misallocation of resources from unsubsidized to subsidized sectors of the economy. If all Americans are paid a living wage and have adequate social insurance, then it might not be necessary to subsidize some particular merit goods like housing at all. Other merit goods, like higher education and child care, might be best provided as public services by state and local governments. The expansion of reliable and solvent social insurance would eliminate the rationale for subsidies for merit goods like housing and savings accounts, to the extent that they are valued chiefly as emergency economic assets. While public support for housing and savings should be phased out, support for the merit goods of education, including preschool and higher education, and medical facilities should be increased. Because schools and hospitals are club goods in particular localities, the best way to increase access to these is not to create pseudomarkets for vouchers but to expand public healthcare and public education at the state and local level, financed by federal fiscal equalization or revenue sharing. In the case of assets, most tax expenditures to encourage purchase of particular assets should be eliminated. The expansion of social insurance we propose would allow the elimination of most tax-favored retirement and healthcare accounts. The experience of other countries like Canada with home ownership rates comparable to that of the US proves that tax expenditures for home ownership are not needed to ensure a home-owning middle class. Tax subsidies for housing should be capped at a low level or eliminated. While subsidies for some merit goods like savings and housing should be reduced or abolished, other merit goods might be provided most efficiently by direct public provision rather than by subsidies for private purchase. Many of the amenity services on which increasingly rich societies, like increasingly rich individuals, can be expected to spend a growing share of their incomes are also club goods, goods which are most efficiently provided if people pool their resources. For merit goods like these, the most efficient and fair form of provision would be a major expansion of both public employment and public services, rather than an expansion of wage subsidies and subsidized purchases of private services. The case for the permanent expansion of public services is strengthened by the striking fact that most employment growth in the past decade has been concentrated in three sectors which provide merit goods that are also club goods: healthcare, education, and government, mostly state and local public services. The growth of these sectors refutes fashionable predictions about the jobs of the future. In the 1990s, advocates of the new economy argued that we would increasingly depend on what Robert Reich called symbolic analyst jobs. But the vision of a nation of tech workers was oversold. A world-class technology sector will transform the economy and generate tax revenue but will create relatively few jobs. And graduate and professional schools are turning out too many lawyers, professors, and other professionals for the limited number of available jobs. Jobs which may diminish further in number as IT substitutes technology for labor in the professional services sector. For the real jobs of the future, look to healthcare, education, and local public services. What is driving this growth? One reason is the aging of the population. Another is the fact that societies, like individuals, choose to purchase more healthcare as they grow more affluent. According to the logic of Engel's law, much of the disposable income freed by productivity-lowered prices in appliances, transportation, energy, and perhaps housing may be spent on quality-of-life goods like health, education, and recreation. There is every reason to believe that there is vast untapped demand among ordinary Americans for many quality-of-life services that only the affluent minority can afford today. While some of these, like recreation and restaurant dining, can best be provided by the private sector, others like education, health, and recreational facilities like parks can be provided most efficiently by government. Of these, the most important is health, the good that makes possible all other goods. According to the Bureau of Labor Statistics, healthcare accounts for 7 out of the 20 fastest-growing occupations, more than any other category. Home health aides and personal and home care aides are found both among the fastest-growing job categories and among the occupations with the largest overall job openings in the years ahead. While employment in manufacturing is declining overall, employment in pharmaceutical and medicine manufacturing in the US is expected to expand. Better yet, the growing healthcare sector is creating jobs for workers at all educational levels, from the highest, physicians and surgeons who need professional degrees, to the lowest, health aides who need only high school qualifications plus brief on-the-job training. The medical industrial complex is unique among industries in combining the potential for greater research and development, more manufacturing, and a growing number of labor-intensive jobs that cannot be offshored. Far from being a problem, then, the steady and sustainable growth of employment in the healthcare sector, along with jobs providing care for the elderly and children, education, and the provision of public goods, may be the next stage in the evolution of advanced economies. The increasing supply of service sector workers interacts with an increasing demand for certain services as populations grow more affluent. While the service sector as a whole will continue to grow, public policy will play a role in determining both the allocation of service jobs between the private and the public sector and the labor market conditions in both. Public provision of some essential goods and services can benefit workers directly, in the case of government employees, and indirectly, in the case of private sector workers. In the mid-20th century, the generous paychecks of unionized industrial workers in Detroit and other manufacturing centers, when spent on goods and services, employed many other Americans and acted as a private, informal method of redistribution of the gains from economic growth. But 21st century countries cannot rely on well-paid production workers as the heart of the middle class. As a result of productivity growth, even in the absence of offshoring, there simply will not be enough of them. The next American middle class must be based on service sector workers with generous paychecks. Many of the best-paid service sector workers will necessarily be found in the public sector. Unlike the oligopolies that dominated US and global manufacturing in the post-World War II era, today's American service sector employers, nursing homes, for example, are price takers, not price makers. Many of them are low-profit businesses in competitive markets. They lack the power of monopolies and oligopolies to raise wages for their workers and pass on the costs to consumers. And any idealistic service sector employer that did so unilaterally would be in danger of going out of business. Unlike private employers, government can tap into the gains generated in the low employment, high productivity sectors and redistribute some of those gains to workers in less productive sectors. Expanding the government's share of low and medium skilled workers can also raise the wages of similar workers in the private service sector indirectly, by creating a tighter private labor market and forcing private employers to compete for workers with generous public employers. In addition to these direct and indirect effects, the public sector can influence wages in the private sector in its roles as a major consumer and a major contractor. Raising private sector wages indirectly, by expanding public employment, would also have the benefit of encouraging greater productivity growth in the private service sector. If private healthcare, leisure, and hospitality had to compete for low-wage workers, they would be forced to make better use of productivity-enhancing technology to compensate for higher labor costs. The promise of the neoliberal hidden welfare state is that competition for voucher-like tax subsidies among producers will lead to price-reducing innovation. But as we have seen, in the imperfect markets for healthcare and education, the infusion of public tax expenditure subsidies without government price controls tends to merely create monopoly and oligopoly rents for producers, inflation, and pressures for rationing. The experience of other countries, as well as the experience of the US utility sector, proves that government provision of services or government regulation of prices does not prevent the introduction of new technology or block productivity gains. Indeed, a public provider can pioneer and adopt new best practices before those practices diffuse among private providers. As Philip Longman has pointed out, the Veterans Administration led the way in adopting information technology in hospital practice, saving money as well as lives. The public sector can also play a role in promoting industry-wide efficiency by forcing contractors to pool patents and adopt common standards, something the federal government has done in sectors as different as penicillin research and aerospace. The contrast of private sector efficiency and public sector inefficiency is an ideological myth. It may sound heretical to propose expanding public employment at a time when state and local governments are being forced to cut jobs and services. Nevertheless, the fact remains that in a high-productivity economy, more of the middle-class jobs in the future will need to be located in the public sector, chiefly at the state and local level. In practice, advocates of wage subsidies like the EITC and subsidies for the private purchase of insurance and merit goods concede this point. The real debate is not about redistribution, but about the form that such redistribution should take. The alternative of expanding wage subsidies for private sector employment should be rejected. The provision of public services directly rather than relying on tax expenditures is superior in terms of fairness and fiscal soundness. Direct provision of merit goods and services is fairer because most tax expenditures disproportionately benefit affluent Americans, often increasing as incomes increase. And direct provision of merit goods services encourages public sector solvency. It is easier to keep the costs of visible programs funded by legislative appropriations under control than it is to control the costs of tax expenditures, which are largely invisible and to which individuals have a right by law, no matter how much the total may be. Is the next social contract that we propose affordable? We have already addressed the issue of incidental unemployment that might be caused by a higher minimum wage, so we will focus here on the cost of our proposals to expand social insurance and state and local public services. Because we seek to replace partly public and partly private systems of income maintenance and merit goods with purely public alternatives, the cost of the alternatives must be measured against the cost of the existing systems as a whole, not merely existing public programs. In 2007, before the Great Recession, net formal public spending on social expenditures in the US was 18.6% of GDP. This was far below the level in the United Kingdom, 22.0%, Germany, 26.5%, and France, 29.6%. Japan had a relatively low level of public social spending, as well, at 19.7% of GDP. But Japan's undeveloped welfare state exists in the context of institutions like employer paternalism and heavy reliance on unpaid female household labor. While public expenditures in the US are low compared to those of similar countries, private social expenditures are much higher, largely because of the heavy reliance in the US on the delivery of benefits by means of tax expenditures for individuals, employers, and lenders. In 2007, the US was an outlier, spending 10.4% of GDP on private social expenditures, far more than the UK, 5.0%, Germany, 2.4%, or France, 3.1%. When net public and net private social expenditures, many of which are publicly subsidized, are added together, America's exceptionalism disappears. The total for the US in 2007 was 27.5% of GDP, higher than the level in the UK, 26.9%, and comparable to that of Germany, 28.4%, and France, 32.7%. The legitimate comparison of the costs of social expenditures under the proposed next social contract would be combined public and private social expenditures, rather than just the formal government share. In our vision of the next social contract, the resulting expansion of the visible government would be much more dramatic than the actual expansion of government as a whole. The United States currently spends more than $1 trillion per year on tax expenditures in total, much of which is for social purposes. Reducing or eliminating tax expenditures would add that amount to the budget, which would partly offset the cost of increasing more visible, direct spending. As liberals and conservative alike have noted, broadening the base through limiting tax expenditures would increase revenue, either to pay for the strengthening of social programs, as we propose, or to cut taxes, as many others have suggested. But revenue neutrality for its own sake should not be a goal in reforming the American social contract. For one thing, even under the existing social contract, the aging of the population will lead to increases in spending on Social Security and Medicare and Medicaid, absent painful and politically unrealistic cuts in spending on the elderly. We propose expansions of social insurance, like family leave and a generous child care payroll tax credit, and of public services, including public daycare and public higher education. Some of the costs could be offset by the elimination of federal income tax expenditures. Undoubtedly, however, additional revenue would need to be raised both for expanded social insurance and for expanded state and local public services. As we argued in Part 3, the expansion of universal federal social insurance should be funded, at least in part, by new federal revenues other than the payroll tax. In order to establish a right to social insurance based on effort, part of every social insurance program, be it an existing and reformed program like Social Security or a completely new federal entitlement like paid family leave, should be funded by a payroll tax. But payroll taxes can and should be supplemented by other taxes that help to pay for social insurance. A large body of economic scholarship holds that taxes on consumption, rents, and unproductive speculation are less harmful to economic growth than other kinds of taxes. In order to minimize the distortion of economic decision-making as well as to avoid shortfalls as a result of economic fluctuations, additional taxes for social insurance should be broad like a value-added tax, VAT, rather than narrow sin taxes, like a carbon tax, which have sometimes been suggested as partial or complete replacements for payroll taxes. The United States is the only developed nation without a value-added tax, and on average the VAT accounts for more than 20% of total tax revenue in OECD countries. A value-added tax is a consumption tax, like a sales tax. But because a VAT is collected at each stage of the production of a product, it avoids the problem of cascading sales taxes on top of sales taxes. Even a narrow-based VAT that exempts necessities like food or children's clothing can collect large amounts of revenue with relatively low rates, and it is harder to game or evade than an income tax. In the US, a VAT could be used to reduce the federal deficit, fund an expansion of social insurance, and serve as the basis for a revived system of revenue sharing in the US. A VAT can also be used to reduce other taxes that tend to distort corporate decision-making and labor markets. A joint study by the New America Foundation's Economic Growth Program and the Urban Institute found that a narrow-based 5% VAT could be used to significantly cut the corporate income tax from 35% to 25.6%, while at the same time slashing the employer portion of the payroll tax from 6.2% to 4.5%. As we noted in our discussion of expanded Social Security, the regressive effect of such broad-based taxes can be mitigated by the overall progressivity of social insurance as a whole or by rebates administered through the Social Security system, like a payroll tax rebate. A VAT could be supplemented by taxes on resource rents, of the kinds already used by Canada and Australia. A financial transaction tax or Tobin tax, named after the economist James Tobin, should also be considered. A minuscule tax on all financial transactions would not affect most individuals or businesses, but it would fall heavily on high-volume transactions, including high-speed, computer-driven stock market and currency exchange trading that is a form of casino speculation rather than socially useful investment. Capital gains taxes should equal taxes on wage income, and might be supplemented by wealth taxes on large holdings which could raise significant revenue even if their rates were very low. Finally, inherited wealth should be taxed, as a kind of rent. Taxes on inheritances by individuals might be easier to collect than taxes on estates. Taxes like these would partly shift the burden of paying for government from individual wage earners, entrepreneurs, and investors in productive enterprises to the undeserving beneficiaries of unearned income. In a system of government that includes any level of decentralized authority, systems of fiscal equalization, partial redistribution of funds to particular regions or states, often exist to help equalize inherent intra-regional differences. Fiscal equalization can ensure that people across regions can have access to similar public services at similar tax rates, and it can also ensure regions against economic shocks that they may not be able to cope with themselves. Equalization exists in two forms, vertical or horizontal. Vertical equalization is a redistribution of funds from the federal government to regional governments, while horizontal equalization is a redistribution of funds between regional governments. Equalization can also target either revenues or costs. Revenue equalization targets the differences in regional capacity to raise revenues, and cost equalization redistributes based on regional costs of providing a given level of public services. The Canadian program of vertical revenue equalization was written into the country's constitution in 1982. The level of redistribution is based on each province's ability to raise revenues. The funds can be spent in any way, and the amount is adjusted based on a 3-year moving average of GDP growth. Australia has a similar vertical system of dispersing equalizing block grants derived from funds raised by the Goods and Services Tax, GST. The goal is to give each state the same per capita fiscal capacity, which is its ability to provide average services by raising revenue at average rates. Via a different mechanism, federal states in Germany are constitutionally required to share state revenues horizontally, rather than receive portions of federal revenues. For example, of the VAT revenues that are dedicated to states, 3/4 is distributed by population and 1/4 is distributed to states that have weaker finances. Although the US abolished its own system of vertical federal revenue sharing in 1987, forms of less overt fiscal equalization still exist in the United States. Medicaid, the health insurance program for low-income Americans, is funded as an open-ended earmarked matching grant with a varying rate inversely related to income and tax-based funding capacity. As such, it does redistribute some federal funds to states. The strategy that we propose of replacing most subsidies for private purchases of merit goods with direct provision of some but not all of the same merit goods by state and local governments can only succeed if state and local governments have adequate revenue. But there are profound inequalities in the abilities of different states to pay for similar public goods. For example, a tiny property tax allocated to education in rich Connecticut might raise far more money than a high property tax in poor Mississippi or New Mexico. Most other democracies in the world use fiscal equalization policies to reduce the inability of poor states or provinces to fund adequate levels of public services at reasonable tax rates. The United States had its own system of fiscal equalization in the form of federal revenue sharing between 1972 and 1987. On October 20, 1972, President Richard Nixon signed the State and Local Fiscal Assistance Act that instituted a system of revenue sharing. Nixon called general revenue sharing a new American revolution, a peaceful revolution in which power is turned back to the people. A revolution as profound, as far-reaching, as exciting as that first revolution almost 200 years ago, and described among its benefits lower taxes, better schools and hospitals, more police, and whatever local officials determine based on local needs. The U.S. General Revenue Sharing Program distributed a portion of federal income tax receipts to states and cities but lasted only 15 years. While critics of the program argued that affluent municipalities should not receive federal aid, most spending was on essential or desirable public services. Small, low-income towns and poor urban communities were able to pay for police salaries, healthcare, and public transportation. At its peak, revenue sharing provided American municipalities with a total of $6.8 billion, the equivalent of almost $20 billion today. Revenue sharing provided more than half of the annual budget for some towns and counties. Broad but shallow bipartisan support was not enough to protect the program from a coalition of anti-government conservatives and liberals who preferred narrowly targeted federal spending programs. The end of revenue sharing was a disaster for many American municipalities, particularly for rural and poor cities and towns. Many were forced to engage in cutbacks of essential public services, including La Mirada, California, which according to the New York Times reduced its government to a shell, contracting out anything from police protection to public works. The end of revenue sharing also forced state and local governments to raise taxes. The poorer the region, the higher the taxes had to be to support comparable levels of public service. Since state and local taxes are more regressive, the abolition of revenue sharing shifted the overall American tax system at all levels in a regressive direction. It is time to revive an idea that has worked successfully, both in the US until 1987 and in other federal democracies. The expansion of state and local public services that we propose should be paid for in part by a new system of federal revenue sharing or vertical fiscal equalization. In the case of one or more taxes, the federal government would collect the tax and distribute part or all of it to state governments on the basis of population. Revenue sharing could be general, with no strings attached, or it could be restricted in purpose, taking the form of block grants for particular activities like public education and public healthcare. To succeed, limited-purpose revenue sharing would have to avoid being used as a tool of centralized micromanagement by Congress. Among other benefits of the restoration of revenue sharing in the U.S. would be a limit to the destructive race to the bottom among states. In the absence of fiscal equalization, some American states can lure firms and industries from others by lowering or abolishing corporate or income taxes and by using selective tax expenditures to subsidize firms. While this strategy may succeed in bringing business to the state, it often comes at a high price in terms of reduced public services or the shifting of taxation from progressive personal and corporate income taxes to regressive sales and property taxes. By providing much state and local spending with a national revenue base, revenue sharing reduces the incentive of state and local governments to sacrifice public services to economic development strategies. Instead of a race to the bottom among states competing on tax rates, there can be a race to the top among states competing for business on the basis of quality public education, infrastructure, and other services that benefit the private sector. It might be objected that rich states would be subsidizing poor states. But states do not pay taxes, only individuals do, directly or indirectly, as through the corporate income tax. In the United States, there are more rich Americans in states like New York and Connecticut than in states like Mississippi and New Mexico. But any taxes used for federal revenue sharing would fall on the rich in Mississippi and New Mexico, and would fund public services to the benefit of the non-rich in New York and Connecticut. Privileged Americans should not be allowed to use subnational jurisdictions as excuses for shirking their responsibility to contribute to minimum levels of public services throughout the United States as a whole. In addition to other benefits, revenue sharing would be good for the U.S. economy as a whole. Booming regions can help other parts of the nation that are suffering from regional downturns. And during national or global economic crises, the greater capacity of the federal government to borrow money for emergency deficit spending could prevent the kind of disastrous layoffs of teachers, police officers and firefighters which, during the Great Recession, did much to neutralize federal stimulus policy. Revenue sharing is, among other things, an effective automatic stabilizer in a modern national economy. Our experience under the Great Recession has underscored the enduring value of the core pillars of a social contract that President Franklin Roosevelt first laid out in his address to Congress in January 1944. The right to a job, the right to adequate compensation, the right to a secure retirement and affordable health care, and the right to improve one's position in life through access to quality public education. We need a new strategy for maintaining full employment even as we reform our benefits system to be less dependent on formal full-time employment. Our basic strategy for maintaining high levels of employment over the past 2 decades was essentially reliant on an expansive monetary policy with minimal intervention in the labor market. But this strategy won't work in a world in which consumer demand is constrained by high debt levels. Businesses are either facing overcapacity or can meet demand with fewer workers, and much of the demand provided by macroeconomic policy leaks out of the United States to stimulate job creation in other economies. In particular, we need to explore ways to expand public and public-generated employment to make up for shortfalls in private sector job creation. The best way to create jobs and make the economy more productive over the long term is by increasing public infrastructure investment, some of which can be targeted to communities with particularly high rates of unemployment. Studies estimate that every $1 billion of infrastructure spending creates on average 18,000 jobs and has a 1.57 multiplier effect on GDP. The United States has an enormous backlog of unmet public infrastructure needs, and it would make sense to address them over the next 5 years in order to help return the economy to full employment. In comparison to other OECD societies, America's social welfare system had done a relatively poor job of cushioning the American population from the economic dislocations associated with the Great Recession. Since the Great Recession began in December 2007, the ranks of America's poor have swollen by at least 3.7 million. Child poverty has climbed to 20.7% from 17.8% a few years earlier. 1 in 8 Americans, including 1 in 4 children, is now on food stamps because he or she is not eligible for unemployment compensation or other social welfare programs. Nearly 50 million Americans lack health insurance, and over 17% of households report that they have postponed or are delaying seeking health care over the past year for financial reasons. The Great Recession has had such a devastating effect on American society because it struck at the very heart of the American social contract. More than in other Western societies, employment has been seen as the best guarantee of both economic security and economic opportunity for American workers. Yet, the recession resulted in the loss of 8.4 million jobs, with official unemployment rising to more than 10% and the number of unemployed and underemployed climbing to over 25 million. What is worse, the employment outlook for the post-bubble economy is extremely worrying. Official unemployment is expected to remain near double digits for some time to come, with the number of jobless much higher for workers in vulnerable communities and for those just out of school. Job creation is projected to be weak by historical standards, raising the level of structural unemployment and depressing wages. And long-term unemployment is increasing, threatening permanently the livelihoods of millions of Americans. In addition to the harm done to the unemployed, the high rate of unemployment has a deleterious ripple effect throughout the economy, as falling tax revenues force government budget cuts and layoffs worsen the long-term outlook for Social Security and Medicare, which have become more important to retirees and prospective retirees who are counting on housing prices or stock market gains for their retirement years. Secondly, the Great Recession was the result of the bursting of a housing and credit bubble that had come to be a core feature of America's social contract over the past decade and a half. The United States, more than other OECD economies, has embraced the idea of the ownership society, with a home being the most commonly owned asset among most working Americans. Credit also became an essential tool for working families to maintain their standard of living and to help smooth out periods of misfortune. For a while, rising home prices and access to credit helped mask the effects of stagnating wages. But now the debt left in the wake of the housing crash is dragging down millions of American families. As of the beginning of the year, nearly 1 in 4 mortgages was underwater, meaning the mortgage holder owes more on the mortgage than the underlying home is worth. That number is expected to increase to 48% by 2011. Overall, American households have suffered a $12.3 trillion loss in household wealth, a significant portion in their homes and retirement accounts, and as a result, 1 in 4 Americans over 62 are putting off retirement because they cannot make ends meet. Our experience during the Great Recession suggests that there are some fundamental flaws in our social safety net. It also suggests that we need to rethink some of the main pillars of our social contract relating to how best to achieve full employment and retirement security. There are 5 major problems with America's system of economic and social security that helps explain why the United States has done so poorly in cushioning the impact of the Great Recession on its middle and working class, and why America's safety net looks even more ragged in its wake. First, as suggested earlier, the American system of social and economic security revolves too closely around employment at a time when the contingent and part-time workforce is rapidly expanding and structural unemployment is on the rise. As is well known, health insurance in the United States is still largely employer-based. If you lose your job, you most likely lose your health insurance as well, and that will only change modestly under the new healthcare reform. But so are other features of America's social welfare system. As a result of the welfare reforms passed under the Clinton administration, America's principal welfare program, temporary assistance for needy families, is now linked to work requirements. Not surprisingly, the number of people accessing the program has scarcely expanded during the recession because employment itself has declined even as the number of poor has increased. Likewise, America's main program for helping the working poor, the Earned Income Tax Credit, is dependent on being able to work. Individuals who can show they have earned income up to a certain level are eligible for a refundable tax credit to supplement their income. Those who have not been employed and have no earned income are not. Yet as the economic security of Americans has become ever more linked to employment, America's job machine has broken down. Since January 2000, the economy has created, on net, no new private sector jobs, and the number of discouraged workers and involuntary part-time workers has steadily increased. As of August 2010, the official unemployment rate was 9.6%, but that number rises to 16.7% when people who have given up looking for work and those working part-time out of necessity are included. That means 1 in 6 working Americans are effectively unemployed or underemployed, and because they are unemployed, many of them have lost their access to health care and other social insurance benefits. Second, U.S. labor markets are characterized by relatively weak unemployment protection. Thus, job losses occur more quickly than they do in Europe, and the unemployment insurance programs available to workers are a lot less robust than they are in the core European Union countries. Since the beginning of the recession, the official U.S. unemployment rate increased by 4.6%, while the unemployment rate in the Eurozone during the same period increased by just 2.7%. But unlike in Europe, many unemployed Americans do not have the protection of unemployment insurance. In most European countries, unemployment benefits are available to nearly all workers, cover well over half of an employee's earlier salary, and extend for more than a year. By contrast, in most states in the United States, unemployment benefits are restricted to a narrow group of workers, often compensate workers for less than half of their previous wages, and generally last less than 1 year. Less than 2/3 of unemployed workers in the United States are eligible for and receive unemployment insurance benefits. That is because many states in the United States have very rigorous eligibility requirements that exclude low-income or part-time workers and that limit any compensation to a very short period of unemployment. As a result, while 15 million workers in the United States are officially unemployed, only 10 million are receiving unemployment insurance benefits, either because they did not qualify initially or because they have already exhausted their benefits. And the number receiving unemployment insurance benefits would even be lower had Congress not taken special measures several times to extend benefits beyond their normal expiration date. In sum, America's system of economic security works reasonably well during periods of full employment but quickly collapses during periods of rising unemployment. A third reason that the Great Recession has created such stress on the social contract relates to what might be called America's system of social welfare federalism, which puts much of the financial burden for many social safety net programs, such as unemployment insurance and healthcare, onto the states and not on the federal government. Over the past 2 decades, the Congress has increasingly resorted to the use of federal mandates requiring the states to provide certain benefits but has failed to provide states adequate funding to meet those mandates. When economic times are good and state budgets are flush with cash, this system works to some degree. But during economic downturns, states immediately face a dilemma. The demands on their budgets rise as the demand for social welfare benefits increases, but the ability to meet these demands declines as tax revenues dry up and states are forced to cut expenditures. What is worse, unlike the federal government which can run deficits, nearly all states are required by law to balance their budgets, which means raising taxes or cutting benefits and services, or both. Such is the situation today. State governments are looking at more than a $200 billion shortfall, and are being forced to lay off teachers and other employees, cut benefits, and raise taxes in an effort to balance their budgets. To be sure, the federal government may step in during an economic downturn to help states, as it has in extending unemployment benefits and in providing some assistance to state and local governments to meet their Medicaid obligations. But in these cases, the federal support is often too little and too late. Overall, this makes America's delivery of social welfare benefits far from being the automatic stabilizers they are in the case of the core European economies. Fourth, another feature of America's social welfare state requiring rethinking is the fact that a significant proportion of many of America's most important social welfare state benefits relating to education, child care, home ownership, and retirement are delivered through the tax code as deductions against income. This has created two perverse results. The first is a social welfare state that heavily favors upper and middle income groups. Indeed, the majority of benefits now go to the top 20%, not to those who need them most, creating in effect a two-tier welfare state. The top tier enjoys generous deductions for healthcare, education, home ownership, and personal retirement savings. The higher one's tax income and tax bracket, the greater the value of the deductions offered in all these areas. At the bottom, the less fortunate receive very little from these deductions because they do not have enough income to take advantage of itemizing deductions. The second effect is that it has created a pro-cyclical social welfare state that awards more benefits during booms and periods of rising economic growth and fewer benefits during recessions and periods of slower economic growth. Thus, rather than helping smooth out families' incomes, it actually adds to income volatility. In other words, as unemployment and underemployment rise and the incomes of Americans decline, so do their social benefits for education, child care, and retirement. As a result, they can quickly find themselves without the resources needed to pay for their children's education and to save for their own retirement. Finally, as noted earlier, the United States has embraced much more readily the idea of the ownership society than has Europe, and thus the American social contract has come to rely much more heavily on home ownership and private pension plans than has the European counterpart. This embrace obviously has advantages when asset prices are rising, but it wreaks havoc when asset bubbles burst. For the past decade, rising home values compensated for stagnant wages, allowing them to maintain and even improve their standard of living by tapping home equity. In addition, easy access to credit allowed families to weather economic downtowns or medical emergencies, but at the expense of rising household indebtedness. With the bursting of the housing and credit bubble, this essential feature of the Clinton-Bush era imploded, leaving many households with a large debt hangover. As a result, the Great Recession has dealt a double blow to many Americans. Not only have they lost their job, but they have lost their home and their life savings as well. Worse, there is little in the way of programs available to help them pick up the pieces. The Great Recession has also hit hard the private retirement savings of working Americans, who have increasingly come to bear the burden and risk of saving for their own retirement. Over the past 2 decades, American companies have steadily shrunk their private pension contributions and have put more of the risk onto employees. They have done so in 2 ways. Either by eliminating company retirement plans altogether or by shifting from a defined benefit to a defined contribution pension program. In a defined benefit system, a retired worker knows exactly how much he or she will receive each month. In a defined contribution system, the employee makes a contribution into his or her retirement account, most likely a 401k, that is then invested in the bond and equity markets with attendant risks. The experience of the past decade shows that this shift in the nature of U.S. retirement system has worked to the disadvantage of American workers while creating more vulnerability and uncertainty. Seniors who retired in the late 90s before the collapse of the stock market in 2000 to 2001 may be able to enjoy a comfortable retirement, but those who are planning to retire this decade face a much bleaker retirement future, having seen much of their retirement savings lost during the past 2 market crashes. That is why for nearly 70% of seniors, Social Security is the main source of retirement income, but Social Security is far less generous than most seniors need to enjoy a comfortable retirement. Unlike other economic downturns, which are largely transitory events that have little lasting impact on American society, the Great Recession is likely to be a multi-year society-shaping force that leaves deep and ugly scars. The most significant effect is likely to be the further collapse of the American middle class, particularly that part of the middle class that has withstood 3 decades of stagnant wages by living off of rising home prices and easier credit. As is evident from the number of home foreclosures, the housing bust is having its most concentrated effect on people on the lower and middle rungs of middle-class life, hitting particularly hard those who have bought a home in the last 5 years. Many of these were first-time home buyers that had achieved a tentative hold on middle-class status, but now they are being pushed back into poverty with the loss of their home and their job. Others were upwardly mobile middle-class families who got caught up in the optimism of the housing bubble and moved from a starter home to a more expensive, and overpriced, house during the same time. These families now are confronted with a staggering mortgage debt that they will never be able to work off. Our experience under the Great Recession has underscored the enduring value of the core pillars of a social contract that President Franklin Roosevelt first laid out in his address to Congress in January 1944. The right to a job, the right to adequate compensation, the right to a secure retirement and affordable health care, and the right to improve one's position in life through access to quality public education. Roosevelt recognized that these rights were essential to a healthy society and to an economy that would be free of the destabilizing inequalities and insecurities that led to the Great Depression. Yet many of these core pillars are still under assault as we adjust to the post-bubble realities of weak economic growth and a huge debt overhang. The economy is not expected to return to anything approaching full employment until 2016, and even then structural unemployment may be several points higher than it was before the crisis. Productivity has skyrocketed during the recession as businesses have cut costs and fired workers, but real wages are by contrast stagnating, further exacerbating the gap between productivity and wages that contributed to the crisis in the first place. Financially stressed businesses and cash-strapped state and local governments have been forced to cut future retirement programs and to trim other benefits, further eroding many workers' access to health care and a secure retirement. The Great Recession may have reinforced the wisdom that a robust social contract is necessary to avoid destabilizing inequalities, but it has also made clear that we need to bring about major changes in how we seek to realize this social contract. First, we need a new strategy for maintaining full employment even as we reform our benefit system to be less dependent on formal full-time employment. Our basic strategy for maintaining high levels of employment over the past 2 decades was essentially reliant on an expansive monetary policy with minimal intervention in the labor market. But this strategy won't work in a world in which consumer demand is constrained by high debt levels. Businesses are either facing overcapacity or can meet demand with fewer workers, and much of the demand provided by macroeconomic policy leaks out of the United States to stimulate job creation in other economies. In such a situation, it is unrealistic to expect macroeconomic policy, especially monetary policy alone, to restore the economy to full employment or for the private sector to generate enough jobs on its own to bring down unemployment. Concerted public sector policy will also be needed. In particular, we need to explore ways to expand public and public-generated employment to make up for shortfalls in private sector job creation. The best way to create jobs and make the economy more productive over the long term is by increasing public infrastructure investment, some of which can be targeted to communities with particularly high rates of unemployment. Studies estimate that every $1 billion of infrastructure spending creates on average 18,000 jobs and has a 1.57 multiplier effect on GDP. The United States has an enormous backlog of unmet public infrastructure needs, and it would make sense to address them over the next 5 years in order to help return the economy to full employment. Second, we will need to complement a program of public infrastructure investment with a general expansion of public services. It may sound heretical to propose expanding public employment at a time when state and local governments are being forced to cut jobs and services, but in a high-productivity private sector economy, more of the jobs in the future will need to be located in the public sector. In addition to investing in infrastructure and energy efficiency to provide a better environment for productive enterprise, the public sector can provide well-paid employment while lowering the cost of essential services by expanding its provision of goods like education, daycare, elderly care, and other essential quality of life services. Such a policy would build upon the trend of the last decade, when public or publicly supported provision of health and education was responsible for most new job creation. There are a number of complementary options for expanding public services. For example, an indirect way by providing vouchers for elderly care as proposed by my New America colleagues Michael Lind and Lauren Dam, or a more direct way by establishing public programs like the Home Care Corps, as suggested by economist James K. Galbraith, that can expand and shrink to provide jobs and services as needed. Second, we need to recommit ourselves to the understanding that economic security begins with jobs that pay wages that can support at a minimum a standard of living above the official poverty level. Unfortunately, a significant portion of the jobs in the U.S. economy fail to meet this standard. An economy with a disproportionate number of jobs that pay low wages not only adds to the social welfare burdens of government but also creates a lopsided pattern of economic growth that is subject to the kind of crisis we have just experienced. Indeed, we will not have a truly sustainable economic recovery or a truly durable social contract until the wages and incomes of American workers begin to rise again. Therefore, one of our principal goals in the wake of the Great Recession must be to increase the take-home pay of workers as part of a new pattern of economic growth. The take-home pay of workers can be increased in essentially two ways: by increasing pre-tax pay and by reducing taxes on moderate and low-income workers. Over the past decade or two, public policy has sought to supplement after-tax income of low-income workers and the working poor by government subsidies, like the Earned Income Tax Credit, EITC. While the EITC and other programs are useful, it is important to understand that they work best together with higher pre-tax wages, not as a substitute for them. In the absence of strong economic growth, the place to begin to raise the pre-tax wages of low-income workers is with the minimum wage. Although recently increased to $7.25 an hour, the federal minimum wage is still far below its value in the 1960s in inflation-adjusted terms and therefore does not provide a sufficient floor for low-wage workers. The problem is that the United States, unlike many other OECD countries, does not have an automatic mechanism for adjusting the minimum wage to keep up with inflation or productivity gains. That needs to change. Another way to increase pre-tax wages in the service sector would be to create a tighter private service sector labor market by expanding public employment of low-income workers. As the experience of Sweden has shown, a high level of employment in the public sector can shrink the available private service sector labor pool, increasing the ability of private service sector workers to bargain with employers for higher wages. In the US context, this means expanding public employment in education, healthcare, child and elderly care, energy conservation, and arts and recreation. In addition to reducing inequality and raising pre-tax incomes at the bottom of the labor market, expanding public employment in these areas would reduce the costs of these services to middle-income and low-income Americans and increase their accessibility. An increasing percentage of the American household's income is spent on services including healthcare, daycare, and education. Reducing their cost by means of greater public provision could increase the ability of American workers and families to save without the need for sacrifice. Expanding public employment would also have the benefit of encouraging greater productivity growth in the private service sector, which would support higher wages in that sector. If private healthcare, leisure, and hospitality had to compete for low-wage workers, they would be forced to make better use of productivity-enhancing technology as well as to pay high wages. A strategy of raising wages in the low-wage private service sector would be complemented by reductions in the tax burden of low-income workers. The best way to reduce the tax burden on low-wage workers would be to reduce the payroll tax and allow individuals and families to take deductions against the payroll tax instead of the income tax. In 2006, 44% of American taxpayers paid more in payroll taxes than they did in income taxes. That number rises to 66% if both the employer and employee parts of the payroll tax are included. Reducing the payroll tax, therefore, would have the greatest benefit for low and moderate income Americans. To make up for the lost revenues from FICA, we could raise the cap on the payroll tax and broaden the FICA base by making capital gains and unearned income subject to FICA contribution, and we could also introduce a modest value-added tax with reimbursements for necessities or up to a certain income level. Reducing the payroll tax would simultaneously increase the take-home pay of workers, particularly low-income workers, and reduce the cost of hiring workers, thereby facilitating job creation. It would also make the overall tax system more progressive in two ways. It would reduce our dependence on one of the most regressive taxes to fund Social Security and Medicare, and it would make our system of tax expenditures, tax deductions and tax credits fairer. As it is now, upper-income individuals and families benefit disproportionately from deductions against the income tax. Consolidating existing deductions for housing, child care, saving, and education with a single tax offset against the payroll tax would allow low-income individuals to benefit from America's hidden welfare state while reducing its overall costs. But we also need to begin to move away from a tax code-based social welfare state that is both inefficient and unfair and toward universal social insurance programs like Social Security and Medicare. Social Security and Medicare have succeeded because they were universal programs that included all Americans regardless of class. They were citizen-based, and thus not dependent on the employer. They were non-intrusive into the personal lives of citizens, and they were efficient in that they minimized government overhead or the investment of personal time. Social Security and Medicare have been essential to eliminating poverty among the elderly in the United States. In 1966, The first-year poverty was measured for the elderly. Elderly poverty was at 28.5%. In 2007, it was 9.7%. Social security may even be more important today because retirement savings are skewed heavily by income, with lower-income Americans almost entirely dependent on it. Indeed, for those currently 65 and older, Social Security is the largest source of income, accounting for 38.6% of their income on average. By contrast, pensions and annuities income accounted for only 18.6%. The numbers are even more striking for low-income workers. For the bottom 20% of Americans, Social Security accounts for 88.7% of their income, pensions and annuities only 4.4% of income. Social Security is also growing in importance because of the decline in defined benefit pensions and the shift toward defined contribution savings accounts like 401(k)s. Defined contribution plans have turned out to be an unreliable pillar of retirement security in part because of severe market swings and in part because they have tested the ability of many Americans to manage them effectively. Yet, in spite of this success, Social Security and Medicare are under new attack today, being the principal targets of those who want to shrink government and close the budget deficit. But rather than cutting Social Security, a better approach would be to phase out the tax expenditures associated with the tax breaks provided for private retirement savings and to strengthen Social Security and make it an even more meaningful retirement program for low and moderate income workers. Given the damage the crisis has inflicted on the savings of many American households, there is no choice but to see social insurance as an even more critical pillar of retirement security in the United States for the foreseeable future. We therefore need to give priority to strengthening and expanding Social Security in order to rely less on tax-favored private retirement savings, the benefits of which go disproportionately to the affluent. One approach would increase the minimum Social Security benefit and the replacement rate for low and moderate income Americans. The revenues to fund these increases can come, in part, from gradually reducing the amount of private retirement income that the wealthy can shelter from taxation. Far from hurting the economy, such an expansion of Social Security payouts would likely have a permanent stimulating effect on the economy. Most economists agree that lower-income people are more likely to spend an extra dollar on goods and services than are affluent individuals. It may also discourage asset bubbles from developing in the future and help reduce wealth inequality as well as increase retirement security. Finally, we need to reform our system of social welfare federalism, relieving states of the financial burden of many social safety net programs. As noted before, state governments have difficulty meeting their various financial obligations during recessions, and thus programs that were designed in part to be automatic stabilizers of the economy end up being pro-cyclical drags on state budgets. The fiscal division of labor that has developed between the states and the federal government over the years has produced a very uneven system of economic security, with benefits varying widely among states and with states engaged in various efforts to reduce eligibility to save money while seeking to maximize federal support. It is time to end these games and put core economic security programs on a firmer fiscal ground. It does not make sense for states to assume responsibility for core social safety net programs when they do not have the ability to undertake counter-cyclical spending by running budget deficits and when they rely generally on much more regressive taxes than does the federal government. Thus, for both fairness and effectiveness, it would make sense to fully federalize the financing of core economic security programs. One place to begin would be to complete the process of federalizing Medicaid that it was started but left incomplete by the Affordable Care Act. Another, as suggested by Stephen Atuel, would be to make unemployment insurance a federal responsibility. These reforms would go a long way to make benefits more even and in making these programs effective automatic stabilizers as well as anti-poverty programs. The next year or two could prove decisive in determining the future shape of the social contract, as the nation debates whether a new economic recovery program to create jobs is needed or must be shelved because of rising deficits, whether tax reform will facilitate job creation and increase worker take-home pay or create even more obstacles to full employment, and whether the push for entitlement reform leads to a weakening of Social Security affecting the retirement security of millions of Americans, or whether we strengthen and expand Social Security to make it a more robust pillar of retirement security. It is therefore important we understand not only what is at stake but how best to strengthen the social contract for the future. The next American social contract that we propose would build upon what works today while rejecting what has failed. As an alternative to wage subsidies that create a class of workers dependent on federal checks and reward low-wage, inefficient employers, we propose raising the minimum wage until it is a living wage and indexing it to inflation. As an alternative to achieving income security through individual tax expenditures and hybrid federal-state social insurance programs, we propose creating a comprehensive, expanded system of purely federal social insurance. Finally, as an alternative to tax expenditures that subsidize the private purchases by individuals of particular merit goods, we propose to eliminate subsidies for some, housing, while relying on expanded public provision of others, like education, including public higher education, by state and local governments. The logic in each case is the same. Direct government action is more efficient than indirect subsidies of the private sector which, while helping individuals, funnel money to some private employers and for-profit, private service providers. A living wage can increase incomes at the bottom for employees without subsidizing employers who pay their workers too little to live on. Expanding social insurance in the form of transfer payments based on taxation can increase the security of retirees, parents of newborn children, and the unemployed and disabled, without subsidizing money managers and other intermediaries, as tax-favored private savings programs do. An expanded public provision of higher education and other merit goods can be done at cost, unlike indirect federal subsidies, some of which are siphoned off into salaries and perks for the shareholders and managers of for-profit providers. The next American social contract that we propose would be radical in the original sense of the word. It would get to the root of the dangers posed by low wages and an inadequate economic security system. The reforms that we propose would produce a radical alteration of responsibilities among individuals, employers, and government at different levels. In return for being freed from the burden of providing benefits to employees, employers would be expected to pay more in wages. In the next social contract, the division of labor among federal, state, and local governments would be transformed for the better as well. The federal government would specialize in the public provision of benefits in the form of social insurance, which would be expanded as tax-based subsidies for retirement savings, healthcare, and higher education are gradually phased out. All hybrid federal-state social insurance programs, such as unemployment insurance and Medicaid, would be replaced by purely federal programs. Freed from any burdensome role in providing social insurance, state and local governments, with the help of federal funds via revenue sharing, would specialize in the direct public provision of merit goods such as public education at all levels. The next social contract that we propose breaks with the orthodoxies of today's conventional left, right, and center. The replacement of the hidden welfare state that is made up of the indirect, tax-subsidized private provision of goods and services by direct public provision might be thought of as a progressive proposal. But many centrist Democrats have championed the failed neoliberal strategy of inefficient, indirect tax expenditures in the areas of wages, benefits, and merit goods, a strategy that we reject. Likewise, many progressives favor expanding the means-tested programs that we propose to eliminate or convert into universal social insurance. Each of the elements of the next American social contract described here has also been favored by prominent conservatives. President Ronald Reagan and former Federal Reserve Chairman Paul Volcker have called for the complete nationalization of Medicaid. Ron Unz, the publisher of The American Conservative, has argued that conservatives should favor a higher minimum wage, while Republican presidential candidate Mitt Romney has called for indexing the minimum wage to inflation. The economist Henry Simons, a founder of Chicago School of Economics and a critic of the New Deal, argued that direct public provision of some goods was more efficient than indirect provision subsidized by loans or tax credits. And President Richard Nixon, a Republican, championed fiscal equalization in the form of general revenue sharing. The goal is to consolidate and streamline the economic safety net into a few big, simple, efficient programs that are difficult for special interests to game and easy for citizens and their elected representatives to understand and evaluate. Almost all of the reforms here involve expansions or reductions of existing programs, the minimum wage, Social Security, Medicare, and public schools, rather than the creation of new programs. Indeed, the goal is to consolidate and streamline the economic safety net into a few big, simple, efficient programs that are difficult for special interests to game and easy for citizens and their elected representatives to understand and evaluate. Large, simple, and visible programs are the most direct way to use the strengths of a democratic system and fight regulatory capture and the imbalanced influence of specific interests. Our program would also promote genuine fiscal responsibility, defined as paying for legitimate commitments, not merely shrinking the size of government, reneging on historic commitments, or making ordinary Americans less secure. Direct spending for social insurance and publicly provided goods and services would replace the invisible spending of the hidden welfare state. The replacement of tax expenditures, whose total amounts are determined by individuals rather than Congress, with direct spending programs would permit overall limits to be set on spending for social purposes in a transparent way. The reforms that we propose would benefit employers and the economy as a whole, as well as individual Americans. Businesses would benefit from the complete replacement of employer benefits with universal public benefits, so that companies would no longer need to serve as miniature welfare states. The playing field among big businesses that offer benefits and small businesses that cannot afford to do so would be leveled. The economy would be helped by an end to the misallocation of resources in the form of tax subsidies going to inefficient, for-profit middlemen in healthcare, housing, higher education, and retirement savings. And the US financial industry would be dramatically downsized, as the flood of tax-favored private savings flowing from the American middle class into the hands of Wall Street money managers shrinks to a trickle. Most important of all, the next social contract would reflect core American values. Influenced by the Democratic-Republican tradition, most Americans have believed in equal rights for all, special privileges for none. This principle would be reflected in a move toward more universal social insurance and away from unpopular, means-tested programs for the poor that are resented by the working class and middle class. A minimum wage that is a living wage would resonate with the conviction that workers should earn enough to live without reliance on charity or welfare, while a two-tier social security program based in part on payroll taxes would make personal effort the basis of earned benefits while also keeping the elderly out of poverty. Like the American Republic, the American social contract is a work in progress. As the economy and the world change, each generation faces the need to rebuild our system of shared economic security, which benefits the larger economy and country by cushioning economic volatility, restoring a sense of fairness, and helping keep alive the American dream. To bequeath greater opportunity and greater security to the next generation should be the priority for this generation of Americans. The conventional wisdom about Social Security is profoundly misguided. According to today's mistaken consensus, the US as a society cannot afford to allocate the money to pay for the present level of Social Security benefits for retirees in future generations. The solution, it is widely argued, is to cut benefits, either directly by means testing or indirectly by raising the retirement age or allowing inflation to erode their real value over time. In this narrative, tax-favored private savings vehicles like 401(k), S and IRAs should be expanded in order to compensate for the allegedly necessary cuts in Social Security. This consensus is not only misconceived in its diagnosis but also mistaken in its prescriptions and potentially disastrous in its consequences. Retirement security is often thought of as a three-legged stool consisting of Social Security, employer retirement plans, and private savings. Social Security has been far more stable and successful than the other two legs of the stool. The reliance on these other legs of the system has resulted in a retirement security crisis for most Americans, shifting costs and risks onto individuals, even as the benefits of these programs go overwhelmingly to upper-income earners. Yet the current debate is arbitrarily restricted to the chief public component of the American retirement system, Social Security. In reforming America's retirement security system, we should build upon what works. Instead of compounding failure by expanding private benefits, a category that includes rapidly disappearing defined benefit pensions, employer-provided 401(k), S and individual retirement accounts, IRAs, we should substantially expand the successful, purely public Social Security program. We offer one possible way to increase the overall public component of retirement security in the US that we call expanded Social Security. Just as Medicare already has different components called Medicare A, B, C, and D, the expanded Social Security program that we propose would have two elements: Social Security A and Social Security B. Under our proposal for expanded Social Security, today's Old Age and Survivors Insurance, OASI, commonly known simply as Social Security, would be retained, possibly with modifications, as an earnings-based defined benefit program. This would be renamed Social Security A. The expected shortfall in funding for promised benefits that is predicted to occur in the 2030s would be made up for by revenue increases, not benefit cuts. To supplement Social Security A, we would add a universal flat benefit for all retirees eligible for OASI called Social Security B. Social Security B could be funded by revenues other than the payroll tax. Today's Supplemental Security Income, SSI, a means-tested anti-poverty program that helps poor children and the disabled as well as the elderly, has always been funded out of general revenues. SSI thus provides a precedent for expanding the funding base for Social Security B. Indeed, one option would be to convert SSI into Social Security B. The two components of expanded Social Security, Social Security A and Social Security B, in combination would provide a much greater share of pre-retirement income than today's OASI does by itself for most Americans. This expansion of the public share of the average American's retirement income would make both tax-favored employer-based pensions and tax-favored individual savings accounts less necessary, allowing federal tax expenditures for those private programs to be reduced or eliminated. Combining major reductions in tax-favored private retirement savings programs with a substantial increase in the public portion of the American security system would make the retirement security system as a whole more progressive, more efficient, and more stable. Designed properly, a new retirement security system could substantially boost public retirement benefits for most Americans without increasing the percentage of GDP devoted to the combined public and private elements of our nation's retirement system as a whole. In addition to increasing the public contribution to the retirement security of most Americans, expanded Social Security would have other benefits for individuals, businesses, and the economy. Unlike employer-provided pensions or 401(k)(s), Social Security B would be universal and would not depend on the generosity of particular employers. At the same time, funding Social Security B with revenues other than payroll taxes could maintain or increase the publicly funded share of retirement security without expanding the payroll tax beyond the levels needed to maintain benefits under Social Security A, today's OASI. Other reforms might achieve similar results by different methods. Any strategy that expands the reliable and efficient public share of retirement security in America would be an improvement over today's system, which is biased toward the affluent and skewed toward private savings. Our purpose in proposing the expanded Social Security plan is to challenge the conventional wisdom about Social Security and to provoke a debate about whether and how to expand the public element of the American retirement security system. At present, the discussion is dominated by those who want to privatize or shrink Social Security and those on the defensive who propose merely incremental reforms to preserve it. We seek not merely to move the ball, but also to move the goalpost in order to enlarge the boundaries of the national conversation about the future of retirement security in America. Today, individual retirement policy in the United States can be compared to a three-legged stool. The three legs are the public programs of Social Security, OASI, and the portion of Supplemental Security Income, SSI, that goes to the elderly poor, employer-based retirement plans like defined benefit pensions and defined contribution 401(k)(s), and personal assets, chiefly the value of one's home. Social Security is the largest and most stable component of this amalgam, providing 37% of all income for Americans ages 65 and older in 2010. Social Security is an especially important source of income for lower-income older Americans, providing 84% of the income of older Americans in the bottom 40% of the income distribution. The other major public source of retirement income, Supplemental Security Income, SSI, makes up less than 0.5% of all older Americans' income. SSI is the source of 7% of income for elderly Americans in the lowest income quintile. The combination of traditional pensions and defined contribution plans such as 401(k)(s) and IRAs provides 18% of all income for older Americans. Both defined benefit pensions and defined contribution plans are much more important to more affluent elders. They provide 25% of all income for older Americans in the second highest income quintile compared to just 3% of income for those in the lowest income quintile. Although the share of older Americans' income from tax-favored private savings has stayed relatively constant over the past 30 years, the source of that income has shifted dramatically. Defined contribution plans like 401(k)(s) are now responsible for an increasing share of that income, as income from defined benefit pensions has declined. The rest of the income of older Americans comes largely from asset income, income from savings accounts, investments, or reverse mortgages on homes, for example, and earnings, which are responsible for 11% and 30%, respectively, of all income of Americans aged 65 and older. By contrast to today, in which people rely more on earnings than assets, less than a generation ago the relative importance of these sources was reversed. In 1984, older Americans received 28% of income from assets and just 16% from earnings, and assets still accounted for a greater share of income as recently as 1992. The problem of an insecure retirement is not reserved for the lowest income earners. Fewer than half of the middle quintile, 40th to 60th percentile, of the elderly have any form of pension income, and only a slim majority have any form of asset income. These problems predate the recent downturn. Even before the Great Recession that began in 2008, 43% of middle-income and 54% of lower-income Americans already were at risk of having insufficient retirement funds. But the economic collapse has made the situation worse. The financial crisis has taken its toll on the private retirement resources of most Americans that are intended to supplement Social Security, employer retirement plans, and individual savings and investment. 2 out of 3 of the legs of retirement security have proven insufficient, with Social Security remaining as the only stable leg. This leaves retirement security as an unstable, one-legged oddity for the majority of retired Americans who now depend almost exclusively on Social Security. But even though Social Security has become, by default, a de facto national retirement system for most Americans, the Social Security payout at its present level is not adequate to compensate for the crumbling of the other 2 elements of retirement security. Employer-based retirement plans always have been the least broadly distributed asset, with fewer than 40% of elderly Americans today, those 65 and over, earning income from any type of pension program. The traditional defined benefit pension, in which employees receive a guaranteed payout during retirement from their employer, once provided a secure stream of retirement income on top of Social Security for many Americans. However, it has been disappearing over the past 4 decades, and now covers fewer than a third of all workers. Among private sector workers, the number is even lower. In 1980, approximately 40% of private sector workers were covered by a pension with a guaranteed payout, and about 80% of employees in medium-sized and large companies had such plans in 1985, according to data from the Labor Department. In 2006, only about 15% of private sector workers had guaranteed payout pensions, including 32% at medium and large organizations. In the public sector, a higher percentage of workers still are covered by guaranteed payout pensions, but the number of public sector workers has declined dramatically in recent years, accelerating as a result of the Great Recession. There are now 1 million fewer federal employees than when Ronald Reagan left office, and public sector employment as a percentage of the population is at a 30-year low. Many public pension plans are plagued by a serious threat to their stability due to underfunding by state and local governments. According to some calculations, states have funded only about 80% of their pension liabilities, leaving a $3.32 trillion funding gap, an estimate which understates the shortfall due to investment declines from the latter half of 2008. 10-1 study concluded that there is a less than 5% chance that the current pattern of pension fund investments can fulfill obligations to retirees in 15 years. In addition to pension liabilities, states are responsible for more than $530 billion in other unfunded benefits, including retiree health and dental insurance, life insurance, and legal services. The public pension funding gap extends to major U.S. cities as well. All of this underfunding predates the Great Recession, which has made the shortfall even more severe. In addition to dwindling in importance, employer-defined benefit pensions have shown poor economic results. American pensions were some of the hardest hit in the world by the Great Recession and stock market collapse, falling in value by 37% from their peak in 2007. They have still not fully recovered. Even at the largest corporations in the United States, pension plans are underfunded. Only 18 of the 338 companies in the S&P that offer defined benefit plans are fully funded, and 7 companies, including the nation's largest, ExxonMobil, had more than a $10 billion funding deficit in 2011. As private employers have shifted away from providing defined benefit pensions, they have turned to defined contribution plans like 401(k)s instead. Unlike traditional defined benefit pensions, defined contribution plans allow employees to set aside fixed amounts of money into investment accounts. That amount is excluded from their gross wage when calculating taxable income, lowering their tax burden. One advantage of this method is that the 401(k)s and IRAs are somewhat portable from job to job. But workers' eventual retirement income from these accounts depends entirely on how much money they set aside during their working lives and how well the stock market and investments in their accounts performed. Employers have greatly preferred 401(k)s over defined benefit pensions because workers shoulder the primary responsibility for funding them rather than the employer. The growth of the 401(k) stems from legislation in the late 1970s. In the Revenue Act of 1978, Congress inserted a new section into the tax code, Section 401(k), that allowed workers to take part of their pay as tax-free deferred compensation. Section 401(k) was not the first tax provision that allowed Americans to save for retirement in tax-deferred accounts. Individual retirement accounts have been created as part of the 1974 Employee Retirement Income Security Act, ERISA, and 403(b) accounts, tax-deferred accounts for employees of nonprofits, have been around since the 1930s. But Section 401(k) was the first provision that allowed workplace-sponsored tax-deferred retirement accounts for all types of employees, and thus opened the door for the proliferation of such accounts that has occurred in the decades since. Since 1979, defined contribution and 401k retirement plans have gone from covering only about 17% of the private workforce to about 42% today. In some businesses, the employer contributes to the 401k plans that are managed by the employees, but the contribution amount is much less than under a defined payout pension. These individual retirement plans, most prominently 401(k)s, have been sold to American workers as the new and improved successors to traditional pensions. 401(k)s, however, have proven to be more costly for both the government and employees than the system they replaced. They force workers as individuals to face a number of significant risks, including losing their savings to a stock market downturn, through investing their money unwisely, or outliving their savings. U.S. workers were insured more efficiently and more securely under the traditional pension system. The risks individuals face in a defined contribution plan include market risk. Workers who have 401(k)s risk losing a chunk of their savings in a market downturn or crash, a particularly damaging prospect for workers nearing retirement. The costs of this risk were shown clearly in the financial crisis. Individuals lost $2.8 trillion in the value of their 401k or IRA plans. Investment risk. In addition to the overall volatility of the market, 401k(s) force workers to manage their own portfolios, which often leads to lower than optimal performance for many reasons. Workers sell winning investments while holding losing ones, tend to hold undiversified portfolios, are invested in too many high-risk stocks, and generally lack the expertise necessary to earn high returns. A study by the National Bureau of Economic Research found that more than 1/4 of baby boomer households, who are due to begin retiring over the next decade, thought hardly at all about retirement, and that financial literacy among boomers was alarmingly low. Half could not do a simple math calculation, divide $2 million by 5, and fewer than 20% could calculate compound interest. Longevity risk. Retirees relying on their 401k to supplement Social Security may outlive their savings. Contribution risk. Workers often contribute too little or too inconsistently to their accounts to accumulate a sufficient nest egg. Financial experts say it will take a monthly retirement income of about 70 to 80% of pre-retirement income levels, in addition to $200,000 to $300,000 in personal savings, for the average American to have a secure retirement. 19 Yet most older Americans have saved only a fraction of that. In 2010, 75% of Americans nearing retirement age had less than $30,000 in their retirement accounts. About half of all Americans are at risk of not having sufficient retirement income, and 3/5 of low-income households are at risk of not having sufficient retirement income to maintain their pre-retirement standards of living at age 65, which was already a low standard to begin with. All of these problems were exacerbated by the Great Recession. Leakage risk. Workers often whittle away their savings by cashing out assets when they change jobs, by borrowing from their 401(k)s, and by making hardship withdrawals from their accounts before retirement. High account fees charged by investment management firms exacerbate these risks and take a big bite out of already inadequate savings. The hyper-individualized administration and investment management generates excessive costs that are ultimately absorbed by the workers themselves. By some estimates, these costs are more than twice as high as they would be under a more efficient retirement system. It is important to emphasize that these risks and costs are an inherent part of the 401k system. It follows that reforms like stricter regulations on brokers, disclosure of 401k fees, or requiring plan sponsors to offer lower-cost index funds would fail to fix this fundamentally broken system. Fees would still remain high and workers would still be forced to shoulder most of the risks. Thus both the private and public components of the U.S. employer-based retirement system are under severe strain, as the Great Recession combined with pre-recession patterns of rising inequality and a diminishing social contract have taken their toll. Even when significant numbers of workers were covered by a guaranteed payout pension, the lack of portability provided a powerful disincentive for workers to change jobs or shift their careers. While 401ks can be more portable, they have shifted risks and costs onto employees and have failed to provide sufficient support for retirees. With defined benefit pensions covering fewer workers and defined contribution plans by definition riskier and more costly for employees, this leg of the three-legged retirement stool has grown too short and is too unstable to provide retirement security. The second failing leg of retirement well-being consists of individual asset ownership, centered on home ownership. For tens of millions of Americans, security in their elderly years has been directly linked to the value of their homes. Yet the rupture of the housing bubble illustrated in dramatic fashion the danger of over-reliance on home values for retirement security. Homeowners lost approximately $8 trillion in home equity during the Great Recession, a 53% drop in the overall value of the national home ownership stock. About 10.7 million Americans, 22% of all homeowners, are still underwater today, owing more on their mortgage than their home is worth. These homeowners are, in effect, flat broke if they have no other accumulated savings or retirement vehicle. This has been devastating for Americans' retirement well-being because home ownership accounts for a large proportion of the assets owned by much of the population. During the 2000s, before the housing market crash, real property accounted for between 77 and 85% of tangible household assets. Individual levels of non-home assets are also too low to serve even as a personal buffer, let alone the basis of a secure retirement. A recent study found that nearly half of Americans, 43.6%, do not have enough savings to cover basic expenses if they were to lose their source of stable income. These 132.1 million liquid asset poor Americans include many members of the middle class and upper middle class, more than a quarter of households earning between $55,465 and $90,000 per year, the entire range of which is above the median household income of $50,054, have less than 3 months of liquid savings. Over 30% of all households do not have a savings account at all. The lack of private savings has weakened the other legs of the retirement stool. More than 1 in 4 households has had to withdraw savings from their 401k or 403b retirement accounts before retirement to pay for emergency savings, the leakage risk of 401k plans. These early withdrawals totaled $60 billion out of a total of $176 billion, 40%, contributed by employees to defined contribution accounts in 2010, and early withdrawals come with heavy penalty fees. 28 with defined contribution plans already insufficient to cover retirement needs. The lack of private savings to cover working-age contingencies has made the problem worse. The second leg of the three-legged retirement stool, other savings and asset ownership, has proven to be as weak and unreliable as employer pensions and defined contribution plans. And with home prices recovering at a glacial pace in most parts of the country, this loss in equity has significantly reduced the economic security of the lower and middle classes, which are less likely to have pensions and other assets such as private savings, beyond home ownership, to sustain them. In the decades ahead, the vast majority of baby boomers and other retirees will be almost completely dependent on the single leg of Social Security for their retirement. The bottom 2 income quartiles for those aged 65 and over depend on Social Security for at least 80% of their income, but even the second richest quintile still depends on Social Security for nearly half of its retirement income. Middle-income elderly, the 40th to 60th percentile, currently rely on Social Security for 2/3 of their income. Due to the inadequacy of pension plans and miscellaneous household savings, the one-legged stool of the U.S. retirement system is increasingly unstable. For more and more Americans, the dream of a secure retirement is threatened. Social Security has become a single-pillar national retirement system, a role for which it was never intended or designed. This development is not to be lamented, however. On the contrary, the centrality and stability of the public component of the American retirement security system should be embraced and built upon. Social Security is already one of the most popular public programs in the country. Numerous surveys show much greater support for preserving benefits for Social Security and Medicare than reducing them, even if it means raising taxes. A December 2012 Pew Research Center poll showed that 56% of people were opposed to raising the eligibility age for either Social Security or Medicare, and, even among Republicans only, more people disapproved of raising the eligibility age, and thus reducing benefits. A Kaiser poll from January 2013 had nearly identical results. 58% opposed any reduction to either Social Security or Medicare. 30% given the popular consensus about the looming budgetary shortfall. Many polls have explored public opinion on reductions in these social insurance programs. But few have looked at whether there is support for expansion of these programs. A late 2012 poll by the National Academy of Social Insurance asked this question, however, and found strong public support. 3 out of 4 respondents said that we should consider increasing Social Security benefits, and 84% said that current benefits are inadequate. In the wake of budget negotiations in February 2013, Pew found that 41% would increase spending on Social Security while only 10% would decrease it. The United States is also less generous to its seniors than other advanced nations. The U.S. gross replacement rate for the average earner, how much of a person's income is covered by mandatory pension programs, is 39.4%, below the average of 57.3% for countries in the Organization for Economic Cooperation and Development, OECD, and 61.6 for countries in the European Union. On other pension replacement metrics like gross pension wealth, which is indexed for life expectancy and retirement age, the United States also lags behind. These measurements by definition only assess pensions, which use income as a proxy for relative levels of well-being. But that income is used to purchase the services, food, shelter, medical care, and other items that a retiree needs. In many developed nations, healthcare, transportation and mass transit, and senior care in institutions are more cost-efficient and less expensive. The United States ranked 19th globally in a recent retirement security index, behind nearly every advanced nation except the United Kingdom. Due to high health costs on seniors and the inadequacy of defined contribution savings plans, the United States even ranked behind countries including Slovenia, Slovakia, and the Czech Republic. Using pensions retirement income as the main measure of elderly well-being fails to provide a complete picture of quality of life and makes the relatively stingy U.S. public retirement system seem more generous than it really is. Instead of trying to diminish the importance of Social Security as a share of retirement income, we should increase it and expand it so that it becomes a more robust core of Americans' retirement system. Insanity has been defined as repeating the same action and expecting a different result. By that definition, the conventional wisdom that Social Security, the most successful element of retirement security, should be reduced, while Americans should be compelled to rely more on less successful private alternatives, is insane. The private alternatives to Social Security, tax-favored employer pensions, tax-favored individual savings accounts, and individual asset ownership, have all failed in comparison to Social Security. Rather than hoping that private sources of retirement income will show better results in the future, we should reduce the reliance of most American workers on those unreliable alternatives by expanding the popular, efficient, and successful Social Security system. We propose to replace most of the country's current, inadequate, hybrid public and private retirement system with a two-part, wholly public system called Expanded Social Security. Expanded Social Security would have two distinct parts. The first part, Social Security A, would be similar to the current Social Security Old Age and Survivors Insurance (OASI) program, which provides a retirement benefit related to earnings. The second part of Expanded Social Security would be a new universal flat benefit, Social Security B, to supplement the traditional earnings-related benefit that would continue to be provided by Social Security A. Some version of this double-decker public system is similar in form to that in a handful of other countries. Japan, Canada, and Luxembourg, to name a few, have both a basic flat public pension and a public defined benefit program based on earnings. In order to illustrate our proposal, we have designed a scenario in which, when Social Security A and B are combined, a career medium earning worker would be guaranteed 60% of his or her average working wage in retirement income. This amount provides a much sturdier foundation than the current system, which replaces only about 40% of income for the average worker. This level also makes Social Security B's flat benefit similar to the poverty line, thus essentially eliminating poverty among the elderly. We use the year 2035 as our example year for our calculations because it allows for medium-term projections and is the first year of data available after the estimated exhaustion of the Social Security Trust Fund, and thus is the focus of contemporary discussions. For the sake of clarity, the scenario excludes some factors, like arrangements for a transition from the old system to the new, which would be significant if a version of our proposal were adopted. 38 Nevertheless, the example provides a useful glimpse at one form that expanded Social Security could take and basic estimations of its cost and its benefits for elderly earners across the income spectrum. If we assume that Social Security benefits are maintained at current levels and that there are no additional cuts to the program, we propose to set Social Security B at $11,669 per year for all elderly earners. This will guarantee a replacement rate of 60% for a medium earner based on calculations derived from Social Security Administration data. With this flat benefit, low-income earners will see their replacement rates boosted to nearly 100%. High-income earners, those making around $100,000 per year, will have a public replacement rate of 46%, and very high earners, $150,000 per year, will have a public replacement rate of 35%. The proposed system would be much more progressive than the current retirement security landscape. Because of the flat benefit, lower-income and middle-income earners would have higher levels of income in retirement. Upper-middle-income earners would also likely be at least equally as well off. The increase in income from the flat benefit would offset most or all of the income they derive from employer retirement programs. The highest income earners would bear the burden of these proposed changes, as they would no longer be able to rely on the tax-favored programs that primarily benefit affluent individuals. However, they would still receive a higher level of direct public benefits than they do currently due to the universal addition of Social Security B. The 2012 Trustees Report projects that the existing Social Security Program, OASI, will have 78.1 million beneficiaries in 2035. We add to this total the approximately 1.5 million elderly Americans who currently receive SSI but not OASI for a total of 79.6 million people projected to be eligible for Social Security B in 2035. Providing Social Security B's flat benefit to the projected eligible population would initially cost $928.9 billion in 2035.40. The program's cost would rise yearly in step with the growth rate of the retiree population. The Trustees Report estimates this rate will be 0.5% in 2035, so we can expect the cost of Social Security B to grow at the same pace. This cost estimate might sound large, but it must be taken in proper context. Figure 6 contrasts the present retirement security system, extrapolated to 2035, with our hypothetical alternative. As the graph indicates, if the current system were unchanged, the publicly sponsored retirement system in 2035, defined as Social Security and SSI plus dispersals from tax-favored employer and individual retirement plans, would be equal to 13.1% of GDP. Of this total, a greater share would be tax-favored private retirement plans, 7.5%, than Social Security or OASI, 5.6%. Because these tax-favored plans skew disproportionately toward upper-income Americans, this plan is not only inefficient but also inequitable. The bar on the right shows a version of our expanded Social Security plan, consisting of Social Security A, Social Security B, and an optional, limited tax-favored private savings plan with a cap of $5,000 per year. For more on the optional third part, see section below. The two-part public core of the proposed expanded Social Security system would cost 9.3% of GDP, and the optional additional tax-favored private savings component would add, at most, 3.2% of GDP for a total cost of 12.4% of GDP. Thus, as this illustration shows, spending from Social Security A and B, combined with dispersals under a modest tax-favored private savings plan, adds up to less as a share of the economy than the 2035 version of today's far less fair and far riskier publicly sponsored retirement system as a whole. For additional comparison, this projected cost of the proposed two-part program would still be less than that currently spent by some OECD countries on their retirement systems. France, for example, spends 12.5% of GDP on its retirement programs. Thus, the combined costs for Social Security A and B seem like a relative bargain considering that they would be providing retirement income for a considerably older population than exists in any OECD country today. One benefit of expanded Social Security is that it would allow the total public retirement benefit for most Americans to be dramatically increased without increasing the payroll tax rate. Under our proposal, the two components of expanded Social Security would be paid for by separate revenue streams. Social Security A would be paid for by payroll taxes. Social Security B, the new universal, flat benefit, would be financed by revenues other than payroll taxes, either general revenues or a dedicated tax or taxes. Although there is no short-term Social Security crisis, there is a long-term Social Security problem. In 2010, the program began paying out more than payroll taxes brought in. The Social Security Trust Fund is projected to make up the difference for 2 decades, but around 2033 the trust fund will run out. Thereafter, the gap between Social Security's revenue and spending is projected to be between 1 and 1.5% of US GDP. This shortfall needs to be addressed to maintain the current base level of benefits so that the additional expansion of the program can be implemented. The reform of OASI Social Security A should consist solely of payroll tax increases, rather than benefit cuts. Today, OASI is paid for by the combined employer-employee payroll tax, which is set at 12.4% of wages below $113,700. Because of increasing wage inequality in America in the last generation, Social Security taxes, which covered 90% of wages in 1980, now cover less than 84%. Increasing the payroll tax until it covers 90% of wages once again would plug half of the shortfall. Lifting the lid on Social Security payroll taxes as a percentage of wages entirely could eliminate the current funding gap altogether. Another financing option would be to broaden the base of tax income by taxing unearned income such as capital gains, investment income, and dividends at the same payroll rate that affects earned labor income. As it stands, unearned income is exempt from payroll taxes. Expanding the taxable base by including both earned and unearned income would generate more revenue for Social Security and would be very progressive, as most unearned income accrues to the wealthiest individuals. Other legislation is moving in this direction. The 2010 healthcare reform law included a provision to tax unearned income at 3.8% to help finance Medicare. While a reformed payroll tax would continue to pay for OASI, Social Security A in the new proposal, we need to look elsewhere to fund the expansion of Social Security that we believe is necessary. The new flat benefit, Social Security B, could be paid for out of either general revenues or a new dedicated tax or taxes, which might include portions of a federal value-added tax, VAT. Many defenders of the current payroll tax-only system of financing fear that mingling other funds with payroll taxes would undermine public support for the direct public benefits portion of the program. The example of Medicare, however, suggests otherwise. According to Congressional Budget Office data, in 2010 payroll taxes and other earmarked taxes covered more than 93% of the cost of Social Security. But in the same year, little more than a third of Medicare's costs were covered by payroll taxes. Slightly more than half were paid for by general revenues, while roughly a seventh of Medicare's costs were provided by beneficiary premiums and other earmarked receipts. If premiums are factored out, then other revenues covered roughly 60% of Medicare's costs while payroll taxes covered around 40%. The difference between Social Security and Medicare arises from the fact that Medicare consists of multiple programs. Medicare Part A, which covers hospital insurance, is financed by payroll taxes, while Medicare Parts B and D, which cover doctors and prescription drugs, are paid for by general revenues and premiums. Medicare Part C consists of private plans. If public support for a social insurance program depends on whether it is financed wholly by payroll taxes, with no infusion from general revenues or other sources of revenue, then public support for Medicare should be weaker than public support for Social Security. But there is no evidence for this. On the contrary, both Medicare and Social Security enjoy strong public support. Indeed, it is likely that few Americans understand how the programs are financed. Their popularity arises from the perceived need for them and the perceived as well as actual benefits, not from the specific details of how they are paid for. The long-term funding gap for the main part of Social Security can be fixed by broadening the payroll tax base to high incomes or untaxed gains, and the addition of the universal flat benefit can be funded with general revenues or a new dedicated tax or taxes. Together, this will create a solvent, more robust social insurance system. The expanded Social Security system that we propose is designed to increase the public component of retirement income for most Americans and to reduce the need for reliance on tax-favored or taxable private savings without increasing payroll taxes that hurt American businesses. The fact that, under the expanded Social Security plan, a majority of Americans would be less dependent on vanishing employer pensions, unreliable IRAs and 401(k) and inadequate household wealth is a feature of the expanded Social Security plan, not a bug. Nevertheless, individuals and families would be free to amass additional private savings for retirement, to supplement the more generous public retirement system that we propose. This would be most relevant for higher-earning individuals for whom expanded Social Security will not replace as large of a share of their pre-retirement earnings. It is not clear, however, that such optional, additional private retirement savings should be subsidized by taxpayers through favorable tax treatment, if the benefits for tax breaks for private retirement savings are enjoyed chiefly by the affluent, as is currently the case. This year, the government will spend $165.4 billion through these tax expenditures to subsidize individual retirement savings, nearly 80% of which will accrue to the top 20% of earners. With all Americans receiving expanded Social Security, the need for these regressive tax-based benefits will be much less pressing. No public interest justifies the provision of subsidies through the tax code for the private retirement savings of the affluent, yet that is exactly what current policy does. If Congress, after enacting a version of expanded Social Security, also wanted to promote individual savings for middle-class Americans, it should consider abolishing 401(k) and other tax-favored individual retirement accounts and replacing them with simple, universal private retirement savings vehicles with strict contribution limits that are more efficient and equitable. Defined contribution plans can exploit economies of scale in order to lower management fees and other administrative costs if individual savings are pooled and if churn is minimal, as in index funds. This is the logic behind proposals that all Americans, not only federal employees, be allowed to invest in the federal government's thrift savings plan. The same logic underlies Senator Tom Harkin's proposal for universal, secure, and adaptable USA retirement funds and economist Teresa Gillidux's proposal for guaranteed retirement accounts, GRA. While the details differ, all of these social insurance plans would promote risk sharing and minimize administrative costs by creating large pools of savings. In addition, the USA retirement funds and GRA would be designed to protect savers to varying degrees against the tumult of stock market fluctuations. The addition of a private retirement savings element to expanded Social Security would need a cap on contributions so that the program helps middle-income earners without becoming a lavish subsidy for the rich. In our scenario, we have a cap of $5,000 per year into either a GRA or equivalent universal retirement account. But a warning is in order here. It is easy to imagine the private money management industry, threatened by the expanded Social Security proposal, adopting a version of our Social Security B proposal for a flat benefit and combining it with an expanded tax-favored private retirement system, perhaps along the lines discussed above, while cutting or eliminating today's earnings-based contributory Social Security program, which would become Social Security in expanded Social Security. Indeed, many past proposals for the partial or complete privatization of Social Security have included a flat, means-tested public benefit to be supplemented by an expansion of tax-favored private savings. In our view, any such policy would defeat the purpose of our expanded Social Security program, which is to reduce, not increase, the reliance of American retirees on tax-favored pensions and tax-favored private retirement savings accounts alike. Any proposal to create a public flat benefit as an alternative to Social Security's public contributory benefit, rather than as an add-on, should be rejected as an attempt at backdoor privatization of Social Security. The three-legged stool of retirement security in the United States, Social Security, employer plans, and private savings, mostly derived from home ownership, has become wobbly and unstable, with employers walking away from their traditional role of providing a private pension, with defined contribution plans like 401(k), S and IRAs dependent on the vagaries of the stock market, and with low levels of personal asset ownership. Social Security now is the only stable leg remaining that is able to prop up retirement security for hundreds of millions of Americans. We propose to replace a wobbly stool and its failing private components with a single, sturdy, portable, and purely public column made up of a strong pillar atop a solid foundation, expanded Social Security. An expansion of Social Security along the lines that we envision not only would be good for America's retirees, it also would be good for the broader macroeconomy. It would act as an automatic stabilizer during economic downturns, keeping money in retirees' pockets and stimulating consumer demand, especially among low and middle-income individuals who are more likely to spend an extra dollar on goods and services than are affluent individuals. In addition, unlike some elements of the current retirement system, such as pensions, no component in the expanded Social Security plan is contingent on benefits provided by particular employers. By replacing all or most employer-provided, tax-favored retirement savings plan with a new flat public benefit and, perhaps, a modest optional savings plan, expanded Social Security would completely unlink the retirement income of individual Americans from particular jobs and particular employers. An expanded Social Security would help American businesses trying to compete with high value-added foreign companies that don't have to provide pensions to their employees, because those countries already have national retirement plans. The combination of today's Social Security A with our proposed Social Security B to create expanded Social Security would provide a stable, secure retirement for every American and contribute greatly toward a solid foundation from which to build a strong and vibrant 21st century economy. America's hard-working citizens deserve no less. The often expressed concern that the aging of the population will lead to a decline or stagnation in living standards has no basis in reality. While an increase in the number of retirees relative to the number of workers can slow the increase in living standards through time, productivity growth will speed it up. Even slow rates of productivity growth will have an impact through time in raising living standards that will swamp the effect of even the most adverse demographic changes. Figure 1 contrasts the impact of the increase in the number of retirees to workers on reducing living standards over the period from 2012 to 2035, the peak years of the baby boomers' retirement, with the impact of annual productivity growth of 1%, 1.5%, and 2% in raising living standards. As is shown, the decline in living standards due to the increased number of retirees per worker is 8.5%. This corresponds to a projected decline in the ratio of workers to retirees from 2.8 in 2012 to 2.0 in 2035. The implication of this number is that the decline in the number of workers to share in the burden of supporting each retiree over this period would lead to a decline of 8.5% in the living standards of workers if there was no increase in productivity growth. This assumes that consumption of retirees is equal to 85% of the consumption of the working-age population. See the technical notes at the end of the paper for a full explanation of the construction of all figures and tables. Of course, there will be increases in productivity growth over this 23-year period. The first bar shows that a 1% rate of annual productivity growth will compound to a 25.7% increase in output per hour over a 23-year period. The cumulative gain from a 1.5% increase in productivity growth would be 40.8%, and from a 2% rate of productivity growth 57.7%. Even in the most pessimistic case, which roughly corresponds to the weak growth during the period of the productivity slowdown from 1973 to 1995, the gains from higher productivity are more than 3 times as large as the decline in living standards that would result from the declining ratio of workers to retirees. In the middle scenario, which shows productivity growth that is roughly in line with the period since 1995, the gains from productivity growth are almost 5 times the losses calculated from the decline in the ratio of workers to retirees. In the case of 2% annual productivity growth, which corresponds to the growth rate of the economic golden age in the 3 decades following World War II, the impact of productivity growth in raising living standards would be almost 7 times as large as the impact of demographics in reducing living standards. It is worth noting that even these numbers seriously overstate the impact of demographics relative to productivity growth in 4 important ways. First, they focus exclusively on the rise in the ratio of elderly dependents to workers. They ignore the projected decline in the number of children per worker. While there is projected to be little change in the ratio of people under age 20 to people between the ages of 20 to 64 between 2010 and 2030, there has been a sharp decline in this ratio since 1965. In fact, the drop in this ratio more than fully offsets the projected rise in the ratio of people over the age of 65 to the working age population. The Social Security trustees project that the ratio of total dependents, young and old, to the working age population will never exceed the level it reached in 1965 when the baby boomers were all still under the age of 20. The second reason that just looking at the ratio of the over 65 population to the prime working age population overstates the impact of demographics is that the percentage of prime age people who are employed is not fixed. The share of the prime age population in the workforce has been increasing over the last 5 decades due to the increase in the share of women who enter the paid workforce. While this process has been largely completed by 2012, there is still likely to be at least some marginal increase in the share of women entering the labor force. It is also possible that many workers will opt to work longer hours. While it would be a negative development if workers felt that they had to work longer hours to maintain their standard of living, there is also the possibility that if real wages rise in response to a shortage of labor, many workers may respond by putting in more hours over the course of the year. This means that the rise in the ratio of dependents to workers will be larger than the rise in the ratio of dependents to working hours. The third reason is that more people over the age of 65 may opt to continue working later in their lives, even assuming no further legislated changes in the age at which workers become eligible for normal retirement benefits under Social Security or for Medicare. Workers who reach age 62 after 2022 will not be able to get normal retirement benefits under Social Security until age 67. Improvements in the health of the population will leave many workers able to work until older ages. Some workers will clearly take advantage of this opportunity, especially if a labor shortage pushes up wages. Finally, the scenario described in Figure 1 shows the absolute worst period for the impact of demographic change on living standards. The ratio of retirees to workers is projected to barely increase and then level off for the rest of the century. This means that all of the projected gains in productivity growth can be translated into higher wages and improvements in workers' living standards. As a result, workers can expect real wages that are 10.5% higher by 2045 than they were in 2035 in the slow productivity growth scenario and 21.9% in the fast growth scenario. By 2055, real wages would have increased by 22% in the slow productivity growth scenario and 48.6% in the fast productivity growth scenario from their 2035 levels. In the fast growth scenario, they will be more than double their current level by 2055, even assuming that a larger portion of wages must be diverted to support the living standards of a growing population of retirees. For these reasons, Figure 1 exaggerates the actual impact of the aging of the population on the well-being of the working age population. Clearly, productivity growth will have far more impact on the living standard of future generations. The impact of even small differences in productivity growth sustained over a long period of time will far exceed the negative effect on living standards of the projected increase in the ratio of retirees to workers. Of course, wages for most workers have not been rising in step with productivity growth, but this raises a completely different set of policy issues. The focus of policy on deficits has been a distraction from policies that might reverse the upward redistribution of income that we have seen over the last 3 decades. This shift has had much more impact on the living standards of young people today than our budget policy, and if the pattern of upward redistribution is allowed to continue, its impact on the living standards of most of our children and grandchildren will swamp the impact of any plausible budget path over the next 2 or 3 decades. At this point, there is a large body of research on the impact of deficits on living standards. The conclusion of most of this research is that the effect of deficits is generally limited and, depending on the timing and the purpose of the deficit, it could actually increase growth. The standard argument for how deficits reduce growth is that they do so by pushing up interest rates and thereby crowding out private investment. This argument is only plausible when the economy is near full employment, however, since otherwise there would be no reason a budget deficit would need to result in higher interest rates. In a period in which the economy is operating below its full employment level of output, like the present, the economy is not supply constrained. Additional demand from a deficit can be met by additional output, so there is no reason that it must crowd out private investment. As a financial matter, the additional borrowing by the government can be accommodated by the increased supply of money from the Federal Reserve Board. Typically, this just means lowering short-term interest rates by enough to offset any impact that increased government borrowing has in raising interest rates. In the current downturn, with the Fed engaged in quantitative easing, it is effectively directly buying up much of the new debt being issued by the government to finance its deficit. When the Fed acts to prevent the deficit from raising interest rates, there is no plausible mechanism through which deficits can reduce future growth. If interest rates do not rise, then there is no reason that investment should decline. In fact, the increase in demand from the deficits is likely to boost investment. There is considerable research that shows that the growth of demand and corporate cash flow are important determinants of investment, and generally have more impact than interest rates, especially with new and fast-growing firms. For this reason, deficits in periods of high unemployment are more likely to increase investment than reduce it, even if they did lead to some increase in interest rates. Sustaining high levels of demand in a downturn can also have other positive long-run effects on growth. Most immediately, by keeping workers employed, it can reduce the likelihood that workers might become difficult to employ or even drop out of the labor force as a result of long periods of unemployment. There are also important generational effects. The children of unemployed workers are likely to suffer in school and have poorer subsequent career prospects. If deficit spending can sustain higher levels of employment, it can mean higher potential GDP in the near future by keeping down the structural rate of unemployment, and also higher GDP in the long term, as children of otherwise unemployed workers would be better prepared to be productive workers. In short, there is little reason to believe that deficits in periods of high unemployment should be cause for concern. They not only have the potential for increasing GDP in the short term but will likely boost the future output of the economy as well. Even deficits that are run when the economy is close to full employment are likely to have fewer negative effects than is generally believed. If a deficit is run when the economy is near full employment, it can be expected to lead to higher interest rates. However, only a portion of the resulting crowding out occurs in investment. Much of the crowding out is likely to be in consumption, either directly, by making various forms of borrowing more expensive, or indirectly, through a negative wealth effect. If higher interest rates lead to lower stock and/or house prices, then it would be expected that consumption would drop due to the resulting decline in household wealth. In recent years, it is likely that most of the crowding out or crowding in associated with higher or lower deficits has been in consumption rather than investment, as shown in Figure 2. At the peak of the business cycle in 1989, the deficit was equal to 2.8% of GDP. At the business cycle peak in 2000, the deficit had turned to a surplus of 2.4% of GDP, a shift of 5.2 percentage points. However, the non-residential investment share of GDP increased by just 1.2 percentage points between these two cyclical peaks. The largest increase in share of GDP was consumption, which rose by 3.4 percentage points from 65.7% of GDP in 1989 to 69.1% of GDP in 2000. Insofar as the reduction in the deficit can be attributed to reduced government consumption, government investment will be discussed shortly. Government consumption was simply replaced by private consumption. While this may lead to more satisfactory outcomes if government consumption is generally valued less than private consumption, it does nothing to increase future growth. The other component of GDP that should be affected by deficits is the trade balance. In principle, higher interest rates can lead to a higher valued dollar as foreign investors seek out dollar-denominated assets to take advantage of the relatively better returns available in the United States. The higher dollar then leads to a larger trade deficit as imports become cheaper for people in the United States and US-made goods become more expensive for people living in other countries. In this textbook case, a higher budget deficit then can translate into a higher trade deficit. Contrary to the standard theory, however, the link between the budget deficit and the trade deficit has proven to be weak or non-existent, primarily because the value of the dollar has not moved in the direction predicted by economic theory. The dollar actually rose strongly in the late 1990s, even as the budget moved to surplus. This led to a trade deficit of 3.9% of GDP in 2000, compared to 1.6% of GDP in 1989. This rise in the dollar was largely the result of political and strategic decisions made by developing countries in response to the bailout from the East Asian financial crisis in the early 1990s. The harsh terms that the International Monetary Fund, IMF, imposed on the countries of the region led developing countries to begin to accumulate massive amounts of foreign exchange reserves, which mostly meant dollars. These reserves were insurance for developing countries against ending up in the same situation as the East Asian countries, needing a bailout from the IMF. However, this development broke the link between budget deficits and trade deficits. With the value of the dollar largely a function of political decisions by developing countries, there is no reason to believe that a lower budget deficit would imply a lower valued dollar. With the channel connecting budget deficits and trade deficits largely dysfunctional in the current world economic environment, the crowding out or in from larger or smaller budget deficits at full employment will mostly be felt on domestic consumption and investment. Even assuming that the impact of deficits at full employment follows the textbook story, the impact of deficits on growth is considerably less than is generally believed. In 1996, the Congressional Budget Office projected future GDP growth under 3 alternative budget scenarios, one of which specified that the government would run a balanced budget every year through 2030. Figure 3 shows the projected growth in the balanced budget scenario, red, compared with the actual growth through 2010 and CBO's projected growth through 2020, blue. As can be seen, the economy has actually done far better through 2010 than the projected balanced budget path. This is in spite of the fact the government has run substantial deficits for the last decade, and the economy plunged into the worst slump since the Great Depression following the collapse of the housing bubble in 2007. Furthermore, the CBO projections show the economy bouncing back over the rest of this decade. Its most recent projections imply that by 2020 per capita GDP will be 13.4% higher than the balanced budget scenario that it had projected back in 1996. In other words, if the point of balancing the budget in 1996 was to make the country richer in the future, more was accomplished in terms of increasing growth without having balanced budgets through most of this period than would have been accomplished had the economy had balanced budgets each and every year over the subsequent quarter century. Put another way, we did far better in terms of growth than the advocates of balanced budgets of that period ever could have hoped. If they considered the balanced budget path projected for 2010 and 2020 to be acceptable, then they should be more than happy with the economic performance we have actually seen. The final point to be made about deficits is that they may be run to promote various forms of public investment, such as infrastructure spending, education, or research and development. These forms of public capital increase the economy's productive capacity. In fact, several studies have found that on a per-dollar basis, public investment increases productivity by more than private investment. This indicates that a deficit that is run to increase public investment will make the economy richer in the future, not poorer. In fact, the gains from running a deficit to increase public investment are even larger than they may immediately appear. If the economy is running near full employment, most of the crowding out from a deficit will be of private consumption, not investment. This means that a dollar increase in public investment may crowd out just 30 to 40 cents of private investment. If on a per-dollar basis, public investment is anywhere near as productive as investment in the private sector, then investments in public sector capital would be a huge positive from the standpoint of long-run growth even if they are done when the economy is near full employment. Of course, the gains are even larger in an economic slump, when there is likely no trade-off in terms of lost private sector investment. It could be argued that the gains would be even larger if additional public sector investment in a fully employed economy were offset by cuts in government consumption or tax increases. If political considerations make this impractical, though, the evidence suggests that increasing public sector investment is likely to increase growth even if it raises deficits. It is amazing that many highly respected people in policy debates use the national debt as a measure of intergenerational equity, implying that it represents an obligation imposed on future generations. This is a fallacy at every level. Most obviously, it is a fallacy because the debt doesn't tell us anything about the distribution between generations. The debt is currently held by people who are alive. At some point, everyone who is alive today will be dead. That means that whatever bonds that they hold will be passed on to future generations. At that point, the interest and the principal on the bonds will constitute payments within generations, not between generations. There could be important distributional issues. For example, if there is a large public debt and the bonds are concentrated among a small number of people. But that is a question of intragenerational equity, not intergenerational equity. There are also issues of efficiency, since the taxes needed to pay the interest on the debt will inevitably be associated with some economic cost. This would arise even if the bonds were equally distributed among the population, since it would still be necessary to raise the taxes needed to pay the interest. But the efficiency costs of taxation are substantially smaller than the annual interest burden. Furthermore, this is just one of many ways in which past arrangements can impose a burden on the economy in the future. To fully understand intergenerational equity, we need to look at all of the ways that current policies affect the future of the economy. For example, the government has claimed to literally tens of trillions of dollars of assets that could, in principle, be sold off to private individuals or corporations. Insofar as these assets are sold off, it creates a burden on future generations in much the same way as does the debt. This is most evident in the case of physical assets that can be readily privatized, like a highway. If the government sells off a highway to the private sector, it can use the proceeds to reduce its current debt. Several state and local governments have made such asset sales in recent years for exactly this purpose. However, if future generations must pay tolls to use a highway that otherwise would have been free, then they are not obviously better off than if they had a higher tax burden and the highway was still owned by the government. There are a wide range of physical assets held by the government, such as waterfront property, national parks, and other areas of scenic beauty. A government can reduce its debt burden by selling off such assets. This will lessen the need for government revenue, but it will mean that people who will want to use these resources in the future will in effect be taxed by the private parties who own them. Governments can also sell off claims to assets that are not strictly physical, such as use of the airwaves. This effectively allows private parties to tax the public for use of the airwaves. In the same vein, but of much greater consequence, the government can sell off, or award as prizes, patent and copyright monopolies in a wide range of areas. This means that the government will stop competitors in order to allow private actors to earn monopoly profits in various sectors of the market. The cost to consumers and the deadweight loss to the economy can be enormous, yet this issue is never raised in discussions of intergenerational equity. This point can be seen most clearly in the case of prescription drugs. As a result of the fact that companies have patent monopolies, drugs that would sell as generics for between $5 and $10 per prescription can sell for hundreds or even thousands of dollars each. The difference between patent-protected prices and the free market price is on the order of $270 billion a year and will likely come to more than $3.5 trillion over the next decade. Obviously, the total cost to the economy of all patent and copyright protection is considerably larger. It is also important to recognize that one set of burdens can be traded off for the other. If we only focus on debt as a measure of intergenerational equity, then it can encourage trade-offs that are very much to the disadvantage of future generations. To build on the prescription drug example, suppose that we could easily replace the research that is currently financed through the patent system with a mechanism for directly financing research with government spending. Let's assume that this would require an amount of additional funding equal to 0.5% of GDP. If this led to a situation where all drugs could be purchased at their free market price, the projected net savings to patients over the next decade would be well over $2 trillion. However, if these savings all accrued to the private sector, much of the savings would actually be in the form of lower costs to Medicare and Medicaid and other public programs. But for purposes of this analysis, we will assume that all the savings go to the private sector. Then a commitment to lowering the deficit could lead the government to replace a more efficient mechanism of funding with patent-supported research, since the latter doesn't require direct payments from the government. While patent-financed research would unambiguously make future generations worse off under the assumptions used in this discussion, it would nonetheless lead to lower government spending and therefore lower future deficits and debt. If policy is driven solely by the desire to reduce the debt, then it would end up taking a route that lowered the debt by making future generations considerably worse off. Similarly, as noted previously, deficits can be run to finance public investment. If the government chooses not to invest in long-term improvements like infrastructure because of worries about deficits, it will hinder the economy and leave future generations worse off. As a measure of intergenerational equity, then, not financing necessary productive investments is as much of a burden on future generations as debt is. For example, if the government saves money by not maintaining highways, then future generations will bear this cost in terms of higher transportation costs and more time spent commuting. If the savings are on education, then output in the future will suffer due to a less productive workforce. There is one final aspect to the debt discussion that is tremendously misleading. The true burden of the debt is the economic distortions that result from the taxes needed to make the interest payment on the debt. This suggests that interest, rather than debt, is the better measure of the burden. To see why this matters, it is worth noting that the United States is presently issuing large amounts of debt at very low interest rates. The reason that the interest rates are so low is that the economy remains extraordinarily weak. As a result, even the ratio of debt to GDP is projected to hit levels not seen since the years immediately following World War II. The ratio of interest payments to GDP is near a post-war low, as shown in Figure 4. A brief thought experiment shows why it is interest burden and not debt itself that is the relevant factor in assessing the burden of the debt. CBO and other forecasters project that the economy will recover over the next several years. When it does, interest rates will return to more normal levels. When the interest rate rises, the price of long-term bonds falls. Table 1 shows the market price of a 30-year bond, with 27 years left until maturity, at various interest rates. The calculations in the table assume that the bond was initially issued with a 2.75 interest rate, roughly the prevailing interest rate in August of 2012. As can be seen, the price of the bond falls sharply as interest rates rise. If the interest rate on 30-year bonds rises to 6%, somewhat below its average in the late 1990s, then the price of the bond would fall to $57, little more than half of its initial value. If the interest rate on 30-year bonds rose to 8.5%, the average in the late 1980s, then the price of the bonds would fall to $39.80, less than 40% of its initial value. This means that if the concern was simply over the size of the government's debt, and not the amount of interest that it pays, there is an easy remedy. The government could simply take advantage of the rise in interest rates projected by the Congressional Budget Office and virtually all other forecasters to buy up large amounts of debt at sharp discounts. For example, if the government bought $3 trillion worth of 30-year bonds that were issued at near a 2.75% interest rate, when the interest rate rises to 6%, it can instantly eliminate almost $1.3 trillion worth of debt. If all that matters is the size of the debt, then the widely expected rise in interest rates in future years would provide the government with an opportunity to hugely reduce its debt burden. There is no obvious reason that the government should bother buying up debt in this sort of exercise, since it will not reduce the interest burden it faces. But if for some reason we need to reduce our debt to GDP ratio, then this is an obvious mechanism for accomplishing this result. This point can even be taken a step further. If the problem of the debt is somehow measured by the debt and not the interest burden, then if the US government were to ever face the Greek-style meltdown of which many deficit hawks have warned, it presents an enormous opportunity. If the concerns over the country's solvency sent interest rates on existing debt soaring, the bond prices would plummet. As Table 1 shows, if the interest rate rose to 12%, then the price of a 30-year bond issued at 2.75% interest rate with 27 years left to maturity would be just $26.56. This means that the Treasury could buy up its outstanding debt at a huge discount, sharply reducing its debt burden. Again, this would not change the interest burden, but if the concern is the amount of debt outstanding, this would be a quick way to make progress by this metric. There is one other important point that should be noted about the burden of the debt. At present, the Federal Reserve Board holds close to $3 trillion in assets, primarily government bonds and mortgage-backed securities. There are substantial interest earnings on these assets, most of which end up being refunded back to the Treasury. In 2011, the Fed refunded $83 billion back to the Treasury. This means that the actual interest burden to the federal government was considerably lower than the 1.5% of GDP shown in Figure 4. Subtracting the amount refunded from the Fed to the Treasury, the net interest burden in 2011 was just over $140 billion, or less than 1% of GDP. This is a lower interest burden than at any other point in the post-war era. The projections from the Congressional Budget Office and other authoritative sources assume that the Fed will soon sell off these assets so that its payments to the Treasury will fall sharply over the next decade. The reason for this assumption is that it is believed that the Fed will want to withdraw reserves from the system to head off the threat of inflation. While this is one route that the Fed could go to limit the potentially inflationary effects of excessive reserves in the banking system, it does have other options. For example, it could increase banks' reserve requirements. An increase in reserve requirements can be every bit as effective in reducing the money supply as directly pulling reserves out of the system. China's central bank relies heavily on changes in reserve requirements for controlling the money supply. Increasing reserve requirements would allow the Fed to keep more of its assets and thus continue to refund money to the Treasury. It is generally believed that changing the reserve requirement is a less desirable tool for conducting monetary policy than changing the amount of reserves in the system, because changes in the reserve requirement can be a blunt instrument with unpredictable effects. However, in the current context, where it is likely that there will be a prolonged period in which the Fed will want to gradually reduce the money supply, it might be quite reasonable for the Fed to lay out a schedule of increases in the reserve requirement over a set number of years. This would remove the problem that unpredictable changes in the reserve requirement could lead to instability in the system. Also, the additional controls over the financial system more generally provided by Dodd-Frank should mean that financial regulators could limit the extent to which non-bank financial institutions attempt to circumvent the higher reserve requirements imposed on banks. Table 2 shows the year-by-year impact on the deficit if the Fed were to continue to hold its current level of financial assets so that it is able to refund $80 billion a year to the Treasury over the next decade. The cumulative savings to the Treasury compared with the baseline scenario used by CBO is over $340 billion after factoring in the interest savings over this period. A higher reserve requirement would imply an increased wedge between the rate at which money is lent out and the interest rate paid on deposits. In this sense, the proposal to increase the reserve requirement to head off inflationary pressures can be seen as equivalent to imposing a tax on the banking system. While that is true, it is worth noting that there had been higher reserve requirements in place in the decades immediately after World War II, with the reserve requirement exceeding 20% of checking deposits for major money center banks for most of the decade immediate following World War II. It is now 10% and 0% for non-transactions accounts. At that time, no one discussed higher than necessary reserve requirements as a tax, and it is certainly not treated as a tax in historical accounts of federal taxation, which would have to show a higher level of taxation in those decades. At present, the data only includes taxes that are explicitly identified as such. As a practical matter, this is yet another situation in which the government's direction of resources goes far beyond its formal taxing and spending authority. Just as the power to sustain patent and copyright monopolies can involve payments for serving public purposes that are quite large relative to explicit tax flows, reserve requirements that are higher than necessary for prudential purposes can also imply a large implicit tax that is not counted in standard budget numbers. As noted earlier, the horror story in long-term deficit projections is almost entirely the story of the projected explosion of healthcare costs. While it is widely believed that the aging of the population is the main culprit, the additional costs associated with aging can be met without major disruptions to the economy. However, if healthcare costs unrelated to aging follow the path in the baseline projections, then it will present nearly insoluble budget problems. Of course, if healthcare costs follow this projected path, it would also take a devastating toll on the rest of the economy, too. Families would face enormous difficulties covering their healthcare costs, and companies that are unable to avoid paying for the healthcare benefits of their workers might follow the path of General Motors and Chrysler into bankruptcy. The fact that the aging of the population is not a major factor in future deficit projections can be seen from examining the projections for Social Security, a program whose costs are driven almost entirely by aging. The projected cost of Social Security rises from 5% of GDP in 2012 to 6.2% of GDP by 2033. It then stabilizes at this level for the next quarter century before gradually rising to 6.7% of GDP by 2087, the end of the CBO projection period. The increase in spending of 1.2 percentage points of GDP projected for the next 2 decades is a considerably slower pace of increase than the 0.9 percentage point increase in spending on Social Security that we actually experienced from 2000 to 2012. Insofar as the cost of Medicare and Medicaid are driven by aging, the rate of increase would be no more rapid than for Social Security, since the rate at which aging increases the number of beneficiaries for both programs will be roughly the same. The much more rapid rate of cost growth in Medicare and Medicaid is due to the growth of per-person healthcare costs, not aging. If Social Security is viewed as a standalone program, as it is structured under current law, the projected shortfall in the program is relatively modest. According to the Congressional Budget Office's projections, the program faces a shortfall that is equal to 1.6% of taxable payroll over its 75-year planning horizon. If this shortfall were fully closed by simply raising the payroll tax, the increase in the tax would be equal to 4.1% of projected wage growth over the next 30 years. Real wage growth is projected to average 1.1% annually. Furthermore, much of the projected shortfall is not due to aging, but rather due to the upward redistribution of income over the last 3 decades. When the formula for the cap on taxable wages was last changed in 1983, 90% of wage income fell under the cap. In recent years, the share of wages under the cap has hovered between 82% and 85%. CBO projects that the proportion of wages subject to Social Security taxes will fall back to 82% between now and 2032. According to the Social Security Administration's calculations, if the tax were raised enough to again cover 90% of wages, it would reduce the projected shortfall by 0.8% of taxable payroll, enough to cover half of the shortfall projected by CBO. This assumes that benefits are increased accordingly. If the cap on wages subject to the payroll tax was eliminated entirely, SSA projects that it would lead to a net increase in revenue of 1.91% of payroll, more than enough to fully eliminate the 75-year shortfall projected by the Congressional Budget Office. 26. In short, closing the projected shortfall in Social Security does not pose a daunting task. If it were to be done entirely on the revenue side, the amounts needed are well within the range of past tax increases for Social Security and can be spread over long periods of time. Figure 5 shows the CBO projections for federal government healthcare spending as a share of GDP under both a baseline scenario and a somewhat more pessimistic alternative fiscal scenario. In the former case, CBO assumes that annual age-adjusted spending increases at a rate of 1.6% more than per capita GDP growth in 2011 in all government healthcare programs. The difference between the rate of growth of age-adjusted spending and per capita GDP growth is projected to eventually fall to zero by 2087 for Medicaid and the healthcare exchanges. This measure of excess cost growth is projected to fall to 1% by 2087 in Medicare. The baseline scenario assumes a slower rate of cost growth through 2030 in Medicare than the alternative fiscal scenario. It is important to note that these projections do not assume that public sector healthcare costs rise more rapidly than private sector costs. These projections are based on the assumption that the growth of healthcare costs for the economy hugely outpaces the growth rate of the overall economy. In these projections, even in the more conservative baseline scenario, healthcare costs would be more than 36% of GDP by 2087. With per capita GDP projected to be over $171,000 by 2087, this implies per capita healthcare spending of more than $61,000 a year. Both figures are in 2012 dollars. To assess the plausibility of these projections, it is worth noting that the United States already pays more than twice as much per person as the average for other wealthy countries, even though the United States has little obvious advantage in terms of outcomes. It actually ranks near the bottom in life expectancy, and its record is mixed in most other outcome measures. Figure 6 shows per capita healthcare spending, adjusted for purchasing power parity, in the United States and several other wealthy countries. As can be seen, the United States already spends close to twice as much per person as Canada and Germany, two of the higher cost countries. It spends close to 2.5 times as much per person as Japan and the UK. The assumption that age-adjusted healthcare costs will continue to outpace per capita GDP growth implies that healthcare spending will continue to rise as a share of GDP. It also means that the gap between per-person spending in the United States and in other countries would continue to grow. This would mean that there would be enormous potential savings if people from the United States could take advantage of the more efficient healthcare systems in other countries. One way in which this could be done would be to negotiate arrangements with other OECD countries under which Medicare beneficiaries would be allowed to buy into other countries' healthcare systems. They would get their healthcare from the system in Canada, Germany, or whatever country they chose rather than the United States. The beneficiary and the government would split the savings, which would quickly run into the tens of thousands of dollars per beneficiary per year, according to current projections. The potential gains are sufficiently large that it would be possible to offer countries a premium of 10 to 15% above current costs, while still leaving a large gap to be shared. There are many other potential mechanisms for controlling costs. The point is that if costs for the US healthcare system can be brought in line with costs in other wealthy countries, then the United States would not face serious long-term deficit problems. If per-person healthcare costs in the United States could be brought near the level of other wealthy countries, the United States would be looking at long-term budget surpluses, not deficits. Given the nature of the problem, a serious discussion should focus on fixing the US healthcare system. It is misleading to discuss this as a deficit problem, as though the government is somehow spending too much money or not raising enough tax revenue. An honest discussion would focus on the inefficiencies of the US healthcare system and the need to get costs under control. Reducing or eliminating the public sector commitment to provide healthcare is beside the point. The public sector was initially given this responsibility because of the failure of the private sector to provide adequate health care for large segments of the population. The real policy goal is fixing the healthcare system so that the public can be assured of decent care at a reasonable cost. It is not simply reducing the budget deficit to an acceptable level. The emphasis on budget deficits in national policy debates over the last 3 decades has badly distorted national priorities. There has been an enormous amount of fundamentally confused thinking on budget deficits that has made its way into mainstream political debates. Future generations of workers will see a decline in living standards due to the effects of an aging population. Even using pessimistic assumptions, the average standard of living 25 to 30 years from now will be far higher than it is today, in spite of the projected rise in the ratio of retirees to workers. Furthermore, the potential harm from budget deficits has been seriously misrepresented. If a budget deficit occurs when the economy is below full employment, as is the case presently, it will almost certainly make future generations of workers better off, rather than worse off. Even deficits that are run when the economy is near full employment are likely to be less harmful than is generally believed. Also, if the deficit is run to increase public investment, it is likely to be a net positive for future generations. There are also serious misunderstandings in the national conversation about the nature of the burden imposed by government debt. The debt is not a measure in any way of intergenerational burdens. It is simply one of many ways in which the government commits flows of income in the future. In addition, it is important to recognize that the real burden of debt is measured by the size of annual interest payments, not the size of the debt. As of 2012, the ratio of interest payments to GDP was near its post-war low. Finally, the long-term deficit horror stories that appear frequently in public discussions are driven almost entirely by projections of exploding healthcare costs. If health costs actually follow the current projected path, it will have a devastating impact on the economy regardless of what is done with public sector healthcare programs like Medicare and Medicaid. This points to the urgency of fixing the healthcare system itself. Treating the projected explosion of healthcare costs as a budget problem conceals the true nature of the problem. The economy and the country do face many real problems going forward. The deficit, however, is not one of them. By misdirecting attention toward debts and deficits, our policy focus has been diverted from the issues that will truly have the largest impact on the standard of living of future generations. Social Security is facing insolvency. 8 years from now, its trust fund will be exhausted and, absent congressional action, its payments to beneficiaries will decline to match what incoming payroll taxes cover. If we are to believe the bipartisan conventional wisdom, only 2 options exist for avoiding the impending Social Security shortfall: cut benefits or increase payroll tax revenue. A third option for making Social Security solvent is almost never mentioned. Congress can fix the problem by refilling the depleted trust fund with money from the general revenues of the U.S. Treasury, the fund created by federal taxes other than dedicated taxes like payroll taxes from which Congress can appropriate money as it sees fit. Why not avoid both major benefit cuts and major payroll tax increases by simply removing the arbitrary requirement that Social Security benefits paid out cannot exceed payroll taxes paid in? This obvious question is never answered because it is politically incorrect to ask in elite political, academic, and journalistic circles. Merely to mention the option of using federal revenues to bail out Social Security is to demonstrate that you are a heretic who was invited to the unfunded liabilities conference by mistake. Of course, the United States faces very serious fiscal problems that will require action one way or another. But that applies as much to our defense spending as our entitlements. By what logic should we subject the elderly to an unavoidable cut while borrowing freely to meet the Pentagon's needs? The choice to plant a time bomb at the heart of one of the nation's most important public programs was a purely political one. In its report delivered to President Franklin Delano Roosevelt in January 1935, the Committee on Economic Security, organized in June 1934 to design a new program of old age insurance, recommended that Social Security should be financed in the long run by a mix of payroll taxes and general revenues. Benefit payments will be light in the early years, but will increase steadily until by 1965 they will exceed the annual receipts. It is at this stage that the federal government would begin to make contributions. When he read the report, FDR ordered the removal of the recommendation that general revenues play a role in the future. In February, he passed the amended report on to Congress, which then debated and eventually enacted the Social Security Act on August 14, 1935. Roosevelt declared, "If I have anything to say about it, it will always be contributed, both on the part of the employer and the employee, on a sound actuarial basis. It means no money out of the Treasury. But Social Security's reliance on payroll taxes was controversial from the beginning. Abraham Epstein, an influential American proponent of social insurance, was enraged that the program taxed only wage earners and not capitalists. In the Liberal Nation magazine, he accused the payroll tax of distributing poverty among the poor. Some favored funding the program out of general revenues or even a national sales tax, like the sales taxes that many states had used to finance their welfare programs. In 1941, addressing a critic of the payroll taxes, FDR replied, "I guess you're right on the economics. They are politics all the way through. We put those payroll contributions there so as to give the contributors a legal, moral, and political right to collect their pensions and their unemployment benefits. With those taxes in there, no damn politician can ever scrap my Social Security program. Those taxes aren't a matter of economics, they're straight politics." In addition to his insistence on exclusive payroll tax financing, FDR's initial design called for Social Security to accumulate a reserve fund before it began dispersing benefits. But amendments to the Social Security Act in 1939 shifted the program away from reserve financing to pay-go financing, in which today's wage earners pay for today's retirees, in return for the promise that future workers will pay when they themselves retire. Free market ideologues opposed the New Deal's establishment of social insurance from the start and have used the unsustainability of Social Security's financing as an excuse to undermine its structure through privatization. One popular model, pursued unsuccessfully by President George W. Bush in his second term, would allow workers to divert a portion of their payroll taxes to private retirement savings accounts. The fear-mongering about Social Security's solvency was pretextual. The new scheme would have taken generations to come into full effect, and its partial diversion of payroll taxes would have accelerated the trust fund's insolvency in the interim. Even worse, paying already scheduled benefits while funneling up to 4 percentage points of the 12.4% Social Security payroll tax to private accounts would have created transition costs amounting to more than 4% of the federal budget for 40 years. As the Congressional Research Service, CRS, noted in 2005, while we know the individual accounts are likely to make the solvency problem worse, the President has not yet specified how this additional shortfall will be financed. It could be financed through 1. Increased government borrowing, to be paid off eventually through general revenues, 2. Increased payroll taxes or other tax increases, or 3. Additional benefit reductions. Bush's partial privatization plan was so unpopular, even with Republican voters, that it was smothered in the cradle by his own allies in a Republican-controlled Congress. In Chile, the murderous dictator General Augusto Pinochet, not having to bother with political opposition or public opinion, and advised by American libertarians like the economist Milton Friedman, had already privatized the national social security system in 1981. The experiment has been a miserable failure, as Council on Foreign Relations Senior Vice President Shannon K. O'Neill observed in 2022. 4 decades later, Chile's system hasn't worked as promised or expected. The creators anticipated that the average worker would save enough to earn 70% of their salary in retirement. The reality has been closer to 1/3. They thought the new system would expand the number of workers with retirement funds. Instead, nearly 40% of Chileans have nothing to fall back on. Rather than improve the lives of Chile's elderly, most pensioners live on less than the minimum wage, with women hit harder than men. Officials thought less than 10% of wage earners would rely on public largesse for a minimum pension. Today, more than 40% need the government to step in. In the aftermath of the privatization debacles under Pinochet and Bush, many libertarians and neoliberals have refocused their attention to tax-favored add-ons like individual retirement accounts, IRAs, and 401(k)s. But those are a very expensive way to not solve the problem. In 2022, the Secure Act ordered employers who offer 401(k)s to automatically enroll their workers, unless they objected. However, in 2023 only 57% of American workers had access to 401(k)s, and they tended to be more affluent workers in larger firms. For small business employees and low-income and part-time workers, some states are experimenting with other Rube Goldberg schemes like auto IRAs, multiple employer plans, and retirement marketplaces, all seemingly designed by lobbyists to stealthily enrich Wall Street money managers. No doubt there is a role for private savings to supplement Social Security income for many Americans. But if an increasing Social Security retiree-to-worker dependency ratios, driven by the aging of the population, really does threaten to impoverish millions of older Americans in the foreseeable future, why set up a complicated scheme of universal private accounts, which, because they must be pre-funded and built up slowly, will not be of much use for many decades. Why not just expand Social Security benefits for the neediest retirees, if not for all? As the libertarian Andrew Biggs and the progressive Alicia Munnell pointed out last year in a co-authored paper, Fixing Social Security, Let's Use Subsidies for Retirement Plans, subsidies for all tax-favored retirement plans, including 401(k), S and Roth IRAs cost $185 billion or 0.9% of GDP in 2020. They concluded, over the next 75 years, Social Security faces an actuarial deficit of 1.3% of GDP, so applying the revenues from eliminating the tax expenditure would solve 70% of the problem. And the gains would be higher than this estimate for two reasons. 1. The government would continue to collect income taxes on past tax-preferred contributions. And 2. Payroll tax revenues would be higher as well because they are also affected by the tax preferences. This year, the maximum contribution to a 401(k) is $23,500. For those over 50, it is $31,000. Why are taxpayers subsidizing the privileged few who can put this much money in tax-deferred accounts, in a country in which the median individual annual income in 2024 was $61,984? The downsizing of tax breaks for 401(k), S and IRAs could be phased in gradually. Before the invention and unfair exploitation by the economic elite of taxpayer-subsidized IRAs and 401(k), S in the 1970s, the rich and the merely affluent saved money for their retirement in the form of taxable investment accounts and other assets. They can do so again. In 2010, in an essay marking the 75th anniversary of the program, Social Security expert Dharma D. Hoskins observed that the reliance of Social Security on payroll taxes made the United States an outlier among its peers. The almost exclusive reliance on payroll tax financing of Social Security places the United States in a different camp from most of the industrialized countries that have long used general revenue funding to supplement payroll taxes and other earmarked taxes in their Social Security programs. In France, Germany, and Japan, general revenues fund 30% to 50% of public pension program expenditures. A simple explanation for this willingness to use general revenue financing has of course been the reluctance of politicians to raise taxes on workers and employers, fearing, in more recent times, the negative impact on the nation's ability to compete against other countries in the global marketplace. This is one kind of American exceptionalism that does not benefit Americans. In hindsight, FDR was wrong and the Committee on Economic Security was right back in 1935. In the 1960s or later, as an alternative to raising payroll taxes, Congress should have authorized the addition of general revenues. This would have permitted several generations of American wage earners to have enjoyed higher take-home pay in the half-century that followed, while averting decades of sterile controversy over unfunded liabilities stoked by libertarians on the right and deficit hawks in both parties. Before the trust fund is depleted a decade or so from now, Congress should refill it from general revenues. Going forward, Social Security should have two sources of revenue indefinitely: payroll taxes and general revenues, as needed. There might be other arguments for the politically unpopular options of raising payroll taxes or cutting benefits, but the threat of insolvency will not be one. Flexible general revenues of the kind that partly fund Medicare and Medicaid are preferable to a second dedicated tax for Social Security, which would merely provide a second target after the payroll tax for those seeking to spread alarm about unfunded liabilities. How much money are we talking about? If general revenues were to pay for all of Social Security's shortfall in 2034 and thereafter, that would cost an extra $533 billion in 2034 and $25 trillion over the next 75 years. 1.2% of GDP in 2034 and 1.3% of total GDP over the 3/4 of a century between 2034 and 2109. To put this into perspective, the debt-to-GDP ratio in the United States has exploded since the 1990s, under Republicans and Democrats alike. Under George W. Bush, the Republican Congress cut taxes while massively increasing defense and homeland security spending after the 9th of November. With bipartisan support, Congress passed huge stimulus packages following the global financial crisis of 2008 and during the COVID-19 pandemic. Both the Affordable Care Act passed by Democrats in Congress under Obama and the Biden-era Inflation Reduction Act added hundreds of billions of dollars to the federal deficit. The One Big Beautiful Bill, OBBB, Act of 2025 is predicted to increase the deficit between now and 2034 by $4.1 trillion, including interest costs, translating to annual deficits of around 7% of GDP annually, 1 percentage point more than a simple extension of the Tax Cuts and Jobs Act, TCJA, of 2017 would have caused. Overall, The debt-to-GDP ratio has grown from around 54% in 2000 to more than 120% at the beginning of 2025. As Alan J. Auerbach and Danny Yagan show, the historic American pattern of debt expansion followed by deficit reduction from 1984 to 2003 has been abandoned by both parties. At this point, with interest payments on the debt rivaling defense spending, gradually reducing, not eliminating, the debt as a percentage of GDP, by some combination of economic growth, revenue increases, spending cuts, and perhaps some version of financial repression should be a bipartisan priority. But Social Security has contributed nothing to the run-up of the debt since 2000, and an effort to balance the budget on the backs of the elderly going forward makes neither political nor economic sense. The real reason reformers do not consider the straightforward step of eliminating the artificially constructed constraint of the imaginary trust fund is that they remain hopeful the constraint will have substantive purchase and force the politically unpopular choices they think are necessary. This manages to be undemocratic, unprincipled, and unrealistic all at once. Undemocratic, doctrinaire libertarians who want to cut or privatize Social Security should honestly make their case to voters, instead of pretending to be neutral, technocratic fiscal conservatives and lying to the American people by telling them that, alas, Congress has no options other than slashing Social Security benefits or radically raising payroll taxes. Unprincipled, those who claim that general revenue funding of Social Security will bankrupt the country must make the same argument against paying for national security. U.S. national defense has always been flexibly funded out of general revenues. There is no Pentagon trust fund based on a dedicated Pentagon tax. Thus it is impossible for deficit hawks to declare that there is an unfunded defense liabilities crisis because estimated revenues from the Pentagon tax in 2050 or 2100 will fall short of whatever military needs this or that expert predicts will exist in those years. Unrealistic. It's a fantasy to think that Social Security's financing can be fixed once and for all with a painful mix of tax cuts and benefit cuts that will fix the problem and put the program on autopilot for decades or generations to come. The alternative to the pattern of brinkmanship and crisis followed by hasty action that kicks the can down the road again is simple. Provide Social Security with two permanent funding streams, payroll taxes and general revenues, which can be modified incrementally as needed instead of waiting for artificial crises caused by gimmicks like the trust fund. To be sure, statutory constraints to force fiscal discipline can play a legitimate role. Many countries have statutory or constitutional debt limits or expenditure ceilings, though unlike in the US, these usually take the form not of nominal spending limits but of debt-to-GDP ratios. But the effect of a government debt ceiling cannot be mimicked by a confusing patchwork of programs, some of which are paid by dedicated taxes and trust fund gimmicks, while others are paid by general revenues. Supplementing trust funds with general revenues has been standard practice across the federal government. According to the Government Accountability Office, every major federal department has at least two trust funds for revenues dedicated to specific program areas, including an assets forfeiture fund at the Justice Department, a life insurance fund at the Veterans Administration, and the Department of Labor's Unemployment Trust Fund. Unlike Social Security, most trust funds were either designed to have dedicated taxes supplemented by general revenues, or have benefited from intermittent general revenue bailouts. An example of the former type is the Medicare Supplementary Insurance Trust Fund, which by design receives 25% of its revenue from Medicare Part B premiums and 75% from general revenues. An example of a trust fund with a dedicated tax that must be bailed out periodically with general revenues is the Highway Trust Fund, which pays for interstate highways and other transportation projects. Thanks to the understandable reluctance of members of the House and Senate to raise regressive and unpopular gasoline taxes that fall most heavily on working-class Americans, the Highway Trust Fund would have been insolvent in 2008 if Congress had not provided it with general revenues in the same year. By 2025, Congress had made 9 transfers from the General Fund to the Highway Trust Fund, amounting to a cumulative $275 billion. Highway spending went on without interruption. The Highway Trust Fund now has 2 sources of revenue instead of 1. And its revenue base is more progressive, because the affluent and rich disproportionately pay for the general fund with personal and corporate income taxes. Of the 2 ways to add general revenues to a program with a dedicated tax, the Medicare model of permanent federal revenue financing is clearly superior to the Highway Trust Fund model of last-minute bailouts from general revenues. If Medicare Part A, Part B, and Part D are considered together, Medicare as a whole in 2023 received 43% of its income from general revenues, 36% from payroll taxes, 15% from premiums, and the rest from taxation of Social Security benefits, state government payments, interest, and other sources. The example of Medicare suggests that FDR was mistaken to believe that financing Social Security with anything other than payroll taxes would endanger public support for the program by erasing the distinction between Social Security as contributory, earned, universal social insurance and unearned, means-tested, charity-like social assistance or welfare. As long as they contribute some payroll taxes, it seems, Americans will have a sense of ownership in an earned benefit like Medicare or Social Security, even if their payroll taxes fund only a portion of it. There are encouraging signs that the taboo against general revenues is weakening in the bipartisan establishment, as the date of trust fund depletion approaches. The Concord Coalition, a flock of deficit hawks from both parties who first gathered to shriek in alarm about unfunded liabilities in 1992, faced reality in 2022. Despite the impending depletion of the Social Security trust funds, public opposition to increasing payroll taxes or reducing benefits has resulted in political gridlock preventing Congress from taking timely and constructive action. As a result, the path of least resistance leads to the use of general revenue transfers to prevent trust fund insolvency. In December 2024, Louise Shiner of the Brookings Institution and Alexander Gelber of UC San Diego broke with Beltway fiscal orthodoxy in a paper for the National Bureau of Economic Research, NBER. However, it seems highly unlikely that we will institute payroll tax changes and/or benefit cuts in the next decade that would be sufficient to resolve the imbalances over the next few decades, let alone achieve 75-year solvency or build up a sufficient trust fund to ensure against future solvency threats. Furthermore, action is unlikely to be taken soon, and so the trust fund seems likely to get fairly close to depletion. As a result, it seems quite likely we will need and, indeed, will enact policies that include an infusion of general revenues into the Social Security system. At some point in the late 2020s or early 2030s, to prevent any interruption in the flow of Social Security checks to senior citizens, Congress is almost certain to channel general revenues into the trust fund, ensuring its solvency for a time, if not permanently. Of course, Congress will still be free to debate and enact benefit cuts and payroll tax increases, but the permanent addition of general revenues can make any such tweak smaller and less politically divisive, and proponents will need to make the case for cuts or tax increases on the merits, weighed against cuts to other programs or increases in other taxes, without invoking an imminent deadline. Best of all, adding general revenues as a second stream of funding can free Congress from being pressured into hasty, last-minute, ill-considered actions by artificial deadlines like the exhaustion of the trust fund. Nearly a century after its creation, Social Security has freed generations of Americans from panic about their retirement income. Now it is time for Congress to free American politics from periodic panics about the solvency of America's retirement security program. Economics and history tend to agree on the need for a social contract reflecting different priorities from those implied by the status quo. At this historical juncture, the United States and some other industrialized countries can raise economic growth while reducing poverty and inequality. Among the key strategies are investing more in the young, making social insurance more universal, and shifting to broader and more uniform taxation. This essay argues for these broad strategies, featuring specific recommendations on 4 fronts: education, make increasing public investments in the young, with greater urgency for younger age groups than at the university level; health insurance, socialized health insurance works better when it covers everybody; liberate health insurance from jobs, and from bias toward the elderly; pensions, keep the share of adult life spent on public pensions from rising, by extending the working age for each benefit rate in proportion to the average adult life expectancy of people with similar career histories. Index the retirement benefits for each cohort to that same life expectancy at age 60. Index annual pension payouts to recent GDP per working age person. Broad taxes. The 2 best candidates are addiction taxes and the value-added tax, VAT, 2 types successfully applied in virtually all industrialized democracies outside of the United States. These can be progressive as well as pro-growth, as long as they are used to fund universal access to health and education, emphasizing pre-primary education. The task of preparing these prescriptions must start with agreement on a modest list of common economic goals, followed by this essay's proposed budgetary strategies for serving them. I shall focus on the United States, though this country can both import and export some lessons summarized here. Make only positive sum policy changes, raise aggregate material well-being. A Hippocratic oath, distribute those net positive sum gains from economic efficiency so that we do no net harm to the share of disposable income going to those below the poverty line. Among rich industrialized countries, the United States stands out for its income inequality, its reluctance to redistribute from rich to poor, and its share in poverty. The first two of these three distinctions are illustrated by Figure 1's international comparison in inequality and redistribution. Of the 28 OECD countries covered in Figure 1, the United States starts with an above-average inequality of primary income, white bar plus black bar. That is, the gross income one receives before taxes or transfer payments. While all countries redistribute so as to lower inequality, black bars, the United States, like Mexico and Korea, does little to shift income from rich to poor. As a result, we end up with an inequality of final disposable incomes, white bar, that is second only to that of Mexico. Thus we stand out as an unequal income country, largely because we do so little about inequality. The third distinctive performance, our greater share in poverty, is confirmed by recent studies. This is true on either of two definitions of poverty: relative poverty, meaning the share of the population living in households below half the median income, or absolute poverty, the share living below a real purchasing power defined as the U.S. poverty line in a given base year. In terms of absolute poverty, we have a greater share in poverty than most countries, and for children younger than 18 we have the highest share of all the countries studied. Our Hippocratic oath against harming the poor could take any of three forms. 1. Avoiding any reduction in their absolute real disposable income. 2. Avoiding any reduction in their share of real disposable income. And 3. Redistributing income so that the U.S. poverty share of 17.1% drops to the OECD average of 10.6%. Economic growth would make the first and lowest standard of the three increasingly unpopular, since it allows income gaps to widen forever. The third of these options, which would target the fact that inequality in the U.S. is extraordinarily high by OECD standards, seems most desirable to this observer, yet must remain only a longer-term goal. Thus, we will use the second standard, ensuring that the policies we choose will not decrease the share of real disposable income of the poorest members of society. Don't raise the deficit share, except in a slump. Any proposal must be revenue neutral or deficit reducing when the economy is not in recession, leaving the deficit no greater as a share of GDP than it is now. At face value, this goal might seem to reflect some consensus that our current deficits and government debt are already too high in relation to annual GDP. No such consensus exists in the economics profession, however, especially not during slumps. No economist can quantify the optimal ratio of a deficit or debt to GDP. There is no solid basis for trying to legislate a balanced budget. Furthermore, the wolf is not yet at America's door. Our country enjoys more slack in its external credit than do the Mediterranean countries or Japan. Nonetheless, the goal of not adding deficits acknowledges a very long-run constraint. Deficits cannot rise faster than GDP forever. Eventually, once the economy has recovered and is on an upward growth path, the United States should start swimming upstream towards surplus to avoid being swept into larger deficits by the increased flow of debt service that higher interest rates will eventually bring. These basic goals are well served by four strategies on which economists and a fair reading of modern economic history tend to agree. Broad is good. Broad-based taxes and broad universalist social expenditures have good incentive effects and promote a sense of even-handedness. Address externalities. A real-world economy is rife with cases of externalities, in which the costs or benefits of any exchange accrue to third parties, not just to the two parties deciding on the exchange. Economists prescribe tax incentives to offset negative externalities and subsidies or tax forgiveness to encourage positive ones. Again, the prescription is to address the externalities on a broad front, with incentives geared to all sources of the externalities. Let private parties decide how to reduce external damage activities, like pollution, and how to expand external benefit activities. Do not presume, for example, that the government knows which specific pollution control technology needs to be required or subsidized. Similarly, do not presume that it knows what kind of education each individual should have. Grandfathering is good. People become accustomed to any economic policy regime, and typically make plans and contracts based on the assumption that the regime will continue. Any major change will impose costs on their decisions, even if the change is correcting a bad policy regime. Time and again nations have realized that grandfathering is good, meaning that existing contracts must be honored. Pre-announce the changes that will take place only for new contracts, and often only gradually over several years. Competition is good. While economists carefully draw boundaries around the realm where competition and free markets should reign, economic freedom is our default setting. It is, after all, the economic counterpart of democracy. In specific settings, however, having the government as a competitor also improves efficiency, as will be noted below. Most economists prefer broad taxes, with lower rates and few loopholes. A majority of economists also seem to favor broad universalist expenditure programs. Their preference for breadth is not supported by any tight theorem derived from axiomatic principles. Rather, it is their experience that tells them broad is good. The hunch is that we will minimize deadweight costs and GDP loss if we avoid narrow taxes or targeted subsidies that address one specific behavior, only to find that people overdo, or fail to do, something else. By going for broad and even incentives, we also avoid assuming that the government has enough information to micromanage specific solutions. An environmental example is the case for broad effluent taxes as a way to reduce pollution. Similarly, economists' call for a carbon tax is a call for a solution as broad as the problem. And cap-and-trade markets avoid presuming that the government knows just who should do the pollution cutting. While the argument that broad means better incentives remains just a good unproven hunch, one other advantage of broad universal taxes and social programs stands out clearly in the historical data. This is their lower administrative costs, both when collecting the taxes and when spending them. Since the 19th century, prosperity and democracy have allowed countries to economize on administrative costs by shifting from narrow taxes and transfers toward broad taxes and broad entitlements. On the tax side, history shows steep declines in the administrative cost shares of indirect tax collection across the 19th century and the early 20th, both in Britain and in the United States, as shown in Figure 2. In both countries, the cost of collections dropped from over 4.5% of the amounts collected in the mid-19th century or earlier, to 2% or less since the middle of the 20th century. Economies of scale have cut the costs of bureaucracy, so that administering the U.S. Internal Revenue Service, for example, costs only 0.5% of the amounts collected. On the public social expenditure side, contemporaneous comparisons suggest that shifting from narrow and heavily policed social assistance to broad public entitlements programs has cut costs through economies of scale and the reduction in monitoring. Before 1880, European societies, intent on forcing all the able-bodied to work, tried to emphasize indoor relief, in which a person was kept in a poorhouse or workhouse. Its administrative costs were a high share, often 25%, of the total amount spent. Stricter regimes are more bureaucratic and more costly than universal entitlements. By the post-war era, program operating costs have fallen to almost negligible levels in the high-income OECD countries. This applies not only to programs for the poor, but also the data on public pensions. International data on pension support programs show that administrative costs are less than 3% of the pension program budget in all high-income countries, and often below 1%. In the health insurance sector as well, universalism lowers bureaucratic administrative cost shares. The best documented contrast is the somewhat more private healthcare system of the United States, which has administrative and overhead, i.e. bureaucratic, costs far above those in the universal insurance countries of Canada and Germany on a per capita basis. One of the reasons is insufficient breadth of health insurance coverage. Accepting economists' preference for broad taxes and benefits, and seeing the administrative cost saving of universalism, will prepare one for a historic result that still surprises some Americans. The welfare states of Northern Europe, with their social spending as high as 30% of GDP in some cases, have not suffered any clear net loss of GDP from it. So say decades of data on GDP and economic growth, with or without the use of econometric regression analysis. This is what I have called the free lunch puzzle. Large democratic welfare states, with universal entitlements, have not paid any net price in terms of economic growth or competitiveness, while following policies that delivered more equal incomes, less poverty, slightly higher life expectancy, and cleaner government relative to the United States or the average small government economy. While some may try to cite the problems facing Europe, the fiscal troubles of Mediterranean Europe and Ireland are unrelated to the welfare state. Rather, the Mediterranean countries deliver relatively little aid to schools or the poor, while overprotecting senior workers in older industries. Meanwhile, both Spain and Ireland have suffered mainly from the bursting of huge market bubbles in real estate. The lack of any net GDP penalty from the whole welfare state package is not just a statistical finding. There are clear economic reasons for this outcome. The large social budget package has delivered enough economic growth advantages to offset any negative effect on GDP of work disincentives caused by generous unemployment compensation or higher taxation. Among those advantages are better health under universal insurance, better support for the development of mothers' careers, and a more pro-growth tax structure, with consumption taxes like a VAT. There is also an important political side benefit of welfare states having a flatter tax rate that pays for more universal benefits. The parts of the income spectrum that want social insurance and human investments are paying for a large share of it. Beneficial human investment programs and beneficial social insurance programs are not dependent on victories in class warfare. Translating such broad approaches into better ideas for financing social programs is easier for some categories than for others. Let us review the historical and economic wisdom of different kinds of social programs and the taxation that supports them. Our review begins with policies for developing the young and moves up the age ladder to policies toward the elderly. Our country and others have failed to do as much for the young as we have for the elderly. Ever since the late 1960s, when we installed the Social Security cost of living adjustment and shifted to a less pre-funded pay-as-you-go system, poverty among elderly Americans has plummeted, as shown in Figure 3. By contrast, poverty among children and those of working age marches on. The decline in the share of elderly in poverty did not result from any changes in the private market economy. Rather, millions of elderly were removed from poverty by the rise of political grey power. That the decline was policy-driven is clear from Figure 4. On its vertical axis, Figure 4 shows the relative support for the elderly versus others, a double ratio equaling social spending on the elderly per elderly person / social spending on the non-elderly per non-elderly person. This elderly bias is not positively linked to large welfare states, like Denmark, France, and Sweden, as one can see along the horizontal axis. Rather, the elderly bias ratio looms large for 4 countries: Japan, United States, Italy, and Greece, each of which offers little to the poor by OECD standards. What makes these 4 countries stand out from the others is not generous pension support for the elderly, but rather the low levels of public support for children and working-age adults. Our bias towards subsidizing the elderly runs against economists' insights and against any reading of the history of modern economic growth. Economists keep measuring the social rate of return on educating the young, and keep finding the rewards very high. Historically, the countries that were the earliest to achieve modern economic growth were those whose leaders appreciated the case for raising taxes to pay for school. Even such free market advocates as Adam Smith, Thomas Jefferson, and Milton Friedman appreciated the case for tax-based support for schooling. The northern states of the United States were world leaders in tax-financed public school enrollments in the 19th century, and led again in the high school wave of the 20th century. The core economic reasons for turning to the taxpayers for school money are capital market imperfections. Parents can't borrow privately against the prospective future earnings of their children, and the positive externalities from the extra knowledge and the civic engagement that schooling brings. One pattern stands out clearly in the social returns to education. The younger the students, the higher the rate of social return to public funds spent. This result persists, both in the global literature summarizing the average apparent returns to schooling and in the deeper econometric literature based on American data. Indeed, there is an easy way to rank the social rates of return on investments in different levels of schooling, either in this country or globally: preschool, primary, secondary, higher education, with even the rates of return on higher education being as high as those on such alternative assets as long-term bonds. At the top of the education pyramid, the urgency of raising public investment is the least, partly because we have a clear American success story. We have been world leaders in partially subsidizing higher education, going back to the land-grant colleges launched in 1862 and even to the colonial government subsidies to Harvard, Yale, and others. Yet the United States has always shown some finesse in higher education finance, giving only partial and egalitarian support and forcing its institutions to compete against each other. The support is partial and egalitarian to the extent that it features means-tested grants and loans. The goals of economic growth and equality are well served by means-tested Pell Grants and loans, which can be thought of as higher education vouchers for lower-income families. This country wisely avoids the next step taken by some countries in subsidizing higher education. We avoid guaranteeing free rides for well-off students whose private schooling makes them excel on national exams. The competition is also crucial. Higher education is a sector with sovereign consumers quite capable of shopping intelligently. The rising cost of college, led by persistently high returns to higher education, should not be seen as evidence of any lack of competition at the top. Berkeley, for example, faces tough competition, for good students, for good faculty, and for research grants, from its public sector sister UCLA as well as from private competitors like Stanford. The competition is one reason that the United States completely dominates the world rankings, and is a heavy net exporter in higher education. At the bottom of the education pyramid, which we tend to focus less on, investing tax money in preschool education remains more urgent on both efficiency grounds and equity grounds. Here is an opportunity for major productive expansion based on free choice among accredited institutions not controlled by large school districts, large unions, or any officially sanctioned religion. Note that the compelling case for tax financing of education is not a case for public provision of education. Economists have never seen a compelling reason for having the public sector dominate the supply of education services themselves, common as that practice may be. As for primary and secondary education, the middle steps in the pyramid, our country continues to be among the leaders in quantity, though not in quality. We have always been a world leader in the number of years that an average youngster spends in school, despite a post-war rise in high school dropout rates. Yet we consistently fail to rank in the top 15 countries in terms of actual student curriculum learning, as measured in international tests such as PISA. Would injecting more competition, more school choice, improve the quality of primary and secondary education? The fierce fight over vouchers cannot be resolved here. On the one hand, history speaks in favor of them where the status quo was abysmal, as it was when Cleveland and Milwaukee launched their limited voucher programs. Yet Chilean experience with vouchers has not been so positive, and the issue of what to do with the lowest quality schools has no simple resolution and is deeply intertwined with other welfare issues like poverty. Whether the nation goes with vouchers or just with freer choice within the public school system, two side points need emphasis here. First, greater parental choice of schools brings gains even if it does not improve aggregate school performance. Economists recognize a gain in well-being just from allowing dissatisfied parents to change their children's schools. Second, conservatives in favor of vouchers would need to accept the political reality that tax money would not go to private schools without heavy government regulation of a generally secular curriculum, as is practiced in the Netherlands and other European countries, allowing the subsidies to extend to schools run by organized religions. A straightforward broad strategy for fighting poverty has remained popular among American economists since the 1960s. In 2009, fully 79% of economic experts agreed that the government should restructure the welfare system along the lines of a negative income tax such as the one advocated by Milton Friedman, Robert Lampman, James Tobin, and many others. With a negative income tax, we tax everybody's income at a flat percentage and give the revenues back to everybody in equal dollar amounts based on family size, a tax rebate or demo grant, and whether they are rich or poor, so that the poor pay a negative income tax. Aside from a broad low work disincentive, the negative income tax does not mess with the marketplace. It avoids subsidizing family farms, building public housing, or legislating minimum wage rates, all of which are costlier distortions. Given its bipartisan appeal among economists, we might easily settle on the negative income tax as a prescription for a larger social contract. However, the idea of a negative tax remains viscerally unpopular with many Americans. Since 1993, an alternative approach has mustered bipartisan political support, and some theoretical support among economists. That year's expansion of the Earned Income Tax Credit, EITC, subsidizing work among lower-wage earners, and the 1996 Personal Responsibility and Work Opportunity Act, PRURA, setting strict limits on welfare for those out of work, ended welfare as we know it, in the words of President Clinton. Support for those out of work became much less generous, while work became subsidized up to a certain phase-out range of earnings, beyond which one rejoined the usual tax-paying ranks. The new combination of work subsidies and workfare toughness continues to draw bipartisan political support, aside from a brief Tea Party attack on the EITC in 2011. The negative income tax idea is history, it would seem. What are the respective merits of the alternative approaches? Some economists have theorized that the EITC may have raised employment, reasoning that by drawing people initially into low-paid employment, it gets them on a career path they will not leave later when their earnings rise to enter the high-tax phase-out range. Others question whether there has been enough net employment gain to justify the regressivity of the EITC PRURA package relative to a negative income tax. A major test came in the Great Recession of 2008 to 2009, when a large share of the poverty population was no longer entitled to cash welfare. Studying this recent harsh test case, Marianne Bittler and Hilary Hoynes have found that the remaining combination of safety nets seemed to take up much of the slack left by the expiration of cash assistance to poor families. Food stamp benefits proved more quickly responsive to the new hardship than in earlier slumps, and the Great Recession did not show any extra damage in terms of such outcomes as health or household crowding. On the other hand, a given unemployment rise did mean a significantly greater rise in overall poverty after the PRURA reform than under the older regime. Thus, the tidier negative income tax approach preferred by most economists still looks like the more effective short-run anti-poverty safety net, despite some offsetting responses from food stamps and medical aid. To reduce poverty rates over the longer run, so that we at least approach the lower OECD average poverty share, we need greater investments in human capital, on the education and health fronts. The health sector in the United States will be perennially problematic because of its peculiar economics. Thus it has been for the last century, thus it is now, and thus it shall be. The main reason why these problems absorbed less attention before the early 20th century was that medical care was so ineffective. Only in the last 100 years have we seen an explosion of successful, and very costly, health technologies. The demand for healthcare has soared with good reason, especially when the patients and providers could get someone else to pay for it. The rise in demand will surely continue, as technology keeps improving and the population gets richer and older. The battle to contain costs while assuring quality will never end, given the overwhelming informational complexity of healthcare and the fact that within the current system this sector is riddled with market power on the part of providers and insurers. International opinion surveys have never turned up a country where people are enthusiastic about their healthcare sector, and Americans tend to have more complaints than the international average. There never will be a formula that allows the public to relax and ignore the healthcare sector. Nor, in the face of aging, is there a pension-style formula that puts just the right ceiling on care for the elderly. All that can be offered here are two guidelines for reshaping cost control in health insurance. Health insurance is less costly if coverage is mandatory and supplied by either a single payer or a single regulator setting rules for competing insurers. Such a broad approach is superior in health insurance because of the informational structure of healthcare. Having a central insurer, usually the government, cuts administrative costs, as we have already noted. Doing so also addresses the asymmetric information problem with voluntary private insurance. Insurers know less about a customer's health prospects than does the customer. Thus, when insurance is voluntary, those who suspect they are in poor health are more likely to enroll. This sets up the famous voluntary insurance death spiral. The self-selection by high-risk customers forces the insurer to raise premia, which induces healthier customers to flee, leaving an even higher risk residue of customers, which leads to further premium hikes, and so on until the insurance plan disappears. To avoid this spiral, private insurers seize upon whatever information they can get that justifies denying coverage to those with previous conditions. The problem of asymmetric information is more severe in health insurance than in other insurance sectors. Auto insurance, for example, takes advantage of the fact that key predictive information about the customer, such as age or driving record, is in the public realm. Insurers have also tried to raise profit margins by exploiting complexity to delay or deny a certain share of claims. The Patient Protection and Affordable Care Act of 2010, Obamacare, took steps to limit such practices, with partial success. America has yet to accept the insurance solution that has worked relatively well in other countries. Let the government serve as a dominant pair, with mandatory universal coverage and mandated pure community rating. Note that international experience recommends single-payer insurance, but is indifferent to government provision of health care. Instead, American state and federal insurance systems embody an unavoidably messy political compromise, one in which the public is forced to buy coverage choosing from a menu of private insurers. As it stands, the government will act as single regulator, not as single payer. This has the political advantage of keeping government budgets from raising taxes to cover insurance, but the disadvantage of perpetuating, and still subsidizing, a costly private insurance industry. American health insurance is dominated by plans negotiated by employers. There is no economic logic to this. Why should health insurance have anything to do with one's current job? The cheapest way to pool insurance customers at a low informational cost would be to pool the entire population, using national health statistics to define the probabilities of claims. Using employer-based pools has three defects in the American case. Employer-specific coverage is not portable for those who change, or lose, their jobs. Taxpayers have to subsidize the coverage, and to the extent that its extra costs exceed the tax subsidy, employer-based coverage makes American businesses more costly and less competitive. Why are employer-based plans so dominant in this country? At the center of the problem is a series of historical wrong turns. Employer-based plans gained popularity in World War II, when wage controls prevented employers competing for scarce workers by offering higher straight pay, but allowed them to offer attractive fringes. Then came a tax policy, enacted in 1943 and solidified in a 1954 Supreme Court ruling, which exempts employer contributions to employee health plans from taxation, either as corporate income or as employee income. Thus, one major reform left undone by the congressional fight of 2010 is the removal of special subsidies on employer-based health coverage to push the industry toward offering plans that are more portable from job to job. Another needed reform is to liberate public, alias socialized, health insurance from its costly confinement to those over 65, plus the military. This restriction was forged in another costly wrong turn. The passage of Medicare in 1965 was targeted at the elderly because they rightly feared facing costlier healthcare with no job to offer them coverage. Some have tried to reduce this elderly bias by extending Medicare to all age groups. In 2010, Obamacare succeeded in extending insurance toward the young, with extensions of Medicaid and the state Children's Health Insurance Program. It thus made partial steps toward making coverage more universal, while proceeding slowly enough to grandfather existing insurance arrangements. Yet one's 65th birthday still brings a jump in coverage, and this country's deficit in life expectancy among OECD countries is still worse before the age of 65 than after that birthday. We turn next to the kind of social program that lends itself most easily to the use of broad formulae to solve an undeniably big problem. O'Day, for every 100 Americans of working age, 18 to 64 years, there are 35 elderly Americans, 65 and up, most of them retired. By the year 2050, there will be 49 elderly for each 100 Americans of working age, assuming today's rates of birth, migration, and survival. The balance between people paying into retirement and people drawing on it is shifting. So we are warned in the media every week. Social Security currently costs 5% of GDP, but spending will have to rise to 6.2% of GDP by 2037. Actually, the ratio is likely to shift even faster than that, because of a newly documented longevity transition. The life expectancy of seniors is shooting up rapidly, presenting all pension calculations with a possible curse of unexpectedly long life. This demographic fact of life has a clear implication for setting pensions. As the share of elderly rises, their annual benefits past the age of 65 absolutely cannot rise as fast as the average incomes of those of working age. This clear warning is both softer and louder than it may sound at first. Softer, in the sense that it does not mean your pensions have to drop in real purchasing power. Pensions should still keep up ahead of the cost of living. It's just that they cannot grow as fast as earned incomes per person of working age, which historically grow at about 1.8% a year, adjusting for inflation. Yet the warning should sound louder when one realizes that it applies to the future of any kind of provision for old age, no matter how private or public. The curse of longer life is not specific to Social Security or other public pensions. It is the same even if you relied only on your own savings for old age. To plan ahead, if you live to age 65, you are likely to live to 85 even at today's survival rates. Your grandfather only had to plan on living about 14 years more, if he were to reach age 65. Even in such an individualist calculation, your annual consumption in retirement has to be a lower share of annual earnings than in the past, because you'll live more years. So it's not a problem of government pensions, but a problem facing any pension plans, be they individual savings, private job-based pensions, or Social Security. Fortunately, there are broad formulas that can adjust our pensions to longer lifespans. Here are 3 formulas that would make Social Security sustainable indefinitely, formulas that private savings plans should also try to emulate. The first formula is one on which the United States has already done its homework quite well, and just needs to follow through. The formula is this: keep the share of adult life spent on Social Security from rising, by extending the working age for each benefit in proportion to the average adult life expectancy of people with similar career histories. The United States has already taken steps down this path, thanks to the 1983 Greenspan Commission on Social Security Reform. We have advanced the age of full retirement benefits from 65 to 67 for those born after 1960. The gradual formula adopted in 1983 follows the strategy of grandfathering is good, by not hitting those of middle age with a shock to their life plans. Yet the news about accelerating senior longevity means we must continue. Seniors are increasingly healthy, and the share of them in poverty has declined, so it is not unreasonable for them to receive full Social Security benefits only if they work the same share of their adult lives as did their parents. Fixing the share of adult life at work would mean something like this: to receive the year 2007's retirement benefit as a percentage of average earnings at any given age, one must work 51.6% of one's life expectancy for males, and 41.5% for females, as we did in 2007. America's progress along this path needs to continue, with more age adjustments. The second formula builds in an automatic adjustment of the work-retirement balance to the longevity trend. Borrowing from the notional defined contribution pension reform that Sweden set up in the 1990s, the formula is this: index the retirement benefits for each cohort to life expectancy at age 60 for persons of given earnings histories. That is, while every individual's annual pension benefits are still tied to his or her lifetime earnings history, They are indexed to the senior survival odds of people in his or her birth cohort. Thus, if you were born in 1980 and you worked from 2000 to 2045, your Social Security benefits would be tied to your earnings over those years divided by an index that is tied to the age 60 life expectancy calculated from survival outcomes around the year 2040. The longer your cohort of people is expected to live, the less your benefits each year, though of course your benefits are likely to continue for more years. This helps maintain aggregate balance in the pension budget. An extra twist for the United States is one that Sweden didn't need. Since American senior life expectancy is shorter for persons with lower lifetime earnings, avoiding regressivity in the pension formula requires tracking the senior life expectancy of persons in different career earnings ranks. Making that adjustment is not difficult, given the Census Bureau's mortality data and Social Security's career earnings data. The third formula is also patterned after Swedish practice since the 1990s. Index annual pension payouts to recent GDP per working age person. Pensioners' benefits from Social Security should share in the fortunes of the economy. When there is a boom, pensioners share in it, by automatic formula. By the same formula, pensions share the pain of a recession as much as others. In an unlikely Great Depression extreme, their ultimate safety net would be the same as for the young, public support for the poor plus medical care. Pre-commitment to such predetermined formulae could remove the pension parameters from the political arena. Of course, social contracts can only make political pre-commitment easier. They cannot guarantee it. Even Sweden softened its preset formula very slightly in response to the 2008 to 2009 slump. Under the original formula, the government was obligated to cut benefits for the 2 years 2010 to 2011. Afraid to follow through on the cuts in 2010, an election year for Parliament, officials changed the formula to stretch the reductions out over more years. Yet the system remains intact, and it still works. The changes in social programs just sketched imply greater expansions of government expenditures than revenue contributions internal to these same reforms of pensions, education, health insurance, and welfare programs. The net extra expenditures must be covered by more general taxes. Specifically, the tab includes these expansions, in order of expenditure urgency: improving and expanding public education, with an emphasis on the earlier years, deficit reduction, once recovery from the 2008 to 2009 recession is fully underway, and universal government provision of health insurance for citizens under 65. What taxes should pick up the tab here? First, here are 2 types of tax changes that are not needed. We may not need any new taxes or contribution increases for Social Security. There seems to be sufficient time to install the formulas for pension sustainability. There is also no strong case for changing direct taxes from what they were in the Clinton boom of the late 1990s, an era that produced budget surplus. For all the talk of the complexity of the income tax structure, its administrative costs are low. Let the Bush tax cuts expire for high incomes, for capital gains, and for inheritances, slightly reducing the deficit. As for new or expanded taxes, the 2 best candidates are addiction taxes, sin taxes, and the value-added tax, VAT, 2 types successfully applied in virtually all industrialized democracies outside the United States. The United States is a laggard in taxing 3 addictive goods that cause serious negative externalities: alcohol, tobacco, and gasoline. The first 2 are private addictions with obvious health externalities. The third is a collective addiction leading to pollution and climate change, as well as to dependence on oil imports from hostile suppliers. As Figure 5 shows, the United States charges so little tax on gasoline at all levels of government that our overall gasoline prices, per liter or per gallon, are only half those of the average industrialized country. We even tax it less than Canada and Australia, 2 other countries with long travel distances. The resulting high rate of gasoline consumption per capita helps make the United States, along with China, the world's worst contributor to greenhouse gases and other airborne pollutants. There is a strong case for raising federal gasoline taxes over the next decade. To be sure, the amount of increase that would cut our emissions to the average OECD level will not necessarily equal the amount needed for the right budget balance, but the direction in which gasoline taxes should move is clear. The other 2 sin taxes, on alcohol and tobacco, could also be raised toward the OECD average. A European-style credit invoice VAT is the other most appropriate broad tax for filling revenue needs, as long as it is funding worthwhile expenditures that are more progressive than the VAT itself. What needs emphasis here is that the whole American debate has been discussing the wrong context for a new VAT. Post-war US discussions have presumed that the VAT must be a substitute for income taxes and other current taxes, in order to lower administrative costs as a share of the amounts collected. This presumption has a factual error and has a redistributive character that should continue to doom the tax-replacing approach to the VAT. The common assumption that the appeal of the VAT depends on its having lower administrative costs than the direct taxes it would replace is wrong. Direct federal taxes already have a low administrative cost as a share of the amount collected, as we saw in connection with Figure 2. A VAT should supplement the existing direct tax structure at its Clinton-era tax rates, rather than replace it, and can do so without any jump in administrative costs. The fixation on using a VAT to replace other taxes has always been so blatantly regressive as to doom the VAT each time it was introduced into congressional committee. Democrats saw the regressivity, and Republicans saw a new tax. What made the European pioneers so successful in introducing and expanding the VAT was using the revenues to fund such progressive programs as universal health insurance and education. Another error commonly made about the VAT is the regressivity argument. Wait, it's regressive, it takes a bigger share of income from ordinary working folks than from rich people. People base this claim on the fact that the tax consumption would represent a bigger share of the current household incomes for the poor than of the incomes of those who are better off and able to save more to avoid the consumption tax. This is the prevailing American wisdom, something that we all know, and it is wrong. One cannot say whether or not the consumption tax is regressive until one says what is done with the extra tax revenue. The consumption tax could easily be progressive, and actually tends to be progressive in some of the countries that rely heavily on it today. One way to make it progressive is to spend it progressively, with the share of benefits declining with income. For a simple and extreme example, suppose that we had a flat 15% consumption tax, VAT, and used the revenues to give a $5,500 entitlement to every person, or $22,000 per family of 4, approximately the poverty threshold for a family of 4. If your 4-person family consumption were below $146,667, which equals $22,000, 0.15, you would receive more than you pay in consumption tax. The more your consumption exceeded the $146,667, the more your consumption tax would exceed your flat benefit, and the more you would pay to others. The result is clear progressivity, defined as a rise in net taxation as a share of income as income rises. Something like this happened when Sweden introduced the consumption tax in the 1950s with the explicit main purpose of funding universal public health insurance. Even if the unspoken assumption is that we are comparing a consumption tax, VAT, with a fixed percentage tax on all incomes, instead of a flat entitlement, the consumption tax is not necessarily regressive. People usually think it is, reasoning that a consumption tax is proportional to consumption, which declines as a share of income as income rises. Ergo, it takes a higher percentage from low incomes than from high incomes. The fallacy here is to assume that the part of income that is saved avoids the consumption tax. On the contrary, the saver and his or her heirs will actually pay the consumption tax in the future, since the consumption tax is probably permanent. As long as the rate of discount applied to future consumption is the same as the rate of return on savings, the net present value of the taxes paid will be the same, whether you consume now or you consume later. Again, one must take a clear look at the alternative before announcing the effect of a particular tax. The daunting challenges facing any such social contract are all too familiar. For all the desirability of welding the tax and expenditure sides of a contract together, the political process can be unkind to solemn attempts to pre-commit competing sides to a long-term agreement. Some pre-commitments have indeed been carried off, when implemented gradually. Two good examples were the Greenspan Commission's 1983 fixing of the advance of full benefit retirement ages, and the pension index mechanisms still built into Sweden's notional defined contribution system. But binding pre-commitments have failed in the past. Remember Gramm-Rudman, the balanced budget amendments, and other rules aimed at constraining the whole budget? Without bipartisan appeal, presidential commitment, and Supreme Court approval, social contracts will fail. Another challenge is historical path dependence, a historian's way of saying that where you can go is constrained by where you are now. Our history has driven us into some sand traps, such as the double exemption of premiums paid on employer-based health insurance plans, the deductibility of mortgage interest, and California's infamous Proposition 13. To follow through on the golf metaphor, history does not allow mulligans. The wisdom of hindsight about past mistakes helps only a little, and reforms must be incremental. One implementation tactic that can help a little is to time the bundles of reforms so that accounts balance along the way. Thus one can envision a wave one over a decade or less, in which the social contract targets the most urgent expenditures, the expansion of public funding for education, with reforms promoting competition and choice, plus some post-slump deficit reduction. Wave 1's revenue increases can easily include sin taxes and the introduction of VAT at a low rate. A later Wave 2 can expand the generosity of anti-poverty aid, lowering our poverty rate to the OECD 30 average, and phase in government-financed health insurance to lift the burden on employers. These second-wave expenditure targets must again be progressive enough to keep the whole package progressive as the VAT expands, as it has slowly done in other countries. Such a sequence would not be achieved easily, but it is consistent with the goals and strategies of social contract reform, promoting growth, doing no net harm to the poverty population, and reducing deficit shares, and doing so through breadth, addressing externalities, gradualism, and competition. Market reforms have been on the agendas of rich democracies since the mid-1970s. Markets seem like a powerful antidote to sclerotic public programs and regulations, as competition incentivizes firms to cut costs and improve quality as they pursue profits. Lured by these and other promises, policymakers adopted market reforms in industries from aviation to finance and telecommunications, and also targeted the welfare state. Instead of fully privatizing public social programs, however, these reforms often resulted in a complicated web of public and private social benefits and services, a phenomenon scholars label the public-private welfare state. We investigate one distinctive element of the public-private welfare state in the United States and other rich democracies, the politics of welfare markets. Advocates claim that, by harnessing competitive forces, welfare markets can deliver social welfare more cost-effectively than traditional public programs. Welfare markets differ from regular, organic markets in that the state crafts new market structures and products that otherwise would not exist. They also differ from other forms of public-private welfare arrangements, such as contracting, because they make private firms compete for customers and profits. Moreover, these markets are deeply political as customers are voters and products are welfare services. Policymakers are loath to entirely leave provision up to these markets, lest voters blame them for failures. The result is a difficult balancing act, promoting sufficiently competitive pressures to yield gains in efficiency and quality without unleashing the destabilizing tendencies of market forces. Yet, market reforms often yield ambiguous competitive results. The creation of welfare markets is no exception, as they rarely generate market competition, including in the examples of Canadian mortgage securitization, German Riester-pensions, or Dutch healthcare. And if they do, the destabilizing tendencies of competition can threaten stable welfare provision, as our case studies in U.S. healthcare and housing finance will demonstrate. In explaining these mixed results, some privilege the regulatory complexity of creating markets, politicians' cognitive limits and ideological biases, or unanticipated firm behavior. Others emphasize political compromises between the left and right in the context of existing welfare state structures or information asymmetries inherent in welfare markets. We argue that welfare markets exhibit fundamental tensions between competition and stable welfare provision stemming from the allocation of risk between government and welfare providers. In traditional social insurance programs, the state bears risk and covers costs by broadly sharing those burdens. In welfare markets, competition requires private risk-bearing to incentivize firms to improve quality and cost-effectiveness through the threat of revenue losses. Yet, when providers face risk, they will engage in actions that can undermine the functioning of competitive marketplaces. Confronted with the risk of bearing potential losses, some providers will exit markets or avoid covering costly risks through adverse selection. Others may turn to sophisticated financial instruments that contribute to market dynamism but also instabilities. In the political realm, firms can exploit the dependence of policymakers on their participation in markets as a source of leverage to procure greater subsidies or other risk cushions. Together, these dynamics create and reproduce markets that tend to be either uncompetitive but stable, with firms enjoying rent-seeking positions, or competitive but unstable, with private actors exiting markets or engaging in aggressive profit-seeking. In short, policymakers are riding a tiger, as they make themselves vulnerable to the functioning of markets over which they have imperfect control. This article examines the politics of welfare markets in two areas of the U.S. welfare state: health insurance and housing finance. In both domains, policymakers created welfare markets where none existed previously but have struggled to balance competition and stable welfare provision. In health insurance, we examine the private Medicare Advantage (MA) plans that were set up to compete for the business of Medicare beneficiaries as well as the Affordable Care Act's (ACA) insurance marketplaces. In housing, Policymakers intended to create a competitive market for mortgage securitization, where mortgages are pooled and sold as mortgage-backed securities, in order to provide affordable mortgages. All three cases illustrate the built-in tensions between competition and stable welfare provision, particularly how increased competition can lead to market and welfare destabilization. These findings improve our understanding of welfare state marketization. Scholars have shown how market reforms can lead to an expanded role of the state. We concur by drawing attention to how intentionally created competitive marketplaces often destabilize welfare provision and then require government intervention. Making sense of this paradox calls for studying the maneuvers of welfare providers when confronted with risk and competition. A second, related contribution is to bring the question of how firms respond to risk more centrally into analyses of the public-private welfare state and welfare markets. Existing work reveals how welfare systems influence the individual experience of risk. We turn attention to how structuring welfare markets involves consequential decisions about how much risk welfare providers bear, inducing firm behavior that can produce unintended consequences. Our US case studies are cautionary tales for policymakers about the challenges of meshing competition with social welfare provision. In response to the economic challenges and ideological shifts of the post-1970s era, policymakers pursued marketizing reforms, including the privatization of state-owned enterprises, deregulation of industries, and attempts to inject competitive forces into the welfare state. These reforms reflect an array of forces, including budgetary pressures, political ideology and party interests, industry pressure, and the drive to improve welfare efficiency. Underpinning many of these motivations are assumptions about the superiority of markets over government. One claim concerns the existential pressures of operating in a competitive market. Faced with the threat of extinction, firms should hustle for customers by cutting costs and/or improving the quality of their product, while also improving the choices of users. Another concerns the problem of capture. Critics of public programs often argue that the lobbying of organized interests impedes sound government decision-making. For market advocates, competitive reforms should generate higher quality provision at lower cost while minimizing rent-seeking. Similar ideas have driven reforms that led to the development of welfare markets in which social benefits or services are delivered through market mechanisms but with extensive government involvement. It is true that the state sustains all market activity, but the role of the state is particularly crucial in structuring welfare markets, where it crafts, constitutes, and reproduces a marketplace that otherwise would not exist, providing the glue that holds it together. Welfare markets are therefore akin to what Fogel calls fabricated markets, which are characterized by deliberate planning of market design, a specific moment of market launch, and/or the creation of a product and a market that would not exist in the absence of conscious design. Laissez-faire in these cases would mean no market at all. Beyond these qualities, welfare marketplaces are unique in that customers are voters, products are welfare services, and politicians are principals judged by voters on the performance of these markets. This not only sets welfare marketplaces apart from regular or organic markets, where firms sell products to consumers who are free to decide whether or not to buy these products, but it also raises the political stakes around their functioning. Welfare markets are distinct subsets of the public-private welfare systems found in many rich democracies, especially the United States, Hacker 2002, Howard 2007, Morgan and Campbell 2011, Adema, Fron, and Ladake 2011. Public-private welfare systems include traditional contracting, in which providers deliver benefits or services but without much competition for customers and profits. Tax subsidies for employer-provided benefits or individual welfare purchases, such as the mortgage interest deduction, also differ from welfare markets as we define them, because the state did not actively design or launch competitive marketplaces in these instances. While some of the literature on welfare markets conflates these different arrangements, we focus on state-designed welfare markets to investigate cases in which policymakers attempt to improve welfare provision through the creation of competitive markets. In the United States, welfare markets cover major social needs. In housing, policymakers set up marketplaces to securitize mortgages through government-sponsored, privately operated enterprises that encourage bank lending and thereby improve households' access to housing loans and home ownership. In education, they created a securitization market for student loans by tasking the government-sponsored, for-profit enterprise with buying and selling student loans as a way to expand access to education. While the student loan securitization market was fully privatized in the 2000s, the former government-sponsored agency, Sallie Mae, still dominates it. In health insurance, subsidized private insurance plans compete for the business of beneficiaries in MA, the option for Medicare beneficiaries to receive their benefits through private insurers, and Medicare Part D drug coverage, some state-level Medicaid managed care programs, and the ACA health insurance exchanges. In all these examples, policymakers consciously designed and legislated welfare marketplaces, which gave birth to new markets, profit-making opportunities, and products where none existed before. Welfare markets are also present in many other rich democracies. In Canada, policymakers created welfare markets to securitize mortgages, yet through a fully public agency, the Canadian Mortgage and Housing Corporation, CMHC, to encourage affordable mortgages. In Germany, the 2001 Riester pension reform gave rise to a welfare market in which households could invest in subsidized, supplemental private pension products offered by firms in financial markets. Berner, Liesering, and Burr, 2009, Nullmeyer, 2004. Employment rehabilitation services have been marketized in countries such as Denmark, Germany, the Netherlands, and the United Kingdom. And a number of European countries reformed health insurance systems in ways akin to the ACA. In the Netherlands, for example, a 2006 health reform has mandated and subsidized individuals to buy health insurance from a market of competing plans. In sum, welfare markets have become a dominant reform trend which can be observed throughout all welfare regimes and in different social policy fields. However, efforts to reap the benefits of market reforms and competition have often run aground. Most commonly, welfare markets are stable yet lacking in competition. In the cases of housing finance in the United States and Canada today, there is almost no private competition within mortgage securitization markets, as public or quasi-public agencies dominate these marketplaces. The German Riester pension markets, similarly, did not generate the envisioned competition on cost and quality among providers, owing to high and opaque costs for consumers. Competition in the Dutch health insurance system is highly managed. Extensive regulations and subsidies limit competition, as does the high degree of consolidation among insurers. At the other extreme are welfare markets in which intense competition proves destabilizing or generates outcomes contrary to the goals of welfare provision. The marketization of employment rehabilitation services, for instance, has led to widespread problems of adverse selection, creaming and parking, as private agencies prioritize assistance to those deemed most likely to find employment, neglecting cases most in need of support. As our case studies show, U.S. policymakers struggle to stabilize the ACA's health insurance exchanges, experienced similar turmoil with Medicare Advantage markets in the early 2000s, and witnessed destructive instabilities in mortgage securitization in the run-up to the financial crisis of 2008 to 2009. Existing explanations for these failures emphasize how complexity, cognitive constraints, and partisan compromises limit policymakers' ability to construct workable welfare markets. Politicians face high degrees of complexity and uncertainty owing to imperfect and asymmetric information about price and quality of welfare goods and services. These conditions limit their abilities to design marketplaces with predictable interactions between consumers and providers that also fulfill the intended social objectives. In addition, policymakers often resort to cognitive shortcuts rooted in ideology and confirmation bias when creating markets, increasing the likelihood of undesired consequences. Finally, Gingrich shows that market reforms result from left-right compromises. That markets might not work could thus reflect the multiple motivations that shape these reforms. Although we agree that these forces can undermine marketizing reforms, we argue that a more fundamental problem stems from the treatment and management of risk. By risk, we mean the prospects of bearing potential losses, i.e., the chance that actual returns differ from expected returns. In contrast to the existing welfare state literature, which tends to focus on whether social programs cushion individuals from risk, we focus on providers as risk bearers, as their decisions on whether and how to enter and remain in welfare markets are crucial to their existence and effects. This focus sheds light on economic and political dynamics that reflect the distribution of risk between government and these providers. Creating welfare markets entails decisions about how much government and market providers will bear risk. In fully public programs, the government is the primary bearer of risk and thus responsible for cost overruns or revenue shortfalls. Advocates of marketized private programs seek to move some risk onto private actors because, when firms risk losing customers or profits, they should act to deliver higher quality products at lower cost. Yet, risk is a hot potato, generating economic and/or political responses by firms seeking to limit their exposure to risk. These actions, policy feedback effects that operate through providers, and the responses of policymakers to them tend to undermine competitive welfare markets. Providers' economic actions hinge on how risk operates in particular markets. In financial markets, economic agents face credit risk, the possibility that lenders or investors will not be repaid the principal and interest on their loans or investments. Yet, financial actors often believe they can manage these risks through sophisticated financial instruments. One is mortgage-backed securities that pool mortgages, set underwriting standards for mortgages, divide up these securities in different tranches of risk to be sold to investors in portions, or offer investors guaranteed principal and interest payments in exchange for a fee to cover potential losses. The belief that risk can be managed makes financial markets prone to risk-taking. The financial community not only celebrates such actions, but also often pressures market agents to engage in aggressive opportunism in a competitive race for profits. Providers face different risks in health insurance markets, where problems of asymmetric information are particularly pronounced. As individuals usually have better guesses about their prospective healthcare needs than insurers, the latter face difficulties in pricing risk. Insurance companies therefore try to select healthy patients over those they expect will be less healthy to minimize losses and maximize profits. There are similar adverse selection dynamics in marketized employment services, e.g., job training and welfare to work. When private job centers are paid based on their success in placements and thus bear the risk of potential financial losses, they select people they believe are the best candidates for rehabilitation while neglecting others. Making firms bear risk generates economic and political behaviors by providers that undermine welfare markets. In the economic sphere, firms may exit the marketplace or else devise ways to reduce risk. Private actors in housing finance might embrace competition and manage risk with the help of financial instruments. However, if risk is mispriced, these actions can destabilize markets. Their counterparts in healthcare try to drop potentially expensive customers, and if prevented from doing so, could exit the market or engage in other maneuvers that erode coverage. In the political realm, providers often become nasty rent seekers, actions that can stifle competition. Their lobbying efforts for government cushions, such as subsidies and/or protected market share, frequently succeed due to information and resource asymmetries between firms and public officials as well as pantouflage. Moreover, firms in these marketplaces tend to have structural power, owing to the dependence of policymakers on the functioning of these marketplaces in meeting their political objectives. This is what makes these private actors so powerful. Policymakers find themselves in what Zisman and Bresnitz call a double bind of trying to unleash competitive forces while simultaneously having to correct market dysfunctions to avoid collapse, all while depending on the expertise, information, resources, and cooperation of market agents. In short, policymakers are riding a tiger when yoking social welfare goals to competitive market forces. When private firms maneuver in response to risk and profit-making potential, markets evolve in ways that alter their form, nature, or function. The resulting political dynamics reinforce either non-competitive and stable marketplaces with few market participants who enjoy rent-seeking market positions, or competitive and unstable ones with private actors exiting markets or engaging in aggressive profit-seeking. Involving private actors can elicit rent-seeking or aggressive market behavior, undermining the original objectives of these markets and weakening policymakers' capacity to formulate social policy. We illustrate these dynamics in two different areas of the U.S. welfare state, housing and healthcare, where their respective treatment and management of risk generates similar tensions between stability and competition. As noted earlier, European welfare markets tend to be highly regulated and subsidized, thus limiting the degree of competition in favor of stability. We examine U.S. welfare markets in housing and healthcare to demonstrate an additional dynamic, that competition can lead to market and welfare destabilization. Our U.S. case studies should be a cautionary tale for market advocates promoting competitive structures and private risk-bearing in the welfare markets of other rich democracies. Across OECD countries, neoliberal prescriptions have influenced reforms of healthcare provision and insurance. Such ideas are especially powerful in the United States, where policymakers have attempted to constitute new health insurance markets as a way to expand access to insurance. Stimulating competitive pressures is central to this vision. Market advocates argue that as insurance companies strive for profits, they will innovate and cut costs. In reality, these markets have been plagued by two difficulties: the tendency of insurance companies to shed costly risks, thereby undermining the objective of making insurance widely available, and the fact that these marketplaces give insurers power to demand greater subsidies or other favorable treatment. In response, policymakers have adopted measures that undercut competitive forces, reinforcing a situation of rent-seeking on the part of insurers. MA and the ACA markets illustrate the clash between stimulating competition and providing social protection. Free market advocates have long made Medicare, the federal health insurance program for senior citizens and the permanently disabled, the object of competitive reforms. Over several decades, policymakers created a market of private insurance plans that is supposed to compete for beneficiaries. Aiming to provide better care at a lower cost, policymakers initially sought to put enough risk upon private plans to stimulate competitive pressures. In practice, risk cushioning subsidies have been essential to this market, and private insurers threaten market exit to procure and maintain these protections. MA is therefore stable, sustained by private insurers and a growing number of Medicare beneficiaries who rely upon it. However, MA reveals the difficulty of developing competitive welfare marketplaces, as the program's insurance plans rely on excessive public payments and other maneuvers shielding them from risk. The higher payments are not passed through to beneficiaries as reduced cost sharing or more benefits. Instead, plans absorb a sizable portion of these payments as profits. The MA program grew out of efforts to cut federal Medicare spending and improve the quality of care by making health insurers bear more risk for their beneficiaries' costs. Critics argued Medicare used an outdated fee-for-service payment model whereby the federal government reimburses care providers. Replacing this model with one in which private insurance plans compete for beneficiaries and bear some risk for their costs would stimulate market forces and bring managed care techniques, coordinating care and controlling costs, into Medicare. After allowing private managed care plans to contract with Medicare and compete to deliver benefits, a 1982 budget law created risk contracts, whereby Medicare paid private insurers flat-rate payments at 95% of the cost of regular, fee-for-service, Medicare, plus an adjustment for the risk profile of each plan's beneficiary pool. In making plans bear risk for beneficiaries' expenses, one goal was to incentivize private insurers to coordinate care, reduce excess use, and improve beneficiaries' health. Plans could keep some of the savings as profits, which could be used to improve the health plan and compete for more beneficiaries. The proportion of beneficiaries choosing private plans over conventional Medicare expanded markedly, reaching 14% by 1997. Private plan growth partly stemmed from a flourishing market of health maintenance organizations, HMOs, but it also emerged as insurers found ways to avoid covering costly individuals. People who signed up for these plans were healthier than those in traditional Medicare, but private insurers also discouraged potentially sicker beneficiaries from signing up for their plans. Risk adjustment should have modified payments according to the health of the beneficiary pool, but it was based on simple demographic factors. Even though the government paid these plans less, per beneficiary, than fee-for-service Medicare, the government spent more on Medicare than in the absence of these private plans. The congressional response was to cut payments in order to stimulate competitive pressures on private insurers. The 1997 Balanced Budget Act replaced risk contracts with a Medicare Plus Choice program, expanded the types of plans that could participate in the program, introduced health-based risk adjusting that reduced, without eliminating, excess payments and limited payment rate increases. In shrinking the cushion for these plans, the aim was to make them bear more risk. As the GOP congressional majority ultimately aimed to replace Medicare with a system of competing private plans, they hoped Medicare Plus Choice would demonstrate the virtues of competition by delivering better care at lower cost. Private insurers used lobbying and threat of marketplace exit to combat these changes. Plans exited Medicare in droves. Between 1999 and 2003, more than 2 million beneficiaries lost their plans. Angry beneficiaries pressured policymakers to act, and health insurance lobbyists used beneficiaries' complaints as evidence for why generous payments should be restored. The insurance industry also deployed considerable financial resources in campaign contributions and lobbying. Between 1998 and 2004, campaign spending by health services HMOs increased from over $2.9 million to nearly $6.4 million, while spending on lobbying doubled. The push to restore subsidies was aided by the fact that many choice beneficiaries lived in Democratic areas, impelling a bipartisan push to shore up the program. Faced with industry pressure and angry beneficiaries, in 2003 the Republican majority in Congress turned Medicare Plus Choice into Medicare Advantage, restored its generous payments, and improved risk adjustment with the stated purpose of restraining program spending. Instead, average plan payments increased by 10.9%, with some plans receiving increases of as much as 40%. MA costs swelled beyond those of traditional Medicare, and spending reached a high point of, on average, 114% of the cost of fee-for-service Medicare in 2009. As plans used managed care techniques to lower health spending on beneficiaries, they reaped considerable profits. An NBER study of 2010 data found that MA insurer revenues were 30% higher than their spending. The proportion of Medicare beneficiaries in private plans grew from 11% in 2003 to 23% in 2009. To pay for its own healthcare reform, the Obama administration attempted to cut program spending by changing how insurance plan rates would be calculated. But the administration then instituted mechanisms compensating for these cuts, reflecting industry lobbying and a desire to sue the insurers on which the administration depended for implementation of the ACA. The Obama administration also regularly yielded to intense lobbying around MA reimbursement rates. Each year, the Department of Health and Human Services, HHS, announces proposed rate increases and faces furious lobbying by insurers who issue dire warnings about how inadequate rate increases will harm beneficiaries. Usually, HHS relents. In April 2013, HHS abandoned a proposed 2.2% rate cut for 2014 in the face of an intense lobbying campaign by the insurance industry that involved white papers, television ads, grassroots organization, and a series of bipartisan letters from more than 160 members of Congresses. The HHS gave in to these pressures and instituted a 3% rate increase. Similarly, in 2014, health insurers asserted that, if the administration reduced reimbursement rates for 2015, the result would be increased premiums and copays for beneficiaries, as well as lower benefits, all of which would harm Medicare beneficiaries. Instead of a proposed 2.3% cut in rates, HHS allowed a 3.3% increase point for the Trump administration has behaved similarly. A proposed rate increase of 1.84% for 2019 grew to 3.4%, following industry lobbying. Behind these claims is the Coalition for Medicare Choices, a group that an insurance industry trade association created to fight MA reimbursement cuts. 5 insurers also aggressively use diagnostic coding practices, maximizing the number of illnesses coded as needing reimbursement, to compensate for reduced payments. Officially, MA plans receive an average of 101% on what is spent on fee-for-service Medicare, but they actually receive 102 to 103% when accounting for these practices, MedPAC 2018. In sum, insurers found a way to limit risks and maximize profits. As long as plans can select based on risks, they limit the full force of competition. The MA market is not very competitive. 97% of it is highly concentrated and lacks competition between plans. These developments parallel those in health insurance markets as a whole, which have become increasingly concentrated. Average MA plan margins are a healthy 2.6% overall, with for-profit plan margins averaging 4.9% pre-tax, MedPAC 2018. However, this market is more about propping up insurance industry profits than it is about harnessing market forces to save money or improve the quality of Medicare. The ACA healthcare exchanges demonstrate a similar clash between constituting a competitive market and achieving social welfare objectives. The individual insurance marketplaces only exist with substantial government cushioning. Yet, for political reasons, the GOP has fought the law and demanded cuts in subsidies, making insurance plans bear more risk. Such actions undercut the stability of these markets, leading many plans to exit while those that remain often raise premiums. The threat of exit has, however, given private insurers some influence, owing to the political costs of taking away people's health insurance. The resulting tug-of-war has left the exchanges in limbo, with Republicans unable to rally enough support behind destroying these markets, yet also unwilling to support them. The ACA sought to expand health insurance coverage through insurance market reform. Individuals and small employers often had difficulty purchasing affordable, decent quality health insurance. With most people getting insurance through larger employers or federal programs, the remaining risk pools suffered from adverse selection. The result is expensive insurance coverage that further deters healthy people from buying it and exacerbates an unbalanced risk pool. Even those with insurance often faced skimpy coverage, high out-of-pocket costs, lifetime coverage maximums, no coverage for pre-existing conditions, and other insurance plan maneuvers to limit exposure to high risks. The ACA's insurance reform banned many of the latter practices in return for delivering new customers to the industry. Taking a page from the Republican pro-competitive health reform playbook, the ACA created a health insurance marketplace on which people could buy plans. To combat adverse selection, the law mandated that people buy coverage, imposed financial penalties on those who do not, and instituted income-related subsidies to help lower-income people purchase insurance. The law also included 3 measures to cushion insurers from the risks of participating in ACA exchanges. 1. Risk adjustment, a permanent system redistributing costs between plans with a low risk pool of beneficiaries to those enrolling a higher risk pool. 2. Reinsurance, federal payments for the first 3 years to insurers of patients with high health costs. And 3. Risk corridors, a temporary fund to compensate insurers who spend more on care receive while those who spend less pay into the fund. Point 6. Because these marketplaces needed insurance plans to participate, insurers gained political leverage over the law's implementation. As in MA, insurers lobbied for the best deal, leading some to call the ACA the Full Employment Act for K Street. Although many insurers opposed the ACA during its legislative crafting, once passed they saw money-making potential in it. Insurers therefore had reasons to help the administration get the marketplaces up and running, while the Obama administration also was solicitous of their concerns. In spring 2014, for instance, the administration made changes to reinsurance and risk corridors that expanded insurers' access to these funds. For conservative critics, this was a slush fund for the insurance industry. The administration's dependence on the industry to help implement the law also partly explains its willingness to repeatedly raise MA rates. As the insurance industry cozied up to the Democratic administration, Republicans were divided. Some wanted to bolster the exchanges to stymie moves for a government-provided alternative, while sought to undermine Obamacare entirely. Some GOP-controlled state governments refused to expand Medicaid as the law envisioned or set up state-level health insurance exchanges. Between 2011 and 2016, Congress voted more than 6 times to undermine or end the law, with 5 votes on its complete dismantlement. As legislators knew Obama would veto these measures, they were largely symbolic but did stoke concerns among insurers trying to decide whether to enter the marketplaces. More significant was Senator Marco Rubio's quiet legislative sabotage of the health exchanges by seeking to increase competitive pressures on insurance plans. Rubio attacked the ACA's risk corridor mechanism as a boondoggle for insurers and went after the cushions that helped constitute the market, arguing that firms should bear the consequences for failing to make money on these markets. As Rubio said during a Senate debate, if you want to be involved in the exchanges and you lose money, the American taxpayer should not have to bail you out. Consequently, in late 2014, he introduced a measure that barred using general revenues to make risk corridor payments. According to insurers, this meant they never received $12 billion in payments owed to them. These combined attacks on the ACA stymied enrollment. By not setting up state healthcare exchanges, a greater burden fell on the federal exchange. The federal marketplaces had a rocky start, which likely deterred lower-risk people from buying insurance. The tax penalty for non-insurance also was not tough enough to induce healthier people to sign up. Enrollment was therefore about half of that originally projected. As insurers faced a sicker and costlier risk pool, they pressured policymakers through political mobilization and market exit. They issued continuous warnings about how monkeying with risk-sharing mechanisms would reduce plan participation in the exchanges or raise premiums. These were credible threats, given the reluctance of some big insurers to enter the marketplaces. Many held back in 2014 and cautiously expanded participation in 2015, figuring that if they failed to grab market share, the stickiness of insurance plan choices would make it hard to enter later. As enrollment in health plans drew fewer and disproportionately sicker people, and the GOP signaled it would not assist struggling insurers, the latter began raising premiums or leaving the markets. Insurers felt Rubio's attack on risk adjustment starting in late 2015, which contributed to the decision of some insurers to drop out. For example, the Health Republic of Oregon folded once it discovered it would receive only a fraction of the risk payments it expected. Others made dramatic turnabouts in response to worsening market conditions. United Health Group declared in October 2015 that it expected to stay on the exchanges, but only a month later announced it had lost $1 billion on the exchanges and by spring 2016 retreated from most of them. Aetna also declared in 2016 that it lost over $400 million on the exchanges and would leave most markets, and was followed later by Humana, which fully quit all ACA markets in 2018. The remaining plans on the exchanges increased premiums and could so because of declining competition from other plans. Starting in 2016, premiums increased significantly, although this varied by state and county. Premium increases, in turn, led those earning too much to qualify for ACA subsidies to drop their insurance. About 1 million people did just that in 2017. In 2019, premiums leveled off or declined in some areas, because some state governments stepped in and created reinsurance programs to replace the federal one, while the huge premium increases of the previous years gave insurers some breathing room. The upshot is that ACA markets, in contrast to MA, remain in a tenuous situation. Insurers decided not to push to maintain the subsidies that would help keep them in ACA markets. For many big insurers, The ACA exchange business was not of great significance to their bottom line. Even as these firms were losing money on the exchanges, they were still very profitable companies with high stock market valuations. Without much at stake, insurers were thus largely silent during efforts by the GOP to repeal the ACA in 2017. Even so, the GOP's failure to repeal the law, despite having full control of Congress and the presidency, reveals the difficulty of uprooting a system that was delivering health insurance to many. A recent Trump administration effort to throw out the ACA's ban on allowing insurers to refuse coverage or impose higher premiums on people with pre-existing conditions fueled a panic among Republicans in Congress fearful about the impact on 2018 elections. Trump officials also sought to both satisfy the Republican base by taking steps to undermine the law, while adopting other measures to stabilize the marketplaces. The administration ended the individual mandate, cut spending on marketing for enrollment, ended risk adjustment spending for insurers, and encouraged a parallel market of cheaper, lower-quality insurance plans as alternatives to plans meeting ACA requirements. But in July 2018, the administration also reinstated risk adjustment for plans at the urging of GOP members of Congress fearing chaos in the market that could lead to an electoral slaughter. As of this writing, the fate of the ACA may lie in the Supreme Court, which will consider whether or not to invalidate the entire statute. What we have already seen, however, is how much government risk cushioning is needed to sustain these marketplaces. Housing finance markets are deeply entwined with the welfare state, fulfilling important social functions of obtaining home ownership. Much like welfare markets in health insurance, mortgage securitization displays tensions between stable welfare provision and competition. To ensure access to affordable mortgages, policymakers created the mortgage securitization marketplace in the late 1960s by tasking for-profit GSEs, Fannie Mae and Freddie Mac, with buying mortgages from private banks, pooling these mortgages, and selling them to investors as mortgage-backed securities. While policymakers intended to create a competitive securitization marketplace, in which the GSEs would compete with financial institutions, they crowded out private competition. The situation temporarily changed in the 2000s when financial institutions flocked to the securitization marketplace, producing the competition and private risk-bearing that policymakers originally envisioned. Yet, heightened competition between and among private banks and the GSEs fueled aggressive profit-making behavior and resulted in market collapse in 2008. Policymakers responded by bailing out the battered GSEs while private banks exited the market. Today, the GSEs once again dominate the securitization market and there is little private risk-bearing. The origins of the mortgage securitization welfare market lie in the liquidity problems of a strained deposit-based mortgage market in the late 1960s and early 1970s. When savers and investors fled the savings and loans (S+L) market as a result of rising inflation and interest rates, the consequence was maturity mismatches and illiquidity in the S+L sector. That is, these institutions were lending long, e.g., 30-year, fixed-interest mortgages at low rates, but borrowing short, e.g., deposits at rising interest rates. Policymakers then created the securitization market to improve liquidity, counter maturity mismatches, and provide off-budget funding for affordable mortgages. The practice of mortgage securitization takes mortgages off banks' balance sheets and therefore improves liquidity in housing finance. Policymakers envisioned a competitive securitization market in which private banks would emulate and compete with mortgage securitization pioneered by the GSEs. In 1968, the Johnson administration authorized Fannie Mae, then already a for-profit GSE, with issuing mortgage-backed securities. In 1970, the Nixon administration created Freddie Mac, another for-profit GSE, to introduce competition with Fannie. Having issued mortgage-backed securities on a large scale only since the early 1980s, the GSEs have guaranteed investors the principal and interest payments from the underlying mortgages in exchange for fees. According to a congressional report, the rationale was that if such securities become well enough established so that many private issuers are issuing them, they could constitute a significant factor in attracting investment funds to the field of mortgage investment. In other words, policymakers hoped for competition and private risk-bearing in the securitization market. Yet, with the GSEs at the center of the securitization market, little competition followed. By the early 1980s, the GSE's market share only reached 16% of the overall residential mortgage market, as the country's mortgage system was still largely deposit-based. However, the GSE's market share within the securitization market was close to 90%. Private banks could not compete with the GSEs, as the latter received tax privileges that private banks did not, borrowed more cheaply in capital markets, enjoyed more lenient capital buffers, and faced lower regulatory burdens. As a result, the US government bore risk for catastrophic losses in the event of large-scale mortgage defaults, which came at the cost of socializing credit risk in the securitization market. Early deregulatory attempts to introduce more competition in mortgage securitization failed. In 1984, the Reagan administration adopted the Secondary Mortgage Market Enhancement Act to generate competition, increase liquidity, and prevent further GSE growth. The idea was to broaden the number of participants channeling investor capital to the homebuyer, creating a downward impact on mortgages. While the measure removed restrictions for banks and investors to trade mortgage-backed securities, it did little to promote competition, given the persisting unequal playing field between the GSEs and private banks. To create more competition, the Tax Reform Act of 1986 made trading advanced mortgage-backed securities more attractive for both issuers, i.e., fewer tax restrictions, and investors, i.e., tailored to specific needs. Yet, it did not increase competition because the GSEs retained their price advantages and crowded out private banks, much to the dismay of investment banks. Until the late 1990s, mortgage securitization took place in a non-competitive yet stable marketplace that gradually replaced the previous deposit-based mortgage system and met the welfare objective of ensuring affordable mortgage debt. It should be noted that white households disproportionately reaped the benefits of this marketplace, as the home ownership rate among non-whites was much lower, owing to long-standing discrimination in real estate and financial markets, lower parental and family wealth, partly the result of discriminatory federal housing policy of previous decades, and lower median household income. Yet, stable welfare provision was not the result of market competition but was produced by the government-supported duopoly of Fannie and Freddie, behind which the US government absorbed risk. Mion and Sufi note that as long as GSE securitization dominated the mortgage market, credit risk was kept in check through underwriting standards. When the securitization market grew in size and importance, so did the influence of the GSEs. By the early 2000s, Fannie and Freddie were two of the largest US companies listed on the New York Stock Exchange. Together with their fully public cousin Ginnie Mae, they held or securitized $2.6 trillion in mortgages, a market share of 43% of the residential mortgage market, originating roughly 75% of all mortgage-backed securities. In addition to structural market power, their political firepower was legendary. One source of political power was pantouflage, with a long list of Democrats and Republicans having moved back and forth between public service and the GSEs. Another was the powerful mortgage and housing industry that supported the GSE-centered housing finance system from which they benefit. As Koppel notes, lenders, realtors, and other housing-related trade organizations dependent upon Fannie Mae and Freddie Mac for their business can be mobilized to bolster the GSE's political strength. In the early 2000s, a confluence of policy actions and economic developments transformed this stable, non-competitive marketplace into one with considerable competition, volatility, and private risk-bearing. In the political realm, first, the decades-long political efforts to liberalize and deregulate the low-quality mortgage market led to a proliferation of unconventional mortgage instruments, such as subprime, jumbo, and Alt-A mortgages in the primary mortgage market. Second, in the secondary market, the George H.W. Bush administration started relaxing underwriting standards for GSE securitization with the Federal Financial Safety and Soundness Act in 1992. The reform established a lenient regulator for the GSEs and specified affordable housing goals to be met by the GSEs. That is, the GSEs were tasked with securitizing lower-quality mortgages in underserved and low-income communities, relaxing the underwriting standards of the GSEs. GSE lobbying, supported by the housing industry, was instrumental in establishing a lenient regulator. A Fannie official stated that the company was communicating with every member of Congress who we think cares about Fannie Mae and cares about housing and telling them that this bill, with strict regulations, needs to be killed. Third, the Clinton and George W. Bush administrations continued pushing the GSEs further into lower-quality mortgages as part of their respective national home ownership strategy and aggressive housing agenda to produce growth and expand home ownership among minorities. Yet, despite the growing presence of the GSEs in lower-quality mortgage markets, they were still restricted in what mortgages they could securitize and refrained from subprime mortgages. This created an opening for the private market to enter subprime mortgage securitization. While the untapped opportunity in subprime securitization allowed for private market entry, a confluence of factors explains why private banks moved into it. One set of factors is macroeconomic. Booming housing markets and rising house prices generated investor confidence and demand for housing assets. After watching the GSEs make hefty profits in recent decades, private actors jumped at the opportunity of gaining market share. Investment banks, which had worked closely with the GSEs in developing securitization practices, seized on securitization after the dot-com bubble and Asian financial crisis in search of the next big thing. Commercial and mortgage banks quickly followed, acting increasingly like investment banks after the Clinton administration's Financial Services Modernization Act of 1999 allowed them to do so, as they were under pressure from a low-interest environment. That these private actors moved into risky territory was also influenced by the fact that they were becoming so large that many assumed they were backed by implicit government guarantees. As a result, the private subprime securitization market expanded its share in the overall mortgage market from 8% in 2000 to 19% in 2006, while that of the GSEs dropped from 43% to 34%. For the first time, in 2005, private banks issued more mortgage-backed securities, i.e., roughly 55%, than the GSEs, Figure 2. Another set of factors was the availability of financial instruments to purportedly minimize risk. Underlying private market entry was the ill-defined assumption that mortgage-backed securities and their derivatives would be able to absorb the credit risk of low-quality mortgages. For their part, credit rating agencies reassured investors by giving private-label mortgage-backed securities inflated ratings, often as safe as Fannie and Freddie securities. The development and spread of sophisticated derivatives, such as collateralized debt obligations, i.e., resecuritizing existing mortgage-backed securities, and credit default swaps, i.e., insurance against the default of these derivatives, functioned as an equivalent to the risk-absorbing government guarantees behind the GSEs. Investors then bought into the belief that these derivatives were able to manage risk, while these derivatives were still vulnerable to the cash flows of mortgagees. So did federal regulators and central bankers, who were unable to detect and prevent the brewing housing bubble and financial vulnerabilities associated with it. As Tet rightly comments, one problem was that derivatives and securitization were so complex that they introduced a brand new risk into the system: ignorance. In sum, market participants mispriced credit risk in securitization markets, which enabled the housing bubble to build between 2003 and 2007. As the GSEs came under competitive pressure for securing market share and profits, reflecting its ambivalent, dual mission of promoting affordable mortgages and maximizing shareholder returns, they too started investing in the low-quality, subprime mortgage market. This competitive environment led to aggressive profit-seeking activities between and among the GSEs and private banks, generating a race to the bottom. These pressures were especially acute when the market for conventional mortgages was saturated by the mid-2000s, partly because interest rate hikes put an end to the mortgage refinancing boom, and private actors and the GSEs looked to originate and securitize low-quality mortgages to satisfy investor appetite. In the 2000s, the Bush administration became concerned about the growing financial risks of the GSEs borne by the US government, yet was unable to push through reform to tighten regulations. From 2003 to 2005, it proposed the creation of a new regulator for the GSEs, citing concerns about their growing portfolios, opaque accounting practices, and lack of proper regulation. In the words of Senator John McCain, Republican Arizona, in 2006, if Congress does not act, American taxpayers will continue to be exposed to the enormous risk that Fannie Mae and Freddie Mac pose to the housing market, the overall financial system, and the economy as a whole. However, congressional Democrats and housing interest groups, such as the homebuilders, opposed the proposal, fearing that the GSEs would be forced to scale back their affordable housing activities, which would hurt housing growth and the expansion of homeownership in underserved communities. Fannie and Freddie then began lobbying ferociously to divide Republicans over the issue, and spent a total of $164 million on lobbying between 1999 and 2008. One GSE regulator testified to the Financial Crisis Inquiry Commission that, during his tenure from 1999 to 2005, the Fannie and Freddie political machine resisted any meaningful regulation using highly improper tactics, and that regulators were constantly subjected to malicious political attacks and efforts of intimidation. The reform efforts failed. The unintended consequence of heightened competition was the destabilization of the securitization market and then the entire financial system in 2008 to 2009. When millions of homeowners started defaulting on their mortgage payments, Black and minority households were hit particularly hard, as they were more likely to hold subprime loans. These payments could no longer be passed on to investors of mortgage-backed securities and collateralized debt obligations. The GSEs and many financial institutions that guaranteed or insured these payments were completely exposed to credit risk and faced bankruptcy. The importance of the securitization market, which supplies households with mortgages, contributes to economic growth, and affects industries and investors at home and abroad, induced policymakers to quasi-nationalize the securitization market. There was widespread political agreement to bail out the battered GSEs at a cost of $191 billion, as they were considered too big to fail. The housing lobby of realtors, mortgage bankers, and homebuilders supported the bailout to restore the housing finance market. The Bush administration quasi-nationalized the GSEs in 2008, giving them a duopoly in the securitization market as private firms exited it due to perceptions of heightened risk. Once again, the U.S. government is bearing risk, currently guaranteeing $7 trillion in GSE debt and originating more than 90% of all mortgage-backed securities. Regulators already sounded the alarm about protecting taxpayers from GSE credit risk and worked with the GSEs to implement some risk transfer programs to the private market. Housing finance reform stalled during the Obama and Trump administrations, as policymakers could not agree on the precise role of the U.S. government in the securitization market. Today, the quasi-nationalized nature of the housing finance market means that the U.S. government and taxpayers, through the GSEs, are bearing the risk of most mortgages in the country. In rich democracies, policymakers often trumpet the superiority of private markets over public action, and the attendant need to limit the role of the state. These beliefs have driven the creation of welfare markets as part of the public-private welfare state. However, our case studies of U.S. health insurance and housing finance marketplaces reveal the difficulties of reconciling tensions between competitive forces and stable welfare provision. We argue that the treatment of risk produces these tensions. It is difficult to predict how firms respond to risk in these marketplaces, such as through market exit, rent-seeking, or aggressive profit-seeking. When policymakers create these marketplaces in which private firms are central to providing social welfare, they make themselves vulnerable to market dynamics over which they have limited control. This analysis contributes to our understanding of why market reforms often result in a larger state footprint. Many scholars have shown that market liberalization, financialization, and privatization can result less in a retreat of the state than its reconfiguration and expansion. In the words of Jacobs and Telles, a market-making project may, paradoxically, culminate in an expansion of state activity that equals, or even exceeds, its initial retreat. In welfare markets, we identify a new mechanism through which this occurs by tracing the behaviors of private welfare providers when confronted with risk. The resulting instabilities and/or scrabble for government protections by providers generates strong pressures for increased state involvement in these markets. In housing finance, excessive competition and market instability led policymakers to bail out the for-profit GSEs, Fannie Mae and Freddie Mac, in essence socializing the country's multi-trillion-dollar securitization market. Health insurers are only willing to participate in the ACA and Medicare Advantage markets when guaranteed sufficient subsidies and other risk cushioning schemes. A second contribution is to place firms' responses to risk more centrally in the study of public-private welfare systems and welfare markets. Existing scholarship convincingly illustrates how welfare systems shape the individual experience of risk. We complement these studies by emphasizing an additional and related dimension of risk, that is, how welfare providers respond to the risk of bearing losses in welfare markets, behaviors that not only produce tensions between welfare stability and market competition but also ultimately threaten the adequate provision of household social security. Studying how firms respond to risk therefore contributes to a refined understanding of the public-private welfare state. Although our analysis focused on U.S. welfare markets, we believe that the tensions between market competition and stable welfare provision can be found in other countries. For instance, the Dutch and Swiss health insurance systems are often held up as models of managed competition for the United States. But in these systems, insurers are shielded from risk through extensive subsidies and government regulation, while still engaging in selection. Behind the facade of market stability lie practices that undercut competition based on quality and price. The same holds for marketized job training systems in many countries, such as Denmark, Germany, or the United Kingdom, where firms engage in adverse selection to screen out difficult clients. If blocked from engaging in these practices and thus forced to bear risk for successful placements, we expect this would lead to firms exiting markets or lobbying for greater subsidies, using the threat of the former to help support the latter. Similarly, the Canadian mortgage securitization market is often praised for its stability, including during the financial crisis of 2008 to 2009. Yet, the CMHC, a government agency underwriting mortgage debt, dominates the securitization market while private firms largely stayed away from it to avoid bearing risk. Future research might further explore the tensions between competition and stability in these and other welfare markets. Our US case studies are cautionary tales about the destabilizing effects of competitive forces. The resulting market instability can not only lead to costly state involvement correcting for market dysfunctions but also affect the well-being and livelihood of households. Decision-makers who prefer to delegate responsibility for social welfare to private actors should be clear-eyed about the perils of injecting competitive forces into the welfare state. To avoid market instability and costly market corrections, they might instead opt for constraining unfettered market activity through tighter market regulation, traditional public social insurance programs, or well-specified contracting relationships, so as to ensure adequate social welfare for households and avoid instances of privatizing gains and socializing losses for private firms. Home ownership, The Economist writes, is the West's biggest economic policy mistake. Post-war government subsidies for financing private homes, The Weekly argues, contributed to financial instability and bubbles, housing inequalities, and overinvestment in housing. Mistake or not, the sheer size of multi-trillion-dollar mortgage markets, which brought the global economy crashing down in 2008 to 2009, and their role in facilitating private home ownership make them important sites for political contestation. What The Economist's hyperbole overlooks, however, is that mortgage subsidies vary greatly across nations. Some countries, such as the United States, provide extensive public support for financing private homes, while others, such as Germany, offer limited public support. Little research addresses the political foundations of this variation. This article investigates the divergent housing finance policy paths in the United States and Germany. From the mid-20th century, both countries subsidized home ownership through sizable tax subsidies and/or public underwriting of mortgage debt. By the mid-2000s, however, they diverged. During the financial crisis of 2008 to 2009, the United States doubled down on its state-based approach of providing generous mortgage subsidies. In response to the recession, U.S. policymakers quasi-nationalized large parts of the country's housing finance market by taking over Fannie Mae and Freddie Mac, two public-private or government-sponsored enterprises, GSEs, formerly traded on Wall Street. More than a decade later, they remain in the U.S. government's hands, including $5.5 trillion in mortgage debt, or almost 50% of the residential mortgage market. In contrast, German policymakers adopted market-based solutions of retrenching mortgage subsidies just prior to the 2008 to 2009 crash, at a time when the country was considered the sick man of Europe and suffered its own housing crisis in the East. In 2006, Chancellor Angela Merkel's Grand Coalition government eliminated the country's largest tax subsidy and housing program, the homeowner subsidy, Eigenheimzuselig. Why did the two countries adopt sharply opposing policy responses in the face of economic crises? I argue that differences in the structure of macroeconomic growth regimes, and in the ways in which housing markets are embedded within these regimes, shape the housing policy divergence in the United States and Germany. Housing is a major engine of the demand-led U.S. growth regime, where increasing house prices tend to stimulate consumption through wealth, credit, and capital flow channels. However, housing is not an engine of the German export-led growth regime. Stimulating house prices and credit creates frictions with the macroeconomic priorities of restraining prices, credit, wages, and domestic demand to secure cost competitiveness. These different economic linkages shape distinct coalitional logics that led to the opposing policy responses when both countries faced deep economic crises in the 2000s. When the financial crash of 2008 to 2009 threatened the U.S. growth regime, a bipartisan political coalition, supported by housing interest groups, adopted state-based solutions of entrenching mortgage subsidies so as to stabilize and stimulate household credit and consumption. Yet, when Germany's export-led regime suffered a deep economic crisis just prior to the Great Recession of 2008 to 2009, a broad-based political coalition, supported by export-oriented interest groups but opposed by the housing lobby, adopted market-based solutions of retrenching mortgage subsidies to suppress domestic demand and boost competitiveness via fiscal consolidation and structural reforms. From the early 20th century, both the United States and Germany offered sizable mortgage subsidies. In both countries, they originated during hard economic times, the Great Depression in the United States and the early post-WWII years in Germany. The American state has since provided sizable off-budget guarantees in the primary and secondary mortgage markets. The latter work through fully public agencies, such as Ginnie Mae, and the privately operated, government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac. Over time, the GSEs have grown in size and importance. By 2007, Fannie and Freddie guaranteed $3.5 trillion in mortgage debt, or roughly 30% of the US mortgage market. As the US government implicitly guaranteed these large amounts of mortgage debt via the GSEs, the result is a subsidy to homeowners, i.e., lower mortgage rates compared to rates in a fully private mortgage market, which the Congressional Budget Office estimated to have saved homeowners $14 billion in mortgage payments in 2003. Moreover, homeowners received generous tax breaks, such as the mortgage interest deduction, property tax deduction, and capital gains exclusion, which saved them an additional $110 billion that year. To a lesser degree, Germany also adopted large-scale mortgage subsidies. In response to severe post-WWII housing shortages, decision-makers introduced tax subsidies and social housing programs for both homeownership and rental markets. One major program was the Eigenheimzulage, a tax break that subsidized the cost associated with home ownership. Another was social housing that included subsidized loans for rental investors and homeowners. While German politicians started scaling down social housing programs when post-war housing supply shortages subsided in the 1970s, the Eigenheimzulage outlived its original purpose and became a sacred cow in German politics. The popular subsidy amounted to €11 billion in 2004 and benefited 2.6 out of 38 households between 1996 and 2000 alone. One notable difference between the two countries is that Germany's secondary mortgage market has not enjoyed the strong forms of government support found in the United States. The German covered bond, Pfandbrief, market is not only less developed, i.e., constituting 16% of the German mortgage market or €240 billion in 2019, compared to US mortgage-backed securities markets, but the German government also does not back these bonds. Despite some differences, both countries have long-standing traditions of subsidizing home ownership. Yet, when the two countries faced deep economic crises in the 2000s, their housing policy paths diverged sharply. Where the United States responded by entrenching already generous state-based mortgage subsidies, Germany did the opposite and adopted market-based solutions of retrenching mortgage subsidies. During the financial and housing crisis of 2008 to 2009, the US government increased the role of the state in the housing finance market by seizing control of the battered GSEs with one of the largest bailouts in the country's history in the amount of $191.6 billion. Even though investors had long assumed that the US government implicitly backed the GSEs in the case of catastrophic losses, owing to their ambiguous public-private status, the move to quasi-nationalize the GSEs entrenched government support and made it explicit. 1 decade later, the two mortgage giants remain in government control, including $5.5 trillion of their underwritten mortgage debt, a share of roughly 50% of the residential mortgage market. Germany faced a deep economic crisis just before the 2008 shock, plagued by slow growth, rising deficits and debt, and declining export competitiveness. In addition, the country's east experienced a post-unification housing construction boom and bust in the late 1990s and 2000s, contributing to massive vacancies, depressed regional housing demand, and a deep and protracted contraction of the German construction sector. While US policymakers stimulated housing in light of depressed demand and record-high vacancies during the Great Recession, German policymakers retrenched homeowner subsidies in 2006 and did not revive them during the Great Recession of 2008 to 2009. Today, German subsidies for home ownership are much lower than in most other countries and pale in comparison to their US counterparts. Indeed, even in the broader context of rich democracies, the United States stands out in its generosity of extending mortgage subsidies and Germany in its restrictiveness. For instance, Johnston, Reagan, and Fuller developed a mortgage credit index that measures the degree to which national mortgage regimes encourage or discourage mortgage credit through subsidies and other regulatory actions. Note: lower index values indicate mortgage credit encouragement and higher values restrictiveness on a 0 to 10 scale. According to their index, the United States, 0, encourages mortgage credit the most, followed by the Netherlands, 1, Ireland, 2, the United Kingdom, 2, and Spain, 2, whereas Germany, 9, ranked the most restrictive, followed by Austria, 8, Italy, 8, and then France, 7, in 2007. While not a perfect proxy for mortgage subsidies, the index shows that the United States, and the demand-led United Kingdom, and Germany, and export-led Austria, occupy opposite ends of the spectrum when it comes to encouraging mortgage credit in advanced economies. The variation in housing policy paths between the United States and Germany also presents theoretical puzzles. Much accepted wisdom about the two countries originated from the varieties of capitalism framework analyzing firm behavior in the economy, including in the financial system. The United States is a quintessential liberal market economy, in which firms resolve coordination problems through market relations, price signals, and competitive arrangements. Germany is the archetypical coordinated market economy characterized by non-market relations to coordinate firm behavior. In the case of housing finance, a major part of the financial system, the opposite is the case. The United States offers generous public support for housing finance, constituting state-based solutions to resolve coordination problems while distorting price signals and market competition. In contrast, Germany adopted market-based solutions by reducing market-distorting subsidies for housing finance. The variation is also intriguing when considering Esping-Anderson's influential welfare state typology. The United States is a liberal welfare regime with means-tested and minimal public benefits, relying instead on market solutions. While true for many parts of the American welfare state, it does not hold for home ownership, owing to sizable tax expenditure and government guarantees against mortgage default as part of the public-private or hidden welfare state. Germany, in contrast, is a conservative welfare state characterized by generous public benefits to secure status, income, and traditional family life. Home ownership is an ideological mainstay of Christian Democrats, given their preference for conservative family life in single-family homes, the accumulation of private wealth, and privately governed, but publicly financed welfare state arrangements. It is therefore surprising that the Christian Democrats under Chancellor Merkel turned their back on homeowner subsidies. The divergent paths also challenge influential accounts that emphasize the stability of the welfare state. Scholarship in this camp argues that social programs generate either strong constituencies, mass publics, or interest groups that would defend these programs. Mortgage subsidies should be especially resilient as they benefit concentrated and powerful home-owning constituencies, appeal to mass publics, and enjoy interest group backing, e.g., building societies in Germany or realtors in the United States. Yet, the United States and Germany embarked on divergent paths despite being home to powerful interest groups. Are these policies the simple function of the power of home-owning constituents? Germany's current home ownership rate of 47% is indeed lower than 66% in the United States. While home ownership rates are undoubtedly important political determinants, they do not preordain policy outcomes. When both countries started subsidizing home ownership, renters constituted the majority in both countries. Indeed, the German home ownership rate was 30% in the 1950s, while the US rate was 44% in 1940. Similarly, Germany eliminated mortgage subsidies in the mid-2000s, when home ownership was at its peak. The analytical starting point is the burgeoning growth model literature in comparative political economy. The growth model perspective, as advanced by Baccaro and Pontusson, privileges the long-neglected demand-side drivers of the economy, i.e., the main components of aggregate demand, such as exports and household consumption. It advances upon earlier insights emphasizing economy's supply-side institutions of corporate governance, industrial relations, and vocational training. Following Hall as well as Hassel and Palea, I use the term growth regime encompassing the interaction of the demand and supply-side drivers of the economy. The growth regime literature generally divides advanced economies into two camps, demand-led and export-oriented growth regimes, that solidified in the post-Fordist era of declining wage growth and Keynesian demand management. The U.S. economy is a demand and credit-led growth regime that relies on private demand, wage growth, credit expansion, and consumption, whereas the German regime is export-led and characterized by cost competitiveness, wage restraint, savings, and repressed consumption. Since at least the 1970s, private consumption as a share of GDP has been much higher in the United States than in Germany, while the export share has been significantly larger in Germany than in the United States. In 2019, for instance, private consumption was 68% of GDP in the United States and 52% in Germany, whereas exports were only 12% of GDP in the United States and 47% in Germany. The growth regime literature thus far has given little consideration to the sectoral composition of advanced economies, that is, how different growth regimes depend on different sectors to promote growth. Economists have demonstrated that housing is a key engine of growth in demand-led economies, such as the United States and the United Kingdom. Changes in house prices can stimulate domestic demand through the wealth, collateral, and capital flow channels. The wealth effect occurs when growing housing prices increase homeowners' sense of their own wealth and therefore their propensity to consume. The credit and collateral effect occurs when growing house prices ease the credit constraints and increase the net worth of homeowners against which they can borrow, including second mortgages or home equity loans. Global capital flows constitute a third effect. Demand-led economies tend to be deficit countries financed by foreign savings that can flow into housing markets. These capital inflows stimulate mortgage lending, house prices, and household consumption. For these channels to be effective, housing finance markets need to have low transaction costs, liberal lending terms, high ownership and turnover, and a supply of a variety of mortgage products. Housing is much less central to Germany's export-oriented growth regime, as the housing wealth, credit, and capital flow channels are less pronounced, if they exist at all. Economists have found no positive effect of increasing house prices on consumption in the country. Voigtlander, Koffner, and Geiger, Muehlbauer, and Ruprecht all questioned the wealth and collateral effects, finding that higher house prices do not lead to higher spending, owing to high down payments requiring households to increase savings, the absence of home equity withdrawal, and a conservative housing finance system with lower levels of mortgage debt and ownership turnover. As a surplus country, Germany also tends to export excess savings, which until recently contributed to house price stability. The Bundesbank was furthermore avowedly hostile to recent house price surges in the country, fearing financial instability and asset bubbles. These macroeconomic imperatives then shape coalitional dynamics. Recent scholarship in political economy highlights continued partisan competition between the political left and right. In the case of housing, scholars would predict that centre-right parties are likely to favour mortgage subsidies, as they tend to represent homeowners, while left-of-centre parties likely oppose them, given their non-owning constituencies. These are sensible predictions, but they are not fixed across time and space. Instead, the political economy of growth regimes can trump left-right partisan divides and create an unexpected left-right consensus. The key to understanding such broad-based coalitions lies in the different ways in which sectors are integrated in growth regimes. In the US demand-led regime, where housing is a key domestic sector, these macroeconomic imperatives have created a bipartisan coalition in favor of fueling the housing-related wealth and credit channels via mortgage debt subsidies, a form of mortgage Keynesianism. Congressional leaders of both parties have incentives to stimulate housing in their districts to create jobs and profits in real estate, construction, and finance, as well as boost the housing wealth and asset-based welfare of their constituents in times of wage stagnation and austerity. For Democrats, these subsidies are attractive tools to help low-income and minority households obtain wealth. While free-market Republicans tend to oppose government intervention on ideological grounds, they have repeatedly joined moderate Republicans in promoting mortgage subsidies benefiting their constituencies of affluent homeowners and the financial sector. White House administrations also have good reasons to stimulate the national economy through mortgage subsidies. As Achaya et al. Note, this is what so far allowed successive presidential administrations to encourage ever larger short-term consumption and spending during their tenures. It might seem odd that in a game between two political parties to get the seat, both would agree on a strategy to promote housing finance at successively higher levels over time. Well-organized interest groups in the housing sector, realtors, mortgage bankers, and home builders, are part of this coalition, as they benefit from subsidies stimulating housing. When the Great Recession of 2008 to 2009 threatened the US growth regime, both parties favored a state-based policy response to resuscitate housing, credit, and consumption. Targeting housing killed two birds with one stone, stabilizing the battered housing sector and stimulating growth through the wealth, credit, and capital flow effects. Politicians can stimulate these housing-related channels by adopting fiscal measures, such as tax subsidies, or off-budget measures, such as government guarantees. These actions lower the cost of mortgage debt and stimulate house prices, mortgage credit, and consumer spending. During the crisis, policymakers aim to stabilize and stimulate housing by quasi-nationalizing Fannie and Freddie and adopting fiscal and off-budget measures that provided homeowner relief. In Germany, where the domestic housing sector is not a key sector of the economy, homeowner subsidies create frictions with the price-sensitive, export-led growth regime. 56 The German growth regime relies on restraints in credit, consumption, and wages to secure price stability and cost competitiveness through undervalued real exchange rates. These macroeconomic priorities are achieved by the country's wage bargaining system depressing mortgage demand, strict fiscal and monetary policy, restrictive and savings-oriented mortgage markets, and social housing programs that historically helped repress house prices. One key friction is that homeowner subsidies tend to increase house prices, which can have detrimental effects on export activity. Egert and Kierzienkowski find that a decrease in the relative price of real estate helped German exports, just as its increase in France represented headwind for French exports. Rising house prices, and the associated profit-making opportunities, shift labor and capital from the productive sector to housing, construction, and real estate. This not only leads to upward wage pressures in profitable housing sectors, but also channels investments away from manufacturing, hurting export competitiveness. A second friction is that homeowner subsidies tend to stimulate domestic demand, which has inflationary consequences. Yet, as Hoppner notes, from the point of view of the export sector, the best budgetary policy is the one that minimizes firms' cost pressures and, in general, any kind of inflation impulse. The imperative is therefore competitive disinflation by repressing domestic costs and consumption to protect export interests and prevent appreciations of the real effective exchange rate. Such frictions might be somewhat easy to forget in good economic times, but hard times can unravel political coalitions in support of subsidies. During the economically successful post-war period, a centre-right coalition defended mortgage subsidies. Centre-right parties, such as the Christian Democrats, CDU, and Free Democrats, FDP, traditionally supported home ownership subsidies to reinforce conservative, male breadwinner values of traditional family life or to increase wealth and economic freedom. These subsidies also benefit their core constituents of affluent households and strong interest groups, such as building societies. In contrast, the Social Democrats, SPD, and Greens tended to view homeowner subsidies as regressive, as they did not benefit their core constituents of non-owning renters, although some considered these subsidies as sound middle-class policies. Importantly, economic crises can reconfigure these constellations when policymakers ponder what economic sectors to stimulate or sacrifice. When Germany faced deep economic crises in the 2000s, an emerging coalition of centre-left and centre-right parties adopted market-based solutions of retrenching homeowner subsidies. Instead of stimulating domestic demand through housing, policymakers doubled down on export-oriented growth. The imperative was to boost competitiveness through fiscal consolidation and structural reforms, priorities that soon commanded a consensus across the centre ground of German politics. Fiscal consolidation, as Blyth notes, is intended to limit government deficits and debt, boost competitiveness, and deflate domestic costs and prices through public spending cuts. Structural welfare, labor, and tax reforms are partly designed to channel capital back into the productive sector by reducing subsidies that attract capital into consumption-oriented sectors, such as housing. The Merkel Grand Coalition of Christian and Social Democrats, supported by export-oriented interest groups but opposed by domestic-oriented housing interest groups, sacrificed the Eigenheimzulage in the name of fiscal consolidation and structural reform. This article adopts a controlled comparison framework, which is appropriate for the analysis of historical divergences across countries. It deploys general variables that are not uniquely context-specific, growth regimes and housing policy, and highlights some representative variation with testable implications for other demand and export-led growth regimes. To that end, the conclusion briefly evaluates whether the argument travels to the demand-led United Kingdom and export-oriented Poland. Moreover, the selection of the United States and Germany is theoretically informed, as they are cases whose variations simply cannot be accounted for by extant hypotheses in comparative political economy. The case selection also heeds the growing calls of scholars promoting the study of the U.S. political economy in comparative perspective. To evaluate theoretical claims, I employ process tracing methods aiming to connect the hypothesized causes and outcomes. Empirical analysis is based on 42 interviews with American and German politicians, bureaucrats, and interest group representatives, as well as primary archival, congressional, and parliamentary records. The difficult economic times of the 2000s provide fruitful testing grounds for evaluating crisis responses in the two countries. In this period, the United States and Germany experienced their deepest post-war economic crises up until that point. While the Great Recession of 2008 to 2009 was the most severe recession since the Great Depression in the United States, Germany even experienced two major crises within a few years: an economic crisis in the early 2000s and the Great Recession shortly thereafter. In the United States, the financial and housing crash of 2008-09 resulted in dwindling domestic demand. In contrast, Germany suffered from declining competitiveness and a housing collapse in East Germany in the early 2000s, after which the Great Recession of 2008 to 2009 led to a dramatic decline in exports. While different in nature, these crises similarly threaten the foundations of each growth regime, compelling policymakers to respond, including in the housing area. The empirical section compares the trajectories of two major housing programs: the government-sponsored enterprise, GSE, subsidy in the United States and the homeowner subsidy, Eigenheimzulage, in Germany. While the US subsidy is an off-budget policy, entwined with the larger financial system, and the German subsidy is a tax policy, they merit comparative investigation for a number of reasons. One is that both policies belong to the family of home ownership subsidies that reduce the cost of mortgage debt for households, having saved US homeowners $14 billion 2003, and German homeowners €11 billion 2004, in home ownership costs. Another is that they constituted the most important forms of state activism in both countries' housing markets. In the United States, the GSE subsidy was the most sizable housing program next to tax subsidies, such as the mortgage interest deduction that I also briefly discuss in the empirical section to lend further support to the argument. Albeit smaller than its American counterparts, the German homeowner subsidy was the country's largest housing program of recent decades and also its single largest post-war tax break. Whether off-budget or tax subsidies, as Pearson reminds us, home ownership programs tend to benefit affluent constituencies, which should make these subsidies sacrosanct and difficult to reform in both countries. Mortgage subsidies through the GSEs have existed since the Great Depression, but they took center stage only decades later. In a move away from demand management and wage growth since the late 1970s, the United States financialized its demand-led growth regime. In what Green and Wachter call the housing finance revolution, politicians of both parties transformed the country's deposit-based housing finance system into one based on the capital market, that is, on mortgage-backed securities issued by the GSEs. Equipped with the implicit backing of the US government that gave the GSEs an edge over fully private competitors, the GSEs increased their share of the overall residential mortgage market from 16% in 1980 to 40% in 2000. To stimulate growth and home ownership, bipartisan efforts successively expanded the GSE's reach into risky, low-quality mortgages, partly by relaxing underwriting standards and targeting underserved communities. In the 15 years prior to the financial crisis of 2008 to 2009, house prices doubled and, as Schwartz notes, the U.S. housing finance system gave the U.S. economy above-average employment and GDP growth. The GSEs became the heart of the U.S. mortgage market but also contributed to the looming housing crash. When the financial crisis threatened the demand-led growth regime, policymakers across the political spectrum responded by entrenching GSE mortgage subsidies to stabilize growth and promote economic recovery. At the onset of the crisis, policymakers closed ranks around the bipartisan consensus of stimulating housing to stabilize consumption and economic growth. Between 2007 and 2009, the economy entered a deep recession, unemployment almost doubled to 10%, private residential investment halved to 3% of GDP as house prices collapsed and homeowner equity fell by $5 trillion. Policymakers identified the drop in housing prices, wealth, and residential investment as an impairment to the wealth channel of economic growth. As President Bush's economic report reads, the decline in value for housing wealth was among the most important influences on consumer behavior during 2008. Changes in real wealth and real consumer spending are correlated. The administration believed that the housing wealth channel needed to be repaired in order to stabilize consumption and growth. This is especially important as residential fixed investment was the main driver of previous recoveries. One way to resuscitate growth through housing was to rescue the GSEs. When house prices collapsed in 2007 to 2008, Fannie and Freddie faced bankruptcy, owing to the losses incurred from holding and issuing low-quality mortgage-backed securities. By 2007, the GSEs had become massive entities, guaranteeing $3.5 trillion in mortgage debt. The crisis made it impossible for them to pay investors their guaranteed principal and interest on the underlying mortgages. In a bipartisan effort, the Bush administration and the Democratic Congress adopted the Housing and Economic Recovery Act of 2008. The act gave the U.S. Treasury the authority to extend unlimited emergency lending to Fannie and Freddie as well as to seize control of the GSEs through a new regulator, the Federal Housing Finance Administration, FHFA. Then Treasury Secretary Paulson memorably stated that this new authority should calm investors. If you have got a bazooka, and people know you have got it, you may not have to take it out. But it was, as Tooze notes, paradoxical that a conservative, free-market administration led by businessmen was proposing unlimited state spending to nationalize a large part of the housing finance system. Indeed, the political economy of growth trumped traditional party ideologies. However, these actions were insufficient to restore housing stability and growth, which led the Bush Treasury to use its authority to place the two companies in conservatorship. Conservatorship means that the U.S. government collects the profits, chooses the leadership, and conserves the assets of the two firms, including, largely unexercised, warrants on 79.9% ownership in each firm, a number chosen to keep the GSEs off the government's balance sheet. Just days before the collapse of Lehman Brothers, the US government bailed them out with $191.6 billion. Republicans and Democrats agreed that Fannie and Freddie were too systemically important to fail. In Paulson's words, Fannie Mae and Freddie Mac are so large and so interwoven in our financial system that a failure of either of them would cause great turmoil in our financial markets here at home and around the globe. Indeed, the GSEs attracted sizable foreign capital inflows into GSE mortgage-backed securities. International investors, particularly China, owned large amounts of GSE bonds, assuming that these were safe assets backed by the US government. If the US government had allowed the corporations to fail, it would have faced the risk of losing creditworthiness, impairing global capital flows, and crashing the economy. As one regulator noted in an interview, the economic generative power of the housing market just so outweighs anything else you can fiddle with. We have two things we pump up when we need to pump them up. The world wants to buy US Treasuries and the world wants to buy agency, GSE, bonds. Economically, conservatorship not only stabilized housing credit and wealth, but also the flow of global capital. Politically, it entrenched government support for the GSEs and formalized the government's backing of the mortgage giants. Unsurprisingly, the housing lobby supported the bipartisan consensus of bailing out Fannie and Freddie when the housing market deteriorated. The influential National Association of Realtors, NAR, for example, backed the Housing and Economic Recovery Act so as to help the housing and mortgage industries and boost the US economy. When the GSEs almost went bankrupt, the NAR also supported bipartisan efforts to bail out the GSEs. However, policymakers did not need much convincing, as they would have bailed out the GSEs regardless, given the aforementioned macroeconomic concerns. Policymakers were primarily concerned with the systemic role of the GSEs for economic growth, while particular lobby interests or party ideology were secondary. After the crisis, policymakers kept the quasi-nationalized status quo of the GSEs, as the withdrawal of government support could have increased mortgage costs and hurt economic growth. Even though both parties felt uneasy about the state of quasi-nationalization, they realized that reducing the role of the government has one key consequence. Any GSE reform, no matter where it lands, will likely drive up mortgage rates. Starting from a point of conservatorship means that reform would inevitably reduce government involvement and increase private market participation. As private markets would take on more credit risk, this could drive up mortgage rates, lower house prices, and result in lower household credit and spending. The risk of higher mortgage costs, lower consumption, and reduced growth then contributed to stalling the reform process. First, the 2013 PATH Act, proposed by House Republicans, suggested the privatization of Fannie and Freddie. This proposal would have constituted a retreat of the American state, but was immediately dismissed by the Obama White House as well as Democrats and moderate Republicans in Congress, who viewed the proposal as an attack on mortgage prices and the 30-year, fixed-rate mortgage. A second set of bipartisan bills suggested retaining a key role of the federal government by replacing Fannie and Freddie with a new federal entity, while somewhat increasing the role of the private market. However, in an interview, an Obama Treasury official remarked that, here was the overall concern that this would wind up being too expensive for homeowners relative to where things are now. In an internal memorandum, Freddie Mac reckoned that, here is no question that mortgage rates would increase under the bill. The incentives for reform further subsided, as house prices and mortgage lending recovered. Consequently, the proposal did not garner sufficient support. Another bipartisan bill was introduced by Representatives Hensaling, Republican Texas, and Delaney, Democrat Maryland, in 2018, which would have retained strong government guarantees through Ginnie Mae, while privatizing the operations of the GSEs. As one of the most vocal free market Republicans, it was surprising that Hensaling sponsored a bill with strong government involvement, which, in his words, does not necessarily represent my preferred policy or optimal policy. While the perceived importance of housing to economic growth even had the most free market Republicans convinced that the American state is essential in housing finance, the bill stalled, for it still would have driven up mortgage costs. In 2019, the Trump administration proposed reforms combining the privatization of the GSEs with strong government guarantees to support them. Yet, the plan was expected to increase mortgage costs and therefore also faced congressional resistance. In sum, and in contrast to the sweeping Dodd-Frank financial reforms that took on the powerful banking industry, comprehensive housing finance reform stalled owing to the fear of increasing mortgage costs, hurting housing wealth, and reducing growth. The housing lobby fiercely opposed the complete privatization of the GSEs and instead voiced support for proposals that retained a strong role for the government. Early on, in 2013, the NAR condemned the Republican PATH Act, as consumers will pay much higher mortgage interest rates and mortgages may at times not be readily available. 105 Even without these demands, however, it is unlikely that the bill would have passed Congress lacking the necessary political support. More recently, the housing lobby, including the NAR, Mortgage Bankers Association, MBA, National Association of Home Builders, NARB, and the American Banking Association, ABA, endorsed comprehensive housing finance reform that would slowly release the GSEs from conservatorship, while retaining explicit government guarantees on mortgage debt via the GSEs. 106 In principle, many policymakers on both sides of the aisle agreed with these calls for reform. In practice, however, politicians' macroeconomic concerns that reforms could produce higher mortgage costs, entail market disruptions, and hurt growth have thus far locked in the quasi-nationalized status quo of the American mortgage market. Does the argument also hold for the mortgage interest deduction, MID? Once obscure and minuscule, the MID became one of the most expensive and sacred items in the tax code. It faced its first critical test during President Reagan's Tax Reform Act of 1986, as the subsidy was a thorn in the side of Treasury officials, owing to its size, regressive nature, and market-distorting effects. Yet, despite reforming other important tax breaks, the Reagan administration quickly scrapped the Treasury's recommendation of reforming the MID. While housing interest groups lobbied for the preservation of the MID, they found an eager ally in President Reagan in the context of high interest rates and a generally unstable housing market. Internal records from the Ronald Reagan Presidential Archives demonstrate that the President's Housing Commission of 1982 had already recommended continuing the current tax deduction for mortgage interest, while the administration explored ways to achieve an effective countercyclical stimulant for the economy, a program to get housing production going and create jobs. Even without interest group pressure, it is thus likely that the Reagan administration would have declared the MID off limits, as it was considered an effective way to stimulate growth and support the middle class. Several congressional leaders similarly expressed concerns that reforming the MID could hurt house prices, housing wealth, and economic growth. The entrenchment of the MID made it a third-rail issue for years to come. The housing crash of 2008 to 2009 provided another opening for reform, when the Obama administration briefly considered limiting the MID to reduce the deficit. But it did so only half-heartedly. Mettler provides a sensible but incomplete explanation for why the administration did not use much political capital, the political power possessed by the organized groups that benefit from such provisions, starting with the real estate lobby. While the housing lobby stood ready to defend the MID, most policymakers were already behind the MID. As then Housing Secretary Sean Donovan conceded, anything that would change the system substantially now could create a real risk of stopping the momentum that we have in the housing market. Policymakers and interest groups therefore pursued the same objective of promoting a strong housing market, which then further entrenched the MID. It should be noted that President Trump's Tax Cuts and Jobs Act of 2017 temporarily, until 2025, reduced the previously untouchable MID after the economy and housing market recovered from the Great Recession. The reform capped the deduction at $750,000 in principal value, previously $1 million. Scholars consider the MID reform as a political attack on coastal blue states where house prices are high and a move to finance corporate tax cuts. The 2017 Trump reform therefore constitutes a temporary and partial exception to the otherwise deeply entrenched policy legacy of the MID. Despite the reform, however, the MID continues to be one of the largest expenditures in the tax code and, barring additional legislative actions, will automatically return to its pre-2017 status in 2025. President Biden already signaled support for continuing mortgage subsidies through the tax code, including a plan to adopt a progressive tax credit for low- and middle-income homebuyers to complement the regressive MID that favors high-income households, a demand-led growth strategy to stimulate the first-time buyer market in times of surging house prices. Homeowners enjoyed large-scale tax breaks and subsidies as part of social housing programs from the early post-war years. German policymakers subsidized both home ownership and rental markets in times of housing supply and capital shortages after the war. Yet, housing played a minor role when the German export-oriented regime adapted to the post-Fordist era by reinforcing its export strengths. As housing shortages came to an end by the late 1970s, social housing programs no longer delivered the benefits of alleviating shortages from earlier decades and were successively scaled down. While the Eigenheim-Zulage defied this trend and grew into the country's largest housing program and tax subsidy by the mid-2000s, the economic crisis at that time exposed the deeper frictions between the subsidy and the reeling export-led growth regime. These frictions gave rise to a broad-based coalition that retrenched the subsidy to reinvigorate export strength via fiscal consolidation and redirect capital from housing into export-oriented sectors. The reason for the initial growth of the subsidy lies not in its potential to generate growth, but in the hegemonic position of the Christian Democratic Union, CDU, in post-war Germany. It was the CDU-led Adenauer government that created the subsidy to alleviate housing shortages, considering home ownership as an ideological mainstay of Christian democracy, with a preference for private solutions, ownership, and self-responsibility. A number of important domestic-oriented housing interest groups, building societies, construction industries, and mortgage banks supported the centre-right political coalition. Until the late 1990s, homeowner subsidies were protected by centre-right forces in the context of a strong post-war economy. However, when the German growth regime faced its deepest post-war crises in the 2000s, the CDU begrudgingly entered a broad-based coalition of sacrificing the Eigenheim-Zulage. Reunification was a shock to the German economy soon plagued by stubborn unemployment, rigid labour markets, sluggish growth, and a public finance crisis. At the same time, the country faced an unusual period of current account deficits from 1991 until 2001, reflecting the loss of competitiveness. The Eigenheim-Zulage was perceived to be part of these structural economic problems, which eventually resulted in a broad-based political consensus favoring the subsidy's retrenchment. Going after the subsidy was not necessarily good politics, as it was popular among voters, i.e., opinion polls reckoned that 71% of respondents supported the Eigenheim-Zulage. Yet, underlying the consensus was the belief that eliminating the subsidy would improve deficits, labor market flexibility, and competitiveness by redirecting capital into productive areas. Despite a short-lived ideological defense by the Christian Democrats, a growing broad-based coalition and consensus of retrenching homeowner subsidies emerged in the early 2000s. When the country experienced its first centre-left government, the Schroeder government, SPD Green, 1998 to 2005, started going after the subsidy to counter labour market rigidities and improve fiscal deficits. First, it proposed to reduce the subsidy as part of a tax reform in 2002. With an unemployment rate approaching 10% in 2002, a Schroeder cabinet member criticized that the tax break reinforced a sclerotic labor market in an interview. If you have the necessity for firms to restructure and people have to look for new jobs, and they might also have to relocate, and then a high rate of ownership is a hindrance for more flexibility. In spelling out the link between rigid labor markets and home ownership, the proposed retrenchment of the Eigenheim-Zulage is thus linked to the HOTS labor market reforms. While it did not pass the Bundesrat where the CDU blocked the bill for ideological reasons, the subsidy was on borrowed time. Second, in a sign of growing bipartisanship in 2003, Peer Steinbrück, SPD, and Roland Koch, CDU, then the minister-presidents of North Rhine-Westphalia and Hesse, proposed to cut all subsidies in the tax code by 12% to balance the budget, including the Eigenheim-Zulage. As the country's largest tax break, the Eigenheim-Zulage was a source of irritation for the centre-left government, at a time when Germany experienced a financial crisis of the state and started violating the Maastricht criteria by generating fiscal deficits in excess of 3% in 2001. The Schroeder government then successfully passed a budget bill based on the bipartisan proposal, reducing the homeowner subsidy. The SPD Green coalition launched another retrenchment attempt in 2004, emphasizing the detrimental effects of the subsidy on economic growth. Germany just experienced 2 consecutive years of economic recessions and declining competitiveness in 2002 and 2003. In a draft bill, tellingly entitled, Law for the Financial Support of Innovation Through the Elimination of the Eigenheim-Zulage, it proposed to shift public funds spent on the homeowner tax subsidy toward innovation, research, and education to boost competitiveness and growth. As the bill reads, the goal of the federal government is to increase economic growth in Germany. An international comparison shows that policymaking is most successful in achieving this goal when the distorting exceptions and subsidies in the tax code are reduced. The draft bill makes the contradictions between the growth regime and the homeowner subsidy explicit. First, the bill describes the subsidy as a hindrance for growth, owing to its market distortions. Indeed, one Bundestag member, SPD, mentioned in an interview that the rationale of retrenchment was to shift funds from the unproductive housing sector to productive areas, such as education or research, in order to spur growth. As the CDU continued to defend the subsidy, the political left questioned the CDU's commitment to the growth regime, traditionally based on public commitments to education as opposed to home ownership, provocatively asking whether public funds should be spent on bricks or education. Second, The bill criticized the subsidy's undesired effect of raising the cost of housing. Indeed, German economists recommended the elimination of the Eigenheimzulage because of its price-inflating effects in times of already saturated housing markets, which underlines that economists viewed the subsidy as working against the priority of keeping domestic costs and prices down. While the measure passed the centre-left Bundestag, it was still blocked by the CDU in the Bundesrat. The CDU's ideological opposition faded in light of mounting macroeconomic pressures to sacrifice the Eigenheimzulage in order to balance budgets and enhance competitiveness. The federal states accelerated the CDU's preference shift, as they co-financed 42.5% of the subsidy, while experiencing their own public finance crises, competitiveness deficiencies, and housing problems. In the East, housing markets were still reeling from an unwinding housing, investment, and construction boom that left the region with large-scale vacancies, demolitions, and grim demographic projections. Investment incentives, such as the Eigenheimzulage, had produced a notable stream of West German private capital into the East German housing market. The new federal states, including the CDU-led Saxony and Saxony-Anhalt, became increasingly open to eliminating the Eigenheimzulage to both reduce deficits and enhance competitiveness by redirecting spending and capital into productive sectors. One SPD Bundestag member characterized the Eigenheimzulage as misdirected spending, as it reinforced vacancies and depopulating city centers in the East. In the West, deficit-ridden states, including CDU-led Saarland and Hamburg, followed suit. The federal states viewed the Eigenheimzulage as a drain on public funds in light of fiscal crises and as partly holding back investments in productive sectors. The first Merkel Grand Coalition, CDU-SPD, 2005 to 2009, then eliminated the Eigenheimzulage in 2006, which solidified the broad consensus of fiscal consolidation and structural reform. Despite the country's continued poor economic performance, policymakers did not consider the subsidy as a tool to stimulate the economy. Had policymakers done so, they would not have retrenched the subsidy at a time of weak domestic demand and fragile growth. In an interview, a CDU Bundestag member pinpoints how the German growth regime influenced economic policymaking in hard economic times. We don't usually emphasize the demand side of economic policy in Germany, but we instead emphasize the supply side. That's why I don't share the American view of stimulating the economy as a cure for an itch. The macroeconomic priority of balanced budgets trumped the CDU's ideological attachment to the subsidy. As Bernhard, a CDU Bundestag member, expressed, "I have made clear that it was not easy for me to let go of the subsidy. Given the financial situation, we unfortunately don't have room for maneuver. That is why we have to cut back completely, in order to balance the budget." The Eigenheimzulage was then sacrificed in the name of deficit reductions and structural reforms to reinvigorate the German export regime. Then Economy Minister Wolfgang Clement explicated the link between export competitiveness and the retrenchment of the subsidy, stating that the Eigenheimzulage must go to free up investments in innovation and technology in order to increase the competitiveness of the auto industry. The example of the German auto industry illustrates the far-reaching consequences of these developments for our export industries. If we do not widen our technological advantages vis-à-vis China, or at least retain them, and do not invest in research and innovation at home, then we will have nothing to laugh about when it comes to Chinese cars in 10 or 20 years. Retrenchment thus reinforced the export-oriented growth regime mainly via fiscal consolidation and repressing demand, indirectly, but also via redirecting public funds to innovation and technology benefiting export industries, directly. In retrospect, the Council of Economic Experts agreed that retrenching the homeowner subsidy was justified, owing to its price-inflating and market-distorting effects. Despite strong efforts, housing interest groups were unable to save the subsidy. The housing lobby formed a home ownership initiative that included 18 powerful interest groups to defend the subsidy. The initiative included building societies, Verbände Privaten Bausparkassen, property owners, Haus und Grund, and mortgage banks, Verbände Hypothekenbanken. They reckoned that the elimination of the subsidy would result in slowing housing demand and 220,000 lost jobs. Their inability to prevent retrenchment was not due to the lack of mobilization. Instead, arguments about stimulating demand are inherently less effective in export-oriented Germany than in the demand-led United States. In an interview, one SPD Bundestag member stated that housing policy just does not have the same economic salience as labor market policy, which made it easier to retrench the subsidy. One housing interest group representative added, "Even if we see house prices decline by 20%, then this is covered by equity, high down payments, so that banks do not have to be concerned about this at all." Moreover, unlike in the United States, concerns about global capital flows did not feature into German reform debates. Economic actors in Germany's export-led growth regime tend to export capital abroad rather than import it. The German housing market, for example, attracted less global capital than foreign markets at that time, as it was less financialized and more conservative, and correspondingly has not witnessed surging house prices and mortgage debt from the mid-1990s until the Great Recession. While the German home ownership subsidy did not attract capital from abroad, unlike US GSE subsidies, it channeled domestic capital into housing and away from export-oriented sectors. All these economic realities weaken housing interest groups, as they could not convincingly argue that eliminating the subsidy would significantly hurt the German growth regime. Outside housing, the influential export-oriented Bundesverband der Deutschen Industrie, BDI, welcomed the retrenchment of the subsidy to boost competitiveness, while the domestic-oriented Deutsche Gewerkschaftsbund, DGB, lobbied for the preservation of the subsidy to support the construction industry. It should also be noted that the German government did not restore mortgage subsidies to promote domestic demand as a recovery strategy during and after the Great Recession. Instead, it relied on subsidized short-term work schemes to preserve skilled labor and stimulated the export-oriented car industry with cash Vorklunkers programs. When Germany enjoyed an economic renaissance after the Great Recession, the CDU pushed for reintroducing homeowner subsidies, but was only marginally successful. While the first Merkel government adopted a subsidized home ownership pension savings scheme, Wohnriester, in 2008, the measure is modest in size, having amounted to merely €420 million in 2014. The second and third Merkel governments, CDU-FDP, 2009 to 2013, CDU-SPD, 2013 to 2017, discussed the reintroduction of the subsidy, but met the resistance of fiscally conservative social and Christian Democrats. In 2018, the current Merkel government, CDU-SPD, 2017, introduced a temporary and minuscule subsidy for first-time homebuyers with children, Kindergeld, to help them climb the property ladder in times of rising house prices partly caused by ultra-low interest rates and demographic developments. However, the new subsidy is a shadow of the former Eigenheim-Zulage, amounting to a total of €10 billion over 3 years, is criticized for price-inflating effects, and expired in March 2021. Finally, the continued rise of housing prices in rental and owner-occupied markets sparked a major national debate about how to slow price growth. In Germany, rising housing costs are considered a problem and not the solution for stimulating the economy. When it comes to government support for home ownership and mortgage debt, the United States and Germany are polar opposites. Even though both countries subsidized home ownership from the mid-20th centuries, their policy paths diverged sharply. When faced with deep economic crises in the 2000s, the United States adopted state-based policy solutions of quasi-nationalizing its multi-trillion-dollar mortgage market, whereas Germany adopted market-based solutions of retrenching subsidies. This article argued that growth regimes, and the different ways in which housing markets are integrated into them, shape the politics of housing finance. Housing is a key engine of the U.S. demand-led growth regime, creating a long-standing bipartisan coalition to fuel household credit and consumption through generous housing subsidies. Housing occupies a less central position in the export-led German regime, facilitating a broad-based coalition to repress domestic consumption and boost competitiveness through retrenching homeowner subsidies in the name of fiscal consolidation and structural reforms. This is not to argue that policymakers necessarily succeed in reinvigorating their growth regimes. Doubling down on housing-based growth in the United States may have yielded diminishing returns in the post-2008 economy. Rising house prices in times of stagnating wages, tightened financial markets, and insecure employment have excluded households from the housing ladder and exacerbated housing wealth and racial wealth inequality that is itself the result of decades-long discrimination against racial minorities in real estate markets and federal housing programs. Policymakers are also confronting the limits of further ratcheting up subsidies before exhausting the housing credit and wealth channels. Doubling down on export-led growth in Germany poses its own vulnerabilities, including global demand shocks and perpetually weak domestic demand. Yet, the larger point is that American policymakers expanded government support in housing to boost growth through domestic demand. Their German counterparts reduced support for housing to stimulate growth through enhancing competitiveness and suppressing domestic demand. One theoretical contribution is that growth regimes, and how socio-economic sectors are integrated into them, are key determinants of the welfare state. Scholarship on the welfare state often treats the competing partisan preferences of the left and right as fixed. Instead, the macroeconomic imperatives of growth regimes can help produce broad-based coalitions and converging preferences between the political left and right, even despite otherwise ideological or political differences. Under conditions of economic crisis, these dynamics are particularly pronounced, as politicians might find common ground regarding what sectors to stimulate or sacrifice. The focus on macroeconomic features explains the astonishing degrees of bipartisanship in the United States and Germany in the 2000s that have led to sharply contrasting housing policy responses. In the United States, the political left and right considered housing stimulus a growth strategy to tackle the Great Recession and promote economic recovery. In Germany, policymakers on the left and right had a common interest in sacrificing housing subsidies to reinvigorate export growth in hard economic times. The findings of this article also contribute to important debates on economic models in comparative political economy. First, this article promotes a sectoral perspective of growth regimes. Identifying the core sectors of the economy is key for understanding why policymakers form broad-based coalitions to stimulate, or sacrifice, certain sectors over others. Core sectors of growth regimes often enjoy a privileged position in a country's political economy, whereas other sectors enjoy fewer privileges that are also vulnerable to retrenchment. Second, it contributes to scholarship on economic policymaking in hard times. Where Mandel Kern identifies the striking similarity in macroeconomic policy responses to the Great Recession, this article shows that crisis responses in the United States and Germany were more varied than often assumed. Different growth regimes rely on different economic sectors for economic growth, which led U.S. policymakers to stimulate housing, while German policymakers repressed the domestic housing market to boost export competitiveness. The argument has portable implications for other cases. The United Kingdom is another demand-led economy in which housing is a key sector for the economy. Much like the United States, the United Kingdom adopted subsidies to stimulate housing in response to the Great Recession. The Cameron government legislated a series of mortgage subsidies, such as guarantee schemes, subsidized equity loans, and first buyer incentives under the 2013 Help to Buy program. The goal of the program was to recover growth by stimulating housing demand, credit, and domestic demand. In contrast, Poland is another export-oriented growth regime, although one dependent on foreign direct investment, in which housing is not a key driver of the economy. Much like Germany, Poland subsidized mortgage loans through a popular family's own home program. When the country experienced an economic slowdown and housing market problems after the financial crisis, it sacrificed the program in light of a deepening public finance crisis in 2012. Future research might further explore these and other cases as well as the COVID-19 pandemic. In recent decades, advanced industrialized countries have transitioned from Fordist production regimes to knowledge economies. This post-Fordist transition entailed a decline in the wage share of GDP in most advanced economies, which led them to emphasize different aspects of aggregate demand, such as domestic demand and exports. This section examines advanced economies that have championed domestic demand in the form of debt-financed, consumption-led growth in response to these structural economic shifts. We focus on the United States and the United Kingdom as exemplary cases where household debt and private consumption are key engines of growth, but also sources of economic instability and inequality. We argue that these economies generate debt-financed consumption through two major mechanisms that we term the housing channel and income maintenance channel. The former suggests that rising property prices can unleash both household borrowing and spending. When house prices grow, homeowners' wealth increases along with their propensity to consume, while their growing housing wealth also improves their housing collateral against which they can borrow to finance spending on consumer goods or welfare services. The latter channel posits that credit markets allow households to maintain their socio-economic status when earnings stagnate, incomes drop, and expenditures rise, particularly in the context of limited or eroding welfare states. Credit markets functionally substitute for wage growth and government transfers, enabling households to borrow money to smooth income losses and address rising expenditures. Credit-driven, consumption-led growth models do not exist in a political vacuum. They are sustained by powerful political coalitions of producer groups in the financial services industry, asset-owning voters, and mainstream political parties. The key producer group is the so-called FIRE sector, i.e., finance, insurance, and real estate, which directly benefits from increasing financial transactions, the expansion of consumer credit, and growing property markets. In electoral terms, current and aspiring homeowners have an interest in accessible and expanding credit markets. While existing homeowners benefit from political measures that tend to increase home values, aspiring homeowners benefit from easier access to credit. Even poorer voters without much asset wealth increasingly rely on accessible credit markets to both smooth income losses and finance expenditures in light of limited government support. Finally, both centre-left and centre-right parties tend to favour policies that facilitate greater access to credit as growth strategies to generate consumption and domestic demand, particularly in moments of economic crisis. Policymakers have reinforced credit-driven, consumption-led growth models, and the housing and income maintenance channels, through fiscal and regulatory policies. One way to stimulate these channels is to adopt fiscal policies that provide tax relief on mortgage and other consumer loans. Another is to rely on regulatory policies that ease access to credit or support household borrowing through government guarantees on consumer debt. Together, these policy choices have created permissive credit regimes that improve credit access, reduce borrowing costs for households, and thus stimulate debt finance consumption. We examine the foundations and politics of credit finance consumption by turning to the United States and the United Kingdom as exemplary cases. Both countries have permissive credit regimes that allow households to easily borrow money, build asset ownership, and maintain their living standards in the context of declining wages, rising living costs, and limited public welfare programs. In response to post-Fordist challenges of wage stagnation and fiscal austerity since the late 1970s, broad-based growth coalitions have fueled the housing and income maintenance channels in order to boost debt finance consumption. In the United States, policymakers championed fiscal subsidies for consumer debt, government guarantees for mortgages in the primary and secondary markets, and regulatory policies to ease credit access. In the United Kingdom, politicians privatized the social housing stock, liberalized the financial and mortgage system, and relaxed credit constraints for borrowers. While these measures have contributed to economic growth, both countries experienced a house price bubble that resulted in the financial crisis of 2008 to 2009. The crisis exposed the vulnerabilities of growth models that are based on credit and consumption. When the housing bubble burst in both countries, credit markets collapsed and household consumption dropped dramatically. To revive their growth models in the post-crisis years, British and American policymakers again fueled the housing and income maintenance channels by adopting a battery of fiscal and regulatory measures, while central banks facilitated an ultra-low interest rate environment and flooded capital markets with money. While the credit and housing markets of both economies recovered after the Great Recession, policies to support credit markets contributed to soaring asset prices in recent years. These developments have created distributional inequalities between the haves and the have-nots, potential financial instability, and housing affordability crises among younger, low-income, and minority households. Together, these factors risk undermining the US and UK growth models. We argue that credit-driven growth models stimulate economic growth through two distinct but related channels. The housing channel operates through real estate markets, in which rising house prices increase homeowners' wealth and loosen their credit constraints, thus boosting household borrowing and consumption. The income maintenance channel, moreover, works through credit markets that allow households to maintain their living standards in light of stagnating wages, rising expenditures, and weak welfare support. Credit-driven growth models rely heavily on permissive regulatory and fiscal policy environments that make credit easily available to households. Such permissive credit regimes encompass deep financial markets, including capital markets for mortgages and pension assets, and allocate capital and credit disproportionately toward the household sector. Regulatory policies facilitate credit allocation to households by reducing credit risk for lenders, while fiscal policies incentivize household borrowing by subsidizing the costs of loans. Housing markets are key pillars of credit-driven growth models as they are able to stimulate domestic demand and economic growth. The property market is an important sector of the economy, e.g., residential investment and construction, and contributes considerably to the business cycle. In the United States, for instance, declines in residential investment and consumer durables frequently preceded economic downturns, making it a consumer cycle, not a business cycle. More generally, housing affects the macroeconomy through household borrowing and spending. One core mechanism is that increasing house prices tend to stimulate domestic demand and consumption through wealth and credit effects. The wealth effect suggests that increasing house prices, and, in turn, housing wealth, increases households' propensity to borrow and consume. As a result, higher housing wealth can directly influence consumption and domestic demand in the economy. As Fuller notes, gains in housing wealth can partially substitute for savings, as households tend to save less and spend more, knowing that they have backup savings in the shape of accumulated housing wealth. On the flip side, Mion and Sufi, 2014, demonstrate that, when U.S. house prices and wealth fell during the Great Recession, many households were left with unmanageable debt and forced to reduce consumer spending. In the United States, estimates suggest that a $1 increase in housing wealth stimulates consumer spending by an average of 8 cents. Similarly, for the United States, Case, Quigley, and Schiller find that a house price boom, equivalent to the one from 2001 to 2005 that increased housing wealth by $10 trillion, would increase consumer spending by 4.3%, while a 35% decrease in housing wealth, such as the one from 2005 to 2009, would produce a 3.5% decline in consumer spending. Studies on the United Kingdom, similarly, find positive associations between housing wealth and private consumption. The related credit effect implies that rising house prices increase borrowing and consumption by raising the value of housing collateral against which homeowners can borrow. Growing demand for credit is often met by banks' increased willingness to lend due to higher levels of collateral. In turn, enhanced credit availability then translates into higher levels of aggregate demand. For the United Kingdom and the United States, Aron et al. Find that easing credit constraints stimulated consumption, as financial liberalization has enhanced the positive impact of housing wealth on consumption in the UK and US when house prices fall. However, households' decreased net worth constrains their abilities to borrow, which in turn reduces overall lending and spending. Moreover, easier access to credit also allows homeowners to use home equity loans to pay for welfare services, consumer goods, home improvements, business expenses, or other consumer debt. Greenspan and Kennedy estimate that U.S. mortgage equity withdrawal amounted to $5,396 billion per year between 2001 to 2006, which homeowners used for home improvements, personal consumption, paying off consumer debt, or investments in other assets. Similarly, Mion and Sufi show that U.S. homeowners extracted 25 cents for every dollar in house price gain from 2002 to 2006. For the United Kingdom, Cloyne et al. Find that a 10% increase in house prices corresponds to an increase of 2 to 3% in household borrowing through extracting home equity. The credit and wealth effects work particularly well in permissive credit regimes, such as the United States and the United Kingdom, as opposed to restrictive mortgage regimes in export-oriented Germany or Japan. Weidman 2021a. Johnston, Fuller, and Regan characterize the United States and the United Kingdom as some of the most credit-encouraging mortgage systems among advanced economies, measuring mortgage interest subsidies, property transfer taxation, loan-to-value ratios, interest rate restrictions, and the depth of the secondary mortgage market. In both countries, housing finance markets have fairly low transaction costs, low down payments, relatively high numbers of home ownership and turnover, and a variety of mortgage products available to households. While high down payment constraints in Germany or Japan induce prospective homeowners to increase savings in times of rising house prices, lower down payments in the permissive credit regimes of the United States and the United Kingdom ease the credit restraints of prospective homeowners requiring comparatively lower savings. Ultra-low interest rates since the Great Recession and during the COVID-19 pandemic have contributed to surging house prices in the United States and the United Kingdom. Despite both countries' permissive credit regimes and down payments that are often as low as 5%, many young and low to middle-income households in metropolitan regions cannot not keep up with growing house prices, which could limit the housing market's overall effect on private consumption in the years ahead. The second channel to sustain aggregate demand is through supporting households in maintaining their income and economic status when earnings stagnate, incomes drop, and expenditures rise unexpectedly. Debt-financed income maintenance has become a private alternative to public policies that traditionally bolstered households' income. For example, wage bargaining, social insurance against adverse economic events, and social investment in education and family policies have traditionally supported household income. Easier access to credit substitutes for real wage growth, automatic fiscal stabilizers, and other social policies by allowing households to borrow money to maintain their living standards, at least in the short to medium term. We distinguish three specific ways through which a credit-driven growth model helps individuals to smooth income losses and fund rising expenditures. Individuals' expenditures and consumption may suffer severely during periods of income losses. Such losses can stem from unemployment, parental leave, or sickness. These events not only negatively impact households' finances in the short run, but can also permanently lower income during old age if pension benefits are tied to lifetime incomes. Traditional social policies support individuals through unemployment and sickness insurance during times of economic distress or through social investment policies such as paid parental leave. These policies help individuals and their families maintain prior living standards and consumption levels. From a macro-level perspective, social policies keep up aggregate demand and, during periods of economic declines, help mitigate recessionary effects as automatic stabilizers. In liberal welfare states, however, the financial impact of income shocks largely falls onto the shoulders of individuals and may have more severe consequences for aggregate demand. Here, credit markets can operate functionally similar to social insurance policies and allow individuals to smooth income losses and maintain consumption. In the absence of a comprehensive welfare state, home ownership also provides a private insurance and nest egg in old age. During temporary income losses, as described above, homeowners also often take out equity loans against the value of their homes. Wage growth is another component to ensure that households have the necessary financial means to make a living. Credit often becomes the last resort to compensate for stagnating wages and growing inequality. Ahlquist and Ansel 2017, Rajan 2010. While in many countries the earnings of higher income groups grew considerably, those of low and middle income groups increased little or even stagnated in real terms. These patterns of earnings inequality are most pronounced in Anglo-Saxon economies, especially in the United States. Over the period from 1979 to 2020, wages for the top 1% of Americans increased by 180%, whereas wages for the bottom 90% only grew by 28.2%. In 2020, average annual wages for the top 1% were $823,000, while average annual wages for the bottom 90% was only $40,000. Economic Policy Institute, 2021. Earnings and income inequalities allow higher income groups to recycle a share of their earnings through the financial system into loans to middle and lower income groups, thus amplifying the effect of easier access to credit as a substitute for stagnating wages. In the absence of wage increases and redistributive efforts to curb excessive income inequality, easy borrowing allows households to maintain relative consumption levels and emulate consumption patterns of higher income groups. The expansion of debt is a politically feasible way to allow households, especially those in the middle class, to maintain their living standards in the context of increasing inequality. Distributing resources through credit markets is less costly, both fiscally and politically, as it avoids contentious questions of allocating tax revenues and fiscal redistribution. Credit markets offer policymakers a way to deal with growing societal demands and democratic overload in light of limited fiscal capacity. Wage stagnation turns into a financial problem for households as living costs and expenditures for education, childcare, and healthcare have grown faster over the last decades than incomes. A rising number of households live paycheck to paycheck and have little financial leeway to deal with unexpected income shocks, often struggling to meet daily expenditures. Households' limited financial buffers are all the more precarious in the American and British growth models, because they tend to provide market-based welfare services such as education, childcare, and healthcare that are costly to individuals. Social investment policies that offer publicly funded education, subsidized or free childcare, and universal and comprehensive healthcare are either absent or very limited. Instead, households have to finance such goods and services on their own and often resort to credit markets. In countries that rely on domestic demand as the key pillar of growth, income shocks, rising expenditures, and wage stagnation can therefore pose threats to aggregate demand and undermine domestic consumption. A weak welfare state aggravates not only labor market and economic risks but also the unequal distribution of economic growth, and it further contributes to wage stagnation of average incomes. All this is deeply problematic for a growth model that is heavily dependent on domestic consumption. Easier access to credit can, to some extent, fill this void by allowing households to maintain prior consumption levels and living standards and prop up aggregate demand. But at the same time, it also makes people, policymakers, and the economy much more vulnerable and exposed to credit markets. The US and UK credit-led growth models depend and thrive on their unique position in the international political economy. The chapter by Schwartz and Blythe in this volume emphasizes that the United States and, to a lesser degree, the United Kingdom, are global financial power hubs, even though London's status as Europe's financial center remains uncertain after Brexit. Their central and prominent positioning in the global economic and financial order attracts significant capital inflows, as global investors consider their government bonds as safe assets and their currencies as global reserves. As a result, credit-led growth models in the global financial core have been able to sustain large current account deficits supported by capital inflows. These capital inflows often come from export-driven growth models, such as Japan, Germany, and China, which run current account surpluses and channel excess savings abroad. After lifting capital controls across the OECD, the US dollar's status as the major reserve currency gave the United States an exorbitant privilege, allowing it to sustain massive current account deficits that have fueled household borrowing due to foreign investments in US Treasuries and mortgage-backed securities, MBS. When foreign funds flow into domestic capital markets, domestic credit markets expand and borrowing costs fall, bolstering the housing and income maintenance channels of debt finance consumption. Housing bonds, such as mortgage-backed securities, are often considered to be the second best option after government bonds in core credit-led economies. In the United States, the federal government is backing most mortgage-backed securities through the government-sponsored mortgage giants, Fannie Mae and Freddie Mac, and their fully public cousin, Ginnie Mae, which make these bonds attractive to global investors. In 2018, China, Taiwan, and Japan were the largest foreign holders of U.S. mortgage-backed securities, holding roughly $700 billion or 10% of the entire U.S. MBS market. The UK's smaller residential MBS market, i.e., £133 billion in outstanding residential MBS in 2019, also relies on foreign investors, especially from the United States. Global capital inflows into the housing sector, in turn, increase housing demand as well as prices, while boosting housing wealth and easing credit constraints that are associated with higher consumer spending. Credit-driven, consumption-led growth models are underpinned by what Baccaro, Blythe, and Ponterson describe as growth coalitions. These coalitions are constellations of political and economic actors who share a common interest in facilitating easy access to credit and debt-fueled consumption. They include producer groups in the financial services industries, voters that benefit from asset price inflation and easy access to consumer credit, and political parties that claim to act in the general economic interest by stimulating credit and consumption. The most important producer group is the fire service sector, i.e., finance, insurance, and real estate. These industries include banks, insurance companies, credit card companies, hedge funds, mortgage brokers, home builders, and realtors. While these industries do not always agree on policy details, they all profit from the expansion of consumer credit, property markets, and household consumption. These lobby groups are powerful constituents of the Growth Coalition, owing to their central structural position within credit-led growth models and their ability to frame political demands in ways that align with their growth models' macroeconomic imperatives. While labor unions play a key role in moderating wages in price-sensitive, export-oriented economies, they are not part of this coalition because they tend to promote fiscal and redistributive policies seen as incompatible with dynamic financial markets. In fact, the influence of labor unions and the labor share have declined in recent decades in most OECD countries, including the United States and United Kingdom, while the role of capital has increased in globalized financial markets with mobile capital. The key electoral constituency consists of current and aspiring homeowners, and asset owners more generally, who benefit from accessible and subsidized credit. Permissive consumer credit markets stimulate housing prices and other financial assets, allowing many households to move up or down the housing ladder and tap into home equity. As a result, housing is often viewed as an investment good embedded in a wider culture of finance. Renters, by contrast, often face the downside of dynamic real estate markets in the form of rising rents, while being effectively excluded from wealth gains and participation in an asset-based welfare state that heavily depends on real estate ownership. Middle and upper-income households are the ones benefiting the most from such a finance culture, because they are the predominant owners of property and stocks that tend to rise in value when financial markets and credit expand. Finally, political parties represent the interests of these policy demanders and are themselves shaped by the imperatives of the growth model. Mainstream political parties on the left and right tend to favor policies that aim to stimulate debt finance consumption, the key element on which their growth model relies, which often produces surprising degrees of bipartisanship. In doing so, they also advance the interests of the fire industries and asset owners. Particularly in moments of crisis, center-left and center-right parties often agree to stimulate and double down on boosting the fire sector to generate growth. What are the specific strategies available to policymakers to stimulate credit-led growth models? The toolkit of policy choices includes a wide array of fiscal and regulatory policies that make credit more easily and widely available, encourage the establishment of new consumer loan products, and/or subsidize borrowing costs, all of which stimulate debt-fueled consumption through the housing and income maintenance channels. Fiscal policies can encourage consumer debt through tax relief on interest payments, e.g., for student loans or mortgages, favorable tax treatment of debt-financed assets, e.g., for owner-occupied homes, or direct spending programs to finance the cost of home ownership. Second, regulatory policies include government guarantees on household debt that reduces the cost of borrowing for the consumer by absorbing financial risk from banks, liberalizing measures to encourage the proliferation of new consumer loan products, or initiatives to widen credit access to previously excluded groups. Such measures are the building blocks of permissive credit regimes that facilitate access to credit in the US and UK economies with limited welfare states, and they support income losses and social investment by relying on debt finance consumption. In the United States and United Kingdom, the economic power of financial and real estate sectors has grown at much higher rates than in other OECD countries. See also the chapter by Ban and Helgedotter in this volume. Figure 8.1 compares the FIRE sector's value added as a share of GDP in the United States, United Kingdom, and export-oriented Germany. In the 2010s, the finance and insurance sector together added more than 7% of GDP, while the real estate sector contributed more than 13% in both the United States and United Kingdom. In Germany, by contrast, finance and insurance added only 4% of GDP and real estate only 10%. Relatedly, the status of New York and London as major financial centers in the global financial system attracts foreign capital that flows into consumer credit markets and is channeled into secured, e.g., mortgages, and unsecured debt, e.g., credit cards. The central sectoral position of the FIRE industries in credit-driven growth models makes them powerful players in these economies. Unlike in export-oriented Germany, easy access to credit and household borrowing is a key pillar to support aggregate demand in the United States and United Kingdom. The importance of the FIRE sectors is also linked to relatively high levels of home ownership and household indebtedness. As Figure 8.2 shows, around 2/3 of the US population are homeowners, a number that has been fairly stable since the 1970s. In the United Kingdom, home ownership rates increased from around 50% in 1970 to an all-time high of 71% in the mid-2000s. This stands in stark contrast to Germany, where home ownership remains much lower compared to the United Kingdom and the United States. A related key feature of credit-led growth models, although certainly not limited to such economies, is rising house prices. Figure 8.2b shows that between the 1990s and the onset of the Great Recession, property prices have grown nearly 3 times in the United Kingdom and 2.5 times in the United States. Germany, by contrast, even experienced a decade of falling house prices from the mid-1990s until the mid-2000s, and only saw a steep increase during the 2010s. Relatively high levels of home ownership, paired with growing property prices and turnover rates in housing markets, also have consequences for mortgage debt levels. Figure 8.3 shows the average mortgage debt and consumer credit as a share of households' disposable income. Since the mid-1990s, households in the United Kingdom and United States took on increasing levels of mortgage debt relative to their incomes. At the onset of the 2008 to 2009 financial crisis, households in both countries held about 120% of their incomes in mortgages. After the Great Recession, mortgage debt declined as households began deleveraging debt. In contrast, Germany's mortgage debt levels only increased from the mid- until late 1990s and remained relatively flat since then. While mortgage debt is typically the single largest type of household debt, American and British non-mortgage consumer credit, which includes credit card debt, car title loans, and student debt, also increased considerably in the years leading up to the financial crisis. After the Great Recession, US and UK households began deleveraging, while non-mortgage consumer credit plays a negligible role in Germany. Finally, the US and UK economies are both characterized by high consumer spending and low savings in the economy. Figure 8.4 shows that, since the 1970s, US household consumption as a share of GDP climbed from roughly 60% in 1980 to over 68% in the 2000s. At the same time, gross savings as a share of GDP have declined since the late 1970s. After hitting its low point of 3% of disposable US household income in 2005, down from 14% in 1974, the personal savings rate rebounded to around 8% in the 2010s. In the United Kingdom, household consumption has remained between roughly 64 to 69% for most years since the mid-1970s. While the UK's personal savings rate stood at 10% in 1995, it even entered negative territory between 2017 and 2019, but the pandemic lifted the savings rate to 8% again in 2020. In contrast, German household consumption as a share of GDP has dropped considerably from 58% in 1980 to about 52% today. In 2018, private consumption of US and UK households was thus nearly 15 percentage points higher than that of German households, while German gross savings as a share of GDP were 10 to 15 percentage points higher than in the American and British economies that year. The US growth model combines a permissive credit regime with deep and liquid financial markets that allow many households to easily borrow money, build asset ownership, in particular housing wealth, and maintain their living standards in the context of declining wages, rising living costs, and limited social policies. As we show below, the housing and income maintenance channels are key to sustain debt finance consumption in these growth models. The U.S. housing market is a central element of the U.S. growth model. To stimulate housing-based growth, in particular since the 1980s, policymakers from both parties have championed government guarantees in primary and secondary mortgage markets and tax subsidies for home ownership, while also liberalizing and financializing mortgage markets. As these measures widened access to mortgage credit and reduced mortgage costs for borrowers, they contributed to rising mortgage debt, house prices, and debt-financed household consumption from the 1980s until the early 2000s. When the 2000s housing boom turned into a full-blown financial crisis in 2008, policymakers adopted further programs to support housing as a way to restore the U.S. growth model. While these measures stabilized housing and private consumption, they also fueled renewed house price surges in the 2010s, which in turn produced concerns about both financial instability and housing unaffordability in metropolitan regions. The American Growth Coalition behind these policy choices encompasses housing-related interest groups, an influential home-owning constituency, and politicians from both parties. Well-organized interest groups, such as the National Association of Realtors (NAR), and its 1.5 million members active in every single electoral district, the Mortgage Bankers Association (MBA), the National Association of Home Builders (NARB), and other financial institutions have been strong lobbyists in favor of expanding government support for housing. Indeed, the real estate lobby is one of the most powerful ones in the Beltway, with a lobby spending of $133 million in 2020, which made it the fourth largest lobby after the pharma, electronics, and insurance industries that year. Relatedly, members of both the Democratic and Republican parties have repeatedly supported measures to support housing and mortgage markets, a long-standing bipartisan consensus that is increasingly rare in American politics. Policymakers of both parties get behind these policies not only because they benefit the FIRE lobby and home-owning voters, but also because politicians believe these programs to be strategies that can stimulate mortgage debt, housing activity and prices, and ever larger short-term consumption and spending. Underlying the U.S. housing channel is an architecture of fiscal and regulatory policies that subsidize mortgage debt, lowers borrowing costs for homeowners, and widens access to mortgage credit, a set of policies that has evolved for almost a century. The U.S. federal government stimulates housing markets and mortgage debt on at least three different levels. First, the U.S. Treasury provides tax subsidies for home ownership and mortgage debt, such as the mortgage interest deduction and capital gains exclusion on the sale of homes, which together amounted to $62 billion in 2019. Second, in the primary mortgage market, U.S. government agencies offer private banks mortgage insurance against mortgage defaults. In 2018, the Federal Housing Administration and the U.S. Department of Veteran Affairs guaranteed roughly $375 billion in homeowner mortgage payments to banks. Third, quasi-governmental agencies, such as Fannie Mae, Freddie Mac, and Ginnie Mae, guarantee the vast majority of mortgage-backed securities in the country, an astonishing number of more than $7 trillion. These intertwining programs channel significant amounts of domestic and global capital in the housing market by purportedly reducing risk for financial actors and by reducing borrowing costs for consumers. Over time, policymakers have amended and expanded these government programs in repeated efforts to stimulate the country's housing market and domestic demand. Especially since the 1980s, policymakers financialized the country's mortgage market by adopting several measures to stimulate mortgage lending, housing activity, and debt finance consumption. Before then, the U.S. housing finance market was relatively conservative and based on domestic deposits and savings. Yet, policymakers adopted sweeping, regulatory reforms in response to increasingly illiquid mortgage markets and sluggish housing growth. First, they liberalized the primary mortgage market for lower-income households by allowing unconventional mortgage loans, such as Alt-A, adjustable rate, and jumbo mortgages. Home equity loans were part of this liberalization effort and soon grew from only $1 billion in the early 1980s to more than $300 billion in outstanding debt in 2003, while the number of active loans increased from 23,000 in 1980 to 1.3 million in 2000. Second, policymakers revolutionized the secondary mortgage market by creating a new housing finance system based on mortgage-backed securities attractive to domestic and global investors. The quasi-governmental agencies, Fannie Mae, Ginnie Mae, and Freddie Mac, soon became dominant actors trading mortgage-backed securities that came with a government guarantee. By the early 2000s, the government-backed trio underwrote $3.5 trillion in mortgage debt, constituting 35% of the residential mortgage market. Finally, policymakers watched the growth of homeowner tax breaks without curbing these tax breaks when they had the chance, such as during Reagan's 1986 Tax Reform Act. As a result, the mortgage interest deduction grew to $100 billion annually just prior to the financial crisis. The late 1990s and early 2000s saw booming housing markets and debt finance consumption, but also a brewing housing bubble in the subprime market. The boom was in part produced by massive government support for the housing sector, low interest rates, global capital inflows, and aggressive profit-seeking behavior that mispriced risk in deregulated financial markets. Both the Clinton and George W. Bush administrations did little to stop the party. To the contrary, they developed their respective national home ownership strategy and aggressive housing agenda to stimulate housing markets, especially in underserved parts of the population. In this period, many homeowners used their houses as an ATM to finance consumption. In 2009, the amount of outstanding home equity loans was at an all-time high of $700 billion, while the Financial Crisis Inquiry Commission estimates that U.S. households extracted $2 trillion between 2000 and 2007. When the housing bubble burst in 2008, the result was a vicious cycle of falling house prices, growing mortgage defaults and foreclosures, household debt deleveraging, and faltering consumption. To revive the U.S. growth model, the Bush administration quasi-nationalized the battered Fannie Mae and Freddie Mac to stabilize mortgage liquidity and reassure global investors, chiefly China, that the U.S. government was backing agency-related mortgage-backed securities. Fannie and Freddie have since remained in the hands of the U.S. government, meaning that the American state currently guarantees $7.3 trillion in mortgage debt. The Obama administration also adopted the Making Home Affordable initiative, part of the Troubled Asset Relief Program, TARP, of 2009, to reduce principal and interest payments of distressed homeowners, which restructured 1.8 million home loans and refinanced 3.5 million underwater mortgages at lower rates from 2009 until 2018. While home equity withdrawal decreased after the financial crisis, outstanding home equity debt was still around $370 billion in 2019 and remains a major component of debt finance consumption in America. In the fiscal realm, policymakers allowed distressed homeowners tax exemptions on debt forgiveness through the Mortgage Debt Relief Act at a cost of $1.4 billion between 2008 and 2017. And it offered first-time buyer tax credits of up to $7,500 per household, first adopted under the Housing and Economic Recovery Act of 2008, to 2.3 million homeowners that cost taxpayers $16.2 billion between 2008 and 2010. Finally, the Federal Reserve's ultra-expansionary monetary policy reinforced actions by elected officials, as it bought and retained over $2 trillion in mortgage-backed securities as part of quantitative easing programs to reduce mortgage rates and stimulate the wider economy. However, as much as these policies helped produce an economic recovery, they also contributed to surging house prices in times of ultra-low interest rates that have excluded many young, minority, and low-income households from the property ladder. The pandemic has exacerbated these developments, due to prolonged expansionary monetary policy and increased demand for housing, outpacing supply. These developments have reinforced distributional disparities between asset owners and non-owners and created concerns about overheating housing markets, even though mortgage lending is more conservative today than it was before the 2008 to 2009 crash. The income maintenance channel constitutes the second building block of debt finance consumption in the United States. The U.S. growth model is highly dependent on household consumption to sustain aggregate demand, which, in turn, makes it vulnerable to income shocks, stagnating wages, and expenditure hikes that threaten to reduce household consumption. Income shocks caused by unemployment, sickness, or temporary leave from work can negatively affect household consumption and therefore undermine aggregate demand. Through social consumption policies such as unemployment insurance, welfare states typically mitigate the effect of earnings losses on consumption patterns by offering income support during times of economic distress. The American welfare state, however, is much more limited than social democratic or continental European welfare regimes and delegates responsibility to address social risks to individuals, employers, and private markets. Because of insufficient savings, many households have turned to credit markets and borrowed money to smooth income losses. Credit has become a private alternative to a public welfare state that allows households to maintain consumption in light of income losses. Over the past 2 decades, 2 trends have forced more households into debt. First, policy drift and welfare state retrenchment have shifted the burden of social risks even further away from the shoulders of society onto individuals themselves. The Personal Responsibility and Work Opportunity Reconciliation Act, PRURA, of 1996 marked the most far-reaching form of welfare retrenchment under President Clinton, abolishing the Aid to Families with Dependent Children (AFDC) program and replacing it with the Temporary Assistance for Needy Families (TENF), a program with stricter work requirements and time-limited benefits. In the early 2000s, President Bush began to implement welfare entitlement reforms under the guiding philosophy of compassionate conservatism that would shift responsibility for the provision of social welfare away from the government toward private sector organizations such as markets and faith-based groups. His ideas of an ownership society, in which economic prosperity is best rooted in personal ownership of assets, laid the foundations for an asset-based welfare state. The second trend that contributed to rising household indebtedness is that employment trajectories in the United States have become more flexible, interrupted, and unstable. The workplace has become fissured as firms outsource larger shares of their production and construct extensive networks of subcontracting and franchising to streamline operations and cut labor costs. The turn from stakeholder to shareholder models of corporate governance shifted the power from managers to shareholders and the focus from long-term interests such as stable firm-worker relationships to short-term considerations such as stock prices. These trends affect households' financial situation directly as they make household income more volatile and indirectly because interrupted employment patterns often disqualify individuals from social benefits if they no longer meet eligibility requirements. In this environment, credit markets have emerged as a private solution to address income losses during unemployment, sickness, and other periods of temporary leave from work. A 2004 study found that around one-third of U.S. families drew on credit cards to cover basic living expenses during a 4-month period. Easier access to credit is the fuel to keep aggregate demand up and running when incomes and earnings decline and the welfare state is not providing adequate support. Credit markets further help sustain aggregate demand when living costs and prices for expenditures such as education, childcare, and healthcare have increased more than household incomes. Between 1996 and 2014, median household expenditures grew by about 25%. While expenditures recovered from the downturn during the Great Recession, incomes often did not. This pushed the median expenditure-to-income ratio for a two-earner couple with 2 children up to 75%. Pew Research Center 2016. Low-income American households today spend a higher share of their budgets, about 82% in 2014, on basic needs such as housing, food, transportation, healthcare, and clothing than they did 3 decades ago. But the financial burden of rising expenditures is not limited to low-income households. It also affects middle-income households who often live paycheck to paycheck and have little savings to weather income losses or expenditures hikes. In 2020, about 34% of American adults reported having difficulty covering everyday expenditures such as food, rent, or car payments. In another survey, more than a third of American households stated they could not cover unexpected expenditures of $400, or only by going into debt. Rising expenditures have become particularly burdensome because incomes have not grown commensurately. Current real average wages have the same purchasing power as they did nearly 40 years ago. Gains have largely been concentrated among high-income earners. Since 1980, inflation-adjusted hourly wages for workers in the bottom decile have increased by 8.9%, which corresponds to an annualized inflation-adjusted growth rate of just 0.2%. Workers at the median wage earn 16.8% more than 4 decades ago, 0.4% annualized growth rate, while those in the top decile gain 46.9%, about 1% compounded growth rate. Economic Policy Institute 2018. The reasons behind stagnating real wages are hotly debated and include the decline of labor unions, a widening wage gap between workers with and without college degrees, restrictions on job switching, a growing pool of workers who are either in non-standard forms of employment or outside the formal labor force, as well as the technological change and the rise of low-wage service jobs. Wage stagnation poses a key threat to a consumption-driven growth model because it undermines households' ability to consume, especially when the costs of living and other expenditures rise. Financial deregulation and easier access to credit provided policymakers across the political aisles with a solution to prop up aggregate demand that had a limited fiscal imprint on public budgets and, therefore, was politically feasible. The electoral dynamics between policymakers, voters, and interest groups in the American growth model were in full display during and after the financial crisis. Meehan, Soufi, and Treby show that politicians in areas with high mortgage default rates were more likely to support the 2008 American Housing Rescue and Foreclosure Prevention Act, AHRFPA, which provided financial insurance for the Federal Housing Administration for renegotiated mortgages as well as unlimited financial support for Freddie Mac and Fannie Mae. Politicians who received campaign contributions from the financial services industry were much more likely to vote in favor of the Emergency Economic Stabilization Act, EESA, which allowed the government to recapitalize banks through direct purchase of assets and distressed mortgage-backed securities. People who did not own a home but were similarly affected by the crisis through job losses and have large outstanding credit card or student loan payments did not benefit from similar protections and bailouts. Both programs reflect the political and economic importance of homeowners as consumers and the FIRE sector as suppliers of credit. Similar to the United States, the UK's credit and consumption-driven growth model relies on a permissive credit regime and liquid credit and mortgage markets, which generate aggregate demand and, in turn, economic growth through the housing and income maintenance channels. Beginning in the 1980s, UK policymakers began to liberalise financial and mortgage markets, relax credit constraints, and subsidise home ownership by privatising social housing in order to stimulate growth and promote asset-based welfare. The result was a debt-fueled growth model with little incentive to save. Instead, consumers were increasingly encouraged to think of their asset purchases as investments which they might cash in to fuel their consumption in retirement, as the state withdrew from pension provision, or in times of economic difficulty or unemployment. After house prices and the economy collapsed during the 2008 to 2009 financial crisis, policymakers stimulated the housing channel to facilitate economic recovery. However, these demand-side policies contributed to soaring house prices in the context of low interest rates, leaving many households struggling to climb the property ladder amid growing concerns of overvalued housing markets. The UK Growth Coalition consists of centre-right and centre-left political parties, housing-related interest groups, and homeowners. The financial sector and real estate industries, such as the City of London Corporation, UK Finance, the British Bankers Association, or Home Builders Federation, are key forces in support of easy access to household credit and housing growth. The Conservative Thatcher government did much to stimulate housing as a vehicle for growth, as well as to create powerful home-owning voting constituencies. Subsequent Labour governments, including New Labour, followed the path of house price Keynesianism as a growth and asset-based welfare strategy. As Oren and Blythe put it, each policy selection, from Lawson to Brown, put the interests of the financial sector first, deepened the dependency of the economy on credit growth, and further shut down alternative paths for growth. In a far-reaching attempt to privatise housing and boost private ownership, the Thatcher government introduced one of its signature policies, the 1980 Right to Buy programme. More than 2 million council housing units have since been sold to tenants at a subsidised, below-market price. In the 1980s, however, many households faced significant hurdles in obtaining mortgages in what was then a fairly restrictive mortgage system dominated by building societies, while local authorities' efforts to offer public loans to tenants resulted in deficits that worked against the government's austerity principles. In response, the Thatcher government adopted a series of reforms to allow for more competition between commercial banks and building societies in the mortgage market, such as the 1986 Building Society Act. Much like the US savings and loans banks that were the backbone of the pre-financialized mortgage market, UK building societies lost their predominant role in providing mortgage funding as capital markets took over that role through mortgage securitization, which became a core pillar of the British macroeconomic regime. These policy actions paved the way for a property boom in which house prices rose by about 10% on average between the mid-1990s and 2007. Similar to the United States, a low interest rate environment, paired with deregulated mortgage markets, global capital inflows, and investor appetite for mortgage bonds, contributed to the house price boom in the United Kingdom. Armed with increased net worth, UK households also tapped their home equity for credit-based consumption. According to Montgomery and Budenbender, home equity withdrawal constituted 4% of GDP between 2002 and 2007, with a peak of £63 billion extracted in 2003, a number that corresponds to 9% in consumer spending that year. When house prices declined by 20% and over-leveraged households began to default on their mortgages, losses in household wealth constrained their abilities to borrow money and consume. As a result of mortgage defaults, toxic financial investments, and falling consumption, the UK's debt-fueled growth model was in crisis. Once policymakers had stabilised the financial system, they turned to housing to promote economic recovery in the post-crisis years. The Cameron government adopted a series of measures absorbed under the 2013 Help to Buy programme designed to stimulate housing markets and economic growth. The programme included an interest-free loan, for 5 years, of up to 20%, 40% in London, of the home value for newly built homes, while households have to come up with a 5% down payment. This is an expansion of the 2011 First Buy programme designed to help low-income, first-time buyers to make a down payment. The Help to Buy program also included a guarantee scheme in the amount of £12 billion, in place until 2017, which protected lenders from mortgage default and encouraged them to give out £130 billion in mortgages to first-time buyers and low-income households. 15 In response to the COVID-19 pandemic, the Johnson government initiated a new guarantee scheme capped at £4 billion, up to £600,000 in home value, to encourage banks to extend mortgages with a down payment of only 5% in 2021. And it temporarily offered tax relief on the stamp duty holiday, a tax on property purchases, from July 2020 until June 2021. While these demand-side measures have stimulated housing markets and asset prices, they also exacerbated existing supply-side problems and the lack of affordable housing among young and low and middle-income households. The UK's current affordability crisis is also the product of a rigid land use planning system, i.e., greenbelt protections, height restrictions, etc., with few fiscal incentives to develop and an outsized role for local politicians and NIMBYs in the property development process. The UK's growth model also relies on the income maintenance channel to support aggregate demand. Much like its American counterpart, the British growth model is heavily driven by domestic consumption, as Figure 8.4 shows. Yet, the strong reliance on consumption for aggregate demand makes the UK economy vulnerable to income shocks that affect the propensity and ability of households to consume. For the first time in nearly 30 years, UK households in 2017 collectively spent or invested on average around £900 more than they earned, turning households into net debtors, Office for National Statistics 2018. A set of policy choices in the 1980s and 1990s paved the way for credit-based income maintenance to become part of the British growth model. The Conservative Thatcher and major governments privatised and deregulated labour, finance, and product markets as well as several industrial sectors. They dismantled trade unions and Britain's already weak corporatist structures, and they retrenched many welfare state programs. Guided by a new workfare rhetoric, the government tightened welfare eligibility criteria and coupled social benefits more closely to past employment. At the same time, middle-income households were encouraged to opt into private supplemental pension plans and health insurance and to become homeowners with property that can serve as a private nest egg during retirement. The third way policy strategy under New Labour made social benefits further contingent upon paid employment and turned their focus of the welfare state to more active labour market policies with the goal to enable re-entry into the workforce. These policy changes were embedded in a more fundamental shift in aggregate demand, replacing Keynesian demand management with what Crouch called privatised Keynesianism, meaning that the economy is no longer stimulated by wage growth or government spending and public debt but by individuals borrowing money to maintain income in times of stagnant wages and waning welfare. After the Great Recession, the Cameron government embarked on a series of austerity policies that severely cut government spending across a wide range of services, including welfare benefits. In 2010, it introduced universal credit, a new type of benefit for working-age people, which replaced 6 existing benefit categories, i.e., income support, income-based job seeker allowances, income-related employment and support allowances, housing benefits, child tax credits, and working tax credits, by merging them into a single payment with reduced benefit rates. Welfare retrenchment aggravated the more unequal distribution of economic growth in liberal market economies. To alleviate the fiscal impact of income shocks and rising expenditures, governments sought to appease and acquiesce voters by providing easy access to credit, such as through subprime lending and cheap unsecured credit cards. Together, these policy bundles culminated in the rise of an asset-based welfare state in which households address income shocks or additional expenditures through equity release from their homes. Households without sufficient access to real estate assets, however, have to rely on unsecured forms of debt to address financial shortfalls. This asset and debt-based welfare state has now become a cornerstone of a consumption-driven growth model, sustained by widely and easily available access to credit and critical to help households sustain aggregate demand. We identified 2 distinct channels through which these growth models generate domestic demand. First, the housing channel facilitates household borrowing and consumption through rising house prices and homeowners' wealth, which both increases households' propensity to spend money and improves their collateral against which they can borrow to finance consumption. Second, the income maintenance channel strengthens aggregate demand by encouraging households to draw on credit markets to maintain their income and economic status when earnings stagnate, incomes drop, and personal expenditures rise in the context of limited welfare states. We showed that the production of these growth models hinges on a political coalition of policy demanders, which consists of producer groups in the fire service sector, asset owners, and centre-left and centre-right political parties, who all share a common policy agenda geared toward easy credit access and asset price inflation to generate consumption. We conclude, necessarily speculative, that the future of these growth models depends on how policymakers address internal vulnerabilities related to financial stability and distributional inequalities. First, credit markets are instrumental in producing innovation and sustaining economic growth in these models. Yet the very forces that bring about growth can also have destabilizing effects when financial actors engage in risk-taking behaviors, disrupt existing markets with new financial innovations, or exploit regulatory loopholes in pursuit of profits. For their part, politicians have strong incentives to prop up credit markets for growth but fewer incentives to restrain financial capitalism when markets overheat. The financial crisis of 2008 to 2009 was a case in point, revealing the internal contradictions of credit-driven consumption. Expanding credit produces growth but may also lead to asset bubbles and financial crises. Concerns about financial stability have hardly disappeared in the post-crisis world of ultra-low interest rates and asset price inflation. While permissive credit regimes have helped facilitate credit access when interest rates were higher in the past, the current combination of permissive credit and ultra-low interest rates have contributed to soaring asset prices, a development that the COVID-19 pandemic reinforced. Policymakers have tightened financial regulations after the Great Recession, but should be concerned about asset price inflation that could result in future financial bubbles. A second challenge pertains to the distributional implications of credit-driven growth models. Asset price inflation during the past decades has benefited those with assets over those without and, therefore, has exacerbated distributional inequalities between the haves and the have-nots, as people without assets have not seen the same economic gains from stocks and property as those with assets. Fuller et al. 2020. In the case of housing markets, many younger, low-income, and minority households have been priced out of the property market, as their down payment savings cannot keep up with house prices. These inequalities pose important socio-economic challenges, as concentrated income and wealth are found to be detrimental to economic growth, in part because rich households have a higher propensity to save than lower-income households. Economic Policy Institute 2017. The United States and the United Kingdom are among the most unequal societies in the OECD, with the top 10% income groups capturing 45.5% of total income in the US and 35.7% in the UK, respectively. World Inequality Database, 2021. Inequality-related drags on demand have thus far been compensated by permissive credit and low interest rates, but this begs the question as to how much further the housing and income maintenance channels can be pushed. And as rising inequality enables high-income groups to use the financial system to recycle a share of their growing wealth as loans to low- and middle-income groups, this can contribute to rising indebtedness and financial crises. Existing accounts of international institutional creation privilege both rationalist and historical institutionalist explanations. While some of these theories have been used to explain the origins of formal international organizations, they can also generate observable implications for regulatory networks. First, rationalist accounts tend to focus on the functional and Pareto-improving effects of creating regulatory networks. According to Slaughter, disaggregating states into regulatory subnational building blocks and establishing transnational linkages between domestic regulators is an effective way to govern an increasingly interdependent world. Regulatory networks would provide the most efficient, rational design in the information age, provided the fast pace of interaction, flexibility, informality, and low cost that these networks entail. These accounts thus emphasize the comparative advantages of networks vis-a-vis hierarchies in solving coordination problems. From this rational design perspective, we should expect states to design a single institutional equilibrium for the FSF that primarily focuses on solving coordination problems. As financial regulation is considered to be highly technical, states should create a regulatory network without using bargaining power to defend national interests or fighting over the distributive consequences of such a new body. In short, the FSF should constitute a technical consensus and the most efficient solution to solve coordination problems. Yet, these accounts not only turn a blind eye to conflict between states, with varying state interests and abilities to pursue these interests, but also neglect the possible variation in network designs along the Pareto frontier. Second, historical institutionalists tend to stress the ways in which states attempt to replicate their domestic economic preferences at the international level, which is often based on the varieties of capitalism framework. According to these accounts, states seek to protect and extend their domestic regulatory frameworks by promoting their domestic preferences through regulatory initiatives at the global level. These preferences are derived from domestic economic traditions. This would allow states to avoid the adjustment costs incurred in changing their regulatory status quo and to shape regulatory frameworks abroad in ways preferable to them. Dresner articulates what we would conventionally expect different states to promote. In liberal market economies, particularly the United States, there is a strong tradition of minimal government interference in the economy. Regulatory agencies are separated from government ministries to reduce the state's ability to impose significant regulations. Firms coordinate their activities primarily through decentralized market arrangements. In coordinated market economies, firms rely more on non-market institutions to allocate scarce resources. Government ministries house their own enforcement agencies, making it easier for the state to regulate. The expectation of government intervention in the economy is greater than in liberal market economies. Similarly, Furitus argues that it is important for governments in liberal market economies to secure multilateral designs that are liberal in design because other forms impose significant maladaptation costs on firms. Walter further states that liberal economies prefer technocratic, apolitical, and insulated arm's-length financial regulation. From these varieties of capitalism perspectives, we should expect liberal economies, particularly the USA, to advocate the creation of a technocratic network for the FSF with minimal government interference. Coordinated market economies in Europe should promote a state-centered body with an emphasis on government representation and interference. Yet these accounts neither explain changing preferences over time, making them somewhat strong forms of path dependence, nor why the USA preferred a state-centered network for the FSF, when its European counterparts favored a technocratic body. This body of work also tends to neglect the variation in state preferences among liberal or coordinated economies, which is often based on differences in domestic regulatory structures or traditions. Third, other historical institutionalists emphasize how domestic regulatory institutions empower some actors over others when shaping regulatory networks. Buith and Matley argue that states with unified authority structures can greatly influence regulatory networks, given the high degree of organization, expertise, and resources of their domestic agencies. Establishing institutional compatibility between the domestic and global level then provides an advantage in information aggregation and a superior bargaining position in setting global standards, whereby domestic agencies promote and defend at the international level the regulatory preferences of their domestic stakeholders to minimize domestic switching costs. States with fragmented structures are disadvantaged by a lack of domestic coordination. From this institutional compatibility perspective, we should expect states with unified authority structures to prefer and have a clear advantage in constructing a technocratic structure for the FSF that privileges their domestic unified agencies. Yet there are a number of reasons why this might be different. First, assuming that states are aware of the benefits of unified structures, they might simply replace fragmented domestic institutions with unified ones, in order to speak with one voice at the global level. Second, we even see that states dissolve unified structures. The UK Financial Services Authority, FSA, a centralised regulatory agency, was recently separated into two smaller agencies, at which time it also transferred regulatory power to the Bank of England. Third, this account cannot tell us what states promote if they do not have a consolidated agency from which to access regulatory networks. These points underline that states are not trapped in their institutional legacies and that the merits of unified authority structures are often overstated. A closer look reveals that the USA has a highly fragmented regulatory structure in finance, but is nonetheless able to shape the creation of and secure access to the FSF, even more so than states with unified authority structures such as the UK. It is widely known that regulatory networks serve as instruments for exporting financial standards and securing compliance with these standards. Given the elevated salience of the financial sector and regulatory networks since the early 1990s, it should come as no surprise that the most powerful actors try to gain control of these networks, whereas weaker actors attempt to constrain the most powerful. But little is known about the ways in which actors are able to do so. While technocratic networks can minimize direct political interference, state-centered networks ensure the pursuit of political agendas. State-centered forums provide a clear advantage to the most powerful states, allowing them to exert direct bargaining weight. Technocratic networks that privilege either IFIs or independent domestic or global regulators can, under certain conditions, promote policies that are not in the interest of the most powerful states. Both network designs, therefore, offer distinct political channels that empower certain actors over others in shaping global financial regulation. But what explains that some states prefer the creation of state-centered networks, while others prefer technocratic networks? Existing research has fruitfully explored the ways in which states access regulatory networks if they have a domestic focal point, a consolidated domestic regulatory agency to represent their interests in regulatory networks. The IASB and IOSCO, two technocratic networks in accountancy and securities run by independent domestic regulators, provide good examples. Scholars remark that the USA has been effective in influencing IOSCO and the IASB through its powerful SEC and the Financial Accounting Standards Board. Yet, less is known about what states prefer if they do not have a centralized agency from which to access regulatory networks. The FSF, for instance, is a global regulatory initiative that spans most subsectors of finance, including banking, securities, and insurance. Many states, including the USA, do not have a single regulator for these sectors. The main theoretical contribution of this article is to explore state preferences under conditions of domestic regulatory fragmentation. In fact, the USA has a highly fragmented authority structure that has evolved over the past 150 years, with multiple regulatory agencies in banking, securities, and insurance, e.g., the SEC, the Federal Deposit Insurance Corporation, the Federal Reserve Board, the Commodity Futures Trading Commission, etc. Similarly, Germany had a fragmented regulatory system in the 1990s, with multiple agencies overseeing its financial sector. The Bundesaufsichtsamt für den Wertpapierhandel in securities, Bundesaufsichtsamt für das Versicherungswesen in insurance, and the Bundesaufsichtsamt für das Kreditwesen in banking. France and Italy also retained multiple, functionally differentiated and autonomous regulators to oversee different segments of their financial systems. As a result, these states lacked centralized, domestic agencies able to represent their interests in banking, securities, and insurance in a regulatory network such as the FSF. If the USA, the most powerful state in finance, is unable to draw upon a single domestic regulatory agency to represent its interests in a regulatory network, then the state can privilege its powerful treasury. This state-centered strategy secures control of the network and avoids losses in sovereignty. Involving its treasury positions the USA to 1. Ensure access to regulatory networks and, accordingly, the ability to defend and extend its domestic regulatory status quo by avoiding switching costs for its own industries. 2. Overcome the competing jurisdictions and interests of multiple domestic agencies. And 3. Increase the legitimacy of regulatory networks by privileging government representatives instead of unelected, independent regulators. There is broad agreement that the USA has been the strongest financial power in the late 1990s, given its market size, political heft, and centrality in the global financial system. In a state-centered network, this power position enables the U.S. Treasury to promote U.S. standards in states that previously promoted different standards. The high political profile and policy authority of finance ministries, including their links to leaders and to IFIs, can push states' commitment to financial standards. The USA is therefore able to tie down other states to commitments and minimize losses in sovereignty. This is not to argue that the USA always prefers state-centered networks. The USA can favor such structures if it is unable to select a single domestic agency under conditions of domestic regulatory fragmentation. Where weaker states in finance, such as continental Europe, are unable to draw upon centralized domestic agencies to represent their interests in regulatory networks, they can champion technocratic networks driven by international bodies. This network structure allows weaker states to constrain U.S. power and promote their own interests through international institutions such as IFIs and global regulatory bodies. Certainly, the USA also exerts influence within these international bodies, but the country often laments the overrepresentation of European states at the IMF and the World Bank. As Abdelal suggests, international organizations are, after all, run by bureaucracies and officials, frequently European, who have envisioned the creation of a very different organization of global finance, compared with the US. Scholarship along this path usually refers to international organizations such as the IMF, World Bank, the Organization for Economic Cooperation and Development, OECD, and the Bank for International Settlements, BIS. But others have also pointed out that Europeans have a strong influence in regulatory networks such as the International Association of Insurance Supervisors, IAIS. This demonstrates that continental European states can pursue strategies through which they are able to exert influence in a subtler way, promoting European standards internationally through international organization. Weaker states can thus seek to restrain US power through technocratic institutions. Lastly, this article addresses how divergent state preferences result in institutional outcomes, arguing that state bargaining capabilities, as opposed to strictly functional imperatives, explain international institutional creation. Knight indicates that institutional development is a contest among actors to establish rules that structure outcomes to those equilibria most favorable for them. Accordingly, although new institutional structures might even be Pareto improving in that states agree on mutually undesirable outcomes, they can still disagree on the final institutional choice. In short, all actors would be worse off without any agreement of establishing new institutional structures, but the new agreement leaves room for competing outcomes along the Pareto frontier, which gives powerful states an advantage to dictate the final outcome. These approaches often highlight the relative market size of states as the key source of power. This article concurs with this prominent body of work that characterizes the USA as the strongest financial power in the late 1990s, with a clear bargaining advantage over European states. Concomitantly, European states often have different interests and preferences, which can further decrease their bargaining leverage in international negotiations. While this article is consistent with these approaches in that it demonstrates that bargaining weight often explains institutional outcomes, it also goes beyond conventional power approaches. Power-based accounts in IR tend to explain the creation of regulatory networks, the FSF, in particular as a function of great power interest. As Dresner notes, the United States and European Union created club IGOs like the Financial Stability Forum to ensure control over the establishment and enforcement of common financial standards. Yet, this does not tell us much about the specific design of the FSF, as it does not spell out observable and testable implications. Relatedly, it does not shed light on intracase variation of state preferences and conflict among G7 states. This article fills in these gaps and expects considerable disagreement between G7 states as to what the FSF should look like, with a clear bargaining advantage of the USA. In particular, we should expect the USA to promote a state-centered network, while continental European states should promote a technocratic network, given their fragmented domestic regulatory structures and different power positions in finance. The following section tests these observable implications by examining the creation of the FSF, with a detailed analysis of state preferences and bargaining capabilities of the USA and Germany, including additional evidence from other G7 members, such as the UK. There was little disagreement among advanced economies that financial stability needed to be restored after the financial crises of the 1990s had unfolded. Indeed, the G7 agreed that new structures were needed to overcome regulatory clashes in global finance, which were said to have contributed to these crises in the first place. A series of statements by the G7 suggests that states were seemingly concerned with reducing transaction costs and solving coordination problems. For instance, the final report, which resulted in the creation of the FSF, utilizes relatively technical language, not revealing any conflict among states. The report reads, "These consultations were helpful in identifying key areas in the international financial system where improvements are essential in order to safeguard the proper functioning of the markets." A broad consensus emerged during this consultation process and is reflected in this report. Unsurprisingly, the FSF itself identified the main goal of the forum's establishment as the provision of new structures for enhancing cooperation among the various national and international supervisory bodies and international financial institutions so as to promote stability in the international financial system. These passages capture the repeated technical calls for new, informal arrangements in the global financial system to close coordination gaps, without changing the formalized global architecture in major ways. This appears to support efficiency-seeking and Pareto-improving rational design accounts in that it is effective and mutually beneficial to address coordination problems by creating a regulatory network. Scholarship on epistemic communities and technical expertise often follows such views with regard to the FSF. Porter, for instance, expresses this perspective by stressing, "The work programs of the FSF are also not as biased towards the interests of the powerful." And this can be explained in part by the well-established expectation from the legacy of technical collaboration that problems be addressed through research and reasoned debate rather than demands and threats. However, as Finnemore rightly remarks, no matter how technical international bodies might seem, they are never neutral forums. In a different study, Finnemore and Goldstein elaborate that there is no obvious single equilibrium or Pareto optimal strategy guiding state choices in many, even most, of the situations that might interest us. Their options are often painful and their choices far from foreordained. A closer look reveals competing state preferences, power dynamics, and conflicts among states when modeling the FSF. Certainly, all states agreed on mutually undesirable economic outcomes, including the shared harm of persisting financial volatility, coordination problems, and regulatory clashes. However, there were several political choices available that could have resulted in either a new equilibrium or a failure to cooperate. There was no obvious functional or technical rational outcome, since any choice would have had different distributional consequences. In 1998, the USA organized a meeting of the Group of 22, G22, advanced and emerging economies in Washington, D.C., to discuss dysfunctions in the global financial system and how to reform the existing financial architecture following the crises in the 1990s. The G22 swiftly drafted a report, in which it briefly discussed the creation of a financial sector policy forum as a regulatory and supervisory body that would discuss international financial sector stability issues across functional lines. The forum would consist of representatives of finance ministries, central banks, and financial supervisors from interested systemically important industrial and emerging market economies, as well as the IFIs and the international regulatory bodies. By convening national representatives, global regulatory groups, and IFIs, the G22 envisioned a system for the exchange of information on financial sector regulatory and supervisory methods. Just prior to the G22 report, Gordon Brown, then the UK's Chancellor of the Exchequer, had proposed the creation of a standing committee for global financial regulation. This body would be composed of IFIs, e.g., the IMF, the World Bank, and the BIS, global regulatory groups, e.g., the BCBS and IOSCO, and key domestic regulators, e.g., the FSA or SEC, with the responsibility of setting global financial standards and ensuring compliance. Above all, this technocratic proposal privileged the role of domestic regulatory agencies, as these domestic bodies should have been responsible for coordinating the work of this committee. Since the UK had a single centralised regulatory agency for banking, securities, and insurance, the FSA, this core agency could have functioned as a powerful focal point within this proposed forum. Yet, this disadvantages states without a centralised regulatory agency. For instance, the fragmented systems in the USA or Germany would have made it difficult for their domestic bodies to speak with one voice at this forum. To overcome this, the USA and Germany offered very different proposals. To sum up, both the Brown proposal and the initial G22 discussions served as a foundation for further discussions on the creation of the FSF. Later in 1998, the G7 advocated for the creation of a new institution to coordinate the erection of a new financial architecture of regulatory standards. For this reason, Gordon Brown, then also chair of the G7, entrusted Hans Tietmeyer, former president of the German Bundesbank, with elaborating a balanced approach that incorporated the views of the entire group. In particular, the G7 finance ministers and central bank governors issued Tietmeyer the mandate to consult with other appropriate bodies and to consider with them the arrangements for cooperation and coordination between the various international financial regulatory and supervisory bodies and the international financial institutions interested in such matters, and to put to us expeditiously recommendations for any new structures and arrangements that may be required. One might initially wonder why the G7 picked Tietmeyer to prepare the report. A senior Bundesbank official stated that he was chosen because of his connections within finance ministries and central banks, his seniority, as well as his repeated calls for action to overcome regulatory clashes in the international financial system. His strategic position in multiple networks situated Tietmeyer to commence negotiations. Subsequently, several international bodies and G7 states provided Tietmeyer input on the creation of the FSF. First, the G22 submitted a proposal to Tietmeyer, which already highlighted the core divergence in state preferences during the formation process, the extent to which national authorities should be represented in a new forum. In G22 meetings, states heatedly debated the topic, and the USA made it readily clear that most suggestions, including the UK's proposal, insufficiently involved finance ministries. In light of this, the G22 suggested the establishment of a two-tier forum, leaving the aspect of national representation deliberately unspecified. The forum was to be comprised of a large tier of finance ministries, central banks, and national regulators of important emerging and advanced countries, IFIs, and global regulatory groups that should discuss the broader global financial agenda and give legitimacy to the entire body, and a smaller, coordinative tier of IFIs, global regulatory groups, perhaps the group of 10, G10, central bank governors, and national representatives. This proposed coordinative tier is essential since it would have had the power to coordinate the work of its members. Yet, given the discord concerning the appropriate involvement of national representatives, the G22 left the aspect of membership unspecified. Second, the BIS, the so-called Central Bankers Bank, posited a proposal early on in the process. The BIS proposal differed in significant ways from both the G22 proposal and Brown proposal in that it privileged a technocratic structure with an emphasis on international bodies. Its two-tier suggestion included a coordinative tier, consisting of IFIs and global regulatory groups without any national representatives, that would coordinate the activities of its members, set financial standards, and ensure compliance with these standards, and a larger, less significant group, consisting of national representatives, i.e., finance ministers, central bankers, and regulators, from emerging and advanced economies, IFIs, and global regulators that would lead broad discussions on global financial issues. The BIS had foresight and predicted that conflicts would arise concerning the appropriate involvement of national representatives. It reckoned that a forum without finance ministries in the principal, coordinative tier would not be welcomed by the USA, as their senior policy authorities, i.e., finance ministries, could not assume a leading role in defining regulatory standards. Such a structure could, in fact, result in adjustment costs for its industries imposed by independent organizations. In sum, the BIS and G22 helped Tietmeyer identify some key concerns to be addressed when drafting the proposal. The Bundesbank ultimately adopted a technocratic two-tier proposal, with an emphasis on international bodies. The proposal called for a chief, coordinative tier without any national representatives, whose membership would be composed of IFIs and global regulatory groups only, i.e., the IMF, World Bank, BIS, BCBS, IAIS, and IOSCO. This is important to emphasize, as such a coordinative tier would have had the authority to set financial standards and oversee implementation, with the overall intent of making its decisions politically binding in all countries. The proposal also called for a less significant tier to discuss broad financial policy, convening advanced and emerging economies, IFIs, and global regulators, which would replace ad hoc groups such as the G22. Yet, state governments cannot exert much influence in such a body, as the less significant second tier was in fact a debating society intended to increase the legitimacy of the entire FSF. Tietmeyer's proposal de-emphasized the role of national governments by instead championing the involvement of IFIs and global regulators that would have had the political authority to set global financial standards and oversee compliance. A senior Bundesbank official stated that this proposal was intended to avoid avenues that would permit states to pursue national interests, for the reason that powerful finance ministries, such as the US Treasury, often assume they can direct and delegate issues in global economic governance. The reasoning behind this proposal therefore follows this article's theoretical expectation that continental European states often try to constrain US power by championing the role of IFIs and making the work of global technocrats politically binding. Relatedly, continental European states do not necessarily benefit from a forum that would champion either finance ministries, i.e., due to a lack of bargaining power, or domestic regulators, i.e., due to fragmented authority structures. For this reason, Italy endorsed Tietmeyer's proposal. As an alternative to the Tietmeyer proposal, the USA drafted its own proposal emphasizing the role of finance ministries. The proposal advocated a one-tier forum, consisting of G7 country representatives, i.e., finance ministers, central bankers, and domestic regulators, IFIs, and global regulatory groups, with the option of including more members over time. The main rationale behind the US proposal was to privilege finance ministries, which, according to US officials, were needed for setting regulatory priorities, elaborating policy, and overseeing implementation. But what is the smoking gun that shows that the USA strongly favored the involvement of finance ministries? The remainder of this section explores this question by analyzing interview evidence from US government officials. In an interview, then Deputy Treasury Secretary Lawrence Summers noted, "The idea was to change regulation. So we thought if we have a bunch of regulators together, they would tend to reinforce each other in the status quo. We wanted to bring political energy and change to the process of international financial regulation so as to generate more action. The Treasury wanted to be in power with respect to this forum rather than further empower independent regulatory agencies, which we thought were a bit too independent anyway." Similarly, Donald Cohn, former vice chairman of the Federal Reserve, Fed, stated in an interview, "Global regulators and IFIs lack the necessary authority to accomplish effective global financial regulation without the political support of finance ministries. If there is no input by states in the process of regulation, then states are not willing to implement the output that global regulators propose." When interviewed, then Assistant Secretary of the Treasury for International Affairs Edwin Truman noted, "After the financial crises in the late 1990s, the Treasury thought that global financial regulation was too important to leave it to the technocrats. He also stated that the USA greatly influenced the development of global standards. That was the whole point, to promote and export US standards abroad. The US felt good about its standards and thought that it had already done enough. The compendium of standards was directed at other countries, which would benefit the US by leveling the playing field, but it would not impose any additional costs on the US. This suggests that the USA believed both that it already possessed superior financial standards ready to be exported and that the FSF would not impose any additional costs on the USA, but would instead target other states, especially emerging markets. As William Murden, the Treasury's Director of the Office of International Banking and Securities Markets, remarked, there was a need for international standards in many more areas and a need to convince countries to actually implement them. In an interview, he elaborated that it was the role of finance ministries that gave an extra push to this and elevated the importance of these standards for countries to follow. So the finance ministries bring policy perspectives to the FSF, and they could then urge and give higher profile to these 12 key standards. If they, finance ministries, had not been included, you would have had the status quo. You would not have had a bigger picture and you would not have had the linkage to the IMF. The finance ministries are the ones who can make the national commitment to meeting international codes and standards. For instance, it is the finance ministers that drove the work on the international standards, bringing those international standards together into a compendium and giving the commitment to implement them, a political level commitment. That's where finance ministries came in. Mark Sobel, the Treasury's Deputy Assistant Secretary for International Monetary and Financial Policy, echoed several of these concerns in an interview. He felt that it was critical to have country officials, including finance ministries, at the table, as they, not the IMF nor standard-setting bodies, were ultimately responsible for implementing global standards. He stated that the US Treasury felt it had to be at the table, because it was sharing costs and taking a leading role in addressing the Asia crisis through the IMF, and had to secure additional funding from Congress for the IMF as a result. Most fundamentally, the state-centered dimension of finance ministries was crucial for the USA in guaranteeing access to this forum in order to shape regulatory outcomes in its preferred direction, which neither domestic nor global technocrats could have guaranteed. As Clark underlines, the standards endorsed by the FSF tended to resemble the domestic regulatory status quo within the USA. While a forum with an emphasis on domestic regulators could have disadvantaged the USA, given its fragmented authority structure, a forum led by IFIs could have budged the USA away from assuming a leading role in formulating global standards. US officials were also concerned that some of their domestic bodies, such as the Fed, would not have had the authority to supervise and oversee securities and insurance markets. As such, including finance ministries provided an effective way to overcome domestic regulatory fragmentation and capture control of the forum, allowing the USA to use its political energy to set regulatory policy and oversee implementation. The US position, moreover, did not solely reflect that of the US Treasury. In fact, the Treasury has corresponded closely with the US President and Fed during the negotiations, all of which appeared to be on the same page. Although both Italy and Germany tried to convince the USA to adopt the Bundesbank proposal, US officials stressed that the country would not agree on the German proposal, so long as the proposal circumvented finance ministries. At this time, Germany and Italy lacked the necessary support from the remaining G7 states, including Canada, France, Japan, and the UK, to pressure the USA. In the case of France, the state supported the idea of a small body, consisting of IFIs and global regulators, an information exchange group similar to the coordinative tier in Tietmeyer's proposal. However, France did not support the creation of the larger tier in the Tietmeyer proposal that would bring together emerging and advanced economies. Instead, the country envisioned a strengthened interim committee at the IMF, or a strengthened joint forum. In the case of Canada, the state questioned the participation of finance ministries in a new forum and, instead, favored a different group that would be attached to the IMF. In the case of Japan, the state made clear that its view was in line with the US proposal, but remained a passive actor. In the case of the UK, the state initially emphasized the role of domestic regulators in its Brown proposal, as opposed to finance ministries, but it did not support the Bundesbank proposal, which, above all, privileged international bodies. Given that the UK lacked the bargaining power to push through its own proposal, the state then supported the US proposal. This is because UK officials feared that without any national representation, as presented in the German proposal, no actor would assume the responsibility to set financial standards and monitor compliance. Advancing global financial regulation would require some national input, as the UK did not want to provide other states the opportunity to slip away from their preferred standards. The divergence in state preferences among European states furthermore decreased the leverage of these states vis-à-vis the USA in international negotiations. Eventually, Tietmeyer reached an agreement with the USA that satisfied all US demands, which was then presented to the other G7 states. Both Italian and German officials concluded that a coordinative tier without any national representatives would have been preferable to the US proposal. However, they had to submit to US pressure, which led all other G7 states to agree on the proposal. As the largest and strongest economy, the USA was able to project a great deal of power and influence in the 1990s. This dynamic therefore suggests a go-it-alone outcome, as opposed to the publicized broad consensus. This agreement also highlights that the USA was able to both dictate the structure of and later influence this forum despite the state's fragmented regulatory structure. In fact, the USA exerted more influence than countries with unified structures such as the UK. As Sobel observed, basically, when you get down to the work that has to be done in the FSB, or in a standard setting body, the US plays a very key role. It is important that we do so, given that the US is the world's largest financial market and our strong interest in high-quality global standards. In that regard, it would not be feasible to promulgate global standards without having the US on board. As a result, US regulators and officials heavily engage with the international community, be it in standard-setting bodies, bilaterally or in multilateral fora, and in this way the US exerts a lot of influence, including behind the scenes. Similarly, Elke Koenig, the former president of the German Federal Financial Supervisory Authority, BaFin, noted in an interview that the FSB hosts broad membership among which the US as the largest financial market almost naturally is a powerful player. The counterfactual helps explore what might have been. If either IFIs or domestic regulators led the FSF, one might expect the adoption of financial standards that are not necessarily favorable to the USA. Such a structure could have resulted in relative losses in competitiveness of US financial industries. For this reason, the USA met proposals advancing such structures with considerable resistance. Including finance ministries in such a forum ensures that the USA can exert significant influence in setting standards and securing compliance. Given that all G7 members agreed on the US proposal, Tietmeyer prepared a final report, which proposed a forum that should meet regularly to assess issues and vulnerabilities affecting the global financial system and to identify and oversee the actions needed to address them. The forum would report to the G7 ministers and central bank governors. It would replace the series of ad hoc groups that have been convened by the G7 over the past few years with a view to strengthening the international financial system. The G7 finance ministers and central bankers adopted this final proposal in 1999. Initially, the FSF consisted of the finance ministries, central banks, and national supervisors of the G7, i.e., deputy level, a number of representatives drawn from IFIs and global regulatory groups, i.e., deputy heads or chairs, with the option of extending membership to non-G7 members. The architects of the FSF intended the institutional structure to be small and informal, with biannual meetings of the group and a small permanent secretariat at the BIS with staff drawn from the BIS and the participating international financial institutions. The FSF furthermore established three main working groups focused upon highly leveraged institutions, offshore financial centers, and capital flows, as well as two additional groups, an implementation task force and a deposit insurance study group, with a particular goal of promoting the harmonization of standards among international financial organizations and institutions. One of the FSF's main achievements was the elaboration of a compendium of standards of 12 core cross-sector standards in areas such as banking, securities, insurance, and financial reporting by its implementation task force. Yet, despite market pressures, emerging countries, in particular, often did not comply with these standards. This reality highlights some limitations of the FSF prior to its 2009 institutional reform. Still, as the FSF has driven the work of the international standard-setting bodies, it is often perceived as a rule-maker in the global financial system. Some might argue that the FSF's final design does not really constitute a state-centered network, for the reason that domestic regulatory agencies and international bodies are also represented at the FSF. Yet, both the empirical evidence above and scholarship on the FSF overwhelmingly demonstrate that the political clout of finance ministries, including their links to national leaders, and the G7 and G20 adds a strong political dimension and agenda to the FSF. As Koenig observed, by their very nature and mandate, finance ministries always and rightly so have a political agenda. The FSB as a forum where finance ministries, central banks, and supervisory authorities discuss and align their work adheres in its regulatory measures to the G20 political agenda. Scholarship on the FSF takes this view even further. As Walker notes, it could be argued that the FSF, was simply set up to allow the finance ministers to be able to follow and exercise more substantial control over developments in the financial market area. Similarly, Kennan et al. Argue that through the inclusion of finance ministers, the FSF brings political input into the setting of the agenda for international cooperation in the financial area. As German notes, the FSF is able to move no farther or faster than its powerful member states. According to UK officials, the USA prevented the FSF from doing work on its own by acting as a power of veto over the FSF. All this underlines that while the FSF shares the soft law characteristics of other regulatory networks, e.g., informality, non-treaty cooperation, etc., the distinguishing feature of this network is its state-centered political dimension. Others might argue that it is not entirely surprising that the G7, a body consisting of finance ministers, created a forum that included and privileged finance ministries. Yet, such criticisms overlook the fact that several states, including Germany, Italy, and the UK, intended to create a technocratic forum without much participation of finance ministries. Strikingly, Gordon Brown, then a finance minister, favored a technocratic forum that emphasized the role of domestic regulatory agencies and global regulators in his proposal, but not that of finance ministries. Similarly, the Bundesbank proposal, supported by the German and Italian finance ministries, championed the role of international bodies, but not finance ministries. This shows that government officials in finance ministries did not necessarily favor state-centered structures. There is also little evidence to conclude that national legislatures constrained actors involved in the negotiation process. Rather, the negotiations required a high level of technical expertise and did not touch upon issues of high electoral salience. For this reason, the negotiations could occur behind closed doors. Moreover, the FSF was not merely the result of the powerful global financial industry demanding harmonized standards, as there were not only considerable divisions within these industries reducing the sector's influence, but also opposition from G7 states to the inclusion of business representatives in such a forum. While states tried to foster the interests of their domestic industries, the FSF was not simply the foreordained product of global business. Finally, an alternative explanation for the state-centered dimension of the FSF might be that governments became more concerned about global financial regulation and assumed more direct political management after experiencing the financial crises of the 1990s. Yet, this cannot explain why several G7 members still favored technocratic structures over state-centered ones at the FSF. The creation of the FSF was also part of a larger effort to reform the global financial architecture in the late 1990s. Shortly after the creation of the FSF, the G7 established the Group of 20, G20, a state-centered group of advanced and emerging economies, to steer global financial policy. The G20 succeeded the ad hoc G22 and G33, which had convened to discuss ways of improving and reforming the global financial architecture as a result of the financial crises of the late 1990s. Interestingly, some early proposals for the FSF envisioned emerging market participation as part of a policy tier, which somewhat resembled what would eventually become the G20. However, emerging markets were initially not included in the FSF, despite their growing systemic importance in global finance. This left many emerging economies dissatisfied, as the global financial architecture did not properly represent them. The G20 was then designed to remedy some of these weaknesses. The FSF and the G20 are therefore linked as part of larger global financial reforms in the late 1990s. Central banks have been front and center in the fight against the Great Recession of 2008 to 2009. While scholars in political science have privileged how elected officials have responded to the crisis, they have rarely analyzed monetary policy, particularly not from a comparative perspective. This is surprising, given that major central banks entered the public spotlight when, in addition to lowering interest rates to effectively zero, they adopted multi-trillion-dollar quantitative easing, QE, programs to boost the economy. As part of these programs, central banks purchased large amounts of government and private sector bonds, which bloated their balance sheets to unprecedented levels, yet in very different areas. Why have some central banks expanded their balance sheets by buying large amounts of mortgage debt, while others have not? QE programs have significant distributive implications, as they support certain assets and markets over others, Jacobs and King 2018, Jones and Matthijs forthcoming. At a time when most QE programs are coming to an end, this article analyzes the variation in important QE programs of the Federal Reserve, Fed, and the European Central Bank, ECB, in the housing market. Housing is a particularly important target for central banks' QE programs, as mortgages are one of the largest asset classes in capital markets, Johnston and Kurtzer 2019, in this issue. The Federal Reserve, Fed, made headlines when it started buying massive amounts of mortgage-backed securities, MBS, in 2008, which cumulated to an astonishing amount of $1.7 trillion by 2018. In contrast, the European Central Bank, ECB, only marginally intervened in the housing market as part of its unconventional, large-scale QE programs, having purchased €290 billion in housing bonds by 2018. Even though both central banks have expanded their balance sheets to roughly equal degrees and experienced problems in their housing markets, the Fed has provided extensive monetary stimulus for housing, while the ECB has not. Housing interventions by central banks have often overlooked distributive consequences, as these programs tend to stimulate private housing markets by lowering the cost of mortgage debt and increasing house prices. This led Kevin Warsh, a former Fed governor, to label them fiscal policy in disguise. While fiscal considerations may not be the primary objective of these policies, Binder and Spindell correctly note that these programs blur the boundary between monetary and fiscal policy. When central banks purchase large amounts of mortgage debt, they create winners and losers in the economy, where the former benefit from inflating house prices and the latter face increasingly unaffordable property markets. More generally, many have criticized QE for contributing to soaring asset prices that benefit the rich, for reinforcing wealth inequality, and for producing financial instability, all of which increase the political scrutiny of central banks, Jones and Matthijs forthcoming. This article argues that central banks are embedded in macroeconomic growth models, which shapes the variation in monetary stimulus for housing. The United States has a consolidated growth model that is consumption and credit-based, in which the integrated, well-developed housing finance market is a key sector for producing economic growth. In contrast, the Eurozone contains greater diversity within its growth model, some based on exports, others on domestic demand, in which nationally fragmented, less developed housing finance markets are not universally driving growth. As a result, the Fed targeted housing as a monetary transmission strategy to stimulate the core elements of the U.S. growth model: credit, demand, and consumption. In contrast, the ECB hardly stimulated housing because of the incompleteness of Eurozone housing capital markets and the fact that stimulating housing and consumption creates macroeconomic frictions with some powerful Euro members, particularly export-oriented Germany. Following a comparative sequential approach, this article systematically compares the different responses of the Fed and ECB during and after the Great Recession by evaluating evidence from primary archival material, author interviews with central bankers, and public records. This empirical strategy helps explain the policy differences by tracing the preferences and decision-making processes of central bankers in the two institutions. The article concludes with larger implications for how to think about the welfare state, the politics of central banking, and economic policy in hard times. Following a comparative sequential approach, this article systematically compares the different responses of the Fed and ECB during and after the Great Recession by evaluating evidence from primary archival material, author interviews with central bankers, and public records. This empirical strategy helps explain the policy differences by tracing the preferences and decision-making processes of central bankers in the two institutions. The article concludes with larger implications for how to think about the welfare state, the politics of central banking, and economic policy in hard times. The politics of QE, central banks, growth models, and housing finance. In response to the crisis, central banks have adopted an array of unconventional measures. When short-term rates approached zero, without producing signs of economic strength or meeting inflation targets, central banks started buying large amounts of assets in the open market, such as government or private sector bonds. This practice is known as QE and has significantly expanded the balance sheets of major central banks. The goal was to boost the economy by increasing the reserves of private banks, raising asset prices, and reducing long-term interest rates, which would then stimulate bank lending, investment, consumption, and growth in the economy. By the end of 2018, the ECB and Fed have adopted QE programs that contributed to the expansion of their balances sheets to astonishing amounts of €4.7 trillion and $4.1 trillion, respectively. The housing sector is a prominent target for central bank intervention given its large asset markets for mortgages. Central banks can buy large amounts of housing assets in the secondary market, such as MBS, asset-backed securities, ABS, or covered bonds, which has the effect of increasing the price of the purchased asset and lowering its yields. One mechanism is the signaling channel, suggesting that housing bond purchases signal strong commitment to mortgage markets, which then drives down the risk and yields of these bonds. Another is the portfolio rebalancing channel, suggesting that asset classes are imperfect substitutes in an investor's portfolio, owing to market frictions and regulatory constraints, such that large-scale asset purchases of housing bonds reduce the supply and increase the demand of these bonds in the open market, which then raises their prices and lowers their yields. As the yields of housing bonds and mortgage rates are linked, i.e., mortgages are often securitized, mortgage rates tend to fall along with the yields on housing bonds. If mortgage rates fall, this tends to increase housing demand, prices, and mortgage lending, which in turn stimulates consumption in the larger economy. This is partly because increasing housing demand and prices boosts the wealth of households and eases their credit constraints, which then stimulates household borrowing and consumption. Yet, little is known about why the Fed and ECB differed in offering monetary stimulus for housing as part of their balance sheet expansions. Lombardi and Moschella correctly note that designing asset purchase schemes presents policymakers with a number of alternatives, including to what extent and in which markets to intervene. As Figure 1 demonstrates, the Fed intervenes strongly into the housing market by buying and holding up to $1.7 trillion in MBS by the end of 2018, which constitutes 41% of its balance sheet, $4.1 trillion. In the same year, the ECB has only bought and held €290 billion in housing-related assets, such as covered bonds and ABS, constituting 6% of its balance sheet, €4.7 trillion. Existing scholarship has rarely focused on the political foundations of unconventional monetary policy. First, the central bank literature in political science, with its traditional focus on central bank independence and economic outcomes, has had little to say about QE. Scholars in economics have studied unconventional policies, but not explored the politics of how and why central banks adopt them. While economists have shown that monetary stimulus for housing can have transmission effects for the larger economy, they have not investigated why central banks differed in their housing bond programs and their decision-making processes. Second, studies on economic policy in hard times, such as by Farrell and Quiggin, have convincingly shown that the initial comeback of expansionary fiscal policy during the Great Recession quickly gave way to austerity-led policies shortly after the crisis. Yet, these studies have not taken into account that central bankers defied this trend by engaging in continued expansionary monetary programs that have outlived their fiscal counterparts. Central banks' balance sheets have remained unprecedentedly large even 10 years after the crisis. Indeed, Mandel-Kern does take into account fiscal and monetary policy during the crisis, arguing correctly that the policy responses among central banks were strikingly similar in their expansionary focus, but he does not explore the different ways in which central banks have expanded their balance sheets. Third, Lombardi and Moschella offer a promising account for explaining the different crisis responses of the Fed and the ECB, arguing that their different institutional designs explain the variation in monetary stimulus. More specifically, they argue that the ECB's decentralized decision-making structure as opposed to the Fed's more centralized structure, by which they mean that national central banks have important channels of influencing the ECB's decision-making, whereas regional reserve banks have limited influence over the Fed's monetary policy, made it more difficult to adopt large-scale bond buying programs for the ECB. Yet, despite their different institutional designs, the Fed and the ECB have expanded their balance sheets to similar degrees, but in different ways. While illuminating, the constraints and opportunities of central bank action go well beyond their institutional features, such as the larger macroeconomic structures that shape the strategies and actions of central banks. Relatedly, one might argue that the answer lies in the different legal mandates of the two banks or different natures of the crisis on both sides of the Atlantic. While the ECB has a narrow mandate based on price stability, the Fed's mandate encompasses both price stability and full employment. These legal foundations are certainly important, but they cannot account for why both central banks have expanded their balances sheets to equal degrees, yet with differing expansions in housing. It is also fair to say that the Fed and ECB face different crises, requiring different policy tools. The Eurozone crisis had multiple sources in the sovereign debt, housing, and banking markets, whereas the crisis in the United States originated in housing finance and spread through the financial system. Yet, such a view is better at explaining why the Fed initially bought housing bonds as a direct crisis response in 2008 to 2009 than why it has bought and retained housing bonds long after the worst of the crisis was over. In both cases, the larger point of QE was to stimulate the economy, which begs the question as to why the Fed has picked housing to achieve that goal, whereas the ECB has not. What these accounts are overlooking is the fact that the structure of the economy matters greatly in influencing monetary policy. Advanced economies depend on different sectors to generate growth. As a result, and for all the official claims of neutrality and independence, different central banks promote different markets with the aim of bolstering growth. This article argues that macroeconomic growth models explain the variation in monetary stimulus for housing since the Great Recession. This study builds on a growing body of research on growth models, emphasizing particular components of aggregate demand, such as household consumption and exports. This article places the housing sector more centrally into growth model research, showing that central banks, tasked with securing optimal macroeconomic performance of growth models, have intervened in the sector to transmit monetary policy and stimulate growth. Yet, their decisions to intervene depend greatly on the degree to which housing is a monetary transmission sector for the growth model. While housing tends to be a transmission belt in consumption and credit-led economies, where rising housing prices and growing credit tend to stimulate private consumption, the sector is much less central to export-oriented growth models, where price stability in the housing market is a priority to avoid inflationary consequences. This study concurs with earlier insights on how monetary policy is shaped by larger macroeconomic structures. Hall and Franzese, for instance, have convincingly argued that economic institutions, such as collective bargaining structures, can reinforce monetary policy. For instance, the German Bundesbank's efforts in keeping prices stable were significantly aided by the country's wage bargaining system that kept wages low. Where Hall and Franzese focus on wage bargaining, this article looks at how larger growth models, and the role of housing within them, shape monetary policy. In the United States, monetary policy is conducted in the context of its consumption-oriented growth model in which housing is a major engine to produce growth. Housing occupies a central position within the U.S. growth model, given the sector's ability to stimulate the core aspects of the model: private demand, credit, and consumption. The central position of housing to the U.S. economy has not been lost on central bankers and monetary economists, who have long emphasized that the Fed can target housing as a monetary transmission strategy to generate growth. First, the U.S. housing finance market is integrated, standardized, and well-developed, which allows for large-scale interventions in this market. The most important sources of mortgage funding are MBS in the secondary mortgage market valued at $6.5 trillion. The mortgage market itself is characterized by high degrees of liquidity, liberal lending terms, e.g., low down payments, high turnover, and strong government support. Second, the integrated and well-developed nature of housing finance makes it an important sector for transmitting monetary policy. In a first step, large-scale housing bond buying programs tend to lower mortgage rates through the signaling and portfolio rebalancing channels. In a second step, lowering rates tends to stimulate housing demand, credit, prices, and consumption, as it eases the credit constraints and boosts the wealth of households. Concomitantly, monetary stimulus for housing, supporting mortgage debt, home ownership, and housing wealth, ties in with the country's larger strategy of mortgage Keynesianism and privatized welfare. In the Eurozone, monetary policy is conducted in the context of diverse national growth models where fragmented, less developed housing markets are less central to fuel economic growth. First, European growth models are divided into largely two camps: consumption and export-oriented models. While export-led economies are largely found in Northern Europe, including Germany, Austria, and the Netherlands, consumption-led economies are located in Southern Europe, such as Spain, Greece, and Portugal. Unlike in the United States, stimulating housing, credit, and consumption is no universal growth strategy for all European economies. Johnston and Regan show that in countries with strong wage bargaining, usually export-oriented economies, i.e., Germany and Austria, house price growth and housing booms was restrained, while in countries with lower wage coordination, i.e., Ireland and Spain, housing markets had stronger momentum in recent decades. As a result, housing transmits monetary policy much less in the Eurozone, particularly within its largest economy, Germany. Concomitantly, the housing finance markets of the Eurozone are more fragmented and less developed when compared with their American counterparts. Covered bond markets in the Eurozone are important elements of the area's capital market, amounting to a volume of €1.4 trillion in 2016, yet a number much lower than the integrated US MBS market. Just before the euro crisis, the largest covered bond markets were found in Germany, €720 billion, Spain, €352 billion, France, €327 billion, and Ireland, €80 billion, while Poland's was merely €700 million. In addition, European mortgage markets also vary when it comes to loan-to-value ratios, transactions costs, and government subsidies, Schwartz and Seabrook 2008. While the German mortgage market is highly conservative, with high down payments, transactions costs, and few subsidies for homeowners, other Eurozone mortgage markets, such as those in Spain or the Netherlands, are more lenient and offer significant subsidies. The fragmented nature of housing finance markets reflects the incompleteness of European capital markets and makes monetary transmission through housing difficult. Yet, even under conditions of integrated European covered bond markets, it would have been unlikely for the ECB to intervene extensively, given the frictions between growth models within the Eurozone, as debtor states tend to be consumption-oriented, while creditor nations are largely export-oriented, holding greater sway in the management of the Eurozone. In sum, we would expect the Fed to adopt monetary stimulus for housing as a growth and transmission strategy to stimulate the economy, whereas the ECB should engage in limited monetary stimulus for housing, as it is not a central transmission sector for the Eurozone. During and after the crash of 2008 to 2009, the Fed initiated multi-trillion-dollar bond buying programs in the housing area that were central elements of the country's QE program. The Fed viewed housing as the source of macroeconomic distress and as a transmission sector to kick-start growth in the wider economy. Running out of conventional options at the zero lower bound, the Fed deployed monetary stimulus for housing as a growth strategy designed to lower mortgage rates, stimulate housing demand and prices, and consumption in the wider economy. By 2018, the Fed has bought and held $1.7 trillion in MBS, roughly one quarter of all MBS in the United States. In late 2008, the Fed started supporting housing in order to kill two birds with one stone, fixing the core source of the crisis and generating consumption in the economy. The first round of QE included asset purchases of $500 billion in MBS backed by the government-sponsored housing enterprises Fannie Mae, Ginnie Mae, or Freddie Mac. In a press release, the Fed stated that the objective of these programs was to stimulate housing, so as to reduce the cost and increase the availability of credit for the purchase of houses, which in turn should support housing markets and foster improved conditions in financial markets more generally. In an interview, a former senior Fed official noted that housing was a key sector through which monetary policy could be transmitted. By purchasing mortgage-backed securities, the Fed was trying to influence the flow of credit and faith in the housing markets. I saw that the problems with the mortgage markets were a real impediment to easing monetary policy and the transmission of easing monetary policy. It was an important channel for monetary policy, important in and of itself and because it was the area causing problems. So if you could stabilize the housing market, it would help stabilize the financial system. I think the Federal Reserve had identified the weakness in the housing market and the lack of a bounce back in the housing market as one of the primary factors holding back the economic recovery. The Fed then initiated these housing bond purchases under then Fed Chair Ben Bernanke, whose academic work on the Great Depression and monetary policy at the zero lower bound demonstrated that housing finance has important intermediary functions for aggregate demand. In the early years of the crisis, the Fed's QE measures started with large-scale interventions in the housing market. Most members of the Fed viewed these programs as sound economic and even social policy, reinforcing fiscal measures aimed at helping homeowners. In internal staff memoranda, Fed economists highlighted that MBS buying programs would help homeowners in a number of ways. First, they stated that these programs would tend to lower mortgage rates, helping distressed and affluent homeowners refinance their mortgages at better rates. Second, they would also allow new buyers to enter the housing ladder at historically low mortgage rates. And these programs would stimulate house prices and stabilize the housing wealth of ordinary people, allowing homeowners to tap their housing equity for consumer spending. While the primary objective of the Fed in 2008 was to stimulate the country's housing market and economy, it did so with an eye to social policy objectives of helping homeowners hard hit by the crisis. Within the Fed, most central bankers were not overly concerned with the market-distorting effects of these programs, but there was some disagreement. Despite channeling funds into housing, and thereby privileging housing over other sectors, the majority viewed this as a necessary evil to stimulate the economy. In an internal memo, staff economists noted that this policy tool would tend to skew credit allocation toward one sector of the economy, something that would be unusual from a historical perspective. Nonetheless, some distortion of credit allocation may be an acceptable price to achieve the Federal Reserve's dual mandate of maximum employment and price stability. In an interview, the senior Fed official expressed that there was discomfort, for sure, with the idea that the Federal Reserve was allocating credit to particular a sector, housing. Some of the Reserve Bank presidents, in particular, worried that this would set a precedent and Congress would come to us for other things. I didn't see it as that big of a threat. I saw it making policy more effective. The Fed official raises the issue of internal opposition to these programs by some presidents of the regional banks. For instance, Charles Plosser, then president of the Philadelphia Fed, voiced concern that these programs would invite pressure from politicians and interest groups. We will get pressure from various interest groups to retain certain assets. We will certainly, in all likelihood, get calls from consumers, builders, and congressmen if we start to sell mortgage-backed securities out of our portfolio in order to reduce its size. We will hear fears that the mortgage rates may rise. The president of the Dallas Fed, Richard Fisher, noted that, "I don't believe that we should be in the business of financing housing. I think that is a matter for the Treasury and for other authorities, and I would like to get out of that business as quickly as possible." He went so far as to call the practice of buying housing bonds social engineering. Jeffrey Lacker, president of the Richmond Fed, stated that the Fed's housing programs would distort credit allocations in the market and perpetuate this really corrosive political economy in our country of tapping government resources to subsidize the housing market. In an op-ed, he elaborated that it is as if the Fed has provided off-budget funding for home mortgage borrowers. These few dissenting voices went unheard. The clear majority within the Fed viewed housing as the key impediment holding back the U.S. economy, a conclusion that paved the way for additional housing bond purchases. Shortly thereafter, the Fed started its second and third rounds of QE to support housing and the larger economy. First, in 2010, the Fed introduced an asset purchase program that included $600 billion in Treasury bonds acquired with the goal of bringing down overall long-term interest rates, not just mortgage rates. Second, in 2012, it started a third and final round of QE. Its monthly purchases of $40 billion in MBS and $45 billion in Treasuries were designed to put downward pressure on longer-term interest rates, support mortgage markets, and help to make broader financial conditions more accommodative. Fundamentally, the decision to buy housing bonds was not preordained but rather a deliberate choice by central bankers. When asked about why the Fed did not exclusively expand its balance sheet in U.S. Treasuries, an alternative strategy some regional central bankers considered less risky and more neutral, a staff economist at the Fed responded in an interview that the Fed bought MBS as part of a continued effort to revive housing, depressed levels of which still held back the economic recovery, and thereby to stimulate the larger economy. Consequently, the Fed initiated further purchases to bring down mortgage rates, encourage home purchases, mortgage refinancing, and consumer spending. By 2014, the Fed's housing bond holdings expanded to $1.8 trillion. In response to some optimistic economic data, the Fed ended its balance sheet expansion with the so-called tapering of asset purchases in 2014, while retaining its balance sheet holdings until 2018. Since 2018, the Fed has slowly started to wind down its holdings of housing bonds, but will not necessarily reduce its balance sheet to pre-crisis levels. In terms of pace, the Fed is likely to avoid sudden market shocks and adopt a long-term strategy of wind down. In terms of size, it will likely retain housing assets, which would give it more flexibility to transmit monetary policy. While the Fed's balance sheet expansion started as crisis relief, its large balance sheet is now firmly part of a broader, post-crisis policy toolkit. In sum, the Fed purchased large amounts of housing bonds to stimulate housing and the larger economy as part of its QE programs during and after the Great Recession. Reviving housing meant supporting the heart of the American growth model of credit and consumption, deeply connected with other key sectors of the U.S. economy, as well as homeowners hurt by the crisis. Housing was not only holding back the economic recovery, but also the key sector through which monetary policy could be transmitted to stimulate the country's consumption-led growth model. The result was that, by 2017, the Fed's balance sheet expanded to $4.5 trillion, including $1.8 trillion in MBS and $2.5 trillion in Treasury bonds. In response to the crisis, the ECB also adopted unconventional programs to stimulate the Eurozone, but it supported housing much less relative to the Federation. This is because monetary programs to stimulate housing and consumption do not reinforce the heterogeneous growth models of the Eurozone, some of which rely on exports, others on consumption. Unlike in the United States, housing is not a key driver of growth in most Eurozone countries, most notably not within its creditor states. For instance, export-oriented Germany does not privilege stimulating private consumption and housing as part of its growth model, but instead relies on price stability, wage and credit restraint, and savings. In such a model, increasing housing prices is cause for alarm rather than satisfaction. The German and Dutch central banks already sounded the alarm about overheating housing markets in their countries. Both central banks have promoted a conservative approach to large-scale asset purchases, so as to maintain price stability, market discipline, and financial stability. Relatedly, The fragmented nature of European housing capital markets made monetary interventions in housing more difficult when compared with its integrated US counterparts. As a result, the ECB has bought only €290 billion in covered bonds and ABS by 2018. The ECB started its first covered bond purchase program in 2009, when the crisis hit European banks and the covered bond market started to dry up. To stabilize that market, the ECB initiated its first purchase program by buying €60 billion in covered bonds until 2010. Shortly thereafter, in 2011, the ECB initiated its second covered bond purchase program, which amounted to merely €16 billion until 2012. Although the ECB had targeted purchases in the amount of €40 billion for the second program, it prematurely stopped the program, because the ECB feared squeezing out investors and the covered bond market had already been recovering. Yet, these asset purchases only had a limited effect on housing markets. On one hand, these programs were minuscule in size when compared with those of the Federation. On the other, covered bonds are not exclusively backed by housing, but also by other forms of collateral, such as ships, airplanes, or public sector loans. In the case of German covered bonds, the ECB bought €8 billion in bonds covered by German mortgages and €11 billion in bonds covered by German public sector loans between 2009 and 2012. Moreover, as each member bank of the Eurosystem purchased an amount of covered bonds equivalent to its capital key within the ECB, Spain and Ireland, home to some of the largest covered bond markets in the Eurozone, purchased only moderate amounts of bonds. The direct impact of these asset purchases on housing markets is therefore limited. The rationale for these early purchases was to reactivate the European covered bond and interbank markets, but not to stimulate housing. While European housing markets have partly benefited from these purchases, one senior ECB official called this collateral benefit in an interview. It was not the ECB's objective to provide specific support for housing. Instead, as Francesco Papadia, the ECB's former Director of Monetary Operations, put it, the ECB purchases were not targeting a reduction of long-term yields but rather tried to remedy a market dysfunction in the covered bond segment. On the comparison with the Fed, a senior ECB official elaborated that, "Our goal was not to fix the housing system, but to help the banking and financial system." Another ECB official stated that, while stimulating housing might increase consumption in the US economy, the same would not be true in Europe. Quantitative easing in the United States works through the wealth effect, increasing private consumption and producing stronger growth. And we don't have this effect in Europe. We don't have a market-based financial system, we have a bank-based finance system. Our transmission channel works through the banks. Yet another ECB official echoed that these programs were designed to revive the banking system and parts of the capital market, but not to stimulate housing. It was not so much helping real estate, it was more about helping banks and also helping the biggest private sector bond segment in Europe. I don't think you can say that the housing sector, in the case of Europe, was an objective at all. Indeed, there are some who say that, in some places, we are seeing again something of too much enthusiasm for real estate, for instance in Germany. The Germans agreed. The Bundesbank repeatedly sounded the alarm, when German house prices increased in the years following the crisis, considering overvalued house prices as a source of financial risk partly caused by loose monetary policy. The ECB initiated its third covered bond purchase program in 2014, and shortly thereafter, launched its first ABS program, but again the ECB did not show much interest in boosting housing. The goal of these programs was to ease monetary conditions by providing liquidity for financial markets in times of ultra-low interest rates and deflationary pressures. By January 2015, the ECB had added another €30 billion in covered bonds and €1.8 billion in ABS to its portfolio. Yet, as Papadia noted, it is clear that the ECB has no intention to favor the housing sector, which in countries like Germany may already be too lively. Similarly, a senior ECB official noted that the then most recent round of covered bond purchases had been launched in the context of QE-like thinking, that you wanted to increase the balance sheet, inject reserves, and then you're just looking for assets you can buy. Still, boosting housing was not a priority in implementing the third covered bond program. In general, the difference between the earlier and later programs is that the former were designed to reactivate the covered bond market that had dried up in times of financial turmoil, while the latter were designed to inject liquidity in financial markets in times of deflationary pressures. Has housing played a greater role when the ECB adopted a more extensive version of QE between 2015 and 2018? In 2015, the ECB started purchasing assets in the amount of €60 billion per month, including sovereign bonds, covered bonds, ABS, and, later on, public sector securities and corporate bonds. The ECB's QE program incorporated and extended the already existing covered bond and ABS programs into its larger bond buying scheme. According to the ECB, the new QE program was designed to stave off deflation and ease monetary and financial conditions, making access to finance cheaper for firms and households, so as to stimulate investment and consumption. While the ECB briefly expanded asset purchases to €80 billion per month in 2016, with the goal of raising inflation, it reduced its purchases to €60 billion in 2017, €30 billion in early 2018, and €15 billion later in 2018, given some optimistic economic data and the political limits of these programs. In early 2019, the ECB stopped its asset purchases and quantitative easing, yet retaining its balance sheet holdings for an extended period of time. More importantly, the ECB's balance sheet expansion was mainly driven by assets and tools outside housing, such as public sector securities or refinancing operations to stimulate the interbank lending channel. Given the limited amounts that the ECB has bought in covered bonds and ABS, this did not create much controversy. While these programs did little to stimulate economic growth, Braun correctly notes that they have strengthened the Eurozone securitization and covered bond markets, signaling investors that the ECB is supporting these asset markets. These actions have contributed to the wider efforts of building a capital markets union, of which the ABS and covered bond markets are key pillars, in an attempt to unify Eurozone capital markets and financial markets. Much more controversial were the ECB's decisions to buy sovereign bonds and its larger QE program, triggering heated debates between national central banks, finance ministries, and the media. First, as the Eurozone does not have Eurobonds equivalent to US Treasury bonds, attempts by the ECB to buy sovereign bonds of its member states generated the criticism of offering monetary financing for governments. Second, the Bundesbank and Dutch central banks criticized QE for creating financial instability, undisciplined markets, and misallocated resources. The hawkish members of the Eurozone in particular viewed providing monetary assistance for specific countries or sectors as inappropriate. These conflicts reflect some deeper macroeconomic frictions between the ECB's loose monetary policy, including asset purchase programs, and the German growth model. The German Bundesbank and Finance Ministry have been among the most vocal critics of ultra-loose monetary policy. First, the Bundesbank has argued that loose monetary policy would produce asset bubbles and financial risk, such as an overheating German property market. Andreas Dombret, a Bundesbank official, noted that the mixture of booming real estate market and low interest rates can become a dangerous cocktail for the banking and savings bank sector, quoted in Deutsche Welle 2017. Second, German politicians across the political spectrum have criticized QE and ultra-low interest rates for hurting savers, who have collected lower interest on their deposits since the crisis. Third, while QE tends to weaken the euro, which should help export-oriented economies, German exporters have viewed these policies as artificial, detached from market fundamentals, and threatening currency stability. In sum, QE programs that stimulate housing, hurt savers, and create uncertainty about currency developments create frictions with Germany's export-led model. This stands in stark contrast to central banks faced with collapsing house prices and high private mortgage debt, such as those in Spain and Ireland, favoring QE asset purchase programs. Patrick O'Nohan, then governor of the Irish Central Bank, remarked that QE was an unmitigated plus for the Irish economy, partly because it helped the country's public finances and alleviated the pressure of homeowners, as they will find it possible to do things they were not able to do because they were scrimping and saving to pay. He also acknowledged the macroeconomic frictions between QE and some Eurozone economies, as countries in which the saving constituency is very dominant are not clear that they like quantitative easing at all, with zero interest rates on their savings. Similarly, Luis Maria Linda, governor of the Bank of Spain, praised QE and stated that its estimated impact is superior in the case of public debt and covered bonds. Central banks with problems in their housing markets viewed QE and asset purchase programs more favorably than the Bundesbank. In sum, the ECB purchased only moderate amounts of housing-related bonds as part of its QE programs. This is partly because housing is not a transmission sector for major European economies, such as export-oriented Germany or the Netherlands, where rising house prices are viewed with skepticism. Relatedly, the capital markets for mortgages are more fragmented when compared with their US counterparts, which made effective housing interventions by the ECB more difficult. The most salient conflicts over QE in the Eurozone revolved around whether the ECB should buy sovereign bonds, but much less about the targetability of economic sectors, such as housing. For several decades, it was highly unusual for German economists to quote Friedrich Engels in a study, and not as a dead dog, but as an analyst to be taken seriously. However, the Bonn-based group of authors led by Moritz Schularik, the young star of economics, FAS, the 12th of February 2017, who refer to Engels' work on the housing question in their latest study The New Housing Question, are by no means alone in this. The study, published in June 2019, can be found online at www.macrohistory.net. In the introduction, the authors quote the following passage from Engels' series of articles published in 1872 in the journal Der Volksstaat, in which he polemicized against an author who wanted to transfer Proudhon's myth of just exchange and the evil interest rate to the real estate market. What is understood today by housing shortage is the peculiar aggravation which the poor housing conditions of the workers have suffered as a result of the sudden rush of population to the big cities. A colossal increase in rents, an even greater crowding of inhabitants into individual houses, for some the impossibility of finding shelter at all. The term housing issue, which has long seemed antiquated, has become commonplace again, at the latest since displacement and sellouts, left party, have undeniably reached Berlin, a city in which the local income level now bears no objective relationship to the local rent level, especially for new lettings, a city of notoriously precarious working and living conditions whose only significant and internationally sought-after product is residential real estate, if one disregards the area. Wide supply for international disinhibition tourism. This real estate boom represents a development for the city that is as novel as it is spectacular in a negative sense, as Berlin was still considered a renter's paradise until after the turn of the millennium, with the western part of the city benefiting from a legacy of practiced social democracy and the eastern part from that of real socialism. In the years following the collapse of the GDR, the state of Berlin owned no fewer than 482,000 rental apartments, almost half of which were sold off to private holdings in the first years of the Red Senate from 2002 under the leadership of Finance Senator Thilo Sarrazin, SPD, and Economic Senator Harold Wolff, Left Party, then still PDS. The fact that it still took a few years before rents began to approach those in Frankfurt or Munich was partly due to the fact that at least the starting level of rents in Berlin was low compared to the rest of Germany. A late effect of the fact that rent control for old buildings, including private ones, dating back to the post-war decades had been in place in the western part of the city until 1988. In the eastern part, even more restrictive rent control was in place until October 3, 1990. Berlin is thus shaping the debate on the new housing question not only because of its status as the immediate vicinity of the government district and thus the main location of the ideological state apparatuses, if you will, but also and above all because it forces together in sharp contrast the two divergent types of urban development and investment allocation that post-industrialism produces, not only in one city, but even in one city-state. In this respect, Berlin differs from Munich and Frankfurt, and, of course, from London or Paris anyway, whose average income levels are significantly higher on the one hand and whose precariat, i.e. the working class and lower middle class milieux that have slipped into the service sector and or state support, were pushed to the outskirts and surrounding areas much earlier in a process that has been ongoing for several decades. In Berlin, on the other hand, opposites meet in spatial and administrative densification. The typical boomtown of the so-called creative industries meets the typical flyover city with its €1 stores and betting shops. The NGO economy, which needs the local proximity to the administrators of the funding pots like the impoverished nobility once needed to stay at court, meets the Naples economy of money laundering, brand fraud and snack bars, which needs extra-legal clan structures and closed, preferably Islamic counter-societies because it thrives best in them. Real estate boom meets wage slump, international demand meets local decline, with the result that everyday life in Berlin presents itself as an unpleasant hybrid product of the divergence of cities and regions that is effective throughout the Western world, as the worst of both worlds, so to speak. The fact that the convergence of living conditions between the regions of Germany and Europe, which characterized the first post-war decades, has long been history, and that developments since the 1980s have been moving in the opposite direction, is now hardly denied even in the business section of rather conservative newspapers, just as little as the fact that the economic growth of recent decades has almost exclusively increased existing wealth, while labor income has not benefited in the least. The long-held doctrine of the trickle-down effect, which states that what is given to the rich will eventually trickle down to the poor, is now openly proving to be the lie that it has become in the globally producing and consuming capitalism of the new international division of labor. The Bonn study on the new housing question also does not close its eyes to what could be called the class character of the real estate boom and already asks in its subtitle about the winners and losers of the German real estate boom. As the authors of the study rightly point out, the rapid increase in the value of real estate in cities and regions where people are moving to is escalating the already relatively pronounced inequality in the distribution of wealth in the tenant state of the Federal Republic. Earned income is being squeezed, while rentier income is being boosted. Nevertheless, both the explanations of the new character of the housing issue and the proposals for remedying it clearly and significantly fall short, as do the proposals of all those who simply call for more publicly subsidized construction activity but do not want to face up to the profound need for intervention and regulation that is inextricably linked to the housing issue today. The authors simply state, the rising rents show that there is a clear shortage of housing beyond speculative exaggerations on the real estate market. This is not due to the low interest rate environment, but to the fact that construction activity has been too low for many years, and they logically complain that the public sector has failed for a decade to take advantage of the favorable financing conditions on the capital markets for higher investment in housing construction and infrastructure. The fact that net public investment remains negative at a time of extremely low or even negative real interest rates is not evidence of sound budgeting, but a potentially costly economic policy oversight. End quote. This is not entirely wrong, but it is also far from the truth in both arguments, in the opportunity that lies in low interest rates and in the diagnosis of a physical shortage of housing. There is no doubt that low interest rates make it easier to take out a loan and therefore reduce the amount of equity required by the builder. However, this assumption obscures the fact that building is by no means made cheaper by easier borrowing, rather the opposite. If investors flee into the construction business and at the same time tenants flee from rising housing costs into property, building and land prices will rise rapidly. But even this is only a reinforcing effect of the new real estate boom. Rather, it stems from the crisis of the new international division of labor, which since the late 1970s has drawn its profitability from new and significantly cheaper transport and logistics options. This has made it possible to relocate large parts of industrial production and thus achieve previously unthinkable radical wage savings. The effect of the radical reduction in wage levels in the course of globalization far outweighed the tax burden for social spending in the countries of the corporate headquarters. Even the restriction of purchasing power through falling wages or the switch to wage replacement benefits in Western Europe and North America initially exerted little pressure on average profit rates in the period from the 1980s to after the turn of the millennium, because globalization also brought with it a rapid reduction in the price of essential goods, the sum of which, as is well known, makes up the cost price of the living workforce, which now has to be fed and exploited at the same time. While interest rates shot up at the beginning of this development, particularly in the pioneering countries of the USA and Great Britain, because the new economy without unruly trade unions and dream wages in the second and third worlds promised high profits, in which money capital participated with high lending fees, i.e. interest, the situation is quite different at the end of the era of industrial relocation. This is because low interest rates, especially low-key interest rates permanently frozen by central banks, are an unmistakable indication of poor profit prospects for the capital invested. According to Marx's argument in the third volume of Capital, the interest rate represents a process of independence of money capital from the industrial capital employed. Money capital becomes a sui generis commodity whose price is interest. The fixing of this price thus determines the level of utilization of money capital. In any case, the average rate of profit is to be regarded as the final determining maximum limit of interest. Marx put it in a nutshell in the third volume of Capital. The low interest rates of the past decade are first and foremost an expression and consequence of the fact that the juicy increases in capital yields that could previously be achieved by relocating the former core industries to the very near European and very distant Asian East will no longer be available in the future. For some years now, it has once again become apparent, now on a global scale, that the wage earner is also the consumer of goods, the cost factor is also the buyer. What is taken from one will be missing from the other. The direct cause of the current European low-interest policy, which took shape in 2008 in the wake of the Greek crisis, was the immense national debt ratios of several member states, whose budgets would probably have collapsed without the possibility of interest-free loans. In effect, the national budgets of the Eurozone are being subsidized by cutting the savings of private depositors. This forces them either to make riskier investments or to participate in the real estate boom. The days of guaranteed participation in stable corporate profits are over. Compare to the tenor of newspaper commentaries on the end of Mario Draghi's term of office as head of the ECB, for example in the FAZ, the 7th of March 2019. The profit squeeze, as it was called in the 1970s and from which the industrial clear-cutting in the West was supposed to lead capital, is now being felt again on an enlarged scale in various forms. Be it that the extended workbenches of yesteryear are turning into serious competitors, as in the case of China. Be it that the rising wage demands of second and third world proletarians, now cut off from subsistence, are beginning to gnaw away at profits. Be it that the free-floating, digitally available global supply of goods is now not only eroding trade margins and circulation markups as it once did for grocers and small industrialists, but now also for corporations with big brand names. Low interest rates and the metropolitan real estate boom are therefore linked. Both are symptoms of a global tendency for investment capital to migrate into the field of property income. Both are consequences of the fact that returns in the real estate business have in principle outstripped those that can be achieved with investments and shares. This in turn means that, as already mentioned, many people want to take advantage of the effects of this boom as investors or try to avoid it by buying residential property with low-interest loans, both of which contribute to the further shortage and rising price of rental apartments in the regions where people are moving to. As this boom is of course also causing land prices to rise, as well as demands from construction companies and the cost of building materials, there is little inclination on the part of public budgets to make such high capital investments despite low interest rates, while at the same time foregoing the return in the form of politically necessary social rents that merely cover costs. The common appeals for more public building activity, while everything else should remain as it is, are therefore empty talk. The extent of economic policy regulation that would be necessary for this would exceed even the rent and building regulations of the Federal Republic of Germany in the first post-war decades. You would have to accomplish nothing less than to simply make the real estate market, especially the real estate trade, maddening for investment capital. Price fixing and sensitive special taxes on property yields in certain regions and cities would presumably be the means of choice here, a choice that could have enormous consequences, which are only hinted at here. Ultimately, if only such regulatory measures were taken seriously, this would mean that investment capital would be deprived of the decisive profit replacement benefit of recent years, the return that has so far resulted from tapping into wages, salaries, and wage replacement benefits via the real estate market. And the second part of the conclusion of the study on the new housing question, that there is a clear shortage of housing, could also be objected to, as it would rather be a decades-long lack of regulation or its consequences that need to be criticized and corrected. Statistically, there was only too little living space in Germany in the first 2 decades after the Second World War. Today, the calculated per capita living space available, 46.5 square meters in 2017, is higher than in any other year in Germany's post-war history. By way of comparison, 20 years ago, in 1999, when it was still possible to rent an apartment in a large city without a Schufa credit report and certificate of good conduct, this figure was significantly lower, at 39 square meters per capita. Such measurable housing stock therefore says little about the extent and frequency of rent excesses and fantastic property prices. Rather, the problem is that the apartments, and to an ever-increasing extent since the 1980s, are located in the wrong places, in the wrong cities and regions, where they are not needed or, better still, no longer needed. The new housing issue is also proving to be a long-term effect of the deindustrialization process. This is because capital has also proven to be unimaginably volatile in the material, manufacturing sector. It can move, even when it comes to seemingly immovable things such as gigantic steelworks or the complex mega-areas of the automotive industry. It can move from Sheffield or Duisburg to Gwangyang or Pohang in South Korea. It can move from Detroit, Turin, or Birmingham to New Delhi, Tijuana, or Chengdu. It repeats its history of industrial agglomeration and urbanization in other places, turning small artisan towns and farming villages into new cities, which then finally compete with and outcompete the original industrial production locations of the past centuries. What is left behind is that which cannot be moved, the real estate, entire towns whose buildings and inhabitants are no longer profitable. Unlike in the cities, where the focal points of the so-called knowledge and service society are forming, the cities that were once tailored to production, especially in the former industrial regions with their rather small urban character, with the exception of large parts of the high-tech pampas in Baden-Württemberg, are not succeeding, or only to a completely inadequate extent, in converting old factory buildings into chic open-plan offices for software development or advertising. In the former industrial cities, there is therefore a completely different housing shortage, namely not a shortage of apartments, but a shortage of apartments. The former industrial city of Pirmasens provides a particularly drastic example of such a process of, literally, leaving behind infrastructure and its living inventory. When the city was still one of the main locations of the German clothing industry, it was also the German city with the highest density of millionaires in the early 1970s. Today you can buy a 12-room villa with its own park for less than €300,000. But why should you? Parents, but also the young people themselves, are well aware that the constitutional requirement to bring the respective regional living conditions in the Federal Republic closer together is no longer worth the paper it is printed on with the end of nationwide industrial production, and send their offspring in cohorts into the battle for living space near renowned universities, prospering tech companies or even, as in the case of Berlin, to the suburbs of the political center in order to pursue a career in the subsidized realm of civil society and the cultural sector. This blatant disproportion between available living space and hoped-for future opportunities, which is wrongly referred to as rural exodus, because in fact the movement is primarily from flyover cities to boom towns, can no longer be tackled with concrete for new buildings alone. There are also likely to be limits to the desirable capping of rents and even radical restrictions on real estate transactions. According to a study by the German Economic Institute, IW, Berlin's population is expected to rise to a good 4 million by 2035, for example. Population growth will continue to be supplemented by Berlin families, with one main earner in particular swarming out into the surrounding area. In the small district town of Eberswalde, for example, which once lived from food production and mechanical engineering and nowadays simply from the fact that it has an intact train station with a connection to Berlin 60 kilometers away, property prices have quadrupled in just under 10 years. Tagesspiegel, the 12th of November 2019. Regulations that intervene against the disproportionality of living space and earning and living opportunities, as exemplified by Pirmessens on the one hand and Eberswalde on the other, would have to go far beyond all known structural development programs and financial equalization funds. What began by providing deindustrialized provincial towns with universities of applied sciences would have to expand into a veritable revitalization program, as called for by the British economist Sir Paul Collier, for example, which would give the affected regions a real economic function again. What one could perhaps imagine at the seaside or in the low mountain ranges with the help of the establishment of recreation and retirement regions a la Florida, could probably not be achieved for less than a targeted reindustrialization in the case of the Ruhr area. Friedrich Engels' housing question no longer applies to the situation in the metropolitan areas of the post-industrial era, neither in the so-called left-behind cities nor in those that, to stick with the metaphor, are still attached for the time being. Engels is no longer relevant not because he was wrong in 1872 with his analysis of the emerging and growing industrial city, but because today's basic condition of urban development in Western Europe and North America was simply inconceivable at the time. The separation of cities from the industries for whose benefit these very cities were created in the 18th and 19th centuries. In these cities, separated from their industrial origins and thus socially and economically functionless, Engels' observation that the housing shortage of the workers and some of the petty bourgeoisie of our large modern cities is one of the countless minor, secondary evils arising from today's capitalist mode of production, MEW 18, 214, no longer applies. Just as there can be no justified hope that a socialist takeover of the production apparatus is imminent, in the near future of which Engels, in 1872, the year after the suppression of the Paris Commune, could place the overcoming of the private appropriation of labor power as the conditio sine qua non of the solution to the housing question. This production has been withdrawn from both those still paid and those receiving wage replacement benefits in the former industrial cities of the West, which is why the nexus between wage labor and urban tenancy has broken down. However, it was this connection that once virtually compelled industrial companies and public budgets to build housing and regulate rents, especially in Germany, because both had a positive impact on export-oriented production, whether through social control in the factory housing estate or municipal construction, or through the assimilation of workers to the more effective lifestyle of the middle classes with regulated physical reproduction, an equally regulated daily routine and restrained alcohol consumption. With the relocation of production, however, there was no longer a business case for further investment in the living conditions of the former working population, which was now becoming a burden. Rather, what Horkheimer outlines in Authoritarian State with a quote from the Communist Manifesto applies to post-industrialism as a condition of existence for the dislocated population, that the ruling class must feed the worker instead of being fed by him. This is why the struggle, especially that for the provision of tolerable conditions of reproduction, affordable housing, intact infrastructure, non-violent public space, has become a different one. Less one that can be waged with economic pressures such as strikes, but rather a political one about how much consideration the long-since globalized capital is still willing to show to the former proletarian breadwinners at its national bases and by what means they can still force it to do so. The old recipes of left-wing radicalism are also embarrassed by the new housing question because the ex-worker, who has long since turned into a low-skilled, struggling small-town dweller, Collier, can no longer achieve anything with either self-organization or strikes, but only with pressure to legitimize the state, which should not retreat as in an anarchist-inspired utopia, but must be urgently prevented from retreating. In contrast to historical social democracy, capital and its state no longer have any common development prospects with a living workforce to offer. In short, the exchange of renouncing revolution for the imperative of the welfare state, but instead it is only a matter of wringing concessions, or better, forcing them, by threatening the political legitimacy of the sovereign, in much the same way as the original French Yellow vests forced Macron to make concessions on the minimum wage. If we consider the dimensions of the necessary regulations indicated here, particularly in the housing issue, this would amount to reclaiming the interventionist state, which would have to enforce taxes and prevent capital flight, which would no longer have to invest in civil society, but in the material recivilization of society, in infrastructure, legal security, public education, housing, all in all, a radical departure from the principle of subsidiarity that has been practiced for decades, from which, who is surprised, only those who already have subsidies, inheritances, and networks have benefited. This is probably the core of what could be described as antagonistic reformism, a fortunately chosen term from a rather unfortunate context, a reformism that would be more disruptive and more dangerous to the system than any revolutionary theatre of at least the past 50 years. It comes from the arsenal of terms that Michael Hart and Antonio Negri lay out in their book Assembly, 2017. In this book, the concept of such reformism must coexist with two other concepts that are diametrically opposed to it. The exodus that is supposed to create new social relations outside of existing institutions and conventions, as if there weren't enough digital as well as analog self-reflection already, and the hegemony that is supposed to replace the old welfare state with new, non-sovereign organizations in which social entrepreneurship thrives, as if the transfer of sovereignty to NGOs and social cliques wasn't exactly the problem. But that would probably be the kind of reformism, or so it is feared, for which the vast majority of Germans, unlike their Danish and French neighbors in different ways, are likely to be too jealous of the poorest of their fellow citizens. This is why, in the battle for the distribution of state resources in Germany, only the new middle class, which would prefer to completely shut down the old, white rabble, has had its say so far, for the climate, of course. In its climate crisis plan, the Hamburg chapter of the German Association for the Environment and Nature Conservation recently called for the city to abandon its announced plan to build 10,000 apartments per year so that Hamburg can become climate neutral by 2035, Welt, the 21st of November 2019. Unfortunately, we have so far waited in vain for angry tenants or apartment seekers to pay an unfriendly visit to the Bund office. With a sensational 8.8% of the vote, Die Linke celebrated a triumphant return from the political dead in the 2025 federal election. According to an election analysis by the party's own Rosa Luxemburg Stiftung, even long-time party members were astonished by the recent events. The dynamics unfolding around Die Linke are impressive. It is effectively a new formation of the party. Around 60% of left party members have joined since the 2021 federal elections, and more than 50% since Wagenknecht's departure. This influx of mainly young urban people brought the party a new membership record, almost 100,000, which is also reflected in the election results. Among 18 to 24-year-olds, Die Linke was the strongest force with 25% and even reached 27% among first-time voters. On the other hand, only 8% of all blue-collar workers and 9% of all white-collar workers voted for the party. Tagesschau.de, while 16% of 25 to 34-year-olds still voted for the party, the share of the vote steadily decreases as voters get older, down to around 5% among the over 45s. Voters under the age of 25 are mostly high school students, bachelor students, and interns, while those aged 25 to 34 are either master students, still interns, precariously employed, or working in the social sector. Most of them will not reach the income level of their parents and know that a room in a shared flat or a one-room apartment in an unattractive neighborhood is no longer a temporary solution before starting a career. There are enough reasons to be dissatisfied with one's own prospects, and the impression that the sinecures are irrevocably distributed is more than just an expression of blunt social envy. For this reason alone, the decision in February 2025 to no longer vote for the Greens, who have been favored by primary voters for decades, could be an indication of a growing sense of reality. If the Left Party were a pogo party that gave the red-green establishment the finger, breaking with customs, habitus and, above all, a utopia called authoritarian paternalism, then there would have been no political alternative to choose from on February 23, but at least an uncompromising refusal. Instead, 27% of the first-time voters showed themselves to be responsible and voted for the most brutal crisis solution imaginable, the alliance of people's solidarity and the mosque. Paradoxically, the success of the rejuvenated Left Party with leaders such as top candidate Heidi Reichenegg and the election winner from Berlin-Neukölln, Ferhat Kokak, is due to a bloodletting of members and prominent functionaries. A decisive indication of a new dynamic can be found in the German-language offshoot of the staunchly anti-Zionist magazine Jacobin, which was headed by the current party chairwoman in Schwertner until 2023. The departure of Wagenknecht on the one hand and the grouping around Klaus Ledier on the other has done the party good. Jacobin.de, the emergence of the BSW and the loss of power of prominent Berlin comrades around former culture Senator Klaus Lederer, who distanced themselves from left-wing antisemitism, have paved the way for a new type of party that can finally catch up with what is globally considered left-wing without false consideration for German guilt, which has degenerated into a swear-word empowerment of the marginalized. It can't have been down to the content, because slogans against high rents or low welfare rates don't win elections, and the competition is also too strong when it comes to peace. The success of Wagenknecht's new alliance made an electoral disaster for the Left Party at federal level seem likely in the fall of 2024. However, although 340,000 former Left Party voters, the majority of whom are likely to have been over 34 years old, voted for the BSW on February 23, the trend reversed at the turn of the year. The decisive factor cannot have been appeasement towards Russia. The two parties have little in common in this respect, but approval of the uncontrolled immigration of predominantly Muslim men, which is rejected by the majority of the population. In the European elections in June 2024, the old Left Party, with its lead candidate Carola Rackete, who had backed open borders as a life-saving captain, halved its share of the vote compared to 2019 with 2.8%. Continuing on this course 1 year later would have been political suicide. Accordingly, the new Left Party, with its call for open borders, has propagated a decisively different welcoming culture than its predecessor and has relied on the empowerment of refugees and the Muslim population, some of whom are already living in Germany for the third generation, to not only ignore the external borders. Internally, immigrants are encouraged to override the limits set by the penal code and the job centres with their demand to take up any reasonable work. The Neukölln district branch of the Left Party, which has transformed itself from an unloved dirty child into the avant-garde of the renewed party, has been agitating since 2019 against the characterization of certain migrants as members of family clans and the associated raids on mainly Arab traders for drug trafficking, receiving stolen goods, illegal employment, and tax evasion. Not even having noticed this empowerment of the marginalized, which in reality is aimed at the self-empowerment of white city dwellers to somehow take revenge on the system, is one of the brilliant achievements of the commentators on the Bundestag election. The FAZ, for example, merely listed the reasons for the Left Party's election defeat in its election analysis, because the good conscience it cites in terms of anti-fascism is not a unique selling point of the left, but traditionally also a domain of the SPD and Greens. The general joy over the left's success overlooks the fact that it is programmatically an equivalent of the AfD and BSW, pro-Russia, anti-NATO, Eurosceptic, critical of the elites, and all with a blithely presented claim of radicalism, with a clear conscience, because after all it is against fascism. FAZ, the 25th of February 2025. In its self-image, Die Linke is the natural antithesis of the AfD, and apparently almost 9% of voters, 600,000 of whom have migrated from the Greens, see it the same way. The Left Party's anti-fascism is similar to its somewhat different welcoming culture. Without making a big deal of it, it has long been a migrant faction according to its self-image and was not only able to expose the CDU as the stirrup holder of a new fascism in January 2025, but also to disqualify the SPD and Greens as unnatural cantonists in the fight against the right. Instead of conceding that the AfD and the Left Party are separated by everything except their alliance with Russia, which was already evident on election night from the poor performance of the BSW, which attempted a balancing act between AfD demands and left-wing platforms, the liberal and conservative opinion makers insist that the Left Party and AfD are two sides of the same coin and conjure up their imminent demise. The mutually asserted opposition is a purely rhetorical one. In fact, both fringes reinforce each other through their refusal to accept those values that are denounced by them as outdated relics of the center, specifically as a rejection of what the post-war order of the Federal Republic of Germany stood for. End of quote. In a joint text, the successful Leipzig left politician Nahm Due Nguyen, the winner of the Neukölln direct mandate Ferhat Kokak and Luigi Pantisano from Stuttgart succinctly outlined the party program. We want Die Linke to become a class party. We are socialists for a reason. Our class is huge and diverse. It includes the migrant care worker, the East German loser of reunification, and the queer activist on an academic fixed-term contract in equal measure. We are fighting for everyone. End of quote. The Bulgarian nursing assistant who gets a migrant label, the Leipzig friend of the murderous Hammer gang, the Swabian New Berliner who transfers her strange, queer preferences to young Arab men, and the Rosa Luxemburg Stiftung scholarship holder, who keeps his head above water with poorly paid teaching assignments in the field of post-colonial studies and therefore earns an extra income with articles for the feature section of the extremely anti-Israel news Deutschland, as do Corona damaged. Ideology critics, they are by no means all diverse, but they are all diverse, namely in terms of age, skin color, gender, worldview, sexual orientation, or disabilities. Prejudices and rejections that lead to disadvantage and discrimination. End quote. This class, in which the care assistant may only appear as the damned of this earth in the sense of Frantz Fanon or intersectionalism and not as a worker, presents itself as a community of caregivers who have been harmed. The Left Party claims to be fighting for everyone because it has already singled out the negligible remainder, without whom genuine Volksgemeinschaft cannot exist, and branded them fascist. In the election-deciding campaign against the right in January and February 2025, the Left Party did not discredit Friedrich Merz as a Nazi because he is old, male, and rich, but because these characteristics together make up an enemy declaration that the left will not be able to agree on worldwide in 2025. The fact that Merz promised in a telephone call on February 24, 2025 that he would find ways and means for Benjamin Netanyahu to visit Germany and leave again without being arrested in Germany, and added, "I think it is a completely absurd idea that an Israeli Prime Minister cannot visit the Federal Republic of Germany," underlines why he must be a fascist. Little excitement. When Klaus Ledier, the long-standing State Party chairman and former Senator for Culture, and 4 other prominent Left Party politicians resigned from the party after the Berlin State Party conference in October 2024, there was not as much excitement as the Ledier team, who were blamed for the poor result in the 2023 parliamentary elections, had probably hoped for. There was only talk of great regret and a painful loss from the federal management immediately after the resignation, before it was back to business as usual. The background to this was the dispute over a passage in the motion against all anti-Semitism, defend emancipation and universal human rights, which the aforementioned had tabled with several dozen other comrades. The majority of delegates took offense to the fact that the motion spoke of people on the political left who had relativized and sometimes even celebrated the Hamas massacre on the 7th of October or even called for the destruction of Israel. "We are deeply alarmed that people on the political left in Berlin have relativized and sometimes even celebrated the Hamas massacre of small children, families, and festival goers on the 7th of October 2023 or have called for the annihilation of Israel. The left must never ignore the role of eliminatory anti-Semitism in driving the terror and strategies of actors such as Hamas and Hezbollah and their support from the Iranian Mullah regime. The hate propaganda of such actors posing as liberation movements is catching on here more than ever." By a narrow majority, an amendment was passed that modified the above-mentioned passage as follows. "We strongly criticize the fact that people in Berlin have relativized and sometimes even celebrated the Hamas massacre of civilians, including small children, families, and festival goers and Asian migrant workers, on the 7th of October 2023. End quote. There were still people left of the politically left-wing people, and the reference to the intended destruction of Israel was also removed. The applicants then withdrew their motion and left the meeting room. Ledier and company were already fully in line with the new line with their motion and had made a statement that echoed the words of Ferat Kokak. "We clearly oppose the constant blanket suspicion of Muslims, Palestinians, refugees, and people with a history of migration on the part of the right and conservatives. This generalized suspicion speaks of resentment and racism. Just like the talk of imported anti-Semitism, it serves above all to exonerate a majority society that turns a blind eye to the continuities of anti-Semitism that has never disappeared. We will not allow the struggles against racism and anti-Semitism to be played off against each other." End of quote. The left likes to present itself as a party of consensus. The group around Ledier was punished because an activist from the Neukölln District Association who was much closer to the majority had to be sacrificed with a heavy heart, Ramses Kalani. He had celebrated Hamas for its attack on Israel on October 7th and described himself to the Taz newspaper as a head of the Palestine movement. In January 2025, Kalani was finally expelled for conduct detrimental to the party because he had written in a tweet, "We are ready to carry out the anti-colonial liberation struggle and support it internationally. I think it will take more than murdering Israelis." End quote. Previously, the board of the Neukölln District Association under Ferat Kokak had explicitly backed Kalani. In protest against the expulsion of the comrade, former member of the Bundestag and anti-Semitic agitator Christine Buchholz also left the party along with several other comrades. Like the departure of the Ledier wing, this also stands for a more profound change. Trotskyist submarines such as Christine Buchholz, who most recently headed the Socialism from Below group, stand for a traditional anti-imperialism that is shared by all leftists in terms of content, but is considered damaging to the party due to its overly blatant choice of words. The position of figures such as Kalani and Buchholz, which is aimed at the destruction of Israel, was reinforced by the punishment of people who are suspected of holding on to Israel's right to exist, victory of the Kokak wing. What on the surface appears to be the preservation of the old inner-party parity was in reality the liquidation of a current in the old left party, represented by the BAK Shalom, which had turned against the support of Hamas by prominent party members such as the anti-imperialists Annette Groth, Inge Hoger, and Norman Peach, but also the long-standing member of the Bundestag Petra Pau. Pau's appointment demonstrates the loss of importance of the once influential pro-Israeli wing. Shortly before the Berlin Party Conference, she appropriately criticized herself on the anti-Zionist Deutschlandfunk radio station and called on politicians to rethink their image of the country in the Middle East, as Israel was increasingly dominated by right-wing forces with sometimes authoritarian orientations. Today, Ferhat Kokak, who, unlike Ramsis Kalani, knows the limits of what can be said and at the same time is constantly pushing them further, has the final say on how to deal with Israel. A resolution passed at the Berlin State Party Conference illustrates this. Under the pacifist title Stop the Killing, the dividing line between a supposed fight against antisemitism and justified anti-fascist resistance is shifted from Israel to Sonan Ali, where the condemnable repression by the state and police becomes apparent. The supposed fight against antisemitism is becoming the domain of the right, which in the view of the left ranges from the AfD to Friedrich Merz. It is also being misused by right-wing forces to delegitimize left-wing criticism of the unequal balance of power between Israel and Palestine. End quote. This amounts to the formula popular in the Neukölln resistance: Jew, Jew, cowardly pig, come out and fight alone. Because the denunciation of the fight against antisemitism as right-wing is underpinned by the final demand for a solidarity movement yet to be founded that recognizes the inequality of power in this conflict, i.e. fights for the final victory over Jewish Zionist cowards in Gaza and Berlin. It goes without saying, of course, that they dutifully add that open hatred of Jews, attacks on Jews and Jewish institutions have nothing to do with solidarity with Palestinians and are detrimental to this cause. Just 1 week after the Berlin event, the Federal Party Conference of the Left Party, which took place in Halle from 18.10 to the 20th of October 2024, passed a resolution under the motto De-escalation and disarmament in the Middle East, for peace, international law, against all racism and antisemitism, which also complained that an asymmetrical war of unequal participants is still raging between Israel and the Palestinians. A new element was the threat of civil war in Germany, which would be waged by auxiliary troops yet to be imported. A reception program for refugees from Gaza and the West Bank was demanded. Because Halle is not Berlin and the election must be won not only in Neukölln and Kreuzberg, where the Greens lost their direct mandate to the Left Party, the following evocative passage was also included in the motion. As the left, we will never ignore the role of antisemitism in driving the murderous terror of Hamas or Hezbollah. Anyone who fuels anti-Semitic resentment in the Middle East or in this country, who questions Israel's right to exist, who incites hatred against Jewish people or relativizes the terror of Hamas cannot be an ally. The next sentence makes it clear that this is not what is meant. Allies should just as little be those who approve of or engage in racist, anti-Muslim or anti-Palestinian attacks and propaganda. This is familiar from the Berlin Party Conference, where the supposedly anti-Semitism critical wing around Klaus Ledier declared, "There is no place for anti-Semitism and racism in the left." End of quote. Ferhat Kokak, born in Kreuzberg in 1979, is the figurehead for the new departure or refoundation of the party, while Petra Pau, born in East Berlin in 1963, is a model for the past. Pau has faced up to the confrontation with a fundamental error that shaped my youth in the GDR and was therefore able to speak out in favor of Israel for years. I grew up with the belief, and I was taught at school, that Palestinians are freedom fighters and citizens of the State of Israel belong to the so-called imperialist bloc. End quote. Quite similarly, there was a larger minority in the West German left after the end of the GDR that also recognized its anti-imperialism as a fundamental error and agitated for an exit from the anti-imperialist and anti-Zionist ideology. Ever since post-colonialism took over from left-wing anti-imperialism, first in the universities, then in the media and now on the streets, the East and West German ghosts have returned and no one takes offense at Israel being branded a colonial system of oppression, as Die Linke in Neukölln did in February of this year, immediately before the Bundestag elections, in a call for participation in the worldwide protests against the genocide in Gaza. Terms such as internationalism and national liberation have gone out of fashion since people like Kokak have been propagating a diverse concept of class that no longer recognizes a unified revolutionary subject and immediately appropriates everyone for itself. The joint paper by Nguyen, Kokak and Pantisano states, however, we will only reach the class in its specificity if we focus on central issues that affect everyone. We must work on a few topics communicatively and practically for all, instead of all topics for a few at a time. End of quote. In reality, this became exactly one issue, a commitment to anti-Semitism presented in Antifa rhetoric. It is not known whether the new left-wing politicians took their strategy from Chantal Mouffe's book for a left-wing populism. In any case, it was striking that the Left Party's entire Bundestag election campaign really did fulfill all the political science criteria of left-wing populism. The election posters plastered across Germany proclaimed slogans with remarkable simplicity, such as, "If your shopping is too expensive, a corporation is making money. If your rent is too high, the landlord is happy. If your heating is too expensive, someone is making real money. If your pension is too low, Scholz hasn't delivered. Or if your village is underwater, rich people get on the yacht." No, you can't win an election with old-fashioned slogans like these, not even if a broad spectrum of election appeals, statements, positive newspaper commentaries and other forms of direct and indirect support, from the TAS to influencers, trade union circles to movement actors or the ZDF program Diane Stout provide the resistant party with a strong social tailwind, as the Luxembourg Foundation's election analysis claims. The only way to win, especially as someone who has just been declared dead, is to awaken seemingly buried resentments that see a damaging principle at work behind the mostly justifiably unloved landlords, bosses, and yacht owners, which extends from Gaza to the old neighborhood at home. Reichenek's overall appearance. The new leaders Schwerdner, Van Aken, and Reichenek were no more to thank for the considerable mobilization of the base in the election campaign than for the anti-capitalist slogans on the posters. Rather, the decisive factor was the shift within the party in favor of the Kokak wing. This is exemplified by an incident that apparently followed on from a scandal from 2010. At that time, 4 Left Party MPs, of whom only BDS and PKK supporter Nicole Golka remained in the party, the other 3 being Sarah Wagenknecht, Sevim Dagdalan, and Christine Buchholz, demonstratively did not rise from their seats after the speech by Israeli President Shimon Peres to commemorate the victims of National Socialism in the Bundestag. At the end of March 2025, the newly elected Bochum MP Kansin Kokturk posed on Instagram with a Palestinian scarf around her neck in the plenary chamber of the Bundestag. 15 years ago, the party leadership condemned the behavior of the 4 female comrades after Simon Peres's speech. Today, parliamentary group leader Heidi Reichenek defended Kokturk's action at a press conference, saying, "I think it's good and right that my comrade is wearing this scarf. Because solidarity with Palestine, just like solidarity with Israel, is of course the core of left-wing politics." To be honest, I find it rather pathetic to hang oneself on this symbol and try to use it to create a mood against us again. End quote. Claiming parity where there is none and playing the offended liver sausage when it comes to critical questions is the ploy of the new Left Party and Reichenek in particular, who likes metal music and can speak faster than any rapper. Sat 1 regional de DE, even in her outward appearance, she embodies the opposite model to Sarah Wagenknecht, which also goes down extremely well with the FAZ, which attests to Reichenek's ease and desire for politics. She knows how to break down politics and appeal to young voters in a way that entire social media teams in larger parties couldn't think up better. End quote. The brash appearance, the bright red painted lips, the Rosa Luxemburg tattoo on her forearm and the fast-talking make up the overall appearance of a populist who can be considered one of us and is really just the same in private as she is in politics. Her speech against Friedrich Merz on January 29, 2025 was allegedly the most successful speech ever on social media, and it apparently met with enthusiastic approval, especially among the youngest voters. "The firewall," said Reichenek, "is still us." Addressing Merz personally, she said, referring to the 80th anniversary of the liberation of the Auschwitz concentration camp, "Just 2 days after we commemorated the murdered and tortured, you are working with those who are now perpetuating this very ideology." Die-Link BTDE-ED. This was the message from a radical who began her speech with the words "resist fascism in the country. To the barricades," at the end. This uncompromising anti-fascist is actually fighting on the barricades of the Intifada, whose sole purpose is a second Holocaust, the especially damned of Neukölln. How the stirring up of irrational fears, NZZ, caught on was not only evident in the mass demonstrations in all major German cities, which were led by left-wing party members everywhere. After the AfD voted in favor of the CDU's motion to restrict migration, the Left Party's poll ratings skyrocketed in February 2025. A turbo ignition for a dynamic that had already started rolling is what the Rosa Luxemburg Stiftung calls it, referring to the 2-pronged election campaign consisting of social media appearances and home visits to potential voters, which was quite successful even without the involuntary involvement of Friedrich Merz. The Reichenek speech became a hit on TikTok, where fake news that is often attributed to the right is regularly spread. But the end justifies the means. After all, an algorithm-based structural change in the public sphere, not only leads to politicians dancing for short videos or being filmed eating kebabs in funny sweaters, but also has repercussions on what is perceived as legitimate political discourse. This is why we have to realize that by referring to perceived truths or alternative facts, we can no longer only reap laughter, but can also create reach. Politicians like Reicheneck are attractive to young followers because their habitus breaks down the old bourgeois boundary between private and public, as we are accustomed to from digital media, and live and experience day after day as a bad sublation of both spheres. The young have grown up and been socialized in social conditions in which the boundaries between work and private life are becoming less clear, and working life is not a burden in concept, but an important and valued part of life. They know from their own experience, which they gain during their voluntary social or ecological year, that the state is in doubt the most important and most secure provider of work and funding in precarious times, without noticing the contradiction between propagated self-determination and state dependency. On the contrary, state support is perceived as a prerequisite for self-determination. First-time voters of the Left Party in particular are driven by a need for social security, which becomes all the greater the more insecure the economic conditions become. What applies to young Germans of German origin is all the more true for Muslims seeking meaning and security. The self-confessed atheist Ferhat Kokak neither prays in a mosque nor does he propagate gender segregation or fast during Ramadan. The new king of Newcombe, who is bald, has a full beard and wears a scarf from his Kurdish grandmother around his neck. Die Zeit, who does not rant like Reicheneck and is a bad speaker, has least of all the victims of Islam on his radar, who perhaps want to live just as free from forced morality as he does. For him, those read as Muslims by the white majority society are mere victims of racism who deserve all the solidarity with their difference in customs and traditions in their mosque and cultural associations. This is the only reason why Die Zeit reports that Kokak was able to motivate the post-migrant community to vote, meaning that many children of immigrants helped him to win the election. 29% of Muslim voters nationwide cast their vote for the Left Party, more than for any other party. Kokak not only gives a moral clean bill of health to those who see Germany as their booty country, he also considers looting itself to be legitimate. In 2023, he commented on a Bild report about the daily thefts by refugee home residents in a Regensburger Edeka supermarket as follows. Edeka is short for Einkaufsgenossenschaft der Kolonialwarenhandler. I would say that people are taking back what is rightfully theirs. End quote. However, the Kokak model does not work quite so clumsily. In the same tweet, he immediately added, "But it's not that simple. One of the main problems is that the authorities are overburdened and many refugees are not even paid what they need to live. And even that is secondary. It is more important to grant refugees a work permit immediately so that they can make a self-determined living." End quote. Kokak's successful model works in exactly the same way that the AfD is often accused of being particularly perfidious, pushing forward in a taboo-breaking manner and then backing down again. Kokak opposes any form of immigration criteria as racist or right-wing and, according to Wikipedia, fights for an unconditional right to stay for all refugees. He is a co-founder of the initiatives You Are No Security and No General Suspicion. The former advocates the extensive withdrawal of the police from Newcombe, while the latter opposes the public use of the term clan crime. In left-wing circles, this is often referred to as self-empowerment or, in modern German, empowerment. Not only in Newcombe does the self-stylization as a victim of the rich and powerful often serve as a cipher for the rejection of the infidels, kuffer, almonds, white bread or potatoes, as the Germans of origin are called, and not only in the Migrantifa, which has long since grown into a Migrantifida. On Ferhat Kokak's election campaign website, empowerment to form clans and gangs tailored to the supposedly particularly disadvantaged Newcombe residents sounded quite socially romantic. Life in Newcombe is hard, but the politicians want it to be even harder. Whether CDU, SPD, or Greens, they only think about us when they need our votes. After that, they all make policy for the rich and corporations. They don't care about us, the hard-working people who keep our neighborhood going. End quote. Profiteers of the Hamas massacre. Doing politics differently was the motto under which Kokak, who has been a member of the Berlin House of Representatives for his party since 2021, launched his door-to-door campaign with hundreds of mostly very young helpers, Team Ferhat, underlining the success of the party's nationwide rejuvenation campaign. There were considerably more people door-to-door canvassing in Newcombe than the District Association of the Left Party has members. Germany-wide, it is said to have been the most helpers for one electoral district. According to self-reporting, more than 2,000 people knocked on 139,000 doors. At the same time, an internal party battle was being fought in Newcombe, which George from Ferrat's team described to Jacobin as follows: "We're not just fighting to win here, but also to see which left-wing party gets into parliament. And if Ferrat succeeds, then the left will be more focused on class politics and more pro-Palestinian." End quote. Kokak and his party are profiteers of the Hamas massacre on October 7, who left no stone unturned in their district, where the largest Palestinian diaspora in Europe lives, Taz, to serve and promote left-wing and Muslim antisemitism. Kokak has personally organized several pro-Palestinian demonstrations, which have regularly turned against Israel and the police, including one entitled Beats Against Genocide. He invited the ousted Labour leader Jeremy Corbyn to Newcon shortly before the election, which was only just prevented within the party. In October 2023, he spread the lie that pupils in a Kreuzberg elementary school had to fill out questionnaires about their attitude to the Hamas attack and, of course, it was a matter close to his heart to mention the fight against antisemitism in the same breath as the fight against anti-Muslim racism and any other form of racist discrimination, in a personal statement in the House of Representatives immediately after October 7. The following report reflects the nature of the anti-Zionist doorstep campaign. Kokak describes his own position on the Middle East conflict as follows: "We stand on the side of international law and human rights." In their jute bags, the Left Party campaigners not only carry flyers on their own election manifesto, but also a petition from several German aid organizations such as Pax Christi and Medico for a lasting peace in Gaza. "When people are wearing kufiya at the door, I get straight into the issue," says Kokak. At the front doors, you quickly notice that this attitude is well received. In one house, a young woman opens the door. At first she is reserved. But when Kokak asks her if she wants to sign the Gaza petition, she thaws noticeably. What does she think of Germany's Middle East policy? "Very bad," she blurts out. "My parents are from Palestine." Kokak himself says very little, just lets the young woman talk. She seems to have built up something. End of quote. The most spectacular election campaign was delivered in Newcon, according to the euphoric election analysis by the Rosa Luxemburg Stiftung. A survey from March 2024, which found that 82% of Left Party supporters opposed the IDF's actions in Gaza, far more than in any other party, shows just how wrong people are to believe, like in the US for example, that Kokak is still an exotic figure in the party today. A statement by party leader Van Aken, who is against making citizenship dependent on earning a living, fits in with this mood. Van Aken is right in line with Kokak, as he justifies this with reference to long-term recipients of state transfer payments. "These people have certainly done a lot here. They have raised children and grandchildren here, which is also work for us. They take part in social life. That should be enough as a condition for the passport." Jüdisch Allgemeine, the 30th of January 2025. And Heidi Reicheneck? Because the situation is different, she no longer wants to agree with an essay from 2016, which she co-authored, that calls for dialogue with political Islam and calls the Muslim Brotherhood slogan, "Islam is the solution," just a slogan that should be classified in the same way as when parties in Germany go after votes with election campaign slogans without much programmatic significance. Tagesspiegel, the 28th of March 2025. Reicheneck, like the entire supposedly newly founded Left Party, cannot be taken to be distancing itself from radical Islam, if only because the left and Islam have long been natural allies in the transformation of state and society into a genuine community of responsibility. With its electoral success on February 23, 2025, the Left Party has become the protective power of the followers of the only true religion and other mortal enemies of the Jewish state. The upset victory of the Democratic Socialist candidate Zoran Mamdani over the centrist veteran Andrew Cuomo in the Democratic mayoral primary in New York City has many on the left seeing the dawn of a new socialist era. But the election results show that the real class conflict in the Big Apple is not between the haves and the have-nots, but between the haves and the have-mores. Some factors in this election are unique to New York's ethnic mix. Mamdani won the Hispanic vote, perhaps thanks to a backlash against Donald Trump's deportation policies, and as the first potential South Asian mayor of New York City, born in Uganda, he is of Indian descent, he did well among Asian New Yorkers, particularly Muslims. What about income? The richest and poorest New Yorkers voted against him, as did the black middle class and working class. Mamdani's base is what has jokingly been called the commie corridor in Brooklyn and part of Queens, where young white progressives have created a bohemian culture similar to that of college towns. Mamdani also did well among affluent New Yorkers in the tier below the very rich, as Michael Langer has pointed out in the New York Times. In Tony, liberal neighborhoods like Fort Greene and Clinton Hill, known for their tree-lined streets and multimillion-dollar brownstones, Mr. Mamdani trounced Mr. Cuomo by more than 35 points. The claim that Mamdani won by campaigning on the issue of affordability is hard to reconcile with the fact that he did better among upper-middle-class white voters than among working-class and middle-class black voters. But the definition of affordability is subjective. Young hipsters in Brooklyn and affluent professionals in Manhattan may make more money than black janitors in the Bronx or white nurses' aides in Queens, but they feel that they are poor because they have champagne tastes on beer budgets. Metropolitan professionals are dependent, directly or indirectly, on the super-rich, whether as employees of major business, finance, law, and media firms, as non-profit staffers or professors whose institutions depend on the charitable giving of the wealthy, or as civil servants in cities that depend on taxing a small number of wealthy individuals and enterprises. Nevertheless, as I can attest, having lived in Manhattan for half a decade in the 1990s, many professionals seethe with envy of the rich. Even a six-figure income may not enable academics, journalists, non-profit staffers, lawyers, or doctors to afford a townhouse on the Upper West Side, a weekend place in the Hamptons, or a cook and a French au pair. According to a recent study by Smart Asset, to live comfortably in New York City, a family with 2 children needs $318,406, more than £231,000, while a single individual needs an annual income of $138,570, compared to $75,000 for a single in Houston, Texas. No wonder New York is losing residents to Texas. The division between the metropolitan rich and metropolitan professionals plays out on multiple fronts: housing, transit, and domestic help. In cities like New York, even professionals making a few $100,000 a year cannot afford to buy one of the townhouses or luxury condos they covet in nice neighborhoods. Instead, they are forced to pay crazy rents in order not to suffer the indignity of living far from Manhattan and commuting for an hour or more each day like lowly proles. The rich can Uber or Lyft their way everywhere, but that is costly for merely affluent professionals who may be forced to endure the forecast of hell that is the New York City subway system. But the biggest divide between the rich and the affluent has to do with servants. Truly rich households in America tend to be one-earner couples, in which the man is the sole breadwinner and the wife doesn't work, at least for wages. It can be exhausting to bark orders at the help all day. And in a reversal of the pattern for most of the last century, rich American women are now having more children than less affluent women in the US. In contrast, the typical professional class household in cities like New York consists of 2 college-educated professionals, both of whom must work so that their joint income allows them to eke out a barely comfortable existence in one of the priciest places on earth. If they have children, they must rely on paid child care. The truly rich can afford to pay Mary Poppins along with Jeeves quite well. But metropolitan professional households with children and 2 full-time working parents with professional careers cannot afford to spend much on nannies and maids. They may be progressive in their attitudes toward trans rights and DEI, but professional couples in big cities rely on a pool of low-wage, mostly foreign-born domestic workers who can be paid low wages in cash, with no payroll taxes, no benefits, and no retirement security. This explains the panic among metropolitan professionals caused by Trump's deportations. Every illegal immigrant in the US could be deported, and the rich in Manhattan and elsewhere could still afford not only maids and nannies but also drivers, tutors, personal shoppers, dog walkers, butlers, and personal yoga instructors, if they chose. But without cheap illegal immigrant labor, the precarious finances of many 2-earner professional couples would collapse. One way to keep the wages of menial servants low enough for professional households to afford them is to let taxpayers pick up the tab for many of their expenditures. The public grocery stores in New York City proposed by Mamdani are for the nannies and maids and Uber drivers, not their professional class and rich employers, who will continue to shop at upscale stores like Whole Foods and Trader Joe's. Better yet, if the maid can drop her children off at a publicly funded daycare center on the way to clean the professional couple's apartment, the taxpayer's assumption of her childcare costs makes it easier for her to survive on her paltry wages. To be sure, Mamdani has proposed raising the minimum wage in New York City to $30 an hour. But everyone knows that is not going to happen, making it safe for progressive New Yorkers to pay lip service to high wages and unions while paying their menial servants in cash off the books in the black market for labor. In this way, the benefits of cheap labor for elites are privatized while the costs are socialized. A century ago in the US, the non-Marxist crusade in favor of municipal ownership of water and electric utilities was called source socialism. The 21st century left has come up with something new: servant socialism. Whether Mamdani can be elected mayor of New York City remains to be seen. But the intra-elite class dynamic seen in the Democratic primary will continue to be played out in New York and other plutocratic cities around the globe. What drives it is the desire of the ambitious professional class has to live like the truly rich have mores, at taxpayer expense, if that can be arranged. The issue of low wages has moved to the center of American public debate recently, thanks to protests against the low pay of fast food workers, the large share of poorly paying and part-time jobs that have been created in the aftermath of the Great Recession, and proposals by President Obama and others to raise the minimum wage. But while the debate may be recent, today's low wages are neither new nor surprising. On the contrary, they are the result of decades of public policy. For better or worse, over the last few decades there has been a strong bipartisan consensus in favor of what we call the low-wage social contract as the preferred model of economic support and adequacy. By low-wage social contract we mean an economic system that not only assumes but also accepts that many, if not most, jobs in the US will pay poorly. Rather than try to raise market wages, proponents of the low-wage social contract across the political spectrum prefer to help low-wage individuals through other methods, such as lowering taxes or providing government subsidies in cash or in kind. This has been the logic behind many of the policy interventions on behalf of working Americans in the last few decades, including the Earned Income Tax Credit, EITC, the Child Tax Credit, CTC, and the subsidies for the purchase of individual health insurance established by the Affordable Care Act, ACA. It was also clearly expressed during the budget debates of the last decade, in which tax cuts were implemented by one political party and made permanent by the other. A return to the high-wage model of the American social contract characteristic of the mid-20th century, however, would be difficult if not impossible due to changes in the global economic structure. Even so, it is important to analyze the problems with the current model. The low-wage social contract has failed. By means of well-designed demand-side interventions, public policy could modify and improve the social contract, even if the same high-wage, low-price system cannot exist in exactly the same form as before. In this paper, we lay out the history of the low-wage social contract and the major options for thinking about how to reform the system. The current low-wage model lies in contrast to the high-wage social contract that prevailed in the New Deal era of the 1930s through the 1970s. High and rising wages spurred consumption as many more consumers entered the middle class and could afford a greater number of products. High-paying jobs in manufacturing and industry allowed workers without college degrees to earn a middle-class standard of living, while unionization and the example that unionized firms set for others contributed to ensuring that wages stayed high. On top of this high-wage-driven economy, the government acted to spur additional consumption and provide benefits indirectly. The GI Bill offered scholarships and subsidized loans for returning veterans that allowed them to purchase major items like houses. And while the New Deal did create some universal programs, like Social Security, much of the provision of benefits ended up in the hands of employers rather than the government. This arrangement was the outcome of conflicts between progressives, who favored universal programs, unions that supported the creation of separate associations to pool benefits, and paternalistic corporations that wanted to maintain control of benefits as recruitments and rewards. With large profit margins and limited competition, and an eye for benefiting all stakeholders, rather than shareholders alone, companies in the dominant industrial sectors contributed to a fairly robust social contract that was partly public and partly private. The ability to automate and innovate in the tradable sectors, combined with limited global competition and the ability of organized labor to extract wage concessions from employers such as manufacturing companies and regulated public utilities, made high wages and low prices possible at the same time. Large businesses tended to support the high-wage social contract even more than small businesses until deregulation and the rapid advance of globalization led large corporations to distance themselves from the New Deal-era social contract and favor the low-wage model. Unfortunately, the preconditions that contributed to high wages and rapid productivity increases do not exist in the same form today as they did half a century ago. Innovation is still the linchpin of economic growth, but it will be more difficult to make large productivity leaps in the untradable, technology-resistant sectors in which many new jobs are being created. Industrial sectors like manufacturing continue to shed jobs even as we attempt to retain their important value-added economic functions. An increasing role for what economist William Baumol termed the stagnant sector means a greater share of employment and consumption will take place in services. We have already seen this taking place. More than 86% of the workforce is now employed in the service sector. Service sector jobs are divided between higher-paying professional and business services, like finance, and low-wage final demand industries like food service and hospitality. Most of the recent job growth has come in the low-wage service industries, and many potential sources of future employment in childcare and health assistance also predominantly pay low wages. Unlike many of the big automakers and manufacturing titans of the time that drove the previous economy, low-wage service industries like food service often have lower profit margins. At the same time, service sector jobs are more difficult to unionize because they often involve smaller individual firms and do not have the historical precedent of unionization that manufacturing does. Union membership in the private service providing sectors is 5.7% in the US, compared with 10.1% in private goods producing sectors. Instead of attempting to lift wages along with these economic shifts, the response in the last 4 decades has been policies that have replaced the New Deal model with a low-wage social contract. It is rare when an economics paper gets particular attention, but the recent nomination of Jason Furman to chair of the President's Council of Economic Advisers this year brought back to life a paper he had written in 2005. The paper, entitled Walmart, A Progressive Success Story, argued that Walmart's ability to keep prices low for consumers made low-income Americans better off even if the wages it paid were very low. Furman claims that Walmart could not raise wages of its workers without also raising prices on consumers, which would be worse for the low-income consumers that shop at the store. Correct or not, Furman's approach illustrates the logic of the system that policymakers of both parties have embraced in the last generation. Rather than promote high wages, the current low-wage social contract seeks to compensate for low wages by means of low prices, low taxes, and wage subsidies. In theory, this should mean that the consumer has similar spending power to a high-wage, high-price model. Consumer prices have been lowered not only by technological innovation, as in the past, but also by means of cheap imports from emerging markets with government-subsidized export industries and by low pay for American domestic workers. Companies that pay low wages to workers can sometimes provide lower prices for consumers. As the Department of Labor noted in 1999, the presence of low-wage jobs in the economy helps keep production costs and prices low, thereby benefiting all consumers. A 2005 study by Jerry Hausman and Ephraim Leibtag found that Walmart, notorious for its low wages, offered food prices that were 8% to 27% lower than supermarkets. For many large employers, James Surowiecki notes, the grim truth is that low wages are a big part of why these companies are able to stay profitable while offering low prices. This is particularly applicable to the food service sector, which has had very low productivity growth in the last quarter century. Under Democrats and Republicans alike, public policy has also sought to compensate for low wages with low taxes. In recent years, conservatives have begun to criticize the fact that many low and middle-income Americans pay no federal income taxes. But in the late 20th century, both conservatives and progressives collaborated on the project of lowering taxes on low-wage workers. The result of taking nearly half of the workforce off of federal income tax rolls was achieved by means of tax expenditures, including 2 refundable tax credits: the Earned Income Tax Credit, introduced in 1975 and expanded in 1990 and 1993, and the Child Tax Credit, 1997 and expanded in 2001. A refundable tax credit means that the IRS pays a subsidy to individuals who do not make enough to qualify for the income tax credit otherwise. The number of tax expenditures has increased nearly 60% since the late 1980s, and the cost has grown from about 6% of GDP to more than 8% of GDP. While refundable tax credits have been a major contributor to this growth, other increasing tax expenditures, such as the home mortgage interest deduction, do not primarily affect low-income workers and do not help compensate for low wages. The low-wage social contract of the last generation has enjoyed robust bipartisan political support. Thanks to cheap imports and low-wage employers, prices have been kept lower than they might otherwise have been, while tax expenditures have lowered the burden on low-income workers of federal taxes, though not of more regressive state and local taxes. The benefits to employers of low wages and subsidies have buoyed small businesses and led to job creation, albeit low-wage job creation. And the wage subsidy that is the EITC has supplemented poverty-level wages for millions of American workers and boosted their standard of living. Even so, the low-wage social contract is highly problematic. The total level of after-tax income is still far too low for many Americans. Using the Census Bureau's supplemental poverty measure, which incorporates additional costs and after-tax benefits, the United States has about 50 million people living below the poverty line. Tax credits and welfare programs under the current version of the low-wage social contract have not come anywhere near covering the gap in incomes created by low wages. These wage supports are inadequate to compensate for low incomes. Under the low-wage contract, the economy has struggled to create enough aggregate demand. Workers are also consumers in the economy, so low wages inhibit the consumption-driven demand that powers the rest of the economy. A century ago, this problem was dealt with through the virtuous circle now often associated with industrialist Henry Ford, who agreed to pay his workers enough so that they could afford to buy the cars they were producing. To deal with the lack of aggregate demand under the low-wage system, the government has attempted to promote lower and middle-class consumption in other ways. The proliferation of tax credits and deductions is one way, but this alone has not been enough. To allow households to keep pace with consumption, public policy has also subsidized credit and encouraged borrowing. The personal savings rate averaged around only 2 to 3% during the late 1990s and early 2000s, and after a brief rise due to the global financial crash and recession, has dropped again to similar levels in 2013. Low interest rates, financial innovations, and easy access to credit have promoted consumption even as total buying power, wages and benefits minus taxes, has not increased in turn. On the eve of the crisis, household debt reached almost 100% of GDP, up from 66% just a decade earlier. Compounding the problems that have arisen from the reliance of low-income Americans on credit, deregulation has allowed for an unchecked proliferation of the financial sector, which has created more middlemen and actually made financial intermediation more costly, rather than less. The biggest shortcoming of the low-wage social contract is that it failed to compensate for, and even increase the prices of, the changing set of goods that contribute to improving citizens' quality of life. Even if low wages are able to keep prices low for clothing and food or other items that might be found at Walmart, they make other necessary goods, healthcare, daycare, elder care, post-secondary education, often unaffordable. Healthcare and education childcare combined accounted for 6% of the costs of raising a child in 1960. Now, in inflation-adjusted New America Foundation page 7 terms, it is fully 26%. The total cost of raising a child is 23% higher than it was in 1960, causing families below the official poverty line to spend 30% of their income on childcare. The low-wage social contract only allows workers to have enough wages to buy goods in low-price industries, excluding an increasing share of important household expenses. Health and education illustrate this problem. More than 20% of the population has trouble paying for medical expenses each year, and medical payments are the largest cause of bankruptcy in the United States. Thanks to the increasing cost of college and more widespread attendance, student loan debt has surpassed credit card and auto debt to become the second biggest source of consumer debt. By reducing aggregate demand, low wages in combination with high debt have hurt the economy. Preliminary data suggests that individuals who have student loan debt are consuming less, including delaying important purchases like houses and cars. The low-wage social contract has also fueled extreme inequality, as the gains from economy-wide economic growth have not been shared with most Americans through wage growth. Between 1979 and 2007, the top 5% of tax units took 81% of pre-tax income. The wealth distribution is even more unequal. The wealthiest 10% own 77% of all wealth, and the bottom 60% of households have actually lost wealth since the mid-1980s. The low-wage contract has created what analysts have termed a plutonomy, in which the wealthiest individuals are responsible for a greater portion of both income and consumption in the economy. This plutonomy has contributed to more instability in the system and starker class divides between the haves and the have-nots. Excess wealth is not returned to the system in the form of consumption of manufactured goods and quality of life services, but rather in the form of purely speculative finance, which also contributed to the imbalances that led to the financial crisis of 2007. Part of the growing inequality stems from the fact that the profits of many employers are increasing, even in the service sector. Corporate profits are at an all-time high while wages are at an all-time low. Clearly something is broken in the theory of the low-wage social contract. If profits are rising while wages are falling, the cost savings of lower wages are not being passed on to consumers. Instead, they are flowing to the top. One reason is that not all service industries are created alike. Many service industries have substantially increased their productivity through the implementation of information and communications technology, ICT. While productivity has not increased at the same rate as it has in manufacturing, the retail sector has used ICT to improve coordination with suppliers, inventory management, and sales tracking. This has led to growing profits for corporations at the same time as wages are stagnating or declining. The ratio of compensation to productivity, also known as unit labor costs, has declined consistently since the early 1990s at places like Walmart and other big department stores. If the low-wage contract is to work in practice, the gains from productivity either need to be shared with workers in the form of higher wages or passed on to consumers in the form of lower prices. Currently, Only a limited share of certain industries' cost savings from low wages and productivity increases are being spread around. One alternative to the low-wage system in its current form is what we call the neoliberal contract, or the modified low-wage contract. Building on the low-wage model, the neoliberal contract is comfortable with increasing gains flowing to capital and subsequent low wages, so long as the redistributive mechanisms for those who end up worst off in the system are stronger than we currently have. Neoliberals tend to favor means-tested programs, which target benefits at low-income recipients, rather than universal programs that give benefits to all. Means-tested programs are the most directly redistributive, as they ensure that affluent individuals do not receive benefits. Under an ideal neoliberal system, taxation and benefits would both be very narrow. Taxes would flow predominantly from the richest and benefits would only be available to the poorest. This has been a common position for many centrist liberals and Democrats in recent years. Through redistribution, this model does attempt to rectify some of the concerning trends toward increasing inequality. However, the efficacy of the system can be called into question. First, means testing is a fragile endeavor. Means-tested programs often lack political support because the benefits and burdens are completely distinct and the middle class does not share in the gains. Universal programs, on the other hand, enjoy much stronger support from broader populations. Second, the neoliberal project is much more indirect than the use of more overt labor market interventions such as a mandated minimum wage. If increased wages only come about by letting wages decrease and then using a variety of ex-post mechanisms to bring it back up, complexity in the system is increased to achieve the same goal as a more direct high-wage model. Complexity also tends to disadvantage workers and the poor, as knowledge of how to deal with complexity flows to those with money and power, which suggests the neoliberal avenues of equality will be more difficult to achieve than more direct ones. Additionally, to buoy the consumption of lower and middle-income workers and boost aggregate demand solely through redistribution will likely be a difficult endeavor. While the EITC, for example, has helped increase the incomes of low-wage workers, the largest gains accrue to low-wage employers, not workers. The EITC is a very popular program, because its effects are indirect. However, many scholars have argued that it would work most effectively in tandem with direct labor market regulations like a higher minimum wage. Using tax-favored or means-tested programs alone to redistribute income will, like the EITC, only boost wages part of the way and will add complexity to the system. Direct cash transfers from rich to poor, while less complex, tend to be opposed on the left for violating basic norms of dignity and equality and on the right for acting as a work disincentive. Moreover, the method of subsidized, means-tested support for benefits has made it more difficult to provide low-cost social benefits. Even if enough redistribution can be achieved to ensure that low and middle-income workers have enough income to keep aggregate demand high, subsidies for private sector provision of benefits have not been able to keep costs down. Rather than increase access, much of the subsidization has actually led to cost inflation as providers raise prices to collect more of the gains from subsidized programs. In healthcare, it is now clear that the US attempt to provide insurance through the private sector has led to higher prices than in any other similar country. And tuition subsidies for higher education have likely allowed colleges to increase tuition in turn and capture the subsidy rather than increase access. It is now commonplace in discussions of welfare states to preemptively hear one side issue a warning, "Don't compare us to Sweden." Nordic countries have created successful social democracies with high wages and widespread universal social programs, health insurance, higher education, pensions, unemployment, paid leave, and more. However, as many commentators are quick to note, Scandinavia has a different set of demographics and resources than the United States. In what we term the ideal social democratic contract or high-wage contract, the low-wage, low-price paradigm would be replaced by a high-wage, high-price system with universal public benefits. High wages would enable workers, as consumers, to afford high prices, which in turn would be translated into high wages for other workers. High wages would also enable high, broad taxation to be used to fund universal social programs like healthcare, insurance, education, and unemployment. Under this alternative, workers might have less spending money when high prices and high taxes are taken together, but many of the expenses of a household budget in a low-wage, low-price economy would be covered by public programs in a social democratic system, freeing remaining resources for discretionary consumption. As noted above, an increasing share of families' expenses is going toward costs like health, education, and care for dependents. Guaranteed access to consumption in these sectors is both important to increasing individual standards of living and supporting overall demand in the economy. The high-price, high-wage model of an idealized social democratic system is very appealing because it empowers labor, increases consumption, and ensures access to public benefits. But it could be difficult to transplant to the United States. While the broad taxation is hugely beneficial in creating universal, middle-class programs, its success is dependent on relative pre-tax equality. Because broad taxation is less progressive, the tax system does not act as strongly as a redistributive mechanism as narrow, more overtly redistributive government funding. The United States has extremely high levels of pre-tax and post-tax inequality, which makes a less progressive tax system less appealing and far more difficult to implement. Even in Sweden, the social democratic model is under increasing pressure. Since the financial crisis of the early 1990s, Sweden has been gradually moving away from its historical social contract to a more market-oriented system through tax cuts, decreased wage bargaining power, and more open trade. The centre-right coalition has defeated the Social Democratic Alliance in the last two elections. The Nordic system, while appealing in the abstract, is shifting toward a more middle-of-the-road system. Another possible alternative is a compromise that sorts out some of the flaws of both the current and alternative systems. A middle-income social contract or mid-wage social contract could exist to move past the low-wage model while incorporating the important universal benefits of social democracy and also working to redress the inequality in the system. Rather than embrace the low-wage option, as the United States currently does, under a middle-income social contract public policy might focus on lifting market wages at least part of the way. A higher minimum wage would be a first step. Even if these higher wages were entirely borne by consumers, the effect on prices would likely be limited. A study by the Center for Labor Research and Education at Berkeley found that increasing the minimum wage to $12 an hour would raise prices by only 1.1% at most, or $12.49 per year for the average shopper. For fast food restaurants like McDonald's, research by the Political Economy Research Institute at the University of Massachusetts estimated that increasing the minimum wage to $10.50 would mean a 2.7% increase in costs, which they say could be covered by an increase of 13 cents per Big Mac. A possible middle-income social contract might borrow from a neoliberal vision and increase the progressivity of the tax code by raising taxes on higher earners. There is plenty of room for increased progressivity in the tax code. Despite a very progressive tax system, taxes are still relatively low in the US. Both income and capital gains taxes are much lower than they were in the mid-20th century. Among high-income countries over the last 50 years, the United States has lowered its top tax rate by 47 percentage points, while the share of income accruing to high earners has increased nearly 10 percentage points, far more than any other country. This unilateral shift in favor of high earners leaves room for future policies to shift the distribution part of the way back toward equality and gain more revenue. On the benefits side, a middle-income social contract would take the form of broad, universal social programs similar to those of social democracies. Instead of means-testing benefit programs, the mid-wage model might offer widespread benefits to rich, middle class, and poor alike. In some cases, services like healthcare might be directly provided by the government, for example, via local public hospitals rather than subsidized and delivered by middlemen in the private sector. Given the difficulties that the United States has faced in providing benefits through the private sector, simpler, more universal programs would address this problem. Universal benefit programs would also counteract the difficulty of rising consumer prices in sectors outside of tradable goods in which technology, imports, or a combination of both continue to reduce prices. Low-wage workers who currently cannot afford healthcare, education, or dependent services would have access to these under a system based more on universal, tax-funded provision. And direct provision, or, where appropriate, provision by regulated private utilities, would help keep costs down at the same time. Providing widespread social benefits offers a direct subsidy for consumption of public services like healthcare and education, while employer subsidies to offset low pay offer an indirect subsidy for consumption via the production of low-cost consumer goods and fast food. Often these low-cost goods are less healthy or of worse quality. By using the same level of funds to instead provide public services, the government would more directly and efficiently be supporting longer-term quality of life investments for all. A middle-income social contract would seek to create a broader, more supportive social contract within the difficult confines of an unequal and complex country like the United States. On the taxation side, it would be progressive, combating inequality and redressing the increasing share of the gains going toward capital. On the benefits side, it would be universal, using the benefits of direct provision and universal programs to spread the gains as widely as possible and ensure widespread support for programs while minimizing costly rent-seeking by private sector providers. Any social contract that seeks to be more progressive on the revenue side will require a greater share of funding for programs of all types to come from income and capital gains taxation. Because state taxes are more regressive, the social contract will also benefit from shifting funding from the state and local level to the national level. National funding sources would additionally limit the temptation for states to use excessive tax incentives to undercut other states, a tactic that has led to a negative-sum game for workers and local governments. As states compete with one another to attract businesses, owners of capital have arbitraged the differences and left the public with a hefty bill to pay to those who are already coming out on top. It is possible to keep program administration at a more local level even as funding is nationalized to ensure that the programs remain responsive to local needs. It is time to move past the low-wage social contract, which has not lived up to its promise to be better for lower and middle-income Americans. The United States needs a successor to the failed low-wage contract of today. In creating this new contract, public policy needs to analyze the alternatives and build a social contract that is more equitable, empowers American wage earners, and creates efficient universal programs. In 1975, only 37% of families had two working parents. In 2008, that percentage had risen to 62% of families. Today, there are over between 7 and 8 million single parents in the American workforce, and only a third of workers over 25 have been with their employer for over 10 years. But our safety net has not changed to support working single parents or workers who no longer have one lifelong employer. Even before these demographic changes occurred, support for working families was insufficient. Until the 1990s, Americans had no protection from losing their jobs if they had to take time off to care for a newborn or adopted child, a sick parent, spouse, or sibling, or if they became ill themselves. The Family and Medical Leave Act, FMLA, of 1993, passed by the Clinton administration, changed that situation for millions of American workers. The FMLA allows covered employees to take up to 12 weeks of unpaid, job-protected leave per year for pregnancy complications, caring for a new biological or adopted child, caring for a seriously ill immediate family member, including spouses, children, or parents, and as medical leave for themselves. While the FMLA was a welcome addition to American labor regulations, it fell far short of addressing the needs of contemporary American families. One problem is that a number of exclusions limit the coverage of American workers. Workers must have been with their employers for 12 months and have worked at least 1,250 hours in order to be covered by the FMLA. In addition, employers with fewer than 50 employees within a 75-mile radius are not mandated to provide FMLA-protected leave. Employers with more than 50 employees can therefore avoid FMLA coverage by hiring short-term contractors and temporary workers who are not only ineligible for FMLA-protected leave, but are often unprotected by basic labor standards as well, such as overtime pay, minimum wage, and health and safety protections addressed in the Fair Labor Standards Act. As a result of these shortcomings in coverage, almost half of the American workforce lacks job protection for FMLA-covered leave. According to the most recent estimate from the Department of Labor, in 2012, only 59% of all workers are eligible for FMLA protections. Low-income workers are especially unlikely to be protected by the FMLA. According to the last comprehensive evaluation of the FMLA conducted in 2000, known as the Westat Survey, only 38.6% of workers with an annual family income of less than $20,000 were covered and eligible for FMLA leave, while 64 to 74% of families earning $20,000 or more were covered and eligible. 0.7 even among those who are covered. The number of workers who take FMLA protected leave is low. The Wage and Hour Division believes that between 3.2 and 17.1% of covered and eligible workers take FMLA leave, although the percentage of workers using leave varies by gender as well as the industry and size of the firm in which employees work. The low percentage of leave takers is not surprising in light of the significant evidence that employees are regularly discriminated against for taking time off to bear children, especially those with multiple children, or to care for frail family members. The Department of Labor's Wage and Hour Division enforces these protections, but as enforcement is based upon complaints rather than random evaluations, the odds of protection against unscrupulous employers are stacked against workers. One study found that between 18 to 21% of covered employers are not in compliance with the FMLA. Aside from issues of coverage and enforcement, the fact that FMLA leave is unpaid is its biggest weakness. This problem often makes coverage issues irrelevant for the many workers who, even if eligible, cannot afford to take unpaid leave. Among those covered employees who need FMLA leave and don't take it, 78% don't take it because they can't afford it. Those low-income workers who are covered by the FMLA are the covered group least likely to be able to afford to take unpaid time off. For example, although those earning under $30,000 per year represented 55% of the total U.S. earning population in 2000, this group represented only 27% of leave takers. According to one survey, 9% of leave takers who receive less than their full pay during long leave were actually forced onto public assistance to make ends meet. A terrible situation for workers fulfilling duties to their newborn children or seriously ill family members. Many single, low-income mothers fall into the group of those unable to afford unpaid leave. Leave taking by all women with infants rose an estimated 23% after the FMLA came into effect, and the FMLA has had large, positive effects on leave taking among married women and women with a college education. However, the FMLA has had no significant impact on leave taking among single mothers or mothers without any college education. This is not because single mothers and lower-income mothers need less time to care for their children and families. It is because they cannot afford to take unpaid leave, which may also endanger their jobs. Because the FMLA leave covers parental leave, sick leave, and caregiving leave, new parents who take FMLA leave as parental leave forfeit their ability to take leave for their own serious illness or to caregive should they need time to care for a sick parent, sibling, or spouse. Of the 154 million Americans in the civilian workforce in 2009, 26 million, about 17%, had children under age 18 in 2009, and about 37.5 million Americans over 18 years of age, about a quarter of the workforce, were estimated to be full or part-time caregivers in addition to full or part-time workers 2009. The need for caregiving, including caregiving by family members, will increase monumentally as the number of over 60 Americans grows from the current 18.4% of the population to 25.5% of the population by 2050. As the demand for caregiving increases, more and more working parents will be torn between their jobs, being a good parent to their children, and caring for their own aging parents. Although the Family and Medical Leave Act provided welcome protections for workers who need to provide care for their families or themselves, it is unpaid, poorly enforced, and leaves far too many Americans, especially lower-income workers, uncovered or unable to take advantage of the job-protected leave it provides. The U.S. is the only wealthy country in the world without a public system of statutory paid leave for workers who become parents. The Work, Family, and Equity Index states that 169 countries of 173 countries studied offer paid maternity leave, and 98 countries offer at least 14 weeks of paid leave. The US, along with Liberia, Papua New Guinea, and Swaziland are the only countries without paid maternity leave. In addition to maternity leave, 66 countries provide paid paternity leave, while the US again offers none. The graph below compares the total weeks of leave available to new families with two working parents, including both unpaid leave and the full-time equivalent, in terms of wage replacement levels, paid parental leave. On average, countries belonging to the Organization for Cooperation and Development, OECD, provide about 18 weeks of paid maternity leave, and many offer at least 2 weeks of non-transferable paid paternity leave. This paid leave is often supplemented by optional, job-protected unpaid leave for prolonged periods of at least several years. In contrast, the US offers new parents just 12 weeks of unpaid, job-protected leave through the Family and Medical Leave Act. Most of the above paid leave systems are social insurance programs funded through payroll taxes, contributions, sometimes supplemented by general tax revenues, a system that allows for portable benefits and universal coverage without placing disproportionate burdens upon individual businesses while reducing incentives to discriminate against women. For example, Austria, Belgium, Canada, Finland, France, Germany, Iceland, and the Netherlands all use social insurance programs to provide paid maternity leave. In addition to paid leave, or instead of paid leave for those excluded from the system, often the self-employed, many countries assist new parents with the costs of children through allowances or grants. Allowances are scheduled payments to parents for a specific period of time after the birth of a child. For example, new mothers in Belgium who are self-employed receive €889, $1,203 per month for 3 months after childbirth. In addition to their paid leave supports, Australia has a means-tested program for which 95% of new parents are eligible to receive a baby bonus of $5,000 $5,004.27 paid in 13 installments. Grants are one-time payments to new parents to help offset the costs of childbirth. For example, France provides a means-tested grant for which 90% of families qualify that provides a one-time payment of €840, $1,136.29 at the birth of a new child. Norway provides women not entitled to statutory parental leave a one-time grant of 33,584 Norwegian kroner, $5,729.30. Americans, in contrast, do not have paid parental leave as a foundation of support, nor do they receive a generous supportive allowance or grant. Instead, families receive up to $1,000 through the child tax credit, and varying amounts via the regressive dependent tax exemption, which was $3,650 in 2010. A person in the low 10% tax bracket gained $365 from this exemption, while a higher earner in the 25% tax bracket gained $912.50 per dependent. The lack of paid parental leave is part of the larger picture of antiquated American paid leave policies. For most countries in the world, the parental leave outlined above is in addition to general mandated paid annual leave provided. At least 160 countries worldwide have paid annual leave, and the majority of countries belonging to the OECD require at least 4 weeks, 20 days, per year. This leave may be used for vacation, care of dependents, sometimes specifically allotted to caring for the elderly, or career breaks for personal reasons, such as accidents or injuries. It is also separate from public holidays, which average about 10 to 15 days, for a total of 30 to 35 days of paid leave per year. In fact, the US is the only OECD country that does not have a federally mandated legal minimum of paid annual leave. In sum, US policymakers have not delivered policies or programs that support working American families at a level comparable to those in the rest of the world. It is also worth noting that family supports in other countries are not only provided at a higher basic level, but are delivered within a more generous environment of social welfare benefits compared to those received by Americans. While the most important benefit is probably access to healthcare, free or subsidized childcare and elder care services also account for considerable cost savings for individual families. American voters, both Democrat and Republican, overwhelmingly support paid leave benefits, including paid parental leave, paid sick days, and more generally, expanding the FMLA to provide paid family and medical leave. Perhaps in response to voter preferences, states have started to address the limitations of the FMLA protections with their own legislation. A number of states have built upon the FMLA by creating broader coverage, and a few have formed their own paid family and disability leave insurance programs. In an attempt to make the FMLA more inclusive, several states have extended FMLA coverage by lowering the minimum number of employees in FMLA-covered businesses or expanding definitions of covered family members. For example, in Maine, only companies with 14 or fewer employees are exempted from complying with FMLA protections. States have also extended the coverage of FMLA protections by expanding the definition of family members for whom workers provide care under FMLA-protected leave. Grandparents, in-laws, same-sex partners, and grandchildren are now able to receive care from their FMLA-eligible relatives in a handful of states, as shown in Table 2. A handful of states have established paid temporary disability leave insurance systems that cover pregnancy complications, thus providing some paid maternity leave, including California, 1946, Hawaii, 1969, New Jersey, 1948, New York, 1949, and Rhode Island, 1942. 3 states have built upon their existing disability insurance systems to provide paid family leave insurance to residents. California, 2002, and New Jersey, 2009, have enacted laws for paid family leave via statewide insurance programs, and Washington passed a paid family leave law in 2007, although it has not yet come into effect because it lacks a funding mechanism. The New Jersey paid family leave insurance system is modeled closely upon the California program. As it is the best-studied American example of paid family leave insurance, we examine the experience of California below. In September of 2002, California became the first state to create a paid family leave insurance program, and as such, it has been the most thoroughly evaluated in terms of usage and impacts on both individuals and businesses. Since serious illness and disability, as well as disability due to pregnancy or childbirth, are already covered by California's disability insurance program to provide up to 52 weeks of wage replacement, the Paid Family Leave (PFL) program provides up to 6 weeks of additional paid leave during any 12-month period for the following: bonding with the employee's new biological or adopted child or the new child of the employee's spouse or registered domestic partner, caring for a seriously ill child, spouse, parent, or registered domestic partner. The PFL program is administered through the pre-existing state disability insurance program and is entirely funded by worker contributions through payroll deductions. Workers became eligible for benefits in July 2004. About 13 million Californians paid the mandatory PFL contribution of 1.2% of their wages, on wages up to $93,316, with a maximum withholding of $1,119.79 in 2011. Benefits are taxable, meaning that workers on paid family leave still accrue Social Security benefits. This is important for reducing the mommy penalty women with children pay when they leave the workforce to bond with a new child. To be eligible, employees must have earned at least $300 from which SDI deductions were withheld in any quarter of the 5 to 17 months prior to their PFL claim. All employers are covered, and the self-employed can elect to opt in or not. The benefits pay up to 55% of employee earnings, and range from $50 per week to the maximum weekly benefit of $987. Workers cannot claim disability insurance and paid family leave payments at the same time. 3 years into the PFL program, nearly 90% of all claims were made to bond with a new child, and the other 10% of claims were for family caregiving. Women filed 80% of all paid family leave claims. Low-wage workers, especially female low-wage workers and low-wage workers caring for ill family members, filed claims at much lower rates than any other workers. Employees of large, 1000+ employee firms represented 14% of the California workforce, yet accounted for almost half of all claims, indicating that fewer employees in smaller firms were taking advantage of paid family leave. 6 years into the PFL program, 66 employer concerns about the costs of the program were unfounded. About 90% of employers reported that the PFL program had either positive or no noticeable effects upon business operations, including turnover, morale, profitability, and performance. Employer concerns about abuse of the program through false caregiving claims were unfounded. Most, 91%, of employers reported that they were not aware of any employee abuse of the PFL program. Smaller businesses, under 100 employees, reported even fewer negative effects than larger businesses, challenging the argument that small businesses cannot afford to participate in paid leave programs. About 60% of employers coordinated their own benefits with the PFL program, which allowed them to save money as employees used PFL instead of the employer-provided paid leave. The PFL program increased retention of employees, reducing costly turnover for employers, increased employee satisfaction with leave time, and doubled the duration of breastfeeding for new mothers. Breastfeeding can improve both baby and maternal health and bonding, have positive effects on child development, and decrease instances of postpartum depression. More than half of workers who had a recent life experience that qualified for PFL did not know the program existed. Latinos, low-wage workers, and immigrants were the least likely to be aware of the program. Employees who did not take advantage of the PFL program either, 1. Did not know about the program, 2. Were worried that their employer would react negatively or fire them, or 3. Thought that the level of wage replacement was too low. At the federal level, there have been a number of proposals for a paid family leave program. Policymakers in both the House and Senate have recommended building upon the Family and Medical Leave Act, FMLA, to broaden coverage and provide paid leave, parental or otherwise. Paid family leave proposals, like those in the Healthy Families Act of 2009 or the Balancing Act of 2009, fall into 3 types of models, each with its own advantages and disadvantages. Unfunded mandates upon businesses in which the employer is required to pay wages during qualified leave for a specified period of time, thus directly increasing the cost of labor. For example, the Healthy Families Act of 2009, H.R. 2460s.1152, proposed that employers with 15 or more employees allow their workers to accrue at least 1 hour of paid sick leave for every 30 hours worked, up to 56 hours per year. Combined with our system of insufficient enforcement, unfunded mandates upon businesses can often lead to discrimination in hiring and firing employees who get ill, not to mention those with chronic illnesses. This can be related to age discrimination, or those who may be responsible for a dependent family member. At the national level, this discrimination can lead to higher unemployment rates and exclusion from employment-related benefits among those who may most need a safety net. Costs of these mandates may also be pushed upon workers in the form of lower wages and cuts in other employer-sponsored benefits as companies strive to cut costs. Hybrid federal-state programs, in which both federal and state governments contribute to the cost of leave. For example, the 2009 Family Income to Respond to Significant Transitions Act, H.R. 2339, proposed that the Secretary of Labor award grants to states to help pay for state programs providing wage replacement to individuals who take leave for reasons identified by the FMLA. This avoids placing greater demands upon businesses, but hybrid programs have their own problems. Federal state programs are vulnerable to significant cuts during the economic downturns for the same reason that any partially or fully state-funded program faces cutbacks when tax revenues dry up. All states, except Vermont, must adhere to balanced budget requirements and cannot borrow during downturns. Any hybrid federal state paid leave program will therefore fluctuate in its ability to support the workforce. Federal social insurance programs, such as Social Security and Medicare, have been more successful and less controversial than jointly funded state-federal programs such as Medicaid. At the same time, they minimize demands upon businesses because the full costs of benefits are not borne solely by individual employers. There have been two recent proposals to establish social insurance programs to support paid leave: the Balancing Act of 2009, H.R. 3047, and the Less Extensive Family Leave Insurance Act of 2009, H.R. 1723, both of which propose the establishment of a federal family and medical insurance program. In addition to legislative proposals, the Georgetown Law Workplace Flexibility 2010 and Berkeley Law Center on Health, Economic and Family Security Programs released a detailed proposal for family security insurance, which includes a paid parental leave insurance program proposal, in December 2010. The California Paid Family Leave Insurance Program provides several lessons for the design of a simple, universal federal family leave program. Opponents of paid leave argue that it will raise the cost of labor for businesses, discouraging job creation and encouraging outsourcing. However, evaluations of the California Paid Family Leave Program show a very different picture. First, 86.9% of employers, including small businesses, found that the PFL program resulted in no cost increases, and a further 8.8% stated that the program had generated cost savings through reducing employee turnover and reducing employer-sponsored benefit payments when paid leave was taken through the PFL program. Overall, after 6 years of experience with a paid leave system funded by payroll contributions and delivered through an existing insurance system, the vast majority, over 90%, of both small and large employers found that the insurance program had either no impact or positive impacts upon their business. At the same time, the California PFL program highlights the need for a few design improvements in creating a federal paid family leave insurance program. First, replacement rates must be high enough for low-wage workers to be able to afford to take advantage of a program to which they automatically contribute. For example, California's PFL wage replacement rate is 55% of earnings. However, 55% of the minimum wage in any part of the U.S. does not constitute a living wage, making the paid leave just as unaffordable as unpaid leave and therefore inaccessible for low-wage earners. Second, evaluations of the California PFL insurance program found that employees in small and medium businesses and those working in low-wage industries were much less likely to be aware of or take paid family leave. Outreach and dissemination efforts must therefore be especially targeted at small and medium businesses and, more broadly, at low-wage industries. Third, almost 40% of workers who were aware of the PFL program but did not take PFL when they needed it did so because they were afraid of being punished or fired at work. In the U.S. labor system, where workers have little power compared to their employers, programs like paid family leave insurance must be proactively enforced by the government to protect vulnerable workers' rights to care for a new child or ill family member. Oversight and enforcement should especially target low-wage industries with vulnerable workers. Funding paid parental leave in the form of universal social insurance based on employee contributions and using the administrative capacity of the very efficient Social Security Administration minimizes costs to employers, besides the cost of temporarily replacing some employees. Even these costs may be low, though. 96.6% of businesses in the California PFL evaluation temporarily shifted the work of employees on leave to other workers instead of hiring temporary replacements. Indeed, costs associated with paid leave may be somewhat offset by the savings gained from increased employee productivity in a healthy workplace, retention of valuable skills, and avoiding the cost of hiring and retraining new employees. Social insurance programs are more stable than state-based and hybrid federal-state programs. At their best, they offer portable, individual benefits independent of specific employers, which may also help to balance power between workers and employers and improve flexibility in the labor market, as workers become less likely to hold on to poorly matched jobs simply to keep benefits. Policymakers have failed to address the needs of hard-working American families, and the lack of access to paid parental leave hurts children, frays family bonds, and can lead to poorer outcomes for our society as a whole. The average American employee has no access to paid parental leave. What is a benefit for the lucky few in the US is considered a basic right in most of the world. Although the FMLA was a step in the right direction, we must do more to enable workers to be good parents to their children without risking their jobs. The California Paid Family Leave Program shows that not only is it possible to support working families, but that it is possible to do so with virtually no negative short-term economic impacts on individual businesses. A federal paid parental leave insurance program would impose limited costs on business, while the benefits to newborns and their parents would be truly priceless. If there is one thing that libertarians, free market conservatives, and even many center-left neoliberals agree on, it is the logic of paying for highways and other forms of infrastructure out of user fees rather than general taxes. This approach, they argue, is both fairer and more efficient. Fair because it ensures those who use the infrastructure pay for its costs, including long-term maintenance and repair. Efficient because the amount spent on infrastructure will correspond to users' willingness to pay. This same logic should apply to ensuring that workers earn a family-supporting wage. Wages are to workers' output what user fees are to highways and toll bridges. The benefits from the labor of most workers in the private sector go entirely to the customers who purchase the private, excludable goods or services that the workers provide, not to the general public. Logically, then, libertarians who want to prevent infrastructure users from free-riding on taxpayers who do not use the infrastructure should also insist that the consumers of private goods and services pay prices, and employers pay wages, that incorporate all of the costs of the worker who provides the good or service. This would include occupational training, the equivalent of installation, regular wages high enough to pay for day-to-day living expenses, the equivalent of operating expenses, and enough extra to pay for purely private healthcare and to save for an adequate retirement based on purely private savings, long-term maintenance. Contemporary libertarians and neoliberals often call themselves classical liberals. But two of the original classical liberals, Adam Smith and David Ricardo, took precisely the view that I am describing. They thought that customers and employers, not the general public, should pay for all of workers' living costs. If wages were too low, Smith worried that workers would not be able to support themselves as individuals, much less support their families. The result would be social chaos. The lowest class being not only overstocked with its own workmen, but with the overflowing of all the other classes, the competition for employment would be so great in it, as to reduce the wages of labor to the most miserable and scanty subsistence of the laborer. Many would either starve, or be driven to seek a subsistence either by begging, or by the perpetration perhaps of the greatest enormities. An alternative to starvation, begging, crime, and revolt was public welfare, which had existed for centuries in Britain in the form of the Poor Laws. But Smith denounced the punitive nature of the poverty relief system of his day. There is scarce a poor man in England of 40 years of age, I will venture to say, who has not in some part of his life felt himself most cruelly oppressed by this ill-contrived law. None of these evils would exist, Smith believed, if employers paid adequate wages. Ricardo agreed. He supported reductions in spending on poverty relief on the grounds that taxes to maintain the poor on welfare would absorb money that could otherwise go into job-creating investment and wages. What distinguishes Ricardo from contemporary libertarian and conservative advocates of welfare cuts was his assumption that wages would rise, not fall, if employers and customers had to pay the full price of maintenance for a worker. In defining the full price of labor, Smith and Ricardo were both far more generous than today's free marketeers. Both took it for granted that an adequate wage was a family wage that could pay for a breadwinner and a non-working parent and children, not one that paid only for the most miserable and scanty subsistence of the laborer, in Smith's words. As Smith observed, a man must always live by his work, and his wages must be at least sufficient to maintain him. They must even on most occasions be somewhat more, otherwise it would be impossible for him to bring up a family, and the race of such workmen would not last beyond the first generation. In addition to thinking in terms of breadwinner wages sufficient to maintain entire working-class families, genuine classical liberals like Smith and Ricardo also insisted that an adequate wage was defined by standards of comfort in particular countries, not by physiological minima for survival, like 1,200 calories a day. Contemporary libertarians and free market conservatives love to point out that the poor in America are better off in absolute terms than the poor in developing countries or the affluent in earlier historic eras. In America, many poor people have phones, color TVs, and cars. What are they complaining about? Both Smith and Ricardo rejected this argument. They defined poverty in relative, not absolute terms. Here is Smith in The Wealth of Nations. By necessaries I understand, not only the commodities which are indispensably necessary for the support of life, but whatever the customs of the country renders it indecent for creditable people, even of the lowest order, to be without. A linen shirt, for example, is, strictly speaking, not a necessary of life. The Greeks and Romans lived, I suppose, very comfortably, though they had no linen. But in the present times, through the greater part of Europe, a creditable day labourer would be ashamed to appear in public without a linen shirt, the want of which would be supposed to denote that disgraceful degree of poverty which, it is presumed, nobody can well fall into without extreme bad conduct. Custom, in the same manner, has rendered leather shoes a necessary of life in England. Ricardo agreed with Smith that relative poverty and social custom, not absolute poverty, was the measure of an adequate minimal family wage. In Chapter 5 of On the Principles of Political Economy of Taxation, 1817, Ricardo wrote, "It is not to be understood that the natural price of labor, estimated even in food and necessaries, is absolutely fixed and constant. It varies at different times in the same country, and very materially differs in different countries. It essentially depends on the habits and customs of the people. An English labourer would consider his wages under their natural rate, and too scanty to support a family, if they enabled him to purchase no other food than potatoes, and to live in no better habitation than a mud cabin. Yet these moderate demands of nature often deemed sufficient in countries where man's life is cheap, and his wants easily satisfied. Many of the conveniences now enjoyed in an English cottage would have been thought luxuries in an earlier period of our history. Although they pretend to be classical liberals, today's libertarians and free market conservatives reject both the family wage, which Smith and Ricardo supported, and their definition of poverty in relative rather than absolute terms. Moreover, instead of insisting that market wages be adequate to make public welfare and social insurance systems unnecessary, libertarians and free market conservatives have no objection to the existence of a welfare state that allows employers to pay wages that are too low for a single worker, much less an entire family, to survive on without taxpayer subsidies in the form of means-tested or universal welfare programs of some kind. This makes sense if you view the thinkers, pundits, and politicians of the free market right not as authentic classical liberals, but as inconsistent and unprincipled lobbyists for employer and business interests. To my knowledge, not a single prominent libertarian in the 20th or 21st centuries has ever argued along with Ricardo that abolition of welfare would force employers to pay much higher market wages, high enough to cover a worker's family and the worker's own retirement. On the contrary, libertarians often support a safety net of some kind, including Milton Friedman's negative income tax or Charles Murray's universal basic income, but usually on the condition that the safety net be stingy and linked to work requirements that force people to work for undesirable jobs, including those that pay below poverty wages. In other words, the conventional libertarian welfare state is a welfare state designed in the interest of employers. Its purpose is to privatize the benefits of low-wage work for employers and customers, while socializing the costs and minimizing the bargaining power of workers with employers. As we have seen, classical liberals like Smith and Ricardo rejected the views of wages and poverty that are orthodox on the free market right today. But there were 19th century precedents in Britain itself for today's American libertarian orthodoxy. In his classic tale A Christmas Carol, Charles Dickens includes a scene in which the rich businessman Ebenezer Scrooge is approached by gentlemen trying to raise money for charity. The fundraisers make the same argument about relative poverty made by Adam Smith and David Ricardo. At this festive season of the year, Mr. Scrooge, it is more than usually desirable that we should make some slight provision for the poor and destitute, who suffer greatly at the present time. Many thousands are in want of common necessaries. Hundreds of thousands are in want of common comforts, sir. Scrooge irritably rejects the Smith-Ricardo argument about common comforts defined by relative poverty. "Are there no prisons?" asked Scrooge. "Plenty of prisons," said the gentleman, laying down the pen again. "And the union workhouses?" demanded Scrooge. "Are they still in operation?" "They are. Still," returned the gentleman. "I wish I could say they were not." "The treadmill and the poor law are in full vigor, then," said Scrooge. "Both very busy, sir." "I was afraid, from what you said at first, that something had occurred to stop them in their useful course," said Scrooge. "I'm very glad to hear it. I help to support the establishments I have mentioned. They cost enough, and those who are badly off must go there." Unlike Smith and Ricardo, and like the modern free market right, Scrooge had no objection to paying adequate taxes or donations to support a minimal, punitive, pro-employer welfare state, the poor law, with its treadmills and workhouses, and prisons for the poor who turn to crime. For Scrooge, as for modern libertarians and free market conservatives, the alternative favored by Smith and Ricardo, paying every worker a family wage that enables one earner to support a caregiver spouse and children at a standard of living considered decent by their national society, was unthinkable. If you think I am being unfair, I direct your attention to an op-ed by Phil Graham and Mike Solan that appeared just before Christmas, on December 23, 2020, in the Wall Street Journal, in defense of Scrooge, whose thrift blessed the world. If there is to be a welfare state and you take the logic of Smith and Ricardo seriously, it should mimic what rational workers, paid a family wage according to the custom of the country, would create on their own through their mutual private efforts in ideal conditions. Such a mutualist welfare state might look very much like today's universal social insurance systems of Social Security, Medicare, and unemployment insurance. It makes more sense for rational and provident workers to pool their personal maintenance and repair money for old age, unemployment, and sickness in solidaristic mutual insurance schemes, paid for by more or less flat contributions, than to create millions of separate, pre-funded savings accounts. If the economy is working, a pay-go system in which employed workers cross-subsidize the retired and unemployed and perhaps children and caregivers will be more reliable than a system of millions of individual accounts invested in different combinations of assets, often unwisely. Making payroll taxes the fees for participation in the Mutual Social Insurance Club has the effect of being a work requirement that deters free riders. The fact that social insurance systems are not radically redistributive is a feature, not a bug. Their purpose is to ensure that billionaires as well as low-wage workers who go bankrupt have a safety net, not to transfer wealth from the rich to the poor. In short, a contributory, universal, comprehensive, and compulsory social insurance system is the sort of thing that well-paid workers in a hypothetical Smith-Ricardo economy might set up themselves. Means-tested, non-contributory welfare poses more of a challenge than universal, contributory social insurance. In addition to the goal of providing adequate short-term relief to individuals in distress, means-tested welfare programs for working-age people can be designed to promote one of two incompatible social objectives: raising the bargaining power of workers who are between jobs in negotiating with employers, or incentivizing the idle poor to break their addiction to welfare dependency and join or rejoin the workforce. While there is no doubt that a few idle poor exist, the majority of those who use programs like food stamps and housing vouchers are regular workers who have fallen on hard times and stop using these programs when they find jobs with adequate wages. Of the remainder, many have behavioral problems like mental illness or substance abuse, and their challenges are mainly psychological and medical, not economic. Instead of trying to address these two populations with their different problems through a single set of means-tested programs, it would make more sense to pay for the generous custodial care of citizens whose behavioral problems impede long-term attachment to the workforce out of general taxation, as a kind of state-administered charity. This would enable safety net programs to be designed on the assumption that most who use them will do so only temporarily, allowing the programs designed to bolster the bargaining power of ordinary workers who happen to find themselves between jobs. For example, longer, though still time-limited, periods of unemployment insurance would allow workers, including breadwinners, to hold out longer in negotiations with employers for a higher reservation wage. As Adam Smith observed, "In all such disputes the master can hold out much longer. Many workmen could not subsist a week, few could subsist a month, and scarce any a year without employment. In the long run the workman may be as necessary to his master as his master is to him, but the necessity is not so immediate." Now comes the final objection from supply-side libertarians pretending to be classical liberals. Won't high wages bankrupt the economy by taking money away from investment? David Ricardo provides the demand-side rejoinder. Ricardo's reputation has suffered from his identification with the iron law of wages, holding that wages will inevitably be driven down to the minimum needed for workers to survive. But Ricardo stressed that such a catastrophe would only occur in a stagnant economy trapped in the stationary state, not in a country enjoying a period of progressive prosperity, enabled by technology and productive capitalism. According to Ricardo, wages may, in an improving society, be constantly above subsistence wages, because investment-driven productivity growth would permit higher profits, higher wages, and higher future investment, in a virtuous circle. The closest labor force equivalent to an infrastructure system paid for by user fees would be a system of wages high enough to pay for both the operating expenses, day-to-day consumption at a middle-class standard, and universal contributions to cover the maintenance expenses, bouts of sickness and unemployment as well as prolonged retirement, of both a worker and the worker's family. If you don't agree, don't complain to me. Take it up with the classical liberals Adam Smith and David Ricardo.